So welcome to the income tax marathon, which is part 1 video, and this part 1 is going to be for 12 hours. Please do not skip this introduction. Please watch this introduction, hardly 5 minutes. Okay, you can go to the respective timestamp and listen to the classes of your choice. Okay, now in this part 1, I'm covering basic concepts where I'm talking about rates of tax, surcharge, rebate, marginal relief, aggregation of agricultural income, and I'm also covering in this part 1 residential status, and I'm covering heads of income plus amendments under Finance Act 2023 plus even supplementary material related amendments also you are going to watch in the same video of 12 hours. So heads of income in salary, house part, PGBP, capital gain. In other sources, only amendments part I have covered. I have not covered gift provision, all that in other sources. Then immediately you will find at the last timestamp that is default tax regime and alternate minimum tax. Okay, so this is what I'm covering in the part 1. Please do not skip this introduction kindly. Now, whatever the material I have used in this particular revision class, you can download the material from our website. Go to Sept for CSCMA website. Just Google it. You will find this website. Inside that there is a point. There is a thing called PDF resources. Inside that CA Inter, you click and you just open group 1 notes and videos. Open paper 3. So you will find here income tax. So we have a concept book. This is what I have used throughout the marathon. Amendments material which I have used and supplementary material. So at amendments portion, I have used supplementary material, all that. So, and how the approach of this marathon is going to be. This marathon I have recorded in the previous November 23 exam attempt. That marathon I'm using because typically speaking, no changes at all. Between that marathon and this marathon, no changes at all. The same video I'm using only for amendments. This time, no, amendments are not like replacing any existing provision. All the amendments were like additional provisions. That's why whatever marathon for November 23 is that the same is absolutely relevant for May 24. Getting it? Only in capital gain, index number changes. Apart from that, every concept exactly remains the same. Okay, that's it. So while it, just continue watching. And moreover, part 2 I'm going to upload after part 1 is uploaded, maybe 2 to 3 days gap after part 1 is uploaded, part 2 where I'm covering these 3: clubbing, set off and carry forward, chapter 6A along with amendments, which is about some 4.5 hours. Here no, I'm also solving some problems. Getting it? Then and parallelly there is an amendments video which is already uploaded. Okay, Finance Act 2023 entire supplementary related amendments video. You can find it on the YouTube itself. You can find it on the YouTube. Just a minute. Yes. If you open YouTube, see caramharsha, my YouTube channel, go to playlist, go to my playlist, May 2024 amendments. You will find all the amendments. Each chapter wise, you will find amendments. So approximately some 5 hours. In fact, in this note, TDS, the return of income is not added. It will be added very soon in this playlist. So 5.5 hours approximate amendments were also provided. And I'm telling you, whoever watch this part 1 marathon, part 2 marathon, and those amendments, I'm telling you, you are going to do fantastic in the exam. Getting it? And I'm also going to do a video on how to use the 2-3 days gap before tax exam. So I'll be doing a video in the same playlist. You will be finding it. So make use of it, make use of this revision class and do fantastic in your exam. And kindly comment your views, whatever, once you finish a particular topic, how you felt, what you learned in the topic, whatever some extra thing that you learned. 99% I'm sure you will enjoy this marathon. If at all you comment it and like, it will be much more appreciated. Getting it? The YouTube recommends to much more people. If at all, I know you will be satisfied with the content. If at all you are satisfied really well, just put a comment below. So I'll be very happy to see your comments. That's it. Have a nice time. All the very best. Continue watching. So hi guys. So let's start the income tax revision. So first thing that we are going to discuss is basic concepts of income tax. Where in this I'm going to discuss about certain definitions and rates of tax, surcharge, marginal relief, and rebate provision. Agriculture income aggregation topic is there, like if agriculture income is there, how to compute the tax liability. So that topic I'm going to consider. In addition to that, I'm also talking in the same chapter the total incomes concepts. So for November 2023, like nothing but old scheme, for you assessment year 23-24 is what applicable. In your exam, whatever the questions they are testing, they will be testing on assessment year 23-24, nothing but previous year 22-23. Suppose if it is May 24, no. May 24, number 24, previous year 23-24, assessment year 24-25. They just year alone changes every time. So very simple. The logic is very simple. Now you are writing November 23 exams, right? Which financial year is already completed? Tell me. A minute. So which financial year is already completed? Right now we are in 23-24. Is this financial year completed? No. So 22-23 is already completed. So only on the completed previous year, completed financial year, only on that questions will be tested. So if the SSE is earning income in the previous year 22-23, that income will be assessed in 23-24 assessment year. Getting it? So based on this, the November 2023 entire question paper will be set. Got clarity? Now in the same video right now which you are watching, by the way, I'm going to upload chapter wise. Getting it? Now I'll upload this introduction plus total income put together. The next video will be residential status. That next video will be house property. That next videos will be salary. That next video will be like PGBP capital gains, like that. Then I will upload remaining chapter 6A clubbing, setup and carry forward, all that once again. Getting it? So in total income chapter for you as per study material, 115 JC JEE, nothing but alternate minimum tax. That provision is also covered. 115 BAC, optional tax system, optional tax payment or concessional tax payment. Getting it? So these two provisions are covered in total income chapter, which we should also discuss now. So effectively in this chapter, I'm going to talk about basic rates of tax, surcharge, marginal relief, rebate, AMT, concessional rates of tax, agriculture income, aggregation, all that. In addition to that, there are some incomes. Like generally in income tax, we all know that income is earned in previous year and the tax will be paid by the SSE in the assessment year. So income is earned in the previous year. The assessment for income tax will be done in the next year. That's called assessment year. But there are some cases, five exceptions, where income is earned in the year, previous year, in the same financial year, in the same previous year, department will collect a tax also. So there are some 5 cases. What are they? Like in case of non-resident shipping business, 7.5% of the turnover. Getting the point? Indian origin based turnover, 7.5% of Indian origin based turnover. So this is treated as deemed income. On that, tax will be collected by the department then and there. Getting it? Persons leaving India permanently, where they will not be returning back. Maybe they will be returning as a visitor, but not. They are going to settle at abroad. Getting it? So for them also, income will be taxed in the same previous year. So you are earning income in the same year. By the time, when are you leaving? So until the date when you are leaving, whatever income is there, on the date on which you are leaving, income tax department will collect a tax from you. Now for this, how they will collect a tax, how they will file IT return, all that were discussed at CA final level, which we don't have at CA intern. Next, persons who are likely to transfer property to avoid tax. If the department has got an information that some SSE, some person, they are trying to transfer property in order to avoid tax. So under 175, department will immediately collect the tax. Discontinued business. If at all you started some business, you are doing some business, this year you are discontinuing. Until the date of discontinuation, getting it? Whatever the date on which you stop doing the business, getting the point? Up to that date, whatever income is there, income will be computed by applying PGBP provision. Tax will also be computed on the same. That's it. So these are the 5 things. On this, a theory question might come. Getting the point? A theory question or an MCQ might come. Now the main discussion, main agenda, income tax revision. Now that's it. So we have various issues in the basic concepts itself. We have various issues, like we know SSEs are multiple types: individual, HUF, partnership firm, LLP, society, local authority, artificial judicial person, company. So no, these are all various types of SSEs under income tax law, and all of them, they earn income in 1 year. On that, the tax will be computed and paid, and IT return will be filed in the next year. That next year is called as assessment year. Fine. Now, in this, we have certain important points. By the way, this constitutional provision is also very important. This constitutional provision, 7th schedule to Article 246. This is the schedule which gave power to the department to give tax. This 7th schedule is having 3 lists. Union list, parliament. In that union list, there is an entry called entry number 82. There is an entry called entry number 82. So which levies taxes on income other than agriculture income. So by constitution itself, agriculture income cannot be levied for income tax. Getting it? Now what do you mean by agriculture income? definition of agriculture income is covered under 2 clause 1A. So which is given in exempted income chapter, which is given in exempted incomes chapter. So only an income which comes under 2 clause 1A, only if an income that is coming under 2 clause 1A, only that is treated as agricultural income. If at all you are thinking that it's an agricultural income, but that do not satisfy 2-1A definition, then it is not at all agricultural income. You see, any subject in CA course, especially CO or CMA, we should learn the subject like a thumb rule. Means we should have concrete clarity, no more questions again. Is it that, or is it this? No, you should not have such a kind of doubt. You should have a clear-cut clarity, crystal clear clarity, thumb rule kind of clarity. So with this particular revision, day before whatever you are watching, getting it, definitely gives you that thumb rule clarity. Next. Now, another important thing, what do you mean by subsection? What do you mean by clause? Very simple. We have section 10, right? 10 clause 1, 10 clause 1A, 10 clause 2, getting it, not 1A, 10 clause 2, 10 clause 2A, and you remember 10 clause 13A HRA, 10 clause 10 gratuity, 10 clause 10 AA, leave encashment, all that, yes or no? These are all actually clauses, not subsections. Many of us, we refer it as subsection 10 subsection 1, 10 subsection 2. No, they are actually clauses. How come they are clauses? Because 10 clause 1, 10 clause 2, are they dealing with any interrelated matter? No. 10 clause 1 says agriculture income is exempt. 10 clause 2 says share of profit received by a partnership firm, share of profit received by a partner from the partnership firm is exempted. 10 clause 13A, HRA received by an employee is exempted to the extent of least of the following. 10 clause 10, gratuity received is eligible for certain exemption. 10-10A, leave encashment is eligible for certain exemption. Now you see, all these items, clause 1, clause 2, clause 2A, they are not interrelated. If the information under a particular section, getting it, if the points are not interrelated, they are not called as subsections, they are called as clauses. Suppose you see section 23, annual value computation, house property related section 23, getting it, subsection 1 talks about how to compute annual value. Subsection 2 says for self-occupied property annual value is 0. Subsection 3 says unoccupied property some provision. Subsection 4 says deemed let out property. Subsection 5 says real estate people, that kind of related provision. Getting it? Now you see, in all these 5 subsections, they are talking about annual value in different circumstances. Since all of them are interlinked, you can call them as 23 subsection 1, 23 subsection 2, 23 subsection 3, 23 subsection 4. They are subsections because all the subpoints, all the sections inside 23, getting the point, they are interrelated to each other. So we can call them as subsection. Very simple. So here we have given the definitions. Remember, these can be tested as MCQ or they can be given as a short answer questions. Somewhere in May 2022 or November 22 attempt. So what do you mean by proviso and explanation? Theory question for 4 marks they have asked. A straight theory question. Explain the difference between proviso and explanation with an example. So you need to write this. Getting the point? So there is a possibility that subsection clause will also be tested. So here, so what is subsection? What is subsection? A section may have subsections or clauses or subclauses. When each part of the section is independent of each other, one is not related with other, they are independent, then they are called as clauses. If within a section, multiple parts are there, if all the parts are interrelated, getting it, then they are all treated as subsections. Only you read all the complete subsections to understand the entire section. So examples they have given. So I gave certain examples, they have given different example. Then proviso and explanation. Proviso. What is this proviso means? Suppose you see, there is a section called 48. 48 is a section talks about computation of capital gains for non-depreciable assets. Section 48 section talks about computation of capital gains for non-depreciable assets. For that section, there is a proviso 2. The proviso 2 says for long-term capital asset, indexation facility is available. Getting the point? Proviso 3 says debentures and bonds, they are not eligible for indexation. Getting it? So like that, that is for section 48. So So here they might have given some different examples. Suppose 80 GGB, 80 GGC. They have a proviso. What this proviso says is, if at all any donation is paid in cash, getting it, that is not at all eligible for deduction. Fine. So proviso means what? For a particular section or subsection or a clause or a subclause, proviso can be added either to any of these four. Generally, if you look at Income Tax Original Act, you don't find the word proviso at all. You will find the word provided that, further provided that, also provided that, provided further that, like that, these words you will find. The moment you say provided that, it's a proviso. Now within the same clause or same subsection or the section, under one particular subsection, proviso, provided that, provided further that, provided further that, like that 3 times were there. Provided that, provided further that, provided further that. So provided that means proviso 1. Provided further that means proviso 2. Provided further that means proviso 3. Anyhow, all this I've covered, this is a revision class at the end of the day, remember. So I cannot give entirely 100%, it's not possible within the shortest time that we have. Getting it? So proviso, then what will be there in the proviso? Proviso may have an additional condition, or the proviso may have exception. Getting it? Either it may talk about a condition or it may talk about an exception. So the proviso spells out exceptions or conditions to the main provision. Main provision may be section, or it may be subsection, or it may be clause. Now there is something else called explanation. What do you mean by explanation? There is a section called 43 subsection 1 in PGBP. What is it? 43 subsection 1, which talks about actual cost. So while calculating, while adding asset in the block, whenever you purchase any asset, you need to add it in the block of asset. What is the actual cost? So there are explanation 1, explanation 2, explanation 3, explanation 4a, explanation 5, 13 explanations there were. So explanation means they are giving additional clarity, additional information. So it gives a clarification relating to the provision. Explanation gives clarification relating to the provision. That's it. That's called explanation. So this itself can be tested for 4 marks question. Be careful. Don't worry. I'm entering into the straight away. I'm entering into this computation part. Okay. Now what is Finance Sec? You just read it on your own. It's very easy. What do you mean by circulars notification? Circulars will be binding only on the department. Circulars will be, department is bound. Department must follow. For SSA, it is option. For SSA, it is option. Whereas notifications are issued by CBDT, which will be binding both the SSA and department. Then we have something called charging section. It's not that important. Now straight away I will enter into rates of tax. As I already told you, in income tax there is a concept of previous year and assessment year. Getting it? Suppose assessment year 23-24. What do you mean by this? In this assessment year, income tax will be computed by calculating your total income. Total income I will calculate and compute tax. Total income of which year? Previous year. From assessment year point of view, previous year income is what? This year we will compute tax and we will compute income and pay the tax and file the IT return. Getting it? So previous year assessment year is given here. India definition is given. SSC definition is given. Not that important. Getting it? Assessment person definition is given. So for all of that important some extra detailed information is given here. Now this is important for you. Now they may ask you a straight theory question. Dayabaga school versus Mritakshara school of Hindu undivided family. So what's the difference between them? So Dayabaga school, it is applicable only in West Bengal and Assam, whereas Mritakshara is applicable for rest of India except West Bengal and Assam. Getting it? So in Mritakshara, one acquires a right in the property by birth. So a person, if born in HUF, by default, because he was born, he has a right in the property. Getting it? Whereas here, no, nobody will acquire the right in the property until the ancestors were there. So fathers and brothers would be co-parcels of the HUF. Next. So straight away I will start now the tax rates concept. Rates of tax. Yeah, this is what you're looking for, I know. So what are the rates of tax? So generally the rate of tax for company, if you call domestic company, the rate of tax is if previous year 21-22. If previous year 2021 if the company's turnover is not exceeding 400 crore, then in the current year the tax rate is 25%. That is for companies. Anyhow, at CA Inter, company taxation, AOP taxation, society taxation, that and all were not covered. At CA Inter, individual related taxation is only very important. So how to tax individuals? We all know that individuals are two types, resident and non-resident. Straight away I'll go here. So individuals, no, they are two types. So either the individual may be resident or the individual may be non-resident. Correct? Now, for resident individuals, no, we classify into three categories: normal citizen, senior citizen, super senior citizen. Normal citizen means age is less than 60 as on 31st March of the previous year. As on 31st March of the previous year. Simple. As on 31st March. Suppose 31st March 23. 31st March 2023. As on this date, he has not completed 60th birthday. He has not completed. So when the SSC is 60th birthday, when the SSC is celebrating 60th birthday means what? 60 years is completed. 60. See, when you were born, the day on which you were born, you don't celebrate birthday, right? You celebrate birthday only when you complete 1 year. So 60th birthday means what? When you complete 60 years, you celebrate 60th birthday. By 31st March of the previous year, 60th birthday already completed. Then he's a senior citizen. Not completed. He's a normal citizen. So as on 31st March, 60 years is over. So more than or equal to 60. He's a senior citizen. More than or equal to 80. More than or equal to 80. He is a super senior citizen or very senior citizen. He is either a super senior citizen or very senior citizen. Just a minute. Yeah. So normal citizen, super citizen, super senior citizen. Now we all know that in income tax there is something called basic exemption limit. Basic exemption limit means what? Up to that income, up to that total income, you need not pay any tax. The tax amount that you have to pay is zero up to a particular income. So that income is called as basic exemption. You know, the wordings are expressed in a different way. The wordings are expressed in little bit different way. The maximum income not chargeable to tax. What is the maximum income that you earn on which income tax department will not collect tax? And remember, that's not a threshold limit. That's a slab limit. Slab limit means what? Whatever the income you have, first, whatever basic exemption is there, up to that income, you need not pay any tax. For normal citizen, the basic exemption is 2,50,000. For senior citizen, the basic exemption is 3 lakhs. For super senior citizen, the basic exemption is 5 lakh. You know, for a non-resident who is an individual, the basic exemption is always 2.5 lakh. Here in non-resident, there is no category of senior, super senior, nothing. Non-resident, irrespective of age, they're all, for them always the basic exemption is 2.5 lakh. For a non-resident, the basic exemption is always 2.5 lakh. Remember. Now, what are the tax rates? So, what are the tax rates? We all know that first 2.5 lakh for a normal citizen, the tax is 0. Suppose if the income is more than 2.5 but up to 5 lakh. So, up to 5 lakh, beyond 2.5, whatever that extra income is there, no, 5% is the tax rate. Suppose if you have income more than 5 lakh, up to 5 lakh, whatever that income is there, no, tax at 5. Beyond 5, some income is there, no, but up to 10. Getting it? That amount you tax at 20%. What is the tax rate? 20%. Now, suppose if the income is crossing 10 lakhs, then up to 5 lakh, up to 2.5, 0 tax rate. From 2.5 to 5, 5%. 5 to 10, 20%. Beyond 10, whatever that extra income is there, no, that income is taxable at 30% flat rate. Suppose if the senior citizen, then initially 3 lakhs. 3 to 5, 5%. 5 to 10, 20%. Beyond 10, 30%. Super senior citizen up to 5 straight away exempt. Only after 5 lakhs onwards the tax amount will start. So straight away 20% after 5 lakhs up to 10 lakhs. Beyond 10 lakhs, the tax rate is flat 30%. Now for a non-resident, the basic exemption is always 2.5 lakh. And remember, these tax rates, no. The tax rates, these tax rates, no, we will apply on what? Total income. The tax rates is applicable on what? Total income. Now many of us are having this doubt. Sir, when I'm doing tax computation, every time it is getting wrong. So like, Is there any trick? Is there any technique so that we will never compute tax computation wrong? Yes. Whenever you're computing tax, follow this format. There is something called, first what you have to compute is called as basic tax. How to compute this basic tax, I will explain you. For that, add surcharge. For that, add surcharge if applicable. Then you get subtotal. From this subtotal, reduce rebate 87A if applicable, or marginal relief reduce. Now you may say immediately, sir, adding surcharge rebate will not come. No, that's what I told. If this is applicable, whatever is applicable, only then. Suppose, if the SSC total income is 4 lakhs only, on 4 lakhs you computed basic tax, will surcharge apply 0. So subtotal will be the basic tax. Now, since the SSC total income is 4 lakhs, it is not exceeding 5, rebate is applicable. This is a standard format I am telling you. If this amount applies, put it. If the amount is not applicable, it's a 0. Simple, not applicable. Very simple. Getting it? Then you will have fifth one, again subtotal. Now for that, add cess, health and education cess at 4%. Then you will have gross tax liability. What is it? Gross tax liability. Now from this gross tax liability minus TDS, TCS, minus any other reliefs and all, 89 relief, all that, you reduce it. Then you will have balance tax payable. What is it? Balance tax payable. If this balance tax payable is more than 10,000 rupees, section 207 advance tax will apply. If advance tax is applicable, you have to pay the tax in the previous year itself in 4 installments. At least 15% of the tax payable by 15th June, 45% of the tax payable by 15th September, 75% of the tax payable by 15th December, 100% of the tax payable by 15th March. By this way, you need to discharge the tax liability in the same previous year. If you do not, you are liable for 234C, 234B interest. 234C, they will collect interest at 1% per month up to 31st March. After 31st March, from 1st April of the assessment year, 234B will apply. 234C, 234B, there are some relaxations again. Getting it? Anyhow, we will discuss all that in advanced tax provision. Getting it? Fine. I hope you are clear. So if you follow this format, of computation of tax, I'm telling you, you will have enormous clarity. Follow the same format. Now, how to compute this basic tax? Remember, basic tax is computed on what? On total income. On total income, we will compute basic tax. Now, this total income, you have to split into two parts. This total income split into 2 parts. Now, right side, what are the incomes taxable at special rate? And what are the incomes that are taxable at normal rates? What are the incomes that are taxable at special rates? What are the incomes that are taxable at normal rates? Now, whenever you think of rates of tax, immediately you should remember one point. Remember, the rates of income tax are given 2 ways. Certain incomes, they are some rates of tax are based on the type of SSC. Suppose if it's a company, the rate of tax is 30%. 25% in some cases, 22% in some cases. That's a different story. Partnership forms LLP, rate of tax is 30%. Individual, 2.5 lakh basic exemption, 2.5 to 5, certain amount of tax, 5%, 5 to 10, 20%, beyond 10, 30%. These are all SSC specific tax rates. What are they called as? SSC specific tax rates. Now there are some incomes where the tax rate on that particular income is fixed for any type of SSC. For any type of SSC, if at all he is having such income, the tax rate on that income alone is at particular rate. Like what? Example, long-term capital gain referred under 112. Long-term capital gain referred under section 112. The tax rate is 20%. Long-term capital gain referred under 112A. The tax rate is 10% in excess of 1 lakh. In excess of 1 lakh. Suppose the SSC is having long-term capital gain 112A, some 5 lakh. 4 lakh is taxable at 10%. 1 lakh is not exempt, remember. Tax computation will be done only after that 1 lakh amount. It is only tax computation rate. They are not saying up to 1 lakh is exempt. Short-term capital gain referred under 111A, the tax rate is 15%. Casual income, winnings from horse races, all that, the tax rate is 30%. Now, these are the incomes which are called as special incomes. These incomes, suppose if a company is there, generally what is the tax rate for company? 30%. What is the tax rate for partnership firm? 30%. Suppose if the partnership firm is having income which is long-term capital gain, tax rate is 20%. If the partnership firm is having income long-term capital gain 112A, the tax rate is 10%. If the partnership firm is having short-term capital gain under 111A, the tax rate is 15%. Suppose the partnership firm is having normal short-term, not 111A, normal short-term capital gain, 30% flat rate. Partnership firm is getting business income, 30% flat rate. Partnership firm is getting some house property income, 30% flat rate. Only if these incomes are there, only on these incomes, these rates will apply. So these are called as income specific tax rates. Income specific means the tax rate is decided based upon the nature of the income. Now, remaining tax rates are called as SSE specific, like we have seen now slab limits. Up to 2 and off tax rate is 0, 2 and off to 5 tax rate is 5%, 5 to 10 tax rate is 20, beyond 10 tax rate is 30. That is in SSE specific. Whatever income you have, that income is taxable at so and so rate. These incomes alone will be taxable at so and so rate. Now, suppose sir, my income is actually some 30 lakh. My income is actually 30 lakhs, my total income. By the way, how total income is computed? Total income is computed by gross total income minus chapter 6A deductions. How gross total income is computed? Sum of heads of income plus clubbing and set off and carry forward. All that if you apply, you will get gross total income. From that gross total income, reduce chapter 6A deduction, then you get total income. Now, this total income split into two types. Getting it? So how much is long-term capital gain 112? Some 5 lakh. How much is long-term capital gain 112A? Example one I am telling you. Some 3 lakh. How much is long-term capital gain and 111A? Some 3 lakh. How much is winnings from lottery, casual income like that? Some 2 lakh. Okay. So 5 plus 3 plus 3 plus 2 is equal to 13. So what is the balancing figure? 17 lakhs. So apart from this, out of 30, these are the incomes which are taxable. These are the incomes which are taxable at special rates. Out of this 30 lakhs, these incomes are taxable at special rates. So eliminating that, what is the balance income? 17. Now this income, is it a special income? No. This is normal income of the SSE. This is not long-term capital gain. This is not long-term capital gain 112A. This is not short-term capital gain 111A. This is not 115BB income. Now what is this? This is a normal income. That's it. Normal income. Normal income means it is taxable at normal rates. Special income means it is taxable at section specific rate. It is taxable at 15%. It is taxable at 30%. Getting it? Now it is 10%, right? In excess of 1 lakh. Now normal rates. Suppose no. If this is a partnership firm, tax rate is 30%. Suppose if it is a company, tax rate is 25. Suppose if it is a company, tax rate is 30. Suppose if it is a foreign company, tax rate is 40. Straight away. Suppose if it is an individual. Okay, how to compute tax for the individual? Assuming normal citizen, resident. Getting it? Now 17 lakh minus 10 lakh you limit. On 7 lakh 30%, 2 lakh 10,000. Up to 10 lakh 1 lakh 12,500 is equal to, so basic tax is 3 lakh 22,500. Now long term capital gain 5 lakh multiplied by 20%, 1 lakh. Now 3 lakh multiplied by 10%. No. Long term capital gain 112A, the tax rate is 10% on the gain exceeding 1 lakh. Now 3 lakhs is a gain. Exceeding 1 lakh, how much is it? 2 lakhs. Only on 2 lakhs 10% will apply. 2 lakhs into 10 is equal to 20,000. So here 3 lakhs into 15% is equal to 45,000. 2 lakhs into 30%, 60,000. Now you total this. I hope you understood how I am calculating. So 3 lakh 22,500 plus 1 lakh plus 20,000 plus 45,000 plus 60,000 is equal to 5,47,500. Now let us substitute this in our basic tax. So 5,47,500 basic tax only we computed. Now add surcharge. Now surcharge is applicable for all types of assets depending upon the total income. For individual, surcharge is applicable if the total income is crossing 50 lakh. If the total income is crossing 50 lakh but not exceeding 1 crore, 10% is the surcharge. If total income is crossing 1 crore but not exceeding 2 crore, 15%. If the total income is crossing 2 crore but not exceeding 5 crore, 25%. If total income is crossing 5 crore, 37% is the surcharge. Anyhow, individuals related surcharge, there is one confusion among students. I will clarify it separately. Getting it? Once I finish this, I will clarify. Now for companies, what is the surcharge rate? 7%, 12%. So partnership firm, surcharge rate is there. Getting it? Directly 12%. The partnership firm total income is crossing 1 crore, straight away the surcharge rate is 12%. I will show you here itself directly better. So when surcharge is applicable, so I will come back to this. So for partnership firms, LLPs, local authorities, straight away, if the total income is not exceeding 1 crore, surcharge is 0. If the total income is exceeding 1 crore, surcharge is applicable at 12%. Now here in this question, the total income is what? Total income in this question, in our example, 30 lakhs only, not 1 crore. Therefore, surcharge is 0. Therefore, the surcharge is 0. Surcharge is what? 0. Now subtotal 5,47,500. Now rebate relief. In this case not applicable. So 5,47,500 plus 4%. You will have gross tax liability. Very simple. Watch repeatedly this video once again in the past 5-10 minutes. Once again, you will understand more. You will understand clearly. Getting it? Hardly 30 minutes we have covered, but we covered many points within this 30 minutes itself. Now, so this is for firms. Suppose now for corporate society, what is the surcharge rate applicable? Not required from exam point of view, because at CA Inter corporate society taxation is not that important. Getting it? So now domestic company. Suppose if the domestic company is having total income exceeding 1 crore but not exceeding 10 crore. Suppose if the company total income is 5 crore or 6 crore or 2 crore or 3 crore or 1.5 crore or up to 10 crore, the surcharge rate is 7%. So we computed basic tax, no? On that 7% you have to apply surcharge rate. Suppose if the company total income is exceeding 10 crore 5 lakh is there, straight away the surcharge rate is 12%. Now here there is a concept called marginal relief. I will come back to it later. Now look at individuals related surcharge rate. So for an individual, HUF, AOP, BOI, any artificial judicial person, what is the surcharge rate applicable? If the total income of an individual is not exceeding 50, there is no surcharge at all. In our example, total income is 30 lakhs. We have got a tax amount of 5,47,000. What is the surcharge? 0. Because the total income is not exceeding 50 lakh. Suppose if the total income is exceeding 50 lakh, but not exceeding 1 crore. If the total income is exceeding 50 lakh, but not exceeding 1 crore, surcharge is 10%. What is the rate of surcharge? 10%. If total income is exceeding 1 crore, but not exceeding 2 crore, surcharge rate is 15%. Now, here there are some important words that you need to understand. You see here, this is the table. Suppose if the total income is exceeding 50 lakh, but not exceeding 1 crore, rate of surcharge is 10%. Now, when you are calculating surcharge, especially for individual, HUF, AOP, POI, artificial judicial person, total income may have dividend income, long-term capital gain 112, long-term capital gain 112A, short-term capital gain 111A. Getting it? And just a minute. That's it. Including dividend, including all that. Yeah, fine. So getting it. Now, dividend is generally taxable at normal rates. 112, 20%. This is 10%. This is 15%. Getting it. Now, if the total income is having these incomes, and remaining income is called as balancing figure. If this total income is exceeding 2 crore, but not exceeding 5 crore, the rate of surcharge is 25%. If this total income is generally exceeding 5 crore, the rate of surcharge is 37%. But there is a provision. The provision says the tax amount, whatever the tax amount that is computed, whatever the basic tax portion is there no on these incomes, whatever basic tax portions is there no on these incomes, the surcharge rate on the surcharge rate on the basic tax portion on these four incomes cannot exceed 15%. The maximum surcharge rate that is applicable for an individual HUF, AOP, BOI, artificial judicial persons in respect of tax amount on these special incomes, on the dividend income, LTCG 112, LTCG 112A, STCG 111A. Again, here lotteries is not covered. Getting the point? Lottery income is not covered. Anyhow, that not a noteworthy observation. Getting it? So if these incomes, on these incomes, if the surcharge rate cannot exceed 15%. Like what does it mean? Here we have given some examples. Here we have given examples. You see here. Now here itself you observe. Generally, you see first category, if the total income is exceeding 50 lakh but not exceeding 1 crore, surcharge rate is 10%. 10% is same. Even on LTCG, STCG, all that, whatever tax you computed on that also 10% only. Suppose if the total income, including these incomes, if it is exceeding 1 crore but not exceeding 2 crore, surcharge rate is 15. But if the total income is exceeding 2 crore, excluding which incomes? Excluding dividend, capital gains, excluding dividend, excluding capital gains incomes. Which capital gains? 112, 112A, 111A. Normal short-term capital gain we will not exclude. If the total income excluding this is exceeding 2 crore rupee, the surcharge rate is 25. But you compute tax, right? On long-term capital gain, on short-term capital gain 111A, on dividend income tax portion is there, no? On that portion, surcharge is still 15% only. The surcharge is still 15% only. Same way, if the total income excluding these income is crossing 5 crore, surcharge rate on that particular tax portion on that total income, excluding these incomes, whatever total income is there, on that you compute tax rate, straight away the surcharge rate is 37. However, if you compute any tax on long-term capital gain, 111A and dividend income, on that particular income, the surcharge rate cannot exceed 15%. That's it. So that's which is fifth case. This is what many students is having confusion. Suppose, here they say again, where total income including all this is exceeding 2 crore but not covered in the above. What does it mean? Very simple. Suppose if, you are having some business income 1.5 crore. You are having long-term capital gain 40 lakh. You are having long-term capital gain 112A. Some 30 lakh. You are having short-term capital gain 111A, some 10 lakh. You are having dividend income. Some 30 lakh. Now, what is your total income? You see here, total income 1.5 crore plus 40 lakh plus 30 lakh plus 10 lakh plus 30 is equal to 260. Now let's apply the criteria. Is your total income including all these exceeding 50 lakh? Yes. Not exceeding 1 crore? Here it is 2.6. So category 1 will not apply. Category 2, total income including all this. Total income including all these incomes exceeding 1 crore but not exceeding 2. No, here 2.6. So category 2 also will not apply. Category 3, is your total income excluding these incomes, excluding whatever I highlighted within the red color, excluding this, is your total income exceeding 2 crore? 1.5 only. Category 3 will not apply. Is your total income excluding this, is it more than 5 crore? Category 4? No, it is 1.5 only. Now, is your total income including all this? Is your total income including all this is more than 2 crore? Yes. Then straight away surcharge rate is 15%. Straight away surcharge rate is 15%. Sir, in category 2 also we have seen 15. No. In category 2, your total income including all this but not exceeding 2 crore. Your total income is not exceeding 2 crore. Your total income is more than 1 crore but not exceeding 2 crore. Up to that 15%. But you are saying, sir, if the total income is more than 2 crore also 15% only. No. Logic is very simple. Very simple logic. If your total income is in this case, total income crossed 2 crores, yes sir, it is crossed. Because of what incomes? Normally, my business income is 1.5 only. But because of dividend, because of LTCC, because of STCC, because of these items only my total income crossed 2 crore. Otherwise, my total income is less than 2 crore. Because of these incomes, if the total income is crossing 2 crore, then entire total income is liable for surcharge of 15% only. That's what they are telling you. Suppose no, excluding them, your total income is not exceeding 2 crore. Excluding them, you reduce it. In spite of it, your total income is crossing 2 crore. Then you are liable to pay 25% or 37% as the case may be. Because of these incomes only, total income is exceeding 2 crore. Because of these incomes, total income is exceeding 2 crore. Getting the point? Straight away the surcharge rate is 15%. Generally, the moment your income crosses 2 crore, the surcharge rate is applicable is 25%. Simple. The moment your income crosses 2 crore, the surcharge rate is 25 or 37. Suppose if the income is more than 5 crore, surcharge rate is 37. If the income is more than 2 but not exceeding 5, 25. However, your total income is more than 2 crore, but your total income crosses 2 crore, right? Because of long-term capital gain, short-term capital gain, 111A and dividend income. If these three incomes you eliminate, no, your total income is less than 2 crore. If you eliminate these incomes, excluding them, your total income is less than 2 crore. In such a case, the maximum surcharge rate on your entire income is 15%. The surcharge rate applicable for you itself is 15%. I hope you are clear. In fact, I will attach to this video a surcharge video where I specifically explained with a problem on this in my regular class. So that I just uploaded on YouTube long ago. So I will attach that video. You watch that, you will have more clarity, because computation also we will make. So that's about the surcharge rate for individuals, HUF, AOP, BY. So many students have the problem with the fifth point. Total income including these incomes exceeding 2 crore but not covered under the above cases 15%. So what is it? They confuse. Now I hope you got clarity. Once again, the past 15 minutes, 10-15 minutes, whatever is there, please watch it once again. You will have more clarity. So that's regarding surcharge rate for individuals. So like first you have to compute basic tax, then odd surcharge. You get subtotal. From that, if rebate or relief anything is applicable, reduce that. Then you will have again subtotal. For that, add cess 4%. You will have gross tax level. Now, what is relief? Marginal relief. Very simple. Marginal relief. The point is very simple. Marginal relief. What is the logic behind this marginal relief? So, for individuals, I will take individual. Suppose there is an individual. He is having total income of. I will give you one example. Based on the remaining examples, you can frame. Individual is having total income of 2 crore 1 lakh. The individual is having total income of how much? Total income is 2 crore 1 lakh. Okay, if total income is 2 crore 1 lakh, 2 crore 1 lakh, now what is the basic tax on that? What is the basic tax on that? So 2 crore 1 lakh. So 1 crore, sorry, 2 crore 1 lakh, right? Minus basic tax is 58 lakh 42,500 plus. What is the surcharge applicable? Since total income is crossing 2 crore, we all know. Here, let us assume there is no long-term capital gain, nothing, dividend, nothing is there. Normal. Dividend is not there, long-term capital, nothing is there. So, straight away the surcharge rate is applicable. Since it is crossing 2 crore, the straight away surcharge rate is 25%. What is the surcharge rate applicable? 25%. So, 5842 500 into 25%. How much is that? 1 crore, 14 lakh 60,625. What is the subtotal? 5842 500 plus 25%. 73 lakh 3,125. This is the subtotal. Now this SSC is eligible for marginal relief. What do you mean by marginal relief? Now you see, suppose no, This individual is having how much income? 2 crore 1 lakh. Getting the point? Suppose if this fellow is having exactly 2 crore income. Suppose if this fellow is having exactly 2 crore income. How much is the tax? How much is the tax amount? So 2 crore means what? On 1 crore 90 lakh 30%, 1 lakh 12,500 is equal to, so basic tax will be so 5 lakh 50 if at all individual is having exactly 2 crore income, 58 lakh 12,500, and if the income is only 2 crore not exceeding 2 crore, the surcharge rate is 15% only, yes or no? Into 15%, how much it is? 8,71,875. What is the total tax here? 58 12,500 plus 875 is equal to 66,84,375. Now here the total income is exceeding how much? By 1 lakh. 2 crore 1 lakh is there. If at all it is 2 crore 1 lakh. $58,42,500. Since total income crossed 2 crore, 25% is applicable. 58,42,500 into 25%. 14,60,625. What is the tax? 58,42,500 plus 25%. 73,03,125. Now you see. Very clever. Very you see. Now you see. If at all the income of the individual is just 2 crore, his tax plus surcharge put together 66,84,000. Now here in another case, this fellow has earned 1 lakh extra income, just 1 lakh, because he is earning extra 1 lakh. Now here tell me what is the total income? Here how much is the income extra? 1 lakh. How much is the extra income? He earned 1 lakh. Now because of this 1 lakh extra income, how much extra tax he is paying? 73,03,125 minus 73,03,125 minus 66,84,375. is equal to 6,18,750. Now you see this example. If at all the SSC is having exactly 2 crore income, his tax amount would be 66,84,375 plus education cess he will add and pay. But because the SSC is earning 1 lakh rupee extra, department is asking him to pay 73,03,000 rupees tax. If at all this 1 lakh is not there, 66.8 lakh only. Because of this 1 lakh 73.3. Now SSC is arguing, sir, I'm having only 1 lakh extra income, but you're asking me to pay 6,18,000 rupees tax because of this 1 lakh. How unfair. If you want, I'll pay 1 lakh itself, sir. Sir, do one thing. Calculate tax on 2 crores, sir. Extra 1 lakh is there, you take it. Income itself I'll pay, not even tax. I'll pay income itself. Generally, what I should pay? Tax on the income I should pay. I will give you income itself. So whatever my tax is there, 66,84,375. For that I will add my 1 lakh rupee income and I'll pay to you directly. Don't ask me this amount. Consider my income is only 2 crore. This 1 lakh I am donating to income tax department. 5,18,000 rupees. See, for getting 1 lakh extra income, you are asking me 6,18,000 rupees tax. Now, this tax amount is beyond the income itself. This tax amount, the extra tax, see, if I have additional income, I have to pay additional tax, I know. But here, I am having extra income 1 lakh only, but you are asking me to pay 6,18,000, which means additionally you are asking 5,18,750 additional tax beyond my income. Please give me this relief. Please give me this 5,18,000 relief to me. I am ready to pay that extra 1 lakh itself as it is. This is called marginal relief. Just for 1 lakh income, your department is asking to pay 6 lakh rupees tax. So indirectly, SSC is claiming 5,18,000 rupees relief. Getting the point? If you want, I'll pay 1 lakh itself directly. So whatever on 2 crore tax is there, plus I will add this 1 lakh income and I'll pay it as tax. Don't think 1 lakh income I have. So this is called relief. Now for this, indirectly what are they saying? Step 1. Income tax department is asking you to compute basic tax and surcharge on total income. Surcharge at applicable rate. Surcharge at applicable rate, whatever surcharge. Suppose if the total income is more than 2 crore, surcharge applicable rate is 25%. 25%, 15% or 25% or 37%. Getting it? Step number 2, compute tax on 2 crore, or even 10% also. Compute tax on 50 lakh rupee or 1 crore rupee or 2 crore rupee or exactly 5 crore rupee. Getting the point? Plus, this is basic tax. Compute basic tax on these plus total income minus 50 lakh or 1 crore or 2 crore or 5 crore as the case may be. Getting it? Compute basic tax on 50, 1 crore, 2 crore, 5 crore. And surcharge on 1 crore, surcharge on 2 crore, surcharge on 5 crore. Nothing but in step number 1, whatever applicable surcharge rate is there at that rate. In step number 2, applicable rate below another rate is there? No. Suppose if applicable rate is 37, then below it is 25%. Suppose in the step number 1 you computed 25, then in the step number 2 you computed 15. So like that. Getting it? See, because of what reason surcharge rate increased? Getting it? What reason? Income is exceeding 2 crore, that's why surcharge rate is 25%. Then in step number 1, 25%. In step number 2, on 2 crore, what is the surcharge rate of? On 2 crore, 15% only. Suppose in step number 1, SSC total income is 5 crore 1 lakh, surcharge rate is 37%. Step number 2, if the SSC income is 5 crore, on 5 crore, compute tax amount plus surcharge at 25% plus total income minus 5 crore. So you see what is my argument? SSC is ready to pay, and SSC is ready to pay step number 2. What is step number 2? On 5 crore or on 2 crore, whatever tax is up, that much I ready to pay, plus whatever surcharge, plus beyond the 2 or beyond that 5, whatever extra income is there, that also I will pay. Don't ask me the tax amount as given in step number 1, because that is so aggressive. So this is marginal relief concept. This is what marginal, this is whatever I have given you here explanation, right? Whatever explanation I have given you here, right? So the same thing is expressed in the form of a formula. So that formula is also given here. You see? So this entirely, we have given illustrations also. Getting it? So I told, right, surcharge video I will attach. In the same video, I think marginal relief computation is also there. Anyhow, I will attach both marginal relief computation video as well as surcharge video. I will attach. If you have time, you can watch it. If at all you already understood, you are supposed to understand now by this time. You should not be looking for, sir, more detailed example, no, you should not be. Now it is not the time for learning everything. This is the time for revising everything. I'm only revising, man. In the revision itself, I'm giving you this much detailed information, which means you need to feel happy for that. Getting it? So this kind of example I took and explained means you need to be very happy for that. That's it. I hope you understood surcharge rates. I hope you understood marginal relief, why we compute. See, marginal relief is computed very simple. If at all total income exceeding so and so limit rate, surcharge is applicable at so and so rate. Marginal relief main objective is, because of applying surcharge or because of applying higher surcharge rate, is the SSC paying additional tax beyond his additional income? If so, the excess tax beyond the additional income will be treated as relief, will be given as relief to the SSC. So that is a concept behind marginal relief. So with this, I think some key points I have covered. So how to compute, especially the tax, how to compute tax. Now again, no. Generally, if at all SSC is having agricultural income, it is exempt from tax. Now, by the way, what all we have covered is, we have discussed certain introduction. We have discussed how to compute basic tax. So when you are computing basic tax, total income split into 2 parts, special items and normal items. On special items, apply special rates. On normal items, apply flat rate or slab rate, whatever is applicable. Then you compute basic tax. Now add surcharge. When surcharge is applicable, I gave you limits. So based on those limits, surcharge will be applicable. Fine. So now suppose if the SSC is having agriculture income, we all know that 10 subsection 1 says agriculture income is exempt from tax. You know what? The objective of giving exemption, the objective of not taxing agriculture income is very simple. Generally, farmers, agriculture being a very important sector, many farmers, the source of income for them is only agriculture activity. And since agriculture is by birth, nobody can collect tax on that. With that logic, Constitution has given exemption. Now, suppose if I'm a farmer, I don't have any income except agriculture income. whatever income I'm getting is fully exempt. Suppose I'm a businessman. I am having normal business income of some 2 crore. In addition to that, I'm having 1 crore agriculture income also. I'm having agriculture income also, which means I am not having exclusively agriculture income. I am having other incomes along with that agriculture income is also there. These kinds of SSEs who are having normal incomes like taxable incomes and also is having agriculture income, department don't want to give absolute exemption. So they want to collect a tax on agriculture income from these SSEs indirectly. That is called aggregation concept, aggregation of agriculture income. What does it mean? Step number one. So the SSE has to compute tax on total income plus agriculture income, including agriculture income. On that you compute basic tax plus surcharge if applicable. Step number 2. Whatever basic exemption limit is there, for that add agriculture income. On that you apply normal tax rates, whatever is applicable. Getting the point? Whatever rate is applicable. Just a minute. Yeah, sorry for the interruption. Sudden phone call. So what are they saying? First of all, how to compute aggregation? Very simple. The logic behind this aggregation concept is, if an individual, see, by the way, this aggregation concept is not applicable for company, not applicable for firm, not applicable. Very simple. It is not applicable for the SSEs whose total incomes are straight away taxable at flat rates. This aggregation concept is applicable only for the SSEs whose incomes are taxable at slab rates. Very simple. Getting it? So compute tax on total income means non-agriculture income plus agriculture income, total it, and compute tax on that. Sir, agriculture income is exempt. You are asking me to compute tax on agriculture income also. How come? No, compute it. Don't include surcharge. If at all I told you previously you include surcharge, ignore it. No need to include surcharge. Basic tax. This is nothing but basic tax. Then step number 2. What is basic exemption? For that add agriculture income. Then you will get total income again, right? On this compute basic tax. Now step 1 minus step 2, whatever step 3 is there, no, that amount is treated as final basic tax. This amount is treated as what? Final basic tax. If at all you are having agriculture income, basic tax computation shall be done with these 3 steps, using these 3 steps. Getting it? Now here, suppose if you are having agriculture income, suppose I'm having some business income, I'm having house property income, I'm having salary income, I'm having long-term capital gain 112, I'm having long-term capital gain 112A, I'm having casual income, 115BB. I'm also having agriculture income. Getting it? Now my basic my business income is some 20 lakh, my house property income is some 5 lakh, my salary income is some 5 lakh, my long-term capital gain is 5 lakh, 112A is 5 lakh, 115BB is some 10 lakh, and agriculture income is 10 lakh. Now normally when I compute total income, only these I will add. Only these I will add in my total income. So what are they? 20 plus 5 plus 5 plus 5 plus 5 plus 10 is equal to 50. So 50 lakhs is what my total income. But remember, I'm having agriculture income also 10 lakhs. I'm having agriculture income also 10 lakhs. Now how to compute basic tax? This basic tax computation itself is working note 1. So how to compute this basic tax? I told you, right? Basic tax computation. What is the total income? Step number 1. Non-agriculture income 50 plus agriculture income 10 is equal to 60. Now split into 2 parts. Now what? Long-term capital gain 112, 5 lakh. Long-term capital gain 112A, 5 lakh. Short-term capital gain 111A. Did I give short-term capital gain information in this question? No, it is not given. Lottery income is given. Sorry. Lottery income is given. So straight away, lottery. So winnings income 115BB, some 10 lakh. What is the balancing figure? What is the balancing figure? So 60 minus 20, 40. So on this, apply slab rates. Apply slab rates. So 40 lakhs slab rates means what? 30 lakhs multiplied by 30 percentage. 30 lakhs multiplied by 30 percentage. 112,500 is equal to 10 lakh 12,500. Whereas on this 20 percentage, on this 10 percentage, on 4 lakh only, on this 30 percentage. So 5 lakh into 20% is 1 lakh. 4 lakh into 10% is 40,000. 10 lakh into 30% is 3 lakh. So calculate what is the total basic tax. 10 lakh 12,500 plus 1 lakh plus 40,000 plus 3 lakh is equal to 14 lakh 52,000 52,500. 14 lakh 52,500. Now step number 2. This SSC basic exemption limit is 2,50,000 only. Whereas this SSC agriculture income is 10 lakhs. On this, what is the tax amount you compute? This is the total income now. As per step number 2, this is the total income. So 2,50,000 into 30%. So 1,12,500 is equal to 1,87,500. Final basic tax. What is the basic tax? Step 1 minus step 2. 14,52,500 minus 187,500 is equal to 12,65,000 is the final basic tax. This is the basic tax. Normally the SSC is having 50 lakhs only, right? Yes or no? Long term capital gain 5 lakh, 112A that is 5 lakh, 115BB that is how much? 10. So balancing figure is 30. Normally if I compute without ignoring agricultural income, if I compute tax, SSC total income is 50 lakhs only, ignoring agricultural income, because only this is what taxable. Yes or no? So basic tax will be 7,12,500, 1,40,000, 3 lakh. Basic tax will be 11,52,500 normally. But you see, by applying aggregation concept, the basic tax amount is 1265. Without aggregation concept, 11,52,000. Indirectly, department is collecting tax on agriculture income. Indirectly, what are they saying? If at all the SSC is having exclusively agriculture income, it is fully exempt. No need to collect pay it. If at all the SSC is having normal income plus agriculture income, then basic tax has to be computed in 3 steps. Step number 1, total income plus agricultural income, revise the total income on that compute tax, basic tax. Step number 2, basic exemption limit plus agricultural income, that is on the total income, compute again basic tax. Step number 3, step number 1 minus step number 2 is equal to step number 3. That is called as final basic tax. On that basic tax, again as usual, I told you format, right? Basic tax plus surcharge, subtotal minus rebate or relief. Again, you have subtotal plus 4% cess. Clarity. Now further, now there is another concept called, now basic tax computation we understood, surcharge we understood, subtotal minus marginal relief we understood. Now rebate. What is it? Rebate under section 87A. So what is this rebate under section 87A is all about? This is simply saying, if total income, this is applicable only for resident individual. This is applicable only for what? A resident individual. For our non-residents, rebate is not available. If resident individual, total income is not exceeding 5 lakh. If the total income of the resident individual is not exceeding 5 lakh, then basic tax is exempt up to 12,500. Up to 12,500, basic tax will be given as rebate. Nothing but discount. Whatever the tax is on that, there is a discount. How much discount? Maximum up to 12,500. Now this rebate is not applicable for 112A tax amount. Whatever tax you computed under 112A, rebate will not apply. Very simple. Now you see. Suppose I'm having salary income which is 3 lakh, and I'm having 112A. Let us assume I'm having 115BB lottery income also 1 lakh, and I'm having 112A which is again 1 lakh. My total income is 5 lakh. So what is my basic tax here? Let us compute basic tax on this. So let us look at this basic tax. So what is my total income? 5 lakh. So what are my special incomes? Long term capital gain 112. So 112, how much is my long term capital gain? So sorry, 112A 1 lakh. Sorry, 112A. No, let us assume sorry 50,000. 112A, let us assume 1,50,000. Just 3,50,000, 1,50,000. Okay. So 112A, how much? 1,50,000. Now again my 115BB lottery income is how much? 50,000. What is the balancing figure? Salary 3 lakh. On this 3 lakhs, what is the tax rate? Let us assume is a normal citizen. Up to 2.5 it is exempted. So 50,000 into 5%, 2,500 rupees. Here it is Up to 1 lakh, there is no tax rate. Only 50,000 into 10%, 5,000. Now here, 115 BB multiplied by 30%. So 50,000 into 30% is how much? 15,000. Now, what is the total tax here? What is the total tax here? So 15,000 plus 5,000 plus 2,500. How much it is? 22,500. Now, what is my basic tax? 22,500. Surcharge general not applicable, minus rebate. Rebate under section 87A. Now, when you are calculating rebate, no, split this into two parts. 1128 tax amount, how much? Balancing figure tax amount, how much? 1128 tax amount, how much we got? 5,000. 1128 tax amount, how much we got? 5,000. Now, balance tax is how much? 17,500. Only on this you will claim rebate. Minus how much rebate you can claim? Maximum 12,500. So, what is the balance tax? 5,000. So, this 5,000 plus that 5,000. So, that is the balance tax, which is 10,000 plus education says 4%. This is how we have to. Suppose, if this balancing figure is 7,500. Your total tax itself is 12,500, not 22,500. It is only 12,500 your basic tax. Out of this, 5,000 is 1128 tax. Now 7,500 is only normal basic tax other than 1128. Then rebate is 7,500 only. On the tax portion computed on 112A capital gain, rebate under 87A we will not be giving. Even rebate is eligible. Suppose if at all you are having lottery income, on that 30% tax is there. On that also you can claim rebate. If at all your total income as a whole do not exceed 5 lakh. For calculating rebate, total income shall not exceed 5 lakh. That's it. Okay, now I am calculating rebate. Again, rebate cannot be calculated. Rebate cannot be given on the tax amount of 112A capital gain. So that's what they are saying. So listen to this past 5-10 minutes discussion once again. You will have more clarity. So that's 87A rebate is all about. Are you clear? Now, these are the normal tax rates that are applicable for individual, HUF, surcharge, marginal relief, rebate. So, aggregation of agricultural income, all that I have covered within this 1 hour itself. Now, there is something called 115 JC, nothing but 115 JEE. Both the sections are dealing with same thing. 115 JEE talking about applicability of 115 JC. Indirectly, so they both are interrelated sections, and we should also talk about 115 BAC, concessional tax regime. Getting it? So continue watching this video, take some 5 to 10 minutes, 5 minutes break, then continue watching this video. So I will stop this video here and I will do another video and I will attach this video or I will post it as an extra video. Very simple. Getting it? So that's it. So 115 BAC, or else let me do one thing. Let us consider this as a basic concepts video. Now 115 BAC and 115 JC, alternate minimum tax, that concept. This concept I will do it as a separate video. Many times these concepts are being tested. Be careful. Getting it? In order to understand these sections, you need to understand 10 AA. You need to have a basic idea of 35 AD. Especially these two sections, knowledge is very important. Okay, that's it. Take care. In the next video, I will be coming up with these two provisions. By the way, I hope you are enjoying this tax revision. I'm revising you all the key points, especially. May not be entire subject, but key points I'm revising you. Yeah, take care. So let's continue with residential status. So in residential status, there are 3 sections which are very important: 5, 6, and 9. Of course, there is another section called 7, demurred to received in India. Getting it? Income received or demurred to be received. That's not a big deal. Anyhow, so what is this particular residential status is all about? See, any SSE under income tax purpose, we classify them into 2 categories mainly: resident and non-resident. Especially if it is an individual or HUF, we classify them into 3 categories: resident and ordinarily resident, resident but not ordinarily resident, non-resident. Getting it? Now, depending upon their residential status, the income will be taxed accordingly. Now, how income is taxed depending upon the residential status, that point is covered in scope of total income. So, in residential status, there is a point called scope of total income. Directly I'll open and then show you. Now, so like as I told you, broadly 3 categories: resident and ordinarily resident, not ordinarily resident, non-resident. Remember this word: resident, not ordinarily resident, resident but not ordinarily resident. This point is applicable only for individuals and HUF. This point is applicable only for individuals and HUF. For all other SSCs, company, partnership firm, local authority, society, for everybody, either they are resident or they are non-resident. That's it. If at all they are resident, we classify under this particular first part. If they are non-resident, third part. The middle part, this is only for whom? Individuals and HUF. Now, how to identify whether they are ordinarily resident or not ordinarily resident, non-resident? We'll discuss little a while later. Now, what is the impact of these residential statuses? Now, what it says, suppose if the income is accruing or arising or deemed to accrue or arise in India, nothing but if this is called source-based taxation, source-based principle. If the source of income is in India, for everybody it is taxable. Whether you are staying outside India or inside India, doesn't matter. Whether you are a resident in India or resident in US or resident outside India, doesn't matter. Are you having income? For that source is in India, accrual is in India, place of accrue is in India, that's it. Taxable for you under Indian income tax law. You have to compute total income and pay tax of that. Suppose the source is not in India. First, you apply source rule. Source is not in India. Second, apply receipt rule. Where you received it. Have you received that income in India? Received means first time income is coming under your control. Suppose no, you received amount, you are staying somewhere in London, you have a building at London, you rented that building to somebody, getting the point, and the other person paid rent in the London bank account which you have. That amount you later remitted to your parents in India. Now, where you received it? You received it in London only. First time when you get the control on the rent income in London itself. So, receipt is in London. Property situated in London. Source is in London. So, both the source and receipt, both are outside. Not taxable at all. So, suppose if the receipt is in India, taxable in all the cases. An important thumb rule for a resident. If a person is classified as a resident, in case of individual and HUF, if a person is classified as ROR, resident and ordinarily resident, global income is taxable. Whether the income source is in India, receipt is in India, source is outside, receipt is outside, doesn't matter. Global income is taxable. Suppose if the source is outside India, receipt also outside India, both, still it is taxable even if that income is not received in India. For a resident company, for a resident partnership firm, for a resident LLP, for a resident and ordinary resident individual and HUF, global income is taxable. Global income. For a non-resident, income is taxable only if source is in India, it is taxable. Source is not in India. If receipt is in India, taxable. Suppose source is outside, receipt also outside. For a non-resident, nothing is taxable. For a non-resident, if source is outside, receipt is outside, fully exempted, not at all taxable under Indian income tax law. Getting it? Suppose for a resident but not ordinarily resident. For resident but not ordinarily. See, for non-resident and R and OR, for both of them, the provision is mostly same. If source is in India, taxable. Receipt in India, taxable. If both are outside, not at all taxable. However, for R and OR only, even though if the business is outside India, even though if the profession is outside India, suppose if the business is controlled or set up from India, business is actually outside, but it is controlled from India. Or the profession is outside India, but it is set up from India. What is profession set up in India? Simple. I'm a chartered accountant. I opened a branch office outside India. Now, though I opened a branch outside India, that's a CA firm. That particular profession has got validity through a CA degree provided in India. Profession set up from India. Getting the point? Still, it is taxable. Here, actually, business is outside. Profession is outside. You are receiving also, everything is outside. But that business is controlled from India. Profession is set up from India. Therefore, it is taxable for R and OR. Technically speaking, suppose if there is a non-resident, some non-resident is there, he attended India and pursued chartered accountancy course, got chartered accountancy certificate, everything. Let us assume for the sake of getting it. And he went abroad and settled there. Getting the point? Using this qualification, he started a profession and doing that. This is actually a profession that is set up from India. Through a qualification derived from India. Through a skill derived from India. Getting the point? Still not at all taxable. But for R and OR, if the profession is set up from India, business is controlled from India, then it is taxable. See, profession, business control, profession setup is nothing but branches, nothing but it's related to branches. Getting the point? Or it may be related to franchises. It may be related to franchisee businesses. Getting the point? So for R and OR. Remember, for resident and ordinary resident, global income is taxable. No, where is accrual, where is received, that and all, we don't see. Straight away it is taxable. For non-resident, source must be in India or receipt must be in India. For R and OR, same, source must be in India or receipt. If both are outside, not at all taxable. However, if it is from a business control from India, profession setup from India, then again taxable. So this is regarding scope of total income. Next. Now you see, the moment we see residential status, so we completed scope of total income. Now let us understand what is the residential status. How to determine residential status? Like scope of total income, we have seen resident, non-resident, ROR, RNOR, NR. We have seen how to identify them. So there is a section called section 6 in the income tax law. It says for individuals, there are two subsections, 6 subsection 1, 6 subsection 1A. This is talking about residential status of individual. For HUF, 6.2. For company, 6.3. For all others, 6 subsection 4. By the way, 6 subsection 1 and 6 subsection 6, both are there. Getting it? Then 6 subsection 1A. So these are the sections which are dealing with residential status of various SSEs. Now individuals, 6 subsection 1 and 6 subsection 6. So both put together one segment, 6.1A another segment. Now in the individual residential status only many students have confusion. Very simple. I will clear all that confusion in the next 5 minutes itself. I believe me, the kind of clarity that you get after listening to this next 5-10 minutes on individual residential status will be damn amazing. Now, how to determine residential status of an individual? Very simple. They have given basic conditions. 2 basic conditions were there. What we need to check? First basic condition. Suppose we are talking about previous year 22-23, nothing but assessment year 23-24. So for previous year 22-23, whether the individual is a resident or non-resident or not ordinarily resident, we want to check out. How to check out? Very simple. In the relevant previous year, suppose if the individual stayed for 182 days or more, 182 days or more in relevant previous year. Now what do you mean by relevant previous year? Suppose we are checking for 22-23, then 22-23 we should apply. If the individual stayed for 182 days or more in the relevant previous year, then B1 is satisfied. He is a resident. Is simply a resident. I'm not saying ROR. In order to identify ordinarily resident, see, he is resident in this year. In the past also he is a resident. Then he is a resident and ordinarily resident. He is a resident in this year. In this year he is staying. In the past he has not stayed in India. Means he is a resident in this year. Ordinarily is he a resident? No. Ordinarily means about past years we should check. Current residential status, first you must be resident in current year. Then only we can think of whether are you ordinarily resident or not ordinarily resident, depending upon your past year's stay. No, first current year. Current year, are you resident or not? We are checking. Basic condition 1. In the current year, in the relevant year, if you stayed for 182 days or more, you are a resident. Suppose you did not stay for 182 days. 182 days you did not stay. Then condition B2, another option is there. Okay. You have not stayed 182 days or more in the relevant year? No. Okay, then we check B2. Have you stayed at least 60 days or more in the current year? If at all you stayed 60 days or more in the relevant previous year and 365 days or more in past 4 years preceding relevant previous year. Suppose I'm checking for 22-23. Are you, sir, I'm an individual, I just came from abroad, I'm a resident. Did I stay? Have you stayed in the 22-23 for 182 days? Need not be continuous. You can stay. You stayed 50 days, again went back. Again you came back and stayed another 50 days, again went back. You came back, again stayed 90 days. Totally 50 plus 90, 190. You are resident. You have not stayed for 182. Then we will check B2. If B1 is failed, then only we will check B2. As per that, in the current year, in the relevant year, have you stayed for 60 or more? Yes. Before 22-23, last 4 years, 21-22. 2021, 1920, 18-19. In these 4 years put together, have you stayed for totally 365 days or more put together in all the 4 years? Yes. Then B2 is satisfied. You are a resident. So in order to become a resident, either B1 should be satisfied or B2 should be satisfied. Sir, B1 or B2, something is satisfied, sir. I am a resident, sir. Global income taxable for me? No. We should check ordinarily residential status also. Ordinarily status means what? Past year stay. So additional conditions, A1 and A2. There are two more. If both the additional conditions are satisfied, if both of these additional conditions are satisfied, you are a resident and ordinarily resident. If you are an ordinarily resident, what happens? Global income is taxable. If you are not an ordinarily resident, what happens? Only sources in India taxable, receipt in India is taxable, business controlled, business outside, profession outside, but controlled from India, that is only taxable if you are R and OR. If you are a non-resident, sources in India taxable, receipt in India taxable, that's it, no more question. So whether are you ordinarily resident or not, we should check two more additional conditions. If both are satisfied, then you are an ordinarily resident. Wait, in the book that you might have studied, there might be 4 additional conditions where the condition is OR. I will come back and tell you later. First, focus on this, understand. Suppose for 2 years, in the last 10 years, ignore 20 to 23. We are checking for 20 to 23. Ignore that. Ignoring this, last 10 years, for any 2 years, at least 2 years, are you resident? At least 2 years are you resident means what? Apply B1 and B2. Out of last 10 years, in the last 10 years, B1, B2, both you apply for every year. Either B1 or B2. Something is satisfied in the last 10 years. Getting the point? For any 2 years, basic condition is satisfied. That's it. You are a resident. Getting the point? A1 is satisfied. For any 2 years in the last 10 years, if you satisfy for any 2 years in the last 10 years, if you satisfy basic condition, you are a resident and A1 is satisfied. Getting it? Now, A2, in the last 7 years, in the last 7 years, means ignore 20 to 23. We are checking for 20 to 23. Ignore that. Before that, 7 years, 730 days or more. You stayed for 730 days or more in the past 7 years put together in India. You were in India for 730 days or more in the past 7 years. Getting it? Then A2 is satisfied. Suppose B1 or B2, any one is satisfied. A1 and A2 both are satisfied. You are resident and ordinarily resident. You are what? Resident and ordinarily resident. Now these additional conditions under 6 subsection 6 were expressed in different way. What is the different way? I will discuss little while later. I hope until now you understood. Now B1 182 days criteria, B2 60 plus 365 days criteria, A1 2 out of 10 you must be resident, plus A2, here it is R, A2 730 days criteria in 7 years. Getting it? So that's it. These are the criteria. Now if B1 or B2, any one satisfied, you are a resident. A1 and A2 both are satisfied, you are a resident and ordinary resident. Suppose you satisfied either B1 or B2 only, so you are a resident. But A1 is not satisfied, A2 is also not satisfied. You are just a resident but not ordinarily resident. Suppose B1 not satisfied, B2 also not satisfied. You are a non-resident. Basic condition itself you didn't satisfy, you are a non-resident. If basic condition is satisfied, but additional condition one failed, R and OR. If additional both are satisfied, R, OR. That's the logic. Now what you have to do is just once again listen the past 10 minutes clearly. Okay. Now let's go further. Now there are 3 cases. Indian citizen leaving India for employment, means he want to go abroad and settle there, either for job or business, whatever. For some work he is leaving India. He is leaving India permanently. Indian citizen working as a crew in foreign bound ship. Foreign bound ship means that ship it travels from India to abroad and abroad to India. That's called foreign bound ship. Okay, fine. So Indian citizen who works as a crew. Now remember, in both the cases the word used is Indian citizen. Third one, Indian citizen or person of Indian origin. Third case, person of Indian origin. Indian citizen, person of Indian origin, visiting India. Visiting means what? They might have taken a visitor visa and they'll come to India. Visiting, just for visiting, not for permanent settlement. They'll visit and again leave. Getting it? In all these 3 cases, in B2, 60 days logic is there, right? Instead of 60, we apply 180 days logic. Generally, they say B2 condition do not apply. It's not do not apply. The section says in all these three cases, if an Indian citizen is leaving India, or an Indian citizen is working as a crew member in a foreign bound ship, or an Indian citizen or a person of Indian origin who settled outside visiting India, in all these three cases, in condition B2 also, we apply 182 days logic only. We apply what? 182 days logic only. That's what indirectly what they tell. B2 don't check. Directly B1 you check. In B1 also 182 days logic. In B2 also 182 in the current year plus 365 or in the last 4 years. Instead of that, check B1. If B1 is satisfied, that's it, over. B2, why you should check again? For clarity. If you stayed for 182 in the current year, that's enough. No, you are a resident. If at all 182 is not satisfied, 60 days you stayed in current year, 365 in the past 4 years, you are a resident. Now in these three cases, case 1, case 2, case 3, in these three cases, instead of 60 days, apply 182. Means B2 also 182 days criteria only. B1 is 182 days criteria. B2 also 182. So why? That's what they express is what? How they express it in the study material of ICA. B2 will not apply. Simply they say like that. Now here, now 60 days will be substituted with 182, right? Now, suppose you are an Indian citizen or person of Indian origin, visiting India. You are visiting India and having income from India, excluding foreign sources. Indian income, nothing but having Indian source income, excluding foreign source, having Indian source income exceeding 15 lakh. You are an Indian citizen, or you are a person of Indian origin. You are visiting India. Remember, you are visiting India, which means whatever is given in this third category, no, that category, the third criteria, case number 3, no, relating to them, they're talking. You are Indian citizen or person of Indian origin, you are visiting India, and you know what? You are having more than 15 lakh Indian income. Indian income means what? Excluding foreign sources. If the place of accrual of income is not in India, if the place of accrual of income is in India, or if it's a business controlled from India or profession set up from India, only that is considered. If that income is exceeding 15 lakhs, then not even 182, 120 days logic will apply. What will apply? 120. See, B2 condition originally 60 days. For case 1, case 2, case 3, what is the logic? 182 days. B2, I am talking only about condition B2. For case 3, if having Indian source income, if case 3, Indian source income exceeding 15 lakh, then not even 182, then just 120. So 60 days or more plus 365 days or more in the past 4 years. 182 days or more in the current year plus 365 days or more in the past 4 years. 120 days in the current year, 365 days or more in the past 4 years. That's the logic. So now this is what many students confuse. Very simple. Once again, let me revise it once again. So you are an individual. In the current year, you stayed for 182 days. That's it, you are a resident. B2, no need to check. Directly go for additional condition. A1, 2 out of last 10 years you are a resident. Satisfied. A2, out of 7 years in the last, out of last 7 years, you stayed 730 days or more. You are A2 also satisfied. B1 satisfied. A1 and A2 both are satisfied. You are a resident and ordinarily resident. Suppose B1 is not satisfied, then we check B2. As per B2, what is the original condition? 60 days in the current year, 365 days in the past 4 years. Yes, you are a resident. Now, this B2, in B2, instead of 60 days, we check 182 for these 3 cases. For these 3 cases only, in B2 also we apply 182. Which cases? Case number 1, Indian citizen leaving India for employment. Case number 2, Indian citizen working as a crew member in the ship. Case number 3, Indian citizen, Indian origin, both are covered. Indian citizen means if you are born in India, you are an Indian citizen. Indian origin means what? You were not born in India, you born abroad. But your parents or grandparents, no, they were born in India. Means you have Indian origin. For you, the roots is in India. That's called Indian origin. So Indian citizen or person of Indian origin, if it visiting India, for them, instead of 60 days logic, 182 days only we apply. And past 4 years, 365 or more, whatever. Now, suppose this case 3, another exception is there. Suppose if you are an Indian citizen or person of Indian origin, remember Indian origin is also covered. You are visiting India. You are visiting India and you are having Indian sources more than 15 lakh. Income from Indian sources more than 15 lakh. Then instead of 182, we apply 120 days logic. We apply 120. Indirectly, for category 3 people, those who are visiting India, getting it? If at all they stayed in India for 120 days or more and 365 or more in the last 4 years, getting it? They are residents. They are resident. Provided the Indian source income is exceeding 15 lakh. This is the rule. Now, this point many students confuse with 6 subsection 1A deemed resident provision. Fine. So, are you clear with B2? In condition B2, by default it is 60 days. This 60 days logic will not apply. 182 will apply for these 3 cases. Again, if case number 3, if at all they are having Indian source income more than 50 lakh, then 120. Generally, for case number 3, if at all you are a person visiting India normally, 182 days only we will check. Then only you are a resident. Otherwise, you are not a resident. Suppose if you are having 15 lakh or more, 15 lakh, more than 15 lakh income, Indian source income, then not 182, 120 we will check. If at all you are in India for 120 days or more, you are a resident. That's it. You clear? So through this particular point, more people who settled abroad and visiting India, getting it, having Indian source income, we are bringing into residential status in India and taxing more and more income on them. Next. Now there is a provision called deemed resident, 6 subsection 1A. 6 subsection 1A. What is deemed resident? First of all, as per 6 subsection 1 and 6 subsection 6, you are not a resident. You are not a resident. Just I told you B1, B2, A1, A2, nothing is satisfied. You are not a resident at all. But you are an Indian citizen, not Indian origin. Indian origin point is not covered in 6.1a. In 6.1a, Indian origin point is not covered. Remember, this question has been asked in May 23 exam also. Similar question, 6.1a related, 6.1 related, both put together. They developed a question and asked in May 23. And even in November 23, there is a chance that they will ask, very important, MCQ or direct problematic question. Anything might come. Suppose you are an Indian citizen, but you are not a resident as per B1 and B2. Both are not satisfied by you. You means you are not in India for 182 days. 60 days logic also, everything failed. You are not a resident. Basically, as per 6 subsection 1, you are a non-resident. You are a non-resident as per 6 subsection 1. For you, we apply this. And moreover, what? You are an Indian citizen. You are an Indian citizen, not a foreign citizen. You are an Indian citizen but settled abroad. But you did not satisfy 182 days logic, 60 days logic, both you have not satisfied. For you, we will check 6.1a. What is 6.1a? As per 6.1a, if you are an Indian citizen and you are having Indian source income, you are having Indian source income of more than 15 lakh. Exceeding 15 lakh, you are having Indian income. Source of income is in India, not outside, foreign source, not a foreign source. If your total income, excluding foreign sources, is exceeding 15 lakh, that's what the provision says. If the total income of an Indian citizen, excluding foreign sources, is exceeding 15 lakh, and you are not liable to tax, you are not liable to tax in other countries, other territories, other domicile. Getting it? In other countries, you are not liable to tax. You are completely exempted from income tax outside India. And you are having Indian income, Indian source income exceeding 15 lakh, and you are an Indian citizen. You are deemed to be a resident. You are deemed to be a resident. So through this section, the income tax department is taxing Indian citizens even though they are not visiting India. You see here in 6.1a, they don't talk about any number of days, 120 days, 182 days, 60 days, nothing. Are you Indian citizen? Yes. Are you exempted from tax outside India? Yes. Are you having Indian source income? Yes. Is it more than 15 lakhs? Yes. You are a deemed resident. You are a deemed resident. You are a deemed resident under 6.1a. You are a deemed resident under 6.1a. Now summary. So an individual, is he resident in India or not? That's the question. Basic condition 1, 180 days or more in the current year, resident. Suppose basic condition 1 failed. Basic condition 2, 60 days or more in the current year and 365 days or more in the past 4 years. Yes, resident. Check additional condition 1, additional condition 2. 2 out of past 10 years, are you resident? Yes. 730 days or more out of past 7 years you stayed in India? Yes, you are ROR. Now, you are an Indian citizen living in India. You are an Indian citizen working as a crew member in ship. You are an Indian citizen or Indian origin settled outside India but visiting India. If you fall under any of these 3 cases, B2 condition is there, no? In that 60 days criteria is there, no? Instead of 60, 182 we check. Now, case number 3, Indian citizen, Indian origin, visiting India, no. And if he is having Indian source income of 15 lakhs, exceeding 15 lakh, no, then for him in B2, 60 days 182, both will not apply. 120 we will check there. Suppose B1, B2, both are not satisfied. You are not a resident. Then check 61A. See, don't conclude a person is non-resident. If at all B1, B2, both are failed, don't conclude that he is a non-resident. Check 61A. Is he Indian citizen? Remember, under 61A, Indian origin is not covered. Only Indian citizen is covered. Under 6 subsection 1A, Indian citizen is only covered. If an Indian citizen is there, here number of days and all not required. If at all he is having total income, excluding foreign sources, nothing but Indian sources, exceeding 15 lakh and not chargeable to tax under outside India, he is a deemed resident in India. Now, a person who is a deemed resident under 6 subsection 1A and a person who satisfies condition B2 because of 120 days criteria, because of 120 days criteria, if a person satisfies B2 or 61A provision deemed resident, these people are always RNOR, resident but not ordinarily resident. Sir, I told deemed resident, na, is he ROR or RNOR? He is always RNOR. Suppose if a person satisfies condition B2, if a person satisfies condition B2, A1 and A2, all are satisfied. In B2, 120 days logic only satisfied. Getting the point? The person is 15 lakhs or more. Because of that only B2 is satisfied. Getting not 182 logic. Not 182 logic. 120 days logic. Through that he satisfied B2. Then he is a resident but not ordinarily resident. So that's why you see 6 subsection 6 residential status. The following people are always not ordinarily resident. 9 out of 10 years they are non-residents. In the last 7 years they stayed less than 730 days. They are a deemed resident. They are a resident in India because of 120 days logic, having Indian income exceeding 15 lakhs. In all these 4 cases, they are always RNOR. That's how they drafted. And in fact, we have given the same format in the book, in our book also. In our book also, we have given in the same format. Additional conditions for individuals for deciding ordinarily residential status. I hope you are confident now. If not, once again listen, you will get crystal clear clarity. When 60 days we apply, when 182 we apply, when 60 days we apply, 120 we apply in B2. In B1 it is always 182. In B2, 60 days normally. 182 for 3 cases. 120 for 3rd case, having Indian income more than 15 lakhs. Simple, over. Suppose B1, B2 both are not satisfied. 61A, having Indian source income exceeding 15 lakh. Are you Indian citizen? Not taxable anywhere outside India? That's it. You are a deemed resident. Over. Now, so with this, individual related residential status is completed. Individual related residential status is completed. Now, so with this, individual residential status is completed. Now, HUF. Now, is HUF resident or non-resident or resident and ordinarily resident or not ordinarily resident? How to decide? For HUF, there is only one basic condition. If control and management are partly in India, if control and management is partly in India, that's it, HUF is a resident. If control and management 100% outside India, if control and management are 100% outside, for the HUF, entire control and management, entire decisions are taken outside India. 100%, not even one decision, 100% outside India, HUF is operated, non-resident. Sir, suppose some decisions are taken in India. Control and management is partly in India. It's a resident. Now, is it ordinarily resident or not ordinarily resident? We should check A1 and A2 for Karta. Karta has to satisfy A1 and A2 both. If Karta satisfied both A1 and A2, then HUF will be a resident and ordinarily resident. If Karta satisfies both A1 and A2, HUF will be resident and ordinarily resident. So, A1 and A2 we check for Karta. If Karta satisfies both A1 and A2, HUF can be ordinary resident. And remember, just because Karta satisfied A1 and A2, Karta is also an individual, right? He may not be ROR. Karta, B1, B2 both are not satisfied. Karta is a non-resident, but A1, A2 is satisfied. HUF satisfied basic condition. So HUF will be ROR. Clear? Next step. So with this, HUF is over. Now, others, not companies. Companies I'll cover little while later. Others means firms, LLP, society, nothing but other than individual, other than HUF, other than company, any other SSE. How to determine residential status for them? For all others, how to determine residential status? Just a minute. If control and management partly in India, it's a resident. 100% control and management outside India, it's a non-resident. Simple, over. This is applicable for LLP, partnership firm, AOP, local authority, artificial judicial person, for all of them. This is the residential status. 6 subsection 4. Fine. Now 6 subsection 3. How to decide residential status for companies? How to decide residential status for companies? Now, companies are broadly 2 types: Indian companies and other companies. Indian company, always a resident. Always a resident. What is it? What is an Indian company? A company which has registered, incorporated under Companies Act 2013, Companies Act 1956, or erstwhile, whatever previous act. They are all Indian companies. They are always resident. Other companies, if POEM is in India, if POEM, place of effective management in India, they are resident. If place of effective management outside India, they are non-resident. Simple, that's it. So for Indian company, it's always resident. For remaining companies, where is place of effective management? In substance, where the decisions are taken majorly. If it is in India, then it's a resident. That foreign company will become a resident in India. If effective management is outside India, in substance, majority decisions are taken outside India, then it's a non-resident. As simple as such. So if POEM is in India, it's a resident. POEM is outside India, it's a non-resident. Over. That's it. Residential status is almost completed. Now we still have to discuss. Now whatever the points I have told, no, everything is covered here. Everything is covered here. So for a crew member, no, how to decide residential status? For a crew member, no, 180 days logic only we apply. Only if the crew member of Indian ship he stayed in India, getting it for 180 days, then only he is a resident. A person leaving India, he stayed in India for 180, then only he is a resident. A person who is visiting India, 180 days he must stay, then only he is in India. But suppose if the person visiting India having Indian income more than 15 lakh, then for him 12 days, 120 days logic also we apply. Then he may become resident as per that also. Right. Now for a crew member, no, CDC period we will exclude. CDC period, continuous discharge certificate, that period, no, we will treat it as outside India stay. So total 365 minus CDC period is equal to what is the balance number? If it is 182 or more, then is a resident. Otherwise is a non-resident. Remember, the crew member must be Indian citizen. Then 61A, that is also given here completely. HUF, I already told. For AOP, firm, BOA, company, and any other persons, artificial judicial person, all that, everything is covered. Scope of total income I have covered. So income accruer, deemed to accrue or erase in India. In this, many students have doubts on the interest, royalty, and technical services. Many students have doubt on the interest, royalty. Suppose if any dividend is paid by Indian company, you are a foreigner, dividend is paid by Indian company. It's a source of income is in India. So it's a income deemed to accrue or erase in India. If it is salary paid by government, though you are working outside, but salary is paid by Indian government, it's a source of income is in India. Accrual is in India. Now interest income. Suppose an interest income, no, you are earning interest. You are actually a non-resident. You are a non-resident. You are staying somewhere abroad. Now you gave some loan to Indian government. The Indian government is paying interest. Now, where is the source of income? Accrual of income. Accrual of income is from the Indian government. So source of income is in India. So that interest is deemed to accrue or arise in India. Accordingly, source is in India. It is taxable. Whether you are a non-resident or resident doesn't matter. Suppose you are a non-resident. I am a non-resident. I am getting interest income. From whom? From a person resident in India. Okay, a person who is residing in India, no, he is paying me interest. Getting it? So I gave a loan, he is paying me interest. Now, will that be treated as Indian income? Source of income is in India? Straight away, no. Let us look at what are they saying. Suppose, no, I am a non-resident. I am not staying in India. But I gave a loan to my friend who is in India. He is paying me interest. You know what? Whatever loan I gave to him, he is investing outside India completely. He did not even take in his India. He completely invested that outside India for business, profession, whatever. He is not using it in India. He is using it everywhere outside India. Suppose I am staying in Canada. My friend is there in India. I gave a loan to him. He is paying me interest. He is staying in India. He is a resident in India, first of all. As per section 6, he is a resident. This fellow paying me interest income. Technically, what we assume, since resident person is paying interest to me, source is in India, like that we assume, but not. This fellow, whatever loan I gave him, he invested that in London. So in London, he purchased some property or some business, he invested there completely. So from that business, he is getting profit, out of that he is paying me interest, which means I am getting interest income from the business where he invested in London. Source is not in India. So where the interest is payable in respect of debt, which is used for the purpose of business, which is outside India, or for any other source outside India, it is not deemed to accrue or arise in India. It is not treated as Indian income. Getting it? I know, resident person only paying. He is a resident in India, he is only paying interest on loan. But that is not. That interest income which is received by lender, that is not treated as source of income in India. If that entire loan is invested outside India, that entire loan is used for business or some other purpose outside India. That's the point. Next, suppose, sir, I'm a non-resident, I'm staying in Canada, sir, and I have another person who is also in Canada, my friend. I gave a loan to him, and what you know? That loan, this fellow invested in India. This fellow invested that entire loan in India for doing business or profession or for some other activity. Getting it? Sorry, for doing business or profession, only business or profession. So I gave a loan to my friend who is in Canada. I'm staying in Canada. I'm a non-resident. He is also non-resident from Indian point of view. Getting it? This fellow, I gave a loan, right? This fellow took that loan and invested in India, PGBP, business or profession. Now, whatever interest I'm getting from my friend, no, deemed to accrue or arise in India. Suppose if a person who is a non-resident, this fellow is paying, interest, getting it, where the loan is used for the purpose of business carried on by him, business or profession carried on by him. Getting the point? So, if a non-resident is paying interest to another non-resident, the interest received by a non-resident is deemed to accrue or arise in India if it is used for business or profession in India. Exception. Suppose if the interest borrowed by non-resident for any purpose in India other than business or profession, that is not deemed to accrue or arise in India. Very simple. So I gave a loan. I'm a Canadian citizen. So I'm a non-resident. Mr. Ram is a non-resident. He's staying in Canada. Getting it? He gave a loan. To, so, Hanuman, example. Getting it? This fellow is also staying in Canada. Both are non-resident. But Hanuman, no, whatever the loan he took, no, he invested in India. He invested in business or profession in India. Now, whatever interest he is paying me, whatever interest Ram is receiving, no, that is deemed to accrue or arise in India. Suppose, no, Hanuman invested this entire loan in some other business, not in India, but outside India. That is not accrue or arise in India. Suppose Hanuman invested this particular amount in shares of a company for getting dividend income. Now, shares of a company dividend income means for Hanuman, is it a business income? No. If a non-resident gave a loan to another non-resident, that non-resident who received the loan invested in business or a profession in India, then only interest on that loan is deemed to accrue or arise in India. Suppose if a non-resident invested that loan in not a business, some other head of income only he is getting, that is not deemed to accrue or arise in India. Next, same way, royalty also. Similarly, royalty. Suppose if the royalty is received from government of India, always source of income is in India. If a royalty is received from a resident person in India, source is in India. However, exception. Suppose I am receiving royalty from a resident Indian, but that Indian paying me royalty in respect of services used for a business or profession outside India. Whatever service I provided, no, for which he is giving royalty, that service is used outside India, business or profession or some other source. Then that income is not deemed to accrue or arise in India. Where it is payable in respect of transfer of any right or use of any property for utilization of any service, for business or profession outside India or for purpose of earning any income outside India. Simple, I am getting royalty for some service I rendered. This service is used where? Outside India. Whatever income I am getting, royalty, fully, this is not treated as accrue or arise in India. This is not treated as deemed to accrue or arise in India. Suppose I am receiving royalty from non-resident. I am a non-resident and another non-resident is paying me royalty. So both of us are non-residents, example. So a non-resident is paying me royalty. This is not deemed to accrue or arise in India. However, the royalty which I am receiving, no, from a non-resident, I am rendering that service. No. Whatever service I am rendering, no, that is used for business in India or that is used for some other profession or some other activity in India. Means whoever is the person who is paying me royalty, He's paying you royalty by using my services for some source of income in India. It may be business or non-business, doesn't matter. For some source of income in India, getting it, whatever service I render, he is using that and paying royalty. Means Indian origin is there, no. Indian connection is there, no, for my income. It is deemed to accrue or arise in India. Technical service also exactly same. If I'm getting any fees for providing technical services from Government of India, source is in India, taxable. If I'm getting from a person resident in India for using for business in India or any source in India, it's a deemed to accrue or arise. Suppose if I'm getting fees for technical services from a resident in India for services which I provided, which are used completely outside India, then it is not deemed to accrue or arise in India. Suppose I'm getting fees from a non-resident for technical services. These services are used in India business or profession or in India for some other income, then again it is deemed to accrue or arise in India. In all these three cases, royalty, technical services, interest, in all the cases, common point is very simple. Are you getting it from government? It is always deemed to accrue or arise in India. Are you getting it from somebody else? Yes. If you are getting from somebody else, maybe resident in India or non-resident, doesn't matter. If it is used for business or profession in India, if it is used for some other activity in India, that's it. It's accrued in India. Only for interest income, if the business is in India, then only interest income received from non-resident is taxable. If it is for some other purpose, I gave a loan and it is invested for non-business activity in India. Getting the point? Whatever interest on that, that is not deemed to accrue or arise in India. That's a loophole in drafting. Very simple. That's a loophole in drafting. That too for non-resident only, all this logic will apply. So here we have given an example also. Getting it? That's it. If at all you have not at all studied this section and right now you did not understand fully, properly, ignore it. No, don't even read this. Only you already analyzed this section. Somewhere you're having little doubt, then listen to this. Past 15-20 minutes, whatever I have covered, this section 9 related, listen to it once again. That's it. With this, residential status is completed. Entire crux, confusion part in residential status completed. That's it. Take care. So the next chapter of what I'll upload is house property. That next salary. That next PGBP. That next capital gain. That next I'll upload clubbing, setup and carry forward chapter 6A. Getting it? So that next, depending upon my energy and my time, all the tedious topic I'll upload. That's it. So let's start income from salaries revision. So the moment you think of salary, it is a first head of income where the charging section is section 15. And in salaries, we only have three sections. One is 15, another one is 17 and 16. Nothing but 15, 16, 17. 16 talks about deductions from salary. 15 talks about charging section. Whereas 17 talks about, getting it, what do you mean by salary? What are other things that are taxable under the head salaries? So 17 subsection 2 says perquisites is also treated as salary because perquisite is a benefit received from employer by an employee. Profit in lieu of salary. Instead of salary, you're receiving something else, lumps of money. That is also taxable under the head salary because it is received from past employer or current employer. So that is what, salaries is essentially talking about. Now, charging section. What the charging section says. First of all, before I even discuss about charging section, what is the overview of salary? You see, under income tax, under the head salary, if an employee is receiving any benefit from employee, getting it? These benefits are taxable under the head salary. Now the benefits are broadly divided into two categories. Benefits received when the employee is working. So I am working in a company. So every month in this year, whatever the financial year I am working, I am getting some benefits. So benefits during the service. And I may receive certain benefits at the time of retirement. Generally at the time of retirement, we generally receive monetary benefits. Whereas when we are in service, we receive two categories of benefits, that is monetary benefit, non-monetary benefit. And what are all the monetary benefits that you receive? What are all the non-monetary benefits that we receive is what given here as a list. I am giving you this list which is important from exam point of view. More than this, let us assume if in salary we are discussing some 50 issues, 50 types of benefits. Out of 50 I have covered almost 40 items here. 10 items are not at all relevant, that there is no use at all. Getting the point? So all the benefits that are important from exam point of view, I'm covering. Getting it? Now, so what various benefits that we get, we have listed out. Now these benefits in the Bare Act, in the section 17, the benefits whatever I have showed right now, getting an overview, they are classified into three categories. Some benefits, no, they are called as salary. Some benefits which SSE receives, which employee receives, either monetary or non-monetary, they are called as perquisite. Some benefits are taxed under profit in lieu of salary. Now, many students get confused. What do you mean by salary versus perquisite? How they both are different? Salary means something I pay to employee and I don't ask him any question. What purpose is spending doesn't matter to me. All the allowances, getting it? Basic salary, dearness allowance, whether this DA is for retirement benefit or not retirement benefit. You know, in exam they may give you for retirement or forming part of terms of employment, any word they can give. Nothing but this dearness allowance is something which is considered for retirement computation benefits of that employee. Remember, DA you will find only in government companies and government organizations, not in private sector. Dearness allowance is not compulsory in private. You don't find in any private sector DA. And bonus, commission. Commission is again two types, percentage of turnover and fixed commission. Getting it? There are two types of commission. Either it is given as a percentage of turnover or fixed commission. Getting it? So bonus, commission, DA, basic, entertainment allowance, HRA, house rent allowance, leave encashment, gratuity. Getting it? So all these items, contribution by employer to provident fund in excess of 12% of salary, contribution by employer towards interest in excess of 9.5% rate of interest, contribution by employer to pension scheme. All these are monetary benefits which are directly given for the purpose of employee, directly monetary benefits. These are all treated as salary within the meaning of 17 subsection 1. Now, what are all perquisites? Perquisites means salary is something which I give and I don't ask any question. Or on the employee name, I will give some benefit to the employee monetarily. That and all salary. Now, the perquisites, again, this may be two types. Either the perquisite is reimbursement or the perquisite can be non-monetary facility. The perquisite can be either a non-monetary benefit facility or it can be a reimbursement. Remember, only reimbursement and non-monetary benefit given to an employee comes under perquisite. Getting the point? Suppose employee is incurring some medical expenditure. We are reimbursing that. Company is reimbursing. It's a perquisite, taxable in the hands of employee. Of course, we have some exemptions. We'll discuss later. Getting it? And suppose we have given a car facility. It's a perquisite. Whatever the valuation rule, perquisite valuation rule, we compute some value. We will tax it accordingly. We are giving some furniture to the employee for usage. It's a benefit given to the employee. It's a perquisite, non-monetary. So perquisites are basically reimbursement and non-monetary benefit. Reimbursement means what? First of all, perquisite means something which is given for personal benefit of the employee. Perquisites are nowhere related to official purpose. They are absolutely, completely for personal benefit. Only employee will get benefit there. No benefit to organization. So those are called as perquisites. These personal benefits are either reimbursement. Reimbursement means what? Employee incurred some expenditure for personal reason. That amount, he showed me bill, we are reimbursing it. Suppose employee went and bought some, spectacles, or lens, or he went for laser treatment of eyes, whatever, something. Company reimbursed the expenditure he spent, showed the bill, we gave the money. It's a reimbursement, it's a perquisite. Or facility like car, getting it? Education facility, medical facility, various transport facility, getting it? So these are all facilities. Both are treated as perquisites because these are used for personal benefit of the employee. Perquisites are taxable. We have some exemption rules. Now, sir, reimbursement means suppose company reimbursed 1 lakh. If say employee spent 1 lakh for personal, company reimbursed 1 lakh. Accordingly, 1 lakh is taxable, sir. How to tax non-monetary items? Suppose company gave car, sir, car facility. Okay, how to tax this item? Valuation rules were given for perquisites. Those valuation rules we have to apply. Getting it? Fine. So salary means all monetary items which we give to the employee. We don't ask any question there. Okay. Basic salary I am paying. DA I am paying. Some allowances I am paying. Bonus giving. Commission. Whatever. Getting it? All these items are salaries. These are all allowances. All items which are in the nature of allowance. Allowance means what? I pay money at first. I don't ask what he did with that money. So those kinds of money, whatever I give, that's called salary. Suppose an employee joined in an organization, you are paying 50,000 salary to him monthly. Do you ask him what is the breakup of 50,000 for what he is spending? No, that's a salary. All the items that are salary or in elements in the nature of salary, that and all taxable under 17 subsection 1. They are all treated as salary. All the items which are personal purpose, where you are reimbursing or where you are giving a facility, whatever the value you are giving, that is taxable as perquisite. Perquisite is also treated as salary. Able to understand? Now, charging section. What the charging section says, any sum due from an employer by an employee, any sum due from the employer during the previous year is taxable for salary. Second, any sum received from employer is taxable for salary. Nothing but if you collectively read, if any amount is due from the employer or received from the employer, whichever is happened earlier, so it is taxable. That's why they call it as due basis or accrual, receipt basis, whichever is earlier. Due is different, accrual is different. Suppose if April month salary, current month salary is due on 1st May, then 1st May, April month salary is taxable when 1st May it is taxable. May month salary is taxable in which month? June 1st. March month salary is taxable in April 1st. March 2023 salary is taxable in April 1, 2023. April 1, 2023 comes under 23-24 previous year. You understand? Accrual means what? April month salary taxable in April only. When you pay, doesn't matter. March month salary taxable in March only. When you are paying, doesn't matter. That's the difference between due and accrual. Salary is head of income. Salary is taxable on what basis? Due basis it is taxable. Able to understand? So, what are all the due dates are there in the previous year? Salary due dates, check out. On these due dates, how much amount of salary became due? Check out. That much only taxable. Sir, the amount of salary was due, no. That is belonging to last previous year. Doesn't matter. It became due in this current year, no. It is taxable in current year. Same way, if at all an employee received salary in advance, next month salary I received, in March month only I received next year April and May month salary in advance, and I told employee not to pay me April and May again. Amount received in advance is taxable in the year in which it is received. Suppose if I receive a loan from employer, which is where employer will deduct from my salary in 20 months, that's a loan. Loan is not a salary. It is not taxed as income. However, on the loan, interest amount I am not paying to the company. I took a loan from the company, but I am not paying any interest to the company. It's a benefit received by me. It is treated as perquisite. For that, valuation rule is that we will discuss. I hope now you understood the charging section briefly. Getting it? Now, what are all the elements that are there in salary? There are various elements. You have something called salary, which is including basic, DA, whether for retirement or not for retirement. Retirement is also expressed as terms of employment. In exam, they may give you DA for retirement benefit, or within bracket, they may give you terms of employment. Bonus, commission, whether it is percentage of turnover or fixed commission, everything is monetary benefit. Transport elements, children education elements, children hostel elements, HRA, telephone elements, medical reimbursement. Remember, reimbursement is a perquisite. Lunch allowance is a salary. Gift allowance is a salary. Interest free loan is a perquisite. Contribution to RPF is a salary. Interest on RPF, that is a salary. Leave travel concession is a salary. Yes or no? Tax paid by employer, on the salary of employee, that is exempted. Life insurance policy on the employee is exempted. Medical policy on the employee is exempted. All these points now we are going to cover. Are you clear? Now at the time of retirement, a person might get gratuity, pension. Pension, there are two types: uncommuted, commuted, leave salary, voluntary retirement receipt, retrenchment compensation. But retrenchment compensation we are not discussing because it is not at all important from exam point of view. Further, he will get non-monetary benefits like accommodation, mobile asset, car, medical facility, telephone facility, all that. Now, one by one, we will be discussing. Now, so, we will be discussing accommodation facility at last. So, first I will be discussing, if at all an employee is retiring, what benefits he is getting. So, one benefit which employee might get is gratuity. One benefit which employee might get is gratuity. Remember, if gratuity is received on retirement, exemption under 10 clause 10 is available. There is a section called 10 clause 10. In that clause, exemption is given for gratuity received on retirement. If at all gratuity is received before retirement, during the service, fully taxable. Now, if the gratuity is received by government employee, for him it is fully exempt. If the gratuity is received by non-government employee, then it is having exemption under 10 clause 10 to certain limits. So suppose if gratuity is received by an employee for whom payment of gratuity act applies. Suppose an employee is receiving gratuity where for him act is applicable, or suppose if the gratuity is received by an employee where payment of gratuity act not applicable. Now how to calculate exemption? Now exemption is lower of the following. How much exempted? Actual amount, how much? Because exemption cannot be more than actual. Suppose you receive 10 lakhs gratuity. How much is exempted? Maximum 10 lakhs. Statutory limit of exemption is 20 lakh, or 15 by 26 into last drawn salary into completed years of service or part thereof in excess of 6 months. What does it mean? Suppose if an employee completed 30 years 7 months, it is treated as 31 years. If an employee completed 30 years 5 months only, it is treated as 30 years only. So if at all an employee who has completed an year, who has completed more than 6 months in a year, it is treated as full year. Otherwise, it is treated as no year at all. Getting it? Now, at the time of retirement, what is last drawn salary? At the time of retirement, what is your salary? So that is called last drawn salary. Now, sir, salary means what? You are saying salary includes so many. What are they? Here, for the purpose of gratuity, where gratuity act is applicable, basic plus DA basic plus dearness elements. Here, any DA you may consider. Salary means that. So take what is the last drawn monthly salary. Last drawn monthly basic salary, how much? Dearness elements, any DA, retirement, non-retirement, doesn't matter. Now multiply with 15 by 26. 15 by 26 into basic plus DA, any DA of that last month, multiplied by how many years he completed, or more than 6 months if at all he completed any other year, that also you take it as full year. So that you apply, you get some amount. Now among these three, lowest amount is exempt. So employee received something, exemption is something, balance amount is taxed as salary under 17 subsection 1. This is gratuity where act is applicable. Now you see, sir, I told no, salary means this. In this salaries chapter, we have mainly 3 salary definitions. 3 definitions for salary. Suppose if at all the word salary is used for exemption under gratuity, when you are calculating exemption under gratuity, where gratuity act is applicable, they have given 3 criteria. One of the criteria is what? 15 by 26 multiplied by last drawn salary. What does it mean? Salary at the time of retirement. Salary means what? Basic plus any dearness elements plus nothing. So basic plus any dear. So that is what salary at the time of retirement. Now here, in while calculating gratuity exemption where act is applicable, they have used the word salary, right? Salary means this. Now, same way, the word salary has been used at various locations. Recognized provident fund, employers contributing to RPF in excess of 12% of salary is taxable. Beyond 12% of salary is taxable. Now, 12% of salary means what? Salary means what? Basic plus DA for retirement plus commission, only percentage of turnover. Fixed commission you should not take. Here, DA only if it is for retirement benefits you should take. Other DA you should not take. Getting the point? Now, this salary definition is applied at 5 places. RPF, HRA, gratuity, leave encashment, voluntary retirement compensation. In all these 5 cases, in all these clauses, in all these exemptions, if the word salary is used, salary means these 3 components. Suppose if it is used for gratuity where act is applicable, this one. Suppose if it is for gratuity where act is not applicable, an employee received gratuity at the time of retirement, but for him gratuity act do not apply, still he received gratuity. Now for him, how to calculate exemption? They have given a criteria. In that criteria, the word salary has been used. In fact, average salary word is used. Salary means what? This one. Now, suppose employee was given rent-free accommodation facility. Now, accommodation facility, the company gave any accommodation to employee, So, how much is benefit value? Perquisite valuation rule says some percentage of salary. Salary means what? Basic plus DA for retirement plus any commission, bonus, taxable portion of allowances. Actually, for RFA, if you see original salary definition given in the book, it is very comprehensive, very big. That if you convert it into a particular meaning as a formula, This is the definition. If you apply this formula, I am telling you, you will get absolutely correct answer. So basic salary. So while you are computing accommodation benefit, salary means these components you take. Anyhow, when I am discussing that, I will once again come back and show you what are all this. So I'm just giving you a brief idea. Getting it? So very simple. By the way, if at all any of you are looking for these 3 points, you can take a note of it, or alternatively, you download rest of our CACMA application. You download rest of our CACMA application. Just a minute. You download rest of our CACMA application. So just a minute, ma. Sorry. So inside that there is a course called Group 1. Open this Group 1. So inside this content, November 23. Getting it? So inside this P4 taxation is there. P4A taxation is there. Inside the salaries chapter is there. Inside this you can download salaries overview file, accommodation facility. These 2 PDFs are unlocked. You can download this. Getting it? So anyhow, so that's it. Now let's continue with the gratuity. So if an employee who is receiving gratuity, where he is covered under Gratuity Act, which of these three items were the right? Least of them is exempted. Suppose if an employee is receiving gratuity, but he is not covered under Gratuity Act, how much is exempted? Actual 20 lakh, 15 by 30, nothing but half a month salary multiplied by average salary multiplied by completed years of service only. More than 6 months point is not there. Suppose if an employee completed 30 years, 11 months, 10 days, we still consider it as 30 only. Sir, 11 months extra he worked? No, we don't consider. So only completed years we look into. Multiplied by average salary. Salary means what? Basic plus DA for retirement plus commission as a percentage of turnover. Now that salary you should take. Which salary? Average you should take. Average of how many months? Last 10 months preceding the month in which employee retired. So in which month employee retired? Check out. Before that, last 10 months, basic total it. DA for retirement total it. Commission as a percentage of turnover, whatever is there in the last 10 months, total it. Divide it with 10. You will get average salary. So that amount you keep it here. Now 1/2 into average salary into completed years of service. So this is what treated as, third criteria. So among these three, whichever is lower, that much is exempted from the gratuity received by the employee. So first, what is amount received minus these three, whichever is lower, that is exempted. Are you clear? Don't worry, at the end of this video you will find once theory concept provision discussion is over, you will find problem solving also. So don't worry. So most of the adjustments, most of the provisions whatever we are discussing, we have solved it in the form of problems. Next now so this is regarding gratuity. Over. Now in this they have given certain points. This 20 lakhs is lifetime limit. Suppose if an employee is getting gratuity from 2 or 3 employers, from all the employers put together, exemption cannot exceed 20 lakhs. Next. So what is the next benefit? So now right now we have covered gratuity point. We have covered gratuity. So whatever I have covered, I will highlight it with green color. So now let's continue. Pension. So how to understand pension? How to calculate pension value? Now the pension is of 2 types. Generally pension is received at the time of retirement or after retirement you will receive. Pension that you receive generally monthly, that's called uncommuted pension. What is it called as? Uncommuted. Suppose you may also receive in lump sum, that is called commuted pension. Suppose after you retire, company offered you 15,000 rupees monthly pension. Okay, they offered you 15,000 rupees monthly pension, 15,000 they offered you. Alternatively, you can take 15 lakh lump sum also. They told you these 2 options. You can take 15 lakhs lump sum or take 15,000 monthly pension. What you did, sir, you give me 5,000 rupees monthly, 10 lakhs I will take lump sum. You gave this option called, sir, I will take 10 lakhs lump sum, sir. 5 lakhs I don't want. Instead of that 5,000 you give me monthly. You told this proposal to the company agreed. Now you are getting monthly how much? 5,000. Whatever number of months were there in that year, that is fully taxable. Whether the employee is a government employee or non-government employee, monthly pension received is fully taxable. Now you are receiving lump sum. What about this? There is a section 10 clause 10A. There is a 10 subsection 10A, they refer it as, but it's actually clause 10 clause 10A. So this clause says lump sum pension received is exempted as per below. How much is exempted? Suppose if the employee is receiving gratuity, he is receiving gratuity, claiming exemption also for the gratuity, then how much is exempted? 1/3 of full pension value. Whatever full pension value is there, in that 1/3 is exempted. So how much amount received? Check out. Minus 1/3 of full pension value is exempt. Now full pension value, how to calculate? In this case you see, monthly he is getting 15 originally, but he only took 5,000. How much he sacrificed? 2/3 of the monthly pension he sacrificed. Monthly he is getting 15,000, but he is only receiving 5,000. 10,000 he sacrificed. So in 15,000, 10,000 proportion is what? 2/3 he sacrificed. For sacrificing 2/3, lump sum how much is getting? 10 lakh. Now for 2/3, lump sum amount is 10 lakhs. For full amount how much? So 10 lakhs is for 2/3. So it is for 2 portion. So which means 3 portion means what? Full value is 15 lakh. 15 into 1/3 how much? 5 lakh. Employee received how much pension? 10 lakh in our example. How much is exempt? 5. So 5 lakh is taxable. If you want, once repeat this video, last 5 minutes once again. If at all you did not understand, just repeat this video. So in exam they'll give you employee commuted 60% of the pension for 3 lakh. Employee commuted 40% for 2 lakh. Employee commuted 70% of the pension for 5 lakh. How to identify full value? How much amount received divided by what is the commutation percentage? Apply. You will get full value. On that full value, how much is exempted? 1/3. That is exempted value. Exempted value you should reduce from which value? Full value. Huh? No. You should reduce exempted value from pension received in lump sum. Suppose if the employee is not receiving gratuity, then how much he received pension? Identify lump sum. In our example, 10 lakhs received. Now how much is exempt? Half of full pension value. Full pension value is 15 lakhs in our question. So half of full pension value means 7.5 lakh is exempt. So 10 lakhs he received, 7.5 exempt, 2.5 lakh is taxable. And remember, if commuted pension is received by a government employee, it is fully exempt. Commuted pension received by non-government employee, then it is exempted as per the below. If he is receiving gratuity, then how much lump sum pension he received? Put it. Minus 1/3 of full value, full pension value. Full pension value, commuted value they'll give, no? Divided by how much percentage the commuted? Check out, apply that. You will get full value. So 1/3 into full value amount you will get. That you reduce from amount received from lump sum. Taxable amount you get. Same way, half of full pension value. If the employee is not receiving gratuity, then from the total pension received lump sum minus half of full pension value is exempt. That's it. So this is related to pension. I hope you are clear. Now. So I discussed both. What is uncommuted? That pension which you are receiving monthly without any commutation. Commutation means transfer of right. Getting it? Now, commuted pension. Commuted means what? Lump sum pension. Further, we have 10 clause 10A exemption. For government employed, it's fully exempt. For non-government, just now we discussed. Then we have something called leave encashment. What is meant by leave encashment? What is meant by leave encashment? Very simple. Every year company is giving me some 40 or 50 days leave. Every year I can take these many leaves. 20-30 years I worked in this company. 20 years I worked in this company. So every year 40 days I can take. 20 into 40, 800 leaves I can take. But you know what? I only took 400 leaves. 400 leaves company extra gave me, but I didn't use. Now these 400 days, I told company, please give me cash now. I came and worked now. Even though you gave leave, I came and worked now. So you give me cash for that 400 leaves. So company gave me. So what I did, whatever leave I have, no accumulated leave, I encashed it. That's called leave encashment. That's called salary for the leave period. That's called leave salary. So if an employee is receiving leave salary, government employee fully exempt. Non-government employee under 10 clause AA, 10 clause 10 AA, under this leave encashment is exempted to the extent of least of the following. So actual amount, one criteria, 3 lakh, 10 months multiplied by average salary, then how much is unutilized leave? Unutilized leave identify. Unutilized leave identify. Divided by 30. Multiplied by average salary. This much. Out of these 4 categories, whichever is lower, that is exempt. Now, what do you mean by, how do you calculate unutilized leave? How do you calculate this unutilized leave? First of all, leaves granted per annum by the company are 30 days per annum, whichever is lower. This you calculate per annum, multiplied by completed years of service. Part thereof in excess of 6 months, don't consider. So leaves per annum how much? Or 30 days per annum, whichever is lower. If company is giving 40 days leave every year, 30 days only we should consider every year. So 30 or 40, whichever is lower. So 30 into completed years 30. So total you are eligible for 900. How many? This is a total leave availed minus total leave available minus you already availed means utilized 400 leaves means 500 is unutilized leave. So for 500, so for 30 days this much is the average salary. For 30 days this much is the average salary. For unutilized leave how much? This much is exempt. Are you getting it? So in these four, whichever is lower is exempt. So 10 months into average salary, one criteria. Unutilized leave divided by 30 multiplied by average salary is another criteria. How to calculate this unutilized leave? Very simple. Total leave minus utilized leave, unutilized leave. Total leave, how you should calculate? How many years you worked in this company multiplied by how many leaves you are eligible in a year. If you are eligible in a year more than 30 days leave, then take 30. If you are eligible every year less than 30, then take actual leave per year into total years is minus leave utilized by you during this 30 years. Then you will get unutilized leave. For 30 days, you are getting this much average salary. For unutilized leave, how much? That is fourth criteria. Listen to the past 5 minutes once again. You will get clarity. Most of the students at CA Inter do wrong in leave encashment problems. The reason is they don't understand the fourth criteria. Up to third criteria, everybody will do correct. These three criteria, everybody will do correct answer. Fourth criteria, many will do mistake. Why they do mistake is they don't understand the concept of unutilized leave. How to compute unutilized leave, they don't understand. How to compute unutilized leave? Total leave minus utilized leave. Utilized leave, they'll give you in the problem, always. Getting it? Total leave, how to calculate? Actual leave per annum available or 30 days per annum, whichever is lower, multiplied by number of years employee completed service is equal to total leave. Minus utilized leave, they will give in the problem. You will get unutilized leave. Divided by 30, multiplied by average salary over fourth criteria. Among these four, whichever is lower, that much is exempt. So how much you receive? 10 lakhs. Here you calculated lowest value, 2 lakhs you got. So 2 lakhs, 8 lakhs is taxable. That's it. You clear. So that's leave encashment. Now here also they have used the word salary. What do you mean by salary? Salary means basic plus DA for retirement plus commission percentage of turnover. So gratuity where act is applicable, basic plus any DA. Gratuity where act is not applicable, basic plus DA for retirement plus commission percentage of turnover. Leave encashment, basic plus DA for retirement plus commission percentage of turnover. Are you clear? Getting it? By the way, whatever I am explaining, that and all were there. You see here, directly I'll go to, gratuity point. So here it is, pension point is given, pension point is given here itself. Pension, this is our main book. You can download this book in Sept application or even on the website. You go to website septcma.com, there you can download. So pension, commuted pension, uncommuted pension, both I have given. We have even given an illustration. You can solve this illustration. I'm telling you, if at all you solve our book, whatever illustrations we have given in our book, by the way, you can even download the workbook like this. We have a workbook like this also. If you just download this workbook from our website also, if you solve this workbook completely, I'm telling you 99.99% questions will be from this workbook only. Just numbers will be changed. That's it. All the adjustments that are going to be asked in exam, all are covered here. So pension point, here I have given entire thing, whatever I have told. Gratuity point, government employees exempt, defense people exempt, other employees, non-government, act is applicable, I have already told. Act is not applicable, I have told. What do you mean by salary when act is not applicable? What do you mean by salary when act is applicable? Everything I have covered. Then we also covered right now leave encashment, leave salary. For government employee is fully exempt. For non-government employee, 4 categories we have, 4 criteria. So how much you receive? Minus out of these 4, least amount, that much is exempt. So salary means what I have already told. That's it. So which means leave encashment is also completed. Now leave encashment, pension, monthly pension, uncommuted, gratuity, all these are taxable under 17 subsection 1 as part of salary. Now voluntary retirement compensation, what is it? VRS. VRS is taxable as profit in lieu of salary. Of course, at the end of the day it is taxable, but how it is taxed? Gratuity, pension, leave encashment, these are taxed as salary, whereas this is taxed as profit in lieu of salary. So now, public sector companies or private sector companies or private companies or some governmental organizations, only they are eligible to give VRS. If they are giving any VRS compensation to employee, getting it as under a scheme of voluntary retirement, company want to reduce the staff. Overall staff of the company should reduce. And if an employee in a scheme of VRS program receiving compensation from the company for voluntary retirement, and this employee has completed 10 years of service or has 40 years of age, then this person is eligible to get exemption under 1010C. Suppose if an employee who has not completed 10 years of service, if this fellow is getting VRS, fully taxable, no exemption. If an employee completed 10 years of service and receiving VRS under a scheme of VRS, approved scheme of VRS, then 1010C exemption is available. How much is exempted for VRS? Very simple. Actual amount 5 lakh only. Just a minute, sorry. There's so many limits now. So sometimes 5 lakhs or 3 lakhs or some amount is there. Just a minute. It is there in profit in lieu of salary. Sorry. It is there in profit in lieu of salary. Correct only. Always. Just confirmation. 5 lakhs only. 3 lakhs limit is only for leave encashment. In all other cases, it is either 5 lakhs or 20 lakhs. Okay, fine. So 5 lakhs or 3 months into average salary. Yes or no? 3 months of salary for each completed year. For how many completed years is there? Into 3 months of salary. Salary means last on salary. That's enough. Third criteria. Salary at the time of retirement, nothing but salary multiplied by number of months service left. If at all you are not retiring, how many more months you can service for the company? That many months multiplied by last on salary. That is one criteria. Second criteria is what? 3 into completed years of service into salary. Last on salary. Salary means what? For VRS, basic plus DA for retirement plus commission percentage of turnover. Then actual amount or 3 lakh or this one 3 into completed years into last one salary. Fourth criteria, number of months service left multiplied by salary. Salary means what? Basic plus DA for retirement plus commission. So find out these four criteria, whichever is lower, that much is exempted for under VRS 1010C. That's it. So with this, we have even completed, retirement benefit. Now all the retirement benefits that generally be asked in exam, we have completed. No more retirement benefit. That's it. Now let's discuss, monetary benefits which an employee will get. Suppose in the question they are giving you basic salary, fully taxable, DA for retirement, fully taxable, DA. Normally they said nothing is mentioned. They just said DNS elements. Nothing they spoke. That's a normal DA, not for retirement, fully taxable. Bonus is taxable, commission is taxable, fixed commission is taxable. Transport elements. Now, what is this transport elements? Getting it? Just a minute. So transport elements, so there is something called transport elements. Transport elements. Suppose if transport elements is given to a blind, deaf, dumb or orthopedically handicapped. To these people, if an employee who is a blind, deaf, dumb or orthopedically, nothing but physically handicapped person in lower extremities of the body, for him, if at all we give any transport elements. What is transport elements? For coming from home to office, then returning to home, nothing but for commutation between home and office. For that purpose, companies giving transport elements. Then up to 3,200 is exempt. Whether the employee is choosing 115 BAC or not, he may be choosing optional tax regime, he may not be choosing optional tax regime. Irrespective of that, up to 3,200 worth of transport elements received by him is exempted. Suppose if transport elements is given to a person working in transport sector, he is working in transport of passenger or transport of goods. So I am working in a transport company. I am receiving transport elements. How much is exempt? 70% of elements received. 70% of elements received is exempt. But maximum exemption is 10,000 per month. Suppose if company is paying me 10,000 monthly, exactly. Let us assume company is paying 10,000 monthly and the person is working in transport sector. How much is exempt? Entire pen exempt. Wrong. Students do this mistake. If at all you are receiving 10,000, you are receiving 10,000 transport elements every month and you are working in transport sector, how much is exempt? 70%. That is equal to 7,000 or 10,000, whichever is lower. 7,000 only exempted. So if an employee working in transport sector, if he is receiving transport elements, how much is exempt? 70% of the elements received or 10,000, whichever is lower. That much only exempt. In addition to this, company may give transport facility. Getting the point? Transport facility means what? Company itself is arranging bus for the employee to come from home to office, office to home. Fully exempt. Fully exempt. Transport facility is fully exempt. Able to understand? Suppose if the company is giving a transport facility for employee tour purpose. Employee is going on a tour for personal reason, vacation. For that, company is giving transport facility. Whatever market value is there, that much is per present. If it is given in railway, whatever the railway fare is, that is perquisite. If at all, if it is given in airway, airway is the perquisite. Able to understand if it is for personal reason. But anyhow, transport facility point is not at all important from exam point of view. Therefore, right now what we have completed regarding transport, we have completed transport elements point. I hope now you understood transport elements is understood. Transport facility also we have completed. So whatever we have highlighted in green, we completed. Now next, children education elements. Children education elements. What is this? You know, an employee, you know, he may give either education elements, or employer may give education facility. Employer may give education facility. Suppose if education facility is given to children of the employee, if the education facility means what? Employer is having a school, or employee had tied up with our particular school. In that school, only these employer children, only this company employees, know, their children only will join in that school, because the employer company has a tie up with that school. Now in that school, employee joined his children's. Getting the point? Now that entire cost of education employer is only bearing. Getting it? It is not reimbursement. Employer is only bearing it completely. The facility itself we give. You told employee, go and join your children in that school. Or we have our own school. So I told employees to join their children in our school itself. Education facility. Now, what is the perquisite? If cost of, what is it? If cost of education in similar institute is less than or equal to 1000 rupees per month, then it is fully exempt. If cost of education in a similar school is exceeding 1000, it is fully taxable. Fully taxable. What do you mean by fully taxable? Exceeding 1000? No. Suppose no, my employee, I am working in a company. My children, I joined an employer school. That's an international school. Similar education cost is 20,000 per month. Entire 20 is taxable because the cost of education per month exceeds 1000, therefore entirely taxable. Sir, 1000 exceeding means only 19,000 you can tax, monthly. Why entire 10? Why entire 20 you are taxing? Because this 1000 rupees is a threshold limit. This is not a slab limit. What they said, they only talk about exemption. What they told, if cost of education in similar institution does not exceed 1000, it is exempt. What does it mean? If it exceeds 1000, fully taxable. Alternatively, many others, what they are doing is up to 1000 they are claiming exemption. Excess amount facility cost they are taxing. Anyway, you can follow in exam, but you should mention alternative view as a note point compulsorily. Suppose if education facility is given for any other member of the employee, if any other person on behalf of employees taking education facility, company is bearing cost, fully taxable. Whatever cost of education in a similar school is there, no, fully taxable. No 1000 rupees limit also, fully taxable. Suppose company is not giving facility, we are giving allowance. We are giving allowance to employee. Allowance means what? I give some money, whether he will spend it or not, that is his choice. Allowance, education allowance is exempt up to 100 rupees per month per child, maximum 2 children. Maximum for 2 children, 100 rupees per month per child exempted. Now, suppose no, for one of the children, company paid 120 rupees. For another children, company paid 90 rupees allowance. Getting the point? 90 rupees only allowance company. The allowance itself is 90 rupees. Getting it? For one children, we gave 120. 100 is exempt, here 90 only exempt. So 20 is taxable, here 0 is taxable. Some students, what they do is they merge these two, 210. Now up to 2 children, 100 exempt, no 200. So they only tax 10. That's wrong answer. You should calculate children wise exemption. And children wise allowance taxability you should calculate. Remember, careful. So education elements, education facility, both are over. I hope you are able to recollect all the concepts. So education facility is over. Now, suppose no, employee children are staying in hostel. For that purpose, we are giving hostel elements also. For employee children, hostel purpose, employer, company is giving some elements. It is exempted up to 300 per month per child. So, per child, per month, how much is exempted? 300. Maximum for 2 children. Getting it? So, hostel elements is also over. Hostel elements is also over. Next we will discuss house rent elements. What is it? House rent elements. Now look at carefully. House rent elements. So a company, whenever a company recruit an employee, companies, they generally give accommodation to employee. Accommodation to employee. Accommodation is a facility. Accommodation facility means company is having staff quarters. In that quarters, one bungalow is allocated to employee. That's a facility given to employee. So that's a perquisite which is valued as per valuation rule. Alternatively, company may give rental allowance. That's called house rent allowance. What is it called as? House rent allowance. So for rental expenditure purpose, we are giving house rent allowance. Now, if house rent allowance is given, there is an exemption given for that under 10 clause 13A. How much is exempt? How much amount actually received per month? How much is rent paid in that month minus 10% of salary minus 50% of salary. If at all you are paying rent in a city, Delhi, Kolkata, Mumbai, Chennai, then 50%, or 40% of salary if at all you are paying rent in any other city. Suppose if at all you are staying on in a rented accommodation, you are paying rent. That accommodation is in some other city, not Delhi, Kolkata, Mumbai, Chennai, then 40% of salary is one criteria. If at all you are staying in a rented house in Delhi, Kolkata, Mumbai, Chennai, then 50% of salary. Second criteria, how much you are paying rent monthly minus 10% of salary. Salary means what? Basic, DA for retirement, commission percentage of turnover. I told you for 5 purposes salary means same. RPF, HRA, gratuity where act is not applicable, leave encashment, VRS. In all these 5 cases, salary means basic plus DA for retirement plus commission percentage of turnover. We already completed gratuity where act is not applicable. So one time salary we discussed, VRS we completed, leave encashment we discussed, HRA now we are discussing, RPF alone is pending, where this salary definition is applicable. Correct? I hope you are able to recollect what I am explaining. Getting it? You just listen to this carefully. You listen once again. Problems are also given. You just observe those problems. Believe me, you are done with salary chapter. So, how much is exempt? So, actual amount, how much you received. Rent paid minus 10% of salary. Suppose you have paid rent 0. For some 2 or 3 months, you did not pay rent at all. For those 3 months, you will not get HRA exemption at all. Remaining 9 months, you paid rent. For those 9 months, HRA exemption you will calculate. So if for any month you don't have rental expenditure at all, for those months, whatever HRA you received from the company is fully taxable. Remember, HRA you have to calculate month wise. If all the months you have stayed in rented house, all the months salary information is same, HRA amount is same, rent paid expenditure is same, city is same, then entire 12 months put together at a time you can calculate. Getting the point? So this is HRA computation. So actual rent paid minus 10% of salary, 50% of salary or 40% of salary as the case may be. Now salary means what? Basic, DA for retirement plus commission. Suppose, sir, we are giving an employee accommodation facility. Sir, we are giving the employee accommodation. Always remember this thumb rule in salary. Whenever you have a problem, accommodation facility is there. You need to value the perquisite. Calculate this at last. Calculate this at last. Getting it? So how to calculate income under salary? First calculate gross salary minus deductions. Then you will get income from salary. Getting it? Deductions means what? I have already told. No. Deductions. You have 3 deductions. Standard deduction, entertainment allowance, profession tax. Anyhow, we will discuss that later. So always whenever you are computing problem on salaries, accommodation related perquisite valuation, do it at last. Just before you compute gross salary total, compute accommodation perquisite. Next. So right now what is over, which means house rent allowance is over. Next, telephone allowance. You know what? If employer, company gave telephone facility to employee, fully exempt. Nothing is taxable. If allowance is given, allowance means what? I gave money. Whether he will use telephone or not doesn't matter. That is his choice. If I give telephone allowance, fully taxable. Telephone allowance is fully taxable. Are you getting it? Suppose I gave an employee medical allowance. Medical allowance. Again, medical allowance means I have points to say. Suppose, employee for medical purpose, we are giving allowance. We are giving allowance, or we are giving reimbursement, or we are giving facility. Employer is having a hospital, medical, hospital is there. In that hospital, employee and his household member getting treatment. Fully exempt. What is it? Fully exempt. Now, employee plus household member. Household member means family. Family means what? Children, spouse, dependent parents, dependent brother or sister. Only these are covered within the definition of family. If employee or his family members getting medical treatment in employer hospital, employer maintained hospital, it is fully exempt. Suppose employee is not employer is not having hospital. So employee is spending money, getting reimbursement from the company. He is spending money for medical treatment of himself and family. Family means only these people, man. Remember. So for these people, he is spending money, medical expenditure, then getting reimbursement from the company. Now, this reimbursement is exempt. This reimbursement is exempt only if the medical treatment is held in, if the medical treatment is taken in government hospital, or if medical treatment is for prescribed diseases given by Chief Commissioner of Income Tax or Principal Chief Commissioner of Income Tax, or if the medical treatment expenditure is for COVID illness of the employee or family member. For these purpose, he spends some medical expenditure, company is reimbursing, then only exempt. Suppose if employee or family member, they are getting medical treatment in a private clinic, they are getting medical treatment in a nursing home, they are getting medical treatment somewhere in a family doctor, and employer is reimbursing it, fully taxed, fully taxed. Suppose employee suffering from some particular problem, he went abroad. For that, he went abroad and took medical treatment. For that medical treatment, company only reimbursed. Now to travel abroad, travel expenditure also company paid. Now in abroad, they stayed for some number of days. Stay expenses also company paid. So if employee who has taken medical treatment outside India, treatment costs, traveling costs, boarding and lodging costs, completely company only reimbursed. Now what about that? Medical treatment abroad, it is exempted to the extent exempted by RBI. Whatever RBI allowed, to that extent, whatever employer reimbursed, exempted. Suppose the employee spent 10 lakhs expenditure, entire 10 lakhs company gave, but RBI gave 9 lakhs only permit, 1 lakh is taxable. Now on transport, travel expenditure 5 lakhs employee spent, company reimbursed entire 5, but RBI gave 4 lakhs only limit, then 1 lakh taxable. Further, for travel expenditure, abroad travel for medical treatment, that is exempted only to the extent of RBI. That to this exemption, when if gross total income of the employee does not exceed 2 lakhs. If employee gross total income is less than or equal to 2 lakhs, then only this travel expenditure is exempted, which is reimbursed by the company. You getting the point? How to identify gross total income? Compute income from salary. All perquisites, allowances, everything, even medical reimbursement, taxable items, everything, even medical treatment at abroad, taxable portion is there, add it, everything you total, except this 5 lakhs, except 5 lakhs of travel reimbursement, rest everything you total, taxable items. Identify income from salary, identify other heads, gross total income, if it is less than or equal to 2 lakh, then travel reimbursement for abroad medical treatment is exempted, otherwise it is fully taxable. Able to understand. Now, travel reimbursement for employee or the family member who is suffering illness plus one attendant, for them only company will give, that is only exempted. Suppose I am giving monthly some fixed allowance, I am giving some monthly some amount, whether he will spend it or not doesn't matter. Allowance is fully taxable. Reimbursement is exempt only if it is in a government hospital, prescribed disease, COVID, treatment at abroad to the extent permitted by RBI, travel and stay expenses to the extent permitted by RBI is exempted, provided gross total income do not exceed 2 lakh. Over. Suppose if on employee and family members' name, company took a medical policy, company is paying premium, fully exempt. Suppose employee only purchased medical policy, he is paying premium, I am reimbursing it, fully exempt. Allowance of medical allowance is fully taxable, please remember. That's it. So medical reimbursement we discussed, medical allowance we discussed, yes or no? We have covered medical allowance and medical reimbursement, all that. Just a minute, I think something is missing here. Here you see. Here, let me copy this page. Copy the page. I will paste it below that. So paste page. Yes, continuation. That's it. So we have even completed what? Medical policy on the employee. It is fully exempt. Suppose company has taken accident insurance policy on the employee name, fully exempted. Able to understand? Next, suppose company is offering lunch, getting it? If at all company is giving allowance, money is given by the company to employee. Employer gave lunch allowance, fully taxable. Suppose company is having a food court. To the employee, I give a lunch voucher. He can use that voucher and to buy the food only. See, if I give allowance, whether he will spend or not, I don't know. I gave money, monthly some amount I gave for lunch purpose or tiffin purpose, whatever. Some allowance I gave for food and beverages, fully taxable. Suppose if I give him voucher, He cannot use it anywhere else. He can only use it for food redemption. If I give a voucher, lunch voucher, up to 50 rupees per meal is exempted. Getting it? That's it. So lunch facility, if I give lunch facility by voucher, up to 50 rupees per meal is exempted. Gift. Suppose employee did something well in this month. So company want to give a gift to him to reward his service. So we gave a gift. Cash we gave, fully taxable. Suppose you gave a voucher or kind, some non-monetary thing you gave. If the value is not exceeding 5,000, fully exempt. In the entire year, if the value is not exceeding 5,000, fully exempt. If the value is exceeding 5,000, fully taxable. Alternative treatment, up to 5,000 exempt. Beyond that, whatever the value of the gift is, that is taxable. So gift allowance, gift in kind. So gift in kind I did not write here. So gift allowance. So gift allowance is taxable. So here you add one more point. Gift in kind. So that also we have covered. Yes or no? Understood or not? I hope you are able to recollect these many points you have studied in this one. Next. Contribution to RPF in excess of 12%. Interest on RPF in excess of 9.5. What does it mean? Suppose employer is contributing monthly to recognized provident fund in the name of employee. Employee is also contributing out of his salary to provident fund. For him, it's a ATC deduction. Now, company is contributing in your name for your future benefit. That's a benefit for you, right? So, if company is contributing for your future, some amount to the provident fund authorities. How much? If it is up to 12% of salary, company contributed, fully exempt. If it is beyond 12% of salary, that excess amount over and about 12% of salary, if employer is contributing in the name of employee to the provident fund authorities in excess of 12% of salary, fully taxable. 12% of salary means what? Salary means what? Basic. DA for retirement, commission percentage of turnover. So in reality, in problem, what they will tell you is employer contributed 20% of basic to RPF. Employer contributed 15% of salary to RPF. Like that, they'll give you. First, how much he contributed? Money. Convert it into money first. From that, reduce 12% of salary. Identify salary, basic, DA for retirement, commission percentage. Identify the problem amounts. Apply 12%. Value identify. How much value amount contributed? How much amount exempted? Balance, if at all positive, tax it. Otherwise, exempted. Able to understand. Some students know what they do is in exam they give you employer contributed 20% of basic salary to PF. Directly this fellow will do 8% tax. 8% he will tax it directly because 12% exempted. You should not do like that. You will get a wrong answer if you do. Always take a working note. How? Actual amount contributed, how much? Identify. 20% of basic. Basic is what? Check out. 20 apply. Amount you put. Minus 12% of salary. Salary means what? Basic. DA for retirement. Commission percentage of turnover. Amount. Total it. Getting it? Apply 12%. Value you will get. Amount contributed 10 lakh. Value 9 lakh. 1 lakh is taxable. You should always compute like this in a working note. Only then you will get marks. Now, so in excess of 12% of salary, exceeding 12% of salary, if any contribution is there, only that is taxable. Same way, in that RPF, company will be adding interest every year. If the interest rate is 9.5% per annum, that interest is exempted. If the interest is more than 9.5% per annum, suppose if company is paying 13% interest, then 3.5% interest is taxable. They'll give you interest amount. So 14% interest is equal to 14,000 rupees. Now 9.5 means how much? 9,500. So 4,500 is perquisite. 4,500 is salary, not a perquisite, salary. Taxable. Next. Leave travel concession. What is leave travel concession? This is if an employee and along with family, personal reason, they are going for a journey. They are going for a holiday in a block of 4 years. What is it? In a block of 4 years, 2022 to 2025. Right now, the ongoing block is this one, 22 to 25. This provision is added in 1986. So 1986, 87, 88, 89. That is one block. 1991, 92, 93, one block. 94, 95, 96, 97, one block. Like that, right now, what is the block? 2022, 2023, 2024, 2025. This is the block. Sir, financial year, calendar year. Calendar year. In this 4 calendar years, if you go for 2 holiday trips, you and your family. Family means what? Spouse and children. Children means how many? 2 children. Getting the point? 2 children. 2 children means what? 2 children only. Suppose if at all twins were born or triplets were born, Getting it? First time employee has been blessed with one boy. Second time he was blessed with two boys at a time, twins. They are treated as two children only. Now, this employee went for a holiday trip. Entire trip cost, not staying and lodging, only travel cost, company reimbursed fully. Entire travel expenditure which employee went on leave travel, that entire travel expenditure company only paid for the journey. Entire amount is exempted. Entire amount of leave travel is exempted, provided the leave travel must be within India, not outside India. So within leave, if any leave travel facility is taken by employee within India, whatever travel expenditure company is bearing, that is fully exempt. Now, how many holidays employee can take? 2 holidays, 2 journeys. What is it? 2 journeys it is exempted. 2 journeys every year? No. In a block of 4 calendar years, 2 holiday trips employee can take up. 2 holiday trips, whatever traveling cost is it, that is exempted in a block of 4 years. Sir, suppose there is one block 22, 23, 24, 25. In these 4 years, I did not went any place at all. No leave travel benefit I taken. Now what to do? Can I carry forward 2 into the next block 26, 27, 28, 29? In this next block, can I carry forward 2? No. If at all an employee did not utilize leave travel benefit under 10 clause 5, in a block, he didn't use it all. One leave benefit, one holiday can be carried forwarded to next block. Accordingly, in the next block, 3 leaves he can use. 3 holidays he can use, provided the carry forwarded that should be used within the first year in the next block. Then, suppose employer my tax liability, employee tax liability, employer pay. I'm earning salary, right? On this salary I have to pay tax. This tax also company is only paying. So good, my bosses. So on the perquisite which I am getting, company is only paying salary. The salary paid by company on my salary, my tax, my income tax, they pay. It's a benefit to me now. It is taxable in my hands now, but it is exempted. It is exempted. Now, you know what? Company is paying income tax. No, my income tax. For them, it's an expenditure at the end of the day, because my expenditure they are paying. So it's a business expenditure, but they cannot claim deduction under 40 subsection A, clear disallowance point. If a company, if any tax is paid on non-monetary perquisite given to an employee, the tax paid is not allowed as deduction for the employer who is a business person. Under PGBP, he will not get deduction. For me, under salary, is it taxable? No. Almost 1 hour. All these points I've covered. Still, we have few more points. If at all we discuss these points, I'm telling you, majority of the salary provisions we have covered. Next. Okay, already gift in kind is there, ma. Sorry, I wrote here. Gift in kind is there. Next. There are some facilities like what? Medical facility, which I already told you. Telephone facility, servant facility, gas and water facility. By the way, telephone facility is fully exempt. Medical facility already discussed. Facilities, they are taxable only for specified employees. Perquisites, no. Perquisites are 2 types. Reimbursement facilities. Reimbursements are always taxable for every employee. If at all any exemption is there, that exemption apply. Generally, most of the reimbursements are fully taxable. Facilities, they are taxable only for specified employee. Specified employee means what? If an employee is a director in a company, he is a specified employee. If an employee is having more than 20% ownership in the company, more than 20% profit sharing ratio in the employer business, he is a specified employee. If an employee monetary salary, what is it? Monetary salary amount is more than 50,000 per annum, is a special employee. Right now, if you apply that definition, right now, this definition was defined 25-30 years ago, specified employee definition. The same thing is continued even now. Now tell me, even a watchman, security guard is getting yearly 3 lakhs amount. He is a specified employee. So right now, if you apply specified employee definition, everybody is a specified employee in reality. But exam point of view, they are testing MCQs. So specified employee point they will test. So accordingly, facility, what facilities? Gas facility, servant facility, getting it, transport facility, education facility, medical facility, telephone facility, all these are exempted. All these are, by the way, telephone facility is fully exempted, that is given specifically. So medical facility, education facility, let me highlight with red color. Medical facility, just a minute. Yeah. So medical facility we have covered already. Now, medical facility, medical facility, education facility, transport facility, servant facility, gas, water, electricity facility. These facilities, no, only if a specified employee get this, it is taxable for him. If a normal employee also getting these facilities, fully exempt for him, it is not taxable. So these facilities are taxable only for specified employees. For normal employee, we won't tax it. For logic, getting it? So servant facility, how much we will tax it, by the way? Whatever servant salary company is paying, no, that is benefit in the hands of employee, that is taxable. Gas, water, electricity. If company is buying from somebody and then giving gas, water, electricity, whatever company paying them, no, that is perquisite, that is taxable. Suppose if company only manufacturing and giving it to employee, manufacturing cost is the benefit in the hands of employee, that is perquisite, over. So no, servant over, gas, water, electricity over. Then telephone facility fully exempt, not at all taxable. Then suppose if a company is giving a car to an employee, sir, before car I will discuss mobile asset topic. Mobile asset. What is a mobile asset? What is a movable asset? Very simple. Suppose, no, company gave furniture to the employee for usage. Since he is using furniture, so no, it's a benefit to the employee. How much is the value of the benefit that is taxable? How much is the value of the benefit that is taxable? The value of benefit of furniture given to an employee, nothing but movable asset. Suppose if the company is giving movable asset for usage, movable asset for usage. So company is giving movable asset for usage of the employee. How much is the perquisite? 10% per annum of original cost. Suppose if the asset is owned by the company. Suppose company purchases some asset. That asset is given to employee for usage, for personal purpose. What is the benefit value? How much is the benefit employee is getting because of using it? 10% per annum is the benefit. Suppose if the employee is using it only for 6 months, only for 6 months he has taken that facility, then 10% per annum into 6 months into original cost. So for how many months he is using that facility, enjoying that facility, only for that many months only, movable asset perquisite we calculate. Suppose no, company is taking the asset on rent, giving it to employee. Suppose company has taken AC on rent and installed it in employee house. AC rent itself is perquisite. So rental expenditure is perquisite. Rental expenditure is treated as perquisite. See, at the end of this entire chapter, I will give one summary. Like what are all these points? I'll give common sense based summary. If you listen to that, that's enough. Suppose no, for employee, I gave laptop and computer for usage, fully exempt. If the mobile asset is laptop and computer, which is given for employee, whether for official, personal, doesn't matter, fully exempt. If any other asset is given for employee usage, mobile asset, 10% per annum of the original cost if it is own asset. Rental expenditure incurred by the employer, if at all it is rented and then given to employee. Suppose no, company purchased some asset. That asset is sold to employee. Movable asset is sold to employee. On this I have explained the problem already. In that problem also, once again I repeated the provision. Movable asset I sold to employee. Suppose if the company is selling immovable asset to employee, that's a transfer of capital asset, capital gains will apply. If I give movable asset to employee, in the course of employment, he purchased the movable asset from the company. Suppose no, employee has purchased computers and electronic items from the company. Okay, for company, no, company originally purchased at 1 lakh, whereas now employee paid 10,000 rupees and purchased it. Now 90,000 rupees discount, that's a benefit. Oh, you should not calculate like this the benefit. Perquisite valuation rule says for computer and electronics, company has to claim notional. Now some asset belonging to the company I purchased. Is there any benefit in this purchase derived by me? How to calculate this benefit? Look at original cost of the asset minus claim notional depreciation. Reduce notional depreciation for every completed year of usage. For every completed year of usage by the company. So for how many years company used that asset in their own name? For how many years that asset is in the name of the company? For completed years of usage by the company. In case of in case of computers and electronic items, 50% WDV basis, we claim notional depreciation. So 3 completed years. Company purchased the computer on 1st May 2019. This employee purchased. When company purchased, just a minute. When company purchased the computer, 1st May 2019, company purchased the computer. What price? 1 lakh. Getting it? Now the employee purchased this computer from the company on 10th June 2022 employee purchase. At what price? He just paid 10,000 rupees and bought. Or let us assume he paid 1,000 rupees only. 1,000 rupees he paid and purchased at this computer. Now, is employee got any benefit in this? Let's check out. 1 lakh is the original cost, right? Now, since the item is a computer and electronic item, notional depreciation as per perquisite valuation rule is 50% WDV basis. Suppose if it is car, 20% WDV basis. If it is any other asset which is sold by company to employee, 10% SLM basis. These are the valuation rules. Notional depreciation valuation rules. 1 lakh. Now, first of all, now company purchased it on 1st May 2019 and sold it to employee on 10th June, which means the gap, who is the owner? Company only owner. For how many years company is owner? From 1st May 2019 to 10th June, it is more than 3 years. Exactly speaking, 3 years, 2 months approximately. Now, how many completed years company is owner? Only 3 completed years only company is owner. Only for completed years of ownership. Only for that claim notional depreciation. So 1 lakh minus 50%, you will get 50,000. Minus again 50%. This is for first year. This is for second year. 25,000. Again claim depreciation for third year. 12,500. 50%. So what is the value? 12,500. So value of the asset is 12,500. Company employee paid how much? 1,000 rupees he paid and got 12,500 worth of asset. 11,500 is taxed as perquisite. 11,500 rupees is treated as perquisite in the hands of employee. Suppose if it is motor car, then instead of 50%, we will calculate 20%, 20%, 20%. If it is any other asset, SLM 10%. SLM basis means what? On original cost, we will calculate 10%, 10%, 10%, 3 years. So when a company sells any asset, mobile asset to employee, certain price or zero, free price, whatever, what is the value of the movable asset? How to arrive the value of the asset given to employee? Very simple. Computer and electronic items, 50% on WDV basis reduced for every completed year of ownership with the company. I hope I am giving you clarity. By the way, I have given problems also. If you look at these problems, I'm telling you most of these adjustments I've covered in these problems. Getting it? So movable asset, usage, everything, sale, both are completed. Just a minute. Yes, that's it. Now let's continue with motor car. So suppose company is giving car facility. Car facility is taxable only for specified employees. First of all, facility. Now how to tax car facility? Very simple. Very simple. Suppose no, car facility, cars are divided broadly into 2 categories. Less than 1.6 cc, more than or equal to, not exceeding 1.6 cc, more than 1.6 cc. Getting it? So if the cc is up to 1600, then perquisite value is different. If the cc is more than 1600, the perquisite value is different, exceeding 1600. Now, suppose company gave car facility. Company only owns the car. Employer owns the car. Company owns the car. The expenses of the car, they are also employer only bearing. Suppose if this car is completely for official purpose. If the car is completely for official purpose, no benefit to employee. What is the perquisite value? What is the taxable value? 0. Suppose if it is for personal purpose. Now company gave car. Expenses also they are only bearing. Now car, company car I am using, use of movable asset. So use of movable asset, what is the perquisite? 10% per annum for using the car. Less expenses of the car, company only bearing, actual expenses. That itself both put together is taxable in the hands of employee. So actual expenses means what? Fuel, maintenance, repair, driver salary, everything. Company is only paying everything. And remember, this entire car is completely for personal purpose only. So whatever actual expenses company spent, that is for employee benefit, personal benefit, fully taxable. Car is company own car, 10% per annum of the original cost. Suppose company took the car on rent and gave it to employee. Rent expenditure is perquisite. Whether it is more than less than 1.6 or more than 1.6 is, it doesn't matter. Suppose car is used for official plus personal. Both the purposes employee is using. Now I cannot tax full benefit. No. How much? Perquisite valuation rule says if the car is owned by company or rented, whatever, company is providing the car. Company is providing the car. If it is completely personal, we have seen If it is completely official, zero perquisite. If it is completely personal, use of movable asset plus actual expenditure is perquisite. Very simple. If it is official and personal, how to value? Then, if it is complete, if it is official plus personal, no. If the car capacity is less than 1600 cc, then 1800 per month is the perquisite. If the car capacity is more than 1600 cc, 2400 per month is treated as perquisite value. Suppose if company gave driver also, and the driver is also used both officially and personal, then 900 rupees is perquisite in the hands of employee. So what are they saying? If you are using car for both official and personal, car is given by company, expenses are borne by the company, but it is used for both official and personal loan. So personal portion, how much we assume? We assume this much is the benefit of personal portion. Actual expenditure doesn't matter. This is deemed to be the personal portion benefit. Accordingly, this much is taxable. Over. Second part. Suppose car is employee only taking the car. His car only. Car is owned by employee. His car only. Out of his own money he bought. But expenses of the car, running and maintenance, employer, company is bearing. Suppose company is bearing the expenses, no, completely. Suppose if the car is used for complete official, perquisite is 0, 0. Completely personal, actual expenditure. Completely personal, actual expenditure. Sir, for car, a car employee car man, 10% per annum original, that and all don't apply. That when we will apply that point, the company provided the car. Here car is owned by employee. Only expenses we are giving him. Expenses are completely for personal purpose. Car expenses, entire expenses is perquisite. Suppose here official plus personal both are there. Car owned by employee. Employee's car, that is. But expenses are given by company. Maintenance, running, everything. And this car is used for both official and personal. Then look at what is the actual expenditure. Check out. Minus, if the car capacity is less than 1600, 1800 per month you reduce. Suppose if driver is also given 900 per month, you reduce. Balance if any is there. If balance if any is there, this is only perquisite. If balance if any is there, this is only perquisite. Suppose if it is more than 1600, then what is the actual expenditure company spent? Minus 2400 per month you reduce, minus 900 per month. If driver is also given, reduce, balance only perquisite. Over. This is car. Suppose if company, suppose employee is having two-wheeler, company is only giving entire, running and maintenance cost, then actual minus 900 per month, reduce it. Balance is perquisite. That's it. Car is over. Suppose if employee is given two or more than two cars, able to understand? Any one car, we will apply this rule. Remaining cars which company gave, we will treat as if it is for completely personal purpose. That's it. So car related principle is over. Motor car related principle is over. I hope you are getting. Because I need to explain you the things. I'm explaining you. In fact, I'm not just simply reading, opening the book. I'm not reading. Suppose company is giving ESOP shares or sweat equity. So since my employee is working superbly fine, he has contributed a lot, we allotted stock options, or we allotted sweat equity shares, or we allotted preference shares or debentures, some securities we allotted. That recognition for him. Now we allotted shares and securities. No. Whatever the market value of the shares and securities is there, that is the benefit in the hands of employee, and that is taxable. Now you see these many items we are saying taxable. No, that is gross value of perquisite. Suppose we recovered something from employee in return, that you reduce, balance benefit only tax it. Right now whatever I told is benefit valuation. From the benefit value, if employee repaid anything to the employer, reduce that balance only we will tax. That's common sense point. Almost we have discussed many points. Now contribution to ATCCD. Suppose if company is contributing to national pension scheme referred under ATCCD on employee name for future benefit, whatever I contribute, it is treated as salary income under 17 subsection 1, fully taxable in gross salary. Whatever employer contribution is there now, under ATCCD subsection 2, employee can take deduction under ATCCD chapter 6A. In chapter 6A marathon video, it is covered. Check out there. Then finally, suppose if company is giving accommodation facility. How to tax this perquisite? For this, I have a diagram. Just wait a minute. Now you see. So how to value accommodation facility? Suppose If a government employer, if he gave staff quarters or accommodation or bungalow to their employee, getting it, employee and his family and all, they can stay happily in that bungalow. Now they are getting rent-free bungalow, rent-free house. Now, which means employee is getting some benefit. Like, what is the value of the benefit so that we can tax it? How much amount we can tax it? What is the value of the benefit that we can tax it? Very simple. Whatever license fee determined by the government per month, that itself is treated as value of the house per month. Getting it? So this is taxable purpose for government employee. Suppose if the employer is not a government, non-government, and company has their own staff quarters, that quarters is given to employee for his residential purpose, then what is the value of the perquisite so that we can tax it? Suppose we have given accommodation in a city where population is more than 25 lakh, then the value of the perquisite is 15% of salary. Suppose, sir, what is salary? I'll come back, wait. Suppose if the accommodation is given in a city where population is more than 10 lakh but not exceeding 25, then perquisite is 10% of salary. Suppose if accommodation is given in any other city where population is less than 10 lakh, then perquisite value is 7.5% of salary. Suppose no, company don't have own premises. They rented one, they leased one premises. That amount, that premises we gave it to employee for his residential purpose. Means rented accommodation. Then what is the perquisite value? 15% of salary or actual rent, whichever is lower. Suppose company is giving accommodation to employee not in a rented premises but in a hotel, then 24% of salary or actual amount paid to the hotel, whichever is lower, that is the benefit. We are giving house to employee, own house we gave to employee for stay, or rented house we gave him for stay. In that we gave furniture also. Furniture is given, movable asset is given for personal use. What is the perquisite? 10% per annum of the original cost for furniture owned by the company. Or if at all furniture is hired outside, that furniture is given to employee for personal use, rental expenses. So first identify accommodation. So if accommodation is given for employee residential purpose, how to tax? This is the perquisite value. In addition to that, furniture is also given, then this is the perquisite value. Now calculate the perquisite like this. If at all employee repaid company some amount monthly, reduce that. Balance amount benefit only, tax it. Simple. Accommodation provision over. Now what do you mean by salary? Now you see the word salary is used in these many sections while calculating taxable amount. So for accommodation, salary is used. Salary means what? Basic, DA for retirement, any commission, bonus, taxable portion of allowances. So how to apply this definition? I have added a problem also, so you can find out there. Getting it? Basic, DA, any commission, bonus, taxable portion of allowances. Whereas for RPF, in excess of 12% of salary is taxable. HRA, rent paid minus 10% of salary, 40% of salary, 50% of salary. Salary means what? Gratuity, where act is not applicable. 15 by 30, nothing but 1 by 2 into average salary. Means completed years of salary. Salaries means what? Leave encashment. 10 into average salary. Unutilized leave divided by 30 multiplied by average salary. Salary means what? BRS, 3 into completed years of service into salary. Number of months service left multiplied by salary. Salary means what? Basic, DA for retirement, commission, percentage of turnover. Suppose if an employee has received gratuity and he is covered under Gratuity Act. Now 15 by 26 into last drawn salary into completed years of service or part thereof in excess of 6 months. Salary means what? Basic plus any DA. So whatever salary definition that is used in salaries chapter, broadly 3 definitions. For RFA, salary means apply this definition. For these 5 purposes, salary means apply this definition. For gratuity, where Gratuity Act is applicable, apply this salary definition. Be able to understand. Getting it? So that's it. With this, even accommodation facility point is also completed. With this salaries chapter, provisions we have come. Now very simple. Once again, I'll come to the overview. Getting it? So first, in salaries, how to compute. First, you should compute gross salary. How to compute gross salary? First, compute taxable salary under subsection 1. Then compute perquisite values that are taxable. How to compute perquisites? They can be reimbursement or they can be facility. How to compute taxable facility, education facility, medical facility, accommodation facility, car facility, we discussed. If at all, reimbursements fully taxable. Medical reimbursement in government hospital exempt. Medical reimbursement for specified disease, COVID disease exempt. Profit in lieu of salary, VRS, I told. Yes or no? Salary meaning basic, DA, bonus, commission, gratuity, retirement gratuity, exemption we have discussed. Leave encashment on retirement, exemption discussed. Pension on retirement we discussed. Monthly pension fully taxable. So like this, you compute what is gross salary, compute all taxable items. Then from gross salary, we have deductions, 3 deductions, standard deductions up to 50,000. Entertainment elements, deduction for entertainment elements is available only for government employee. First of all, if entertainment elements is there, first we will tax it. Gross salary, we will tax it as part of salary. We will tax it. We have a deduction. 1/5 of basic salary, 5,000 rupees in a year. Actual amount of elements received, whichever is lower, that is deductible. Profession tax paid. If employee is paying profession tax to the state government, whatever amount of profession tax you pay, that you can claim deduction. Suppose if profession tax is paid by employer, first treat it as income from salary under salary definition. Then the amount paid by employee, you will claim deduction under 16 again. So from gross salary, you claim this deduction, then you will get income from salary. In exam, they'll give you entire problem. They may ask you either gross salary or they may ask you income from salary. If gross salary is asked, before deductions, whatever amount is there, that is gross salary. If income from salary or taxable salary they asked, then the net salary, this is the answer. I hope you are clear. Oh my God. Almost 1.5 hours we spent just to revise the content. Okay, in reality, in my regular class, I will be taking 9 hours, 8 to 9 hours on this chapter. Only concept discussion with illustrations. Here I am giving you 1.5 hours and 1 hour problems. Hardly 2.5 hours I am finishing. That's a revision. No, it's a marathon, man. First of all, understand. It's not a detailed regular class. It's a marathon. Still, I have covered all the provisions clearly with explanation and logics. Okay, that's it. Take care, all the very best. With this, salaries is stopped. Provision is over. Now continuation, watch problems. Solving of problem is also important. I told you the provision. Now I'm going to apply the provision in the problems. Some 5 to 6 problems I've given. You just watch these problems. Believe me, you will get complete clarity on the salaries chapter. Remember, salaries weightage is minimum 8 marks to 12 marks or even sometimes 14 marks. That straight question will come. Okay, that's it. Take care. Continue watching the problems. So let's begin with the salaries related amendments for May 24 or even September 24 exams. So in this we have Finance Act 2023 amendments. Of course, we also have supplementary material related amendment. Especially this rent-free accommodation valuation has changed now. Even those of you who followed latest ICM study material applicable for May, you have to go through this particular amendment. So this is very important amendment, no doubt about it. This is going to be tested for sure. I'm thinking so. Hearing it. So rent-free accommodation, the limits, the perquisite valuation rules have been changed. That too, only for own property. If employer is providing a rent-free accommodation or concessional accommodation to an employee, which is owned by employer, but other than a government employer, nothing but a private sector employer, other than a government employer, if at all he is providing rent-free accommodation to an employee, what is the perquisite valuation rule that we already know? It depends. The old rule is what? What is the old limit? If at all the population is more than 25 lakhs in the locality where the accommodation is provided, 15% of the salary. If the population is between 10 to 25 lakh, 10% of salary. If the population is other cases, nothing but 10 lakhs less below 10 lakhs population, 7.5% of the salary. This is the perquisite rule. So no, this much should be the value. So value of perk is equal to 15 or 10 or 7.5% as the case may be. Now these percentages have been modified. Population limit has been modified. Now the population limit is taken as per 2011 census. As per 2011 census, the first category, top category, if the population in a city is more than 40 lakhs, where the accommodation is provided, 10% of the salary is a perquisite value. If the population is provided in a city between 15 to 40 lakhs, 7.5% of the salary. And if it is any other area, 5%. Technically speaking, the perquisite value has been decreased because earlier it is 15, now it is 10. Earlier it is 10, here it is 7.5. Earlier it is 7.5, here it is 5. The value of perquisite has been changed because These limits and all were given in old. These limits and all were given in somewhere in 2005-6 time they drafted. At that time, salary amount is low. So value of accommodation 15% is very high. But now, salary amounts have increased like anything, right? Nowadays, people are having at least 8, 9, 10, 11, 12, 15 lakhs, 20 lakhs, 30 lakhs packages. Yes or no? Salaries have been increased. So accommodation value generally be, the rental expenditure is generally be the 10 to 15% or less than 10 to 15%. On that logic, the percentages have been liberalized. The percentages have been relaxed. Getting it? They reduced it. So now maximum rent-free accommodation per capita value is how much now? 10% of salary. Remember, this is only if the accommodation is owned. What about rented accommodation provided? There is no change. 15% of salary or actual lease rental, whichever is higher. Yes or no? Sorry, whichever is lower. In case of hotel accommodation, if the accommodation is provided in hotel, 24% of salary or actual rent, whichever is lower. All that we know, that exactly same, no changes in that. Only if the accommodation is owned by an employer other than government employer, and if the salary, if the population in that city is more than 40 lakhs, 10% of the salary is a perquisite. If the population is between 15 to 40 lakhs, 7.5%. If the population in any other area, 5%. And this is one amendment. This is one amendment. There is one more big amendment in RFA. There is one more very big amendment in RFA. Cost inflation index, something like capital gains topic has been brought. Many students, they are only thinking about this is the major amendment. This is nothing jujube, percentage change. Nothing big in this. Just 50, instead of 15, 10, instead of 25 lakh, 40 lakh, instead of 10 to 25, 15 to 40, and 10, 7.5, 7.55. This is not a big deal. This is not an amendment according to me. This is not a big deal at all. The big deal is the second. Value of perquisite is restricted to cost inflation index. Generally, how perquisite is valued every year. Suppose 20 to 23 financial year, my salary details, basic salary is this much, DA is this much, commission, various allowances, all that is this much. We have salary definition. We have a salary definition. I explained you rent-free accommodation clearly along with the salary definition, how to compute RFA value in the marathon clearly. Getting it? You can absolutely watch that marathon. Only amended portion you watch this. Enough. Getting it? Because in the main material, this is not amended. This amendment has been given only in the supplementary material. Getting it? Now, salary means what? Basic plus salary means what? Actually, basic plus DA for retirement plus commission percentage of, sorry, it's actually any commission. Basic plus DA for retirement plus any commission plus bonus plus taxable portion of allowances. This is the salary definition which I drafted. Whatever the definition they gave, no, for perquisite valuation, what do you mean by salary? What are the included in salary? What are excluded in the salary? By thoroughly analyzing it, that definition can be drafted as like this. So this logic I clearly covered in the marathon. Go to marathon, income from salary time step. Inside that, you'll find RFA related thing. You just find that. So now, so every year, we have to compute perquisite value based upon the salary figures of the every year. Correct? Now, first year, suppose from previous year 23-24 onwards, or from the year in which accommodation is actually provided to the employee, whichever is later, which means suppose I am working in a company from past 5-6 years. I was given accommodation long back. From 23-24 onwards, accommodation valuation changes. For 23-24, what is your basic salary, DA, all that apply this at 10%, 7.5%, 5% as usual logic. For 23-24 financial year, consider that as a first year, nothing but. Consider that as a first year in which employee got accommodation. Consider 23-24 as the first year for which employee got accommodation. Getting the point? So consider and calculate 10%, 7.5%, 5% as the case may be. Consider, compute, first year accommodation perquisite value. Now 24-25 next year, suppose the employee was given the same accommodation, employee continued to stay in the same accommodation next year also. In the previous year 24-25, how to compute rent, how to compute perquisite value? Generally, how do we compute? In 24-25, basic, how much DA, how much commission, how much bonus, how much, all this we will take and apply 10% or 7.5 or 5. That is the normal rule. But now, for 23-24, you compute perquisite value, right? By taking 10% of salary, 7.5% of salary, 5% of salary, where you take salary various components. For 23-24, you compute, right? 23-24 value, you take it as base year. You take that value as what? Base year. Value in the first previous year. That is actually called as what? First previous year multiplied by. Now 24-25, previous year 24-25. What is the perquisite value for rent-free accommodation? Don't take 24-25 salary figures. Take 23-24 perquisite value. Take 23-24 perquisite value multiplied with CII of 24-25, CII of 23-24, CII of 24-25, CII of cost inflation index of 23-24. Something like indexed cost of acquisition concept is applied here. This change has been brought. What the section says is, like, first I'll read and then again once again I'll give you a detailed explanation. Where the accommodation is owned or taken on lease or rent, whatever it is, doesn't matter. The same accommodation is continued to be provided to the same employee for more than 1 year. The value of perquisite calculated above shall not exceed the amount so calculated for first previous year. Whatever accommodation value you are calculating, it should not exceed first previous year. Multiplied by, look at this, multiplied by amount of which the ratio of CI of the previous year for which you are calculating, and denominator CI of the previous year in which accommodation was initially provided to the employee. You getting the point? So initially when it was provided to the employee, so nothing but first previous year means, so 23-24 or the previous year in which accommodation was provided to the employee, whichever is later. Just a minute. Yes sir. Fine. So once again look at this. So the value of perquisite for subsequent years of the rent-free accommodation, how it shall be calculated? It shall not exceed amount so calculated for first year. First previous year means what? Either 23-24 or the year in which accommodation is actually given to employee, whichever is later. Suppose an employee he is working in the company from long ago, even 23-24 also is working, but he didn't take accommodation facility. 25-26 year he got accommodation facility. 25-26 will be the first year for him. Getting it? If at all I got accommodation from long ago, 23-24 will be the first year. Are you getting it? Nothing but what they are saying is, suppose 23-24, my basic salary is some amount, my DA amount is some amount, a bonus is some amount, various. So rent-free accommodation we calculated. On all this, we applied some 10%. We calculate, let us assume 1,50,000. 1,50,000 is the accommodation value we calculated. Now 23-24 is called as first previous year because you got accommodation earlier, long back. So in the year in which you got accommodation, or 23-24, whichever is later. So that is called as first previous year for the purpose of rent-free accommodation valuation of perquisite. So 1,50,000 is the first previous year. Now 24-25 previous year, 24-25 previous year, I am going to the next year. Next year my basic DA, everything are different numbers. Technically speaking, on this I should apply 10%. No, don't follow like this. The rent-free accommodation value shall not exceed first previous year value multiplied by CI of current year divided by CI of first previous year. This is what they are saying. So previous year value is how much? 1,50,000 multiplied by CI of first previous year is what? 348. CI of 24-25 year might be some 370 something. That number is not yet released. So that will be the value of the perquisite for the next year. That next year, what is the value of perquisite in 26-27? Take same first previous year perquisite value multiplied by 395. Let us assume 27-28 divided by first previous year 348. So that will be the perquisite value in 25-26. 26-27 same index number based, which means first time when we are calculating perquisite value to an employee. First time when we are calculating perquisite value to an employee who was given rent-free accommodation either in the 23-24 or later or before. 23-24 year is the base year for them. If at all already accommodation is provided. Suppose if the employee itself joined the company or employee for the first time got accommodation. Employee got accommodation in 25-26 only for the first time. Then this is the base year for him. Suppose if the employee got accommodation long back. 23-24 is the base year. Are you getting the point? So this is the base year. So this is base year is called as first previous year. And for this employee, base year is called as 25-26 is called as first previous year. So first previous year you calculate by applying 10%, 7.5%, 5% logic, rent-free accommodation value you calculate. You calculate by applying all these percentages. Now, next year, how to calculate? What is the first previous year value? Multiply with CII of the relevant previous year divided by CII of first previous year. First previous year might be 23, 24 or the accommodation where he got, whichever is later. This kind of amendment was brought. I don't think they will test it now this May 24, because for May 24, the problems are generally based upon 23-24 previous year, which means for 23-24 previous year, you generally have to compute. The next previous year, probably for May 25, January 25 exams onwards, they will be testing subsequent year logic. And in fact, I am very clear on this amendment. I got very good clarity on this amendment, but I felt it is better if CBDT gives some guidelines on this. In fact, this formula is derived by me based on the text, whatever I read. This formula is developed by me. Getting it? So something like capital gains concept. So now onwards, rent-free accommodation, every year you need not compute by applying percentage on salary. First time you compute. Next year onwards, remember this CII technique, this cost inflation index technique is same whether it's a own accommodation or leased or rented accommodation also. Even leased or rented accommodation, first year you compute as per perquisite valuation rule. Second year onwards, you have to compute the accommodation value for that employee as per this logic. CBDT, if at all they give a clarification with some examples, it would be good, because now in the supplementary material also, they have not given any details on this. In the supplementary material also, they have not given any details on this. They just mentioned like this. They just mentioned it, as a paragraph. Which I felt very challenging, For government employer, no problem generally. For government employer, no problem. So probably for government employer, license fee, that concept and all is there. For private employers, only this problem is. Now in this amendment, third point, employees serving on deputation. So this is another point which is added, which I have not covered here. You see, that's why I said refer supplementary material for additional points. So in the supplementary material, where accommodation is provided by central government or state government to an employee who is serving on deputation with any body or undertaking under the control of the government. So government is giving accommodation to an employee who is serving with a body corporate or undertaking, some undertaking. The employer of such employee shall be deemed to be the body or undertaking where he is actually serving. Suppose there is a central government employee. Now he is working with Food Corporation of India. Getting it? So though he is a central government employee, now he is working with Food Corporation of India, right? Under deputation, he is treated as Food Corporation of India employee, not government employee. Accordingly, as per 2A, valuation is applicable. As per 2A means, in this diagram, 2A means 10%, 7.5, 5%, that logic. 2A, where accommodation is owned by employer. 2A, this logic is applicable. This table they have given, right? Entire this table is same like old, previous, whatever you have seen in the ICE study material. Only this 2A box changed. Only this is changed. Everything else is same. That's why I'm not covering entire this provision. Why to discuss unnecessarily once again? Only when accommodation is owned by employer and provided to an employee, own accommodation, not a government employer. What is the perquisite valuation rule? We all know it depends upon the population criteria. If it is more than 40 lakhs, 10% of the salary. If it is between 25 to 40 lakh, 15 to 40 lakh, then it is 7.5% of the salary. In any other case, 5% of the salary. That's it. And if at all, along with accommodation, we provided furniture, all that discussion I have clearly discussed in marathon class. Getting it? You watch in that marathon salaries related timestamp, you will clearly understand. At the end of that salaries timestamp, you will find this amendments video, whatever you're watching, you will find this also there. Getting it? That's it. So with this accommodation, major amendment in salaries is completed. I hope you understood this point. I hope you understood this logic. Getting it? If not, just once again, listen to it once again. You will definitely get clarity. Next. And in Finance Act 2023, leave encashment, where there are 4 criteria for leave encashment, right? So one of the criteria is statutory limit 3 lakhs, that is increased to 25 lakh. The maximum exemption for leave encashment is now increased to 25 lakh. Getting it? Then definition of salary under 17 subsection 1 is, definition of salary has been changed. They have added one more clause number 9. Salary definition is there under income from salaries chapter. Inside that 9th clause is added. One of the clause already there is what, contribution by employer to national pension system under 80 CCD subsection 2. contribution by employer, that is treated as first salary. The employee, the same amount employee can claim deduction under 80 CCD subsection 2. Similarly, there is a scheme called Agnipath scheme. Agnipath scheme, more information, in-depth information, I will discuss in chapter 6A related amendments video. So you continue watching, you will find chapter 6A timestamp amendment video. There you will understand. Fine. What is Agnipath scheme? Agnipath scheme is something which is launched in 2022, where the government is giving an opportunity for the youth who are aged between 17 to 22 years, 17 to 22 years. So some age, some 1 or plus or minus 1 year, I'm not sure exactly. So 17 to 21, 22 aged people, you can join in Indian Army and serve for 4 years. How many years? 4 years. Now for these 4 years, no, the government will take care of, some fitment test, everything that and all, health related test and all, everything they do, and they recruit you. Once they recruit you, they will pay every month to you some remuneration. From that remuneration, 30%, approximately 30% you have to contribute to Agnipath scheme. You have to contribute to Agnipath corpus. Getting it? I'll show you. Agniveer corpus fund. So the government has created a fund called Agniveer corpus fund, something like national pension system. So government has created Agniveer corpus fund. Whoever is joining an Agnipath scheme, getting it for 4 years, serving the country, getting it, they'll be getting every month some salary from the government, remuneration from the government, honorarium from the government. On that, whatever you are getting from that, 30% contribute to this. Not only you, central government will give equal contribution how Agniveer is contributing. Agniveer means the person who joined in the scheme is called as Agniveer. The person who joined in this Agnipath scheme is called as Agniveer. Getting it? So Agniveer is nothing but employee of the government now. He is getting salary from the government every month. On that salary, 30% you have to contribute to the Agniveer corpus fund. Equal amount government also will contribute. In this 4 years, so long you are serving the country, you cannot withdraw single rupee. After 4 years, you withdraw, you will get exemption, all that. So that withdrawal, now you are contributing, right? Agniveer is from the salary, whatever is getting, he's contributing to Agniveer corpus fund, right? He will get a chapter 6A deduction. Now government also contributing, right? That also you can claim under chapter 6A. Now, on my name, government is contributing to Agniveer corpus fund. Is it a benefit to me or not? Yes, that is treated as salary. The contribution made by central government in the previous year to Agniveer corpus fund account of an individual who is enrolled in Agnipath scheme, so that is treated as salary. Means first it is taxed as income. Then under chapter 6A deduction, 80 CCH subsection 2, employer contribution, government contribution, you can claim deduction. First it is taxed, then you can claim deduction. Getting it? Agnipath scheme is a central government scheme launched in 2022 for enrollment of Indian youth for 4 years to serve the country. So in pursuance of that, the government want to create a Agniveer corpus fund, a dedicated non-lapsable fund. In that, no fixed percentage of monthly salary would be contributed by Agniveer, and matching amount will also be given by the government, central government. This fund is defined as a fund which is consolidated. This point is not required from exam point of view. Key point. Now you see, central government contribution to Agniveer corpus fund would be treated as salary. First it is taxed. Whatever government is contributing in your name, no, that is first taxed as salary. And not only that, okay, it is treated as salary. You can claim deduction, ma. While computing total income, who is enrolled in Agnipath scheme, being an SSE, a deduction under 80 CCH is allowed in respect of contribution. Getting it? You will get 80 CCH deduction. Whatever amount you contributed, you can claim deduction. 80 CCH. 80 CCH has 2 subsections. 1 subsection 2. 1 Agniveer contribution. Subsection 2. Subsection 2 is what? Central government contribution. And you know, your contribution is the rate. You can claim 80 CCH reduction, but you cannot claim this. You cannot claim this if at all you are choosing 115 BAC. But you can still claim central government employer contribution 80 CC due subsection 2, 80 CCH subsection 2, 80 JJAA. These 3 sections related contributions under chapter 6A you can claim even if you are going with the default tax regime. So deduction under 80 CCH subsection 1 for employee contribution, nothing but Agniveer contribution, is available only if you opt out of the default tax regime, which means you are not choosing default tax regime. And whatever central government is contributing, no, under 80 CCH subsection 2, you can claim irrespective of any regime. And that's it. That's about Agniveer scheme salary definition amendment. 3 amendments I have covered. 1, rent-free accommodation. 2, another amendment which I have covered is definition of salary. 3rd amendment which I have covered is Agnipath scheme. And of course, standard deduction under salaries chapter, you will get 50,000 flat deduction from the gross salary. Whether you are going with the default tax regime or not, doesn't matter. In the old, no, Finance Act 2022, no, standard deduction is not there. But now from 23-24 previous year, from assessment year 24-25 onwards, standard deduction up to 50,000 rupees can be claimed from gross salary, whether or not you are under default tax regime or not. So that's it. A standard deduction will be given. And I showed you already how to compute salaries 115 BAC income to normal provision income. I showed the format already in the ICA material itself, in the DTR, default tax regime. When I'm explaining itself, I clearly showed you. I hope you are confident on salaries related amendments. That's it. Only these amendments, nothing else. So you need not worry. If at all you studied based on Finance Act 2022, you need not worry. If at all you understood these few amendments, 4 amendments, more than enough. Next discussion is house property. So income from house property. So this is not a very complicated chapter, but when a question has been designed exclusively on house property, there were many students who are doing mistakes again on this. Getting it? Of course, in every topic they are doing mistakes, not just 1 or 2 specifically. Especially students do mistakes on pre-construction period interest computation and gross annual value. In fact, only these two, one is interest on loan and gross annual value. Only these are the 2 things. If you learned correctly these 2, house property chapter is over. And we all know charging section is 22. Annual value of any property consisting of building or land attached thereto for which SSE is the owner is chargeable tax under house property. If the building is used for SSE own business or profession, then that is not liable. If the SSE business itself is letting out the properties, then also the property is not liable for business. I mean, not liable for house property provision. And here in house property, what is taxable is annual value is taxable, not rent receipt. Now, what do you mean by annual value? Section 23 subsection 1 talks about that. Now, what do you mean by annual value? So, to compute annual value, we have simple 3 steps. Step number 1, step number 2, step number 3. Very simple. Step number 3, step 1 or step 2, whichever is higher. Getting it? In step number 3, there are 2 cases. Case number 1 is step 1 or step 2, whichever is higher. Case 2, gross annual value, or else let me do one thing. So fine, let us come in the proper order, better. Okay, now what is step number 1? Identify expected rent. First you have to compute what? Expected rent. Expected rent is computed for the period of ownership. For how many months you are the owner of the property, for that many months it will be computed. Generally, we will be owner for the entire 12 months in the previous year. Suppose if we purchase the property in this year only, the property came into existence. The property came into existence only on so and so date. Let us assume the property construction is completed on 30th June, which means property came into existence from 1st July 2022. In this case, expected rent will be computed only for 9 months. Annual value will be computed only for 9 months. Annual value means what? Value for per annum. From this property, per annum, how much value we can expect? What is the value of this property per annum? Per annum value, nothing but. Now, per annum means what? Annual, when we calculate full per annum, when we are the owner for entire 12 months. First year, when you completed the construction or when you purchased the property, you are owner not for the 12 months. See, if you purchase the property on 1st April itself, or if you construct the property, construction is completed as on 1st April itself, then 12 months you are the owner. For 12 months, annual value will be computed. Suppose if the property came into existence only on 1st July, 9 months only you will compute annual value. If the property came into existence only on 1st November, 5 months only you compute annual value. So you need to remember this point. In the exam, suppose we are doing answer for previous year 22-23. So in this year, if at all property was acquired, in this year only construction was completed, keep a note, annual value you should not compute for 12 months. You should only compute from the date of coming into existence till 31st March. Later on onwards, full year. So that's it. So expected rent is computed for the period of ownership. Number of months, whatever your owner in that year, for that many months, provided the property is in existence. Now, how to compute this annual value? The annual value computation is very simple. Getting it, pay rent or similar property rent whichever is higher. Fair rent or similar property rent, whichever is higher. So which is restricted to standard rent, which is restricted to standard rent. Suppose if fair rent is 10,000 per month, similar property rent is 15,000. So whichever is higher, 15. But as per Rent Control Act, you cannot expect more than 12,000 per month rent. If you try to charge more than 12,000, they will punish you. So maximum how much you can expect? You can expect only that much permitted in law. So expected rent is equal to 12,000 per month. Let us assume SSE is owner for entire 12 months. Entire 12 months property is there. So expected rent is 1,44,000. Are you clear? Now step 2. Compute actual rent received. Compute actual rent received. How to compute this actual rent received? Very simple. First identify how much is receivable minus how much is unrealized rent. There is a rule called rule number 4. As per that, some conditions were there. Then only you can reduce this unrealized rent. Then what you will receive is called as actual rent received. Now here received means accrual basis only, not cash basis. Getting it? Now receivable means what? Suppose I rented this property for 9 months only. Only 9 months a tenant stayed. For this 9 months, I rented this property at 15,000 per month. So 15 into 9, what is the amount? So 1,35,000 is the amount that I have to receive. Out of this 9 months, 1 month rent tenant did not pay. 1 month rent tenant did not pay. 15,000 rupees amount out of this 9 months. Remaining 12 months, 3 months property is vacant. Let us assume 3 months is 3 months property is vacant, or 3 months I am only staying. Let us assume I am only staying. Let us not discuss vacancy right now. 3 months I am only staying. 9 months I rented. For 9 months, 15,000 is the rent which I charged. 1,35,000. 15,000 rupees rent tenant did not give me. I filed a case against him. It's a bona fide. Tenancy is a bona fide. It's a genuine tenancy contract. Getting it? And I filed a case. I am trying to recover all the steps. I'm taking all the steps to recover the rent. Getting the point? And I made him vacate the property immediately. Everything is done. So this 15,000 I can reduce. So what is the actual rent received? 1,20,000. Now step number 3. Step number 3. Case number 1. Now by the way, here step 1 is higher. Step 2 is lower. Getting the point? Now generally in step number 3, this is where many students do. Generally, what is gross annual value? Step 1 or step 2, whichever is higher. This is general rule. Suppose, remember, if at all step number 2, the answer is less than step 1. If step 2 our value is less than step 1, then you should check one more point. Is the property vacant during the year? In our example, 3 months owner stayed, 9 months tenant stayed. Which means entire 12 months somebody is occupying. The property is not empty. Therefore, you need not worry about other exception. You can straight away say step 1 or step 2, whichever is higher, gross annual value is equal to 1,44,000. Getting the point? See, if at all, here step 2 is 1,50,000. Let us assume. If at all step 2 is 1,50,000, you need not even think about anything. Step 1 or step 2, whichever is higher. Suppose if step 2 actual rent received is less than step 1, then you should check, is there a vacancy? If at all there is no vacancy, no need to worry. Step 1 or step 2, whichever is higher. If there is a vacancy, suppose, let us assume. Now you understood, right? Case number 1. Suppose no. I told, right, 9 months tenant stayed, 3 months I stayed. Let us assume 3 months the property is vacant. Even I am also not staying. 3 months the property is vacant. It's empty, unoccupied for 3 months. Getting the point? Now look at case number 2. Now by the way, step number 1 computation is same, 1,44,000. Step number 2 computation is same logic. No changes in step 1, step 2. Whether vacancy is there or vacancy is not, doesn't matter. Getting it? Step number 1, we compute generally for 12 months. Step number 2, whatever actual period tenant has stayed for that many months multiplied by actual rent per month is equal to so and so minus unrealized rent is equal to actual rent received. Getting it? Now the answer for step 2 we got, and step 2 answer is lesser than step 1. In step 2 the answer is 120, whereas step 1 144. It is less than step 1, and 3 months property is vacant. Even after vacancy, the actual rent is 1,20,000. Now you need to see, is step 2 less than step 1? Yes. Is there vacancy for 3 months? Yes. What if? Suppose, what is step 2 value? 120. What if there is no vacancy? What if the 3 months also you have rented? What if the 3 months also tenant stayed? Example, another 45,000 I will be receiving. So my step 2 would have been 1,65,000. If at all the 3 months property is not vacant, if at all the 3 months not vacant, I received already 120. Another 15,000 for each month for 3 months, I will receive 45, making it 1,65,000, which is higher than step 1. If at all vacancy is not there, if somebody stayed, if tenant has stayed, getting it, my step 2 actual rent would have been higher than step 1. But now tell me, my step 2 answer is lesser amount, right? 1,20,000, where step 1 is 144. My step 2 is less than step 1, right? Why it is less than step 1? Because 3 months property is empty. Because of vacancy, my step 2 actual rent is less than step 1. If there is no vacancy, my actual rent could have been 165. My expected actual rent would have been 165. But because of vacancy, it is less than step 1. Therefore, the section as per case 2, step 2 is only treated as gross annual value. What is step 2 answer? We already computed. 1,20,000 would be treated as gross annual value. That's it. Generally, case 1 we apply. Step 1 or step 2, whichever is higher. Case 2, check out once. Is the step 2 value less than step 1 value? Yes. Is the property vacant for certain number of months in this year? 1 month or 2 months, whatever? Yes, it is vacant for 3 months. If at all there is no vacancy, how much step 2 answer could be check out? Yes, calculated what? 1,65,000. Now step 2 answer, no, without vacancy, is it higher than step 1? Yes, it is higher than step 1. Therefore, your actual step 2 answer 1,20,000, no, it's less than step 1 expected rent because of the vacancy, which means gross annual value is equal to actual rent only. Indirectly, department is saying, suppose you kept the property for rent, nobody is coming and staying. In such a case, we will take actual rent only for taxability purpose. That's it. Original logic of department is what? Expected rent only we will calculate. Whether you really renting it or not doesn't matter. The annual value we will tax. But if at all you are renting it, but nobody is coming and staying, in such a case, what you will do? And you are keeping the property idle, vacant. What you can do? Actual rent is less than expected rent. If at all there is no vacancy, actual rent could have been higher. I would have taxed happily on actual rent only. But now since the property is vacant, actual rent is less than expected. Therefore, gross annual value is equal to actual rent. Over. This is one important discussion in house property chapter. Are you clear? Now you know. So this is regarding this gross annual value discussion. I hope you understood. Gross annual value. Now once you compute this, in our example, it can be 1,20,000 or it can be 1,44,000 depending upon the case applicable. Compute. Now in the question they will give you municipal taxes paid information. Paid during the year. Municipal taxes accrued, no deduction. Municipal taxes paid, you will get deduction. Municipal taxes paid in this year only, but belonging to last year or that last year, still deduction you will get. You will get deduction for municipal taxes on cash basis, payment basis. In such a case, to which year it relates to, we don't even look at. Even municipal taxes paid for outside India, for property outside India, that will also be eligible for deduction. Suppose you are a resident and ordinarily resident, you are having house property outside India, still that is accessible for income tax. Now you will get from GAV, if I reduce municipal taxes, what you get is called as net annual value. What is it called as? Net annual value. Now there is a provision. There is a provision called 23 subsection 2. What this provision says is, the SSE at his option, for any two houses where the SSE is staying completely or the house was completely vacant throughout the year, means unoccupied property or self-occupied property, SSE or his family members are staying in that house. So if the SSE at his option, getting it, for two houses which are either self-occupied or unoccupied, both are self-occupied, both are unoccupied, doesn't matter. For any two house properties owned by the SSE, NAV can be taken as 0. For any two houses owned by the SSE, the NAV can be taken as what? 0. Now, by the way, that's about self-occupied property, unoccupied property. Again, I will come back to that discussion later. Now, 23 subsection 2 is what? Talking about this particular exemption. Any two house properties which are used for self-occupation, my own residence, I am only staying, I am not renting, I am not getting any income. Okay, NAV is equal to 0. We don't tax it for house property. Don't worry. Unoccupied. I want to rent it, but throughout the 12 months, nobody stayed. Rent received is zero, completely unoccupied. I did not get any benefit from that property at all. NAV is equal to 0. Now, NAV is equal to 0 can be claimed for how many properties in a year? 2 properties. Suppose I'm having 5 houses. And all the 5 houses I'm using it for my personal residence. So I have a house in Guntur, I have a house in Hyderabad, I have a house in Chennai. Let's say I have a house in Bangalore. Getting it? I'm having a house in Mumbai. And can I claim all 5 houses NAV is equal to 0? No. Any 2 houses you claim NAV is equal to 0. For remaining 3, you didn't rent. I know you did not rent it. I know. But expected rent is there now. That itself is gross annual value for remaining 3. We will treat it as deemed let out property. What is it? Deemed let out. So 23 subsection 4. That is what deemed let out property concept. I will come back to it and then discuss. Getting it? So NAV is equal to 0 for any 2 houses. Fine. Anyhow, suppose it is not self-occupied or it is not unoccupied. It is something I rented. So GAV I have computed, municipal taxes I reduced, NAV. Now what is the next step to compute income from house property? 2 deductions you have. 30% of NAV flat. Whatever here amount is there now, on that 30% flat amount you apply. 30% is simple calculation. Why, sir? Whether you take repair for the property, insurance for the property, whitewashing, painting, whatever you do, doesn't matter. How much you spent, it doesn't matter. If you did not spend single rupee also, doesn't matter. On the net annual value, 30% we will give for expenses, maintenance expenses, repairs and maintenance, 30%. This is a flat deduction. Then another deduction is interest on loan. Another deduction is what? Interest on loan borrowed. Getting it? Now, to buy this property, to construct this property, you borrowed some loan. On that loan, you are paying interest. You are incurring interest expenditure. Whatever interest you are incurring, that also you can claim deduction. Now, once these 2 deductions you reduce, the final figure is what called as income from house property. Suppose if the final figure is negative, then we call it as loss from house property. Remember, if at all this house property is a self-occupied property, unoccupied property, where NAV is equal to 0, any loss because of interest, you cannot claim deduction if at all you are choosing 115 BAC. If you go for optional tax regime, interest on housing loan for a self-occupied or unoccupied property where NAV is equal to 0 you have taken, no, you cannot claim. You clear? Fine. Now, what is interest on loan? How to compute this interest on loan? Under house property, interest on loan is broadly classified into 2 categories. Pre-construction period interest, current year interest, nothing but relevant to previous year interest. Whatever the year for which you are doing the problem, for that year, for that financial year, whatever the year you are doing problem, for that year, whatever interest expenditure incurred, accrued. Remember, interest on loan is deductible on accrual basis. How much you incur, that's enough. How much interest you actually pay doesn't matter. Getting it? Current year interest or relevant to previous year interest or interest expenditure incurred during relevant to previous year, we call it as current year interest. Interest expenditure incurred before, first of all, what is PCP interest? Interest incurred during pre-construction period. What is pre-construction period? From the date of borrowal, till end of previous year, preceding year of acquisition or year of construction. Generally, PCP word comes generally in construction cases. Year of from borrowal date till end of the previous year, means 31st March of so and so date. Preceding which year? Preceding year of completion of construction. Year of completion of construction. Very simple. Suppose we completed construction on 30th June 2022. This year only. Property came into existence on 1st July 2022 onwards. It came into existence. So for 9 months we compute gross annual value. All that is fine. Now completion is when? 30th June. Now 30th June 2022 comes under which year? 22-23. For this preceding year is what? 21-22. Preceding year end means what? 31st March 2022. Now when the loan was borrowed? The loan was borrowed on 1st August 2020. So from the date of borrowal of the loan till 31st March 2022. In this case, 31st March 2022 is what? It is end of a particular year. End of a particular previous year. End of 21-22. Preceding year of completion of construction. 22-23 is the year in which the construction is completed. Suppose you were born in 2001, somewhere in the July. So which year you were born? 2001. You will simply say I am 2001 born. So date of construction completion is 30th June 2022, means in which financial year construction is completed? 22-23. Preceding year is what? 21-22. For that end date is what? 31st March. This is pre-construction period definition. From the date of borrower of loan till the end of the previous year, preceding year of completion of construction. Suppose if I borrow the loan, if the date of borrower of loan and construction completion both are in the same previous year, pre-construction period logic will not apply. Okay sir, fine. So up to 31st March, whatever amount, whatever loan, whatever interest expenditure is there, this entire period we call it as pre-construction period interest, sir. Fine. So what should I do? This interest we can claim deduction in 5 installments. This interest we can claim deduction from house property income computation in 5 installments. First installment, year of construction. In our example, 22-23 you can claim. Second installment, 23-24. Third installments, 24-25. Fourth installment, 25-26. Fifth installment, 26-27. Fine, very good. Sir, in 22-23 I am computing, right? In this year also loan is outstanding, sir. In this year also I am incurring interest, sir. What about that? That interest, we call it as relevant previous year interest. So from 22-23, because in this example, 22-23 is which year? 22-23 is year of construction. From year of completion of construction, for that year, whatever interest expenditure is there, in this year you compute income from house property, right? You can claim deduction that interest. So total interest is how much? 1/5 of PCPI installment plus relevant previous year, nothing but current year interest, So these two put together we call it as total interest. This interest you can claim deduction here. Now 30% of NAV, this interest put together is total. Now final figure what you get is income from house property or loss from house property. And you know what? Interest on loan, no. Suppose if I straight away take NAV is equal to 0, in case if at all I am claiming SOP benefit, because the property is not at all occupied by anybody. I did not get single rupee benefit from this property. NAV is equal to 0. And or this is unoccupied property is equal to 0. If NAV is equal to 0, 30% of NAV is 0. Only one deduction you will get, that is interest on loan. When NAV is equal to 0, benefit is given by department. Interest on loan, whatever you get, you cannot claim. There is a limit. If the NAV is equal to 0 is claimed straight away because it is a self-occupied property or unoccupied property. Getting it? Where annual value is taken as 0 because it is self-occupied or unoccupied for two properties. On this, interest on loan is deductible maximum of 2 lakh. What is it? What is the maximum interest deduction? Sir, 1/5 of PCPI is some 50,000 rupees, sir. And current year interest is some 3 lakh rupees, sir. Total interest is 3 lakh 50, sir. Still, maximum deduction is 2 lakhs. Why? NAV is equal to 0. Why NAV is equal to 0? Because it's a self-occupied property, unoccupied property. Now fine, sir. Maximum deduction is how much? 2 lakhs only. Remember, this 2 lakhs limit is per SSE, not per house property. It is per SSE. An SSE maximum deduction for self-occupied, unoccupied property put together, maximum deduction is 2 lakhs. Suppose if you are having one house, maximum deduction for that one house where NAV is equal to 0 is 2 lakhs. If you are having two houses, both the houses put together, total interest deduction cannot exceed 2 lakhs. If at all, both the houses NAV is equal to 0. Suppose if for a particular property, DAV we computed, minus municipal taxes we reduced, then NAV we computed. It may be 0 or may not be 0, doesn't matter. But you computed gross annual value. Straight away NAV is equal to not 0. When straight away NAV is equal to 0, if it is self-occupied or unoccupied, straight away you start with NAV is equal to 0 value. If it is gross annual value, you computed minus municipal taxes paid, then you got NAV is equal to 0. There, this logic and all will not apply. Restriction of 2 lakhs will be applicable when straight away when you compute NAV is equal to 0. When we straight away compute NAV is equal to 0, where we do not compute gross annual value, when if the property is self-occupied or unoccupied. Now, so maximum deduction is what? 2 lakhs. This is per SSC. Remember, this is not per property. This is per SSC. The maximum deduction for self-occupied property or unoccupied property put together for a single SSC, for 2 houses put together, cannot exceed 2 lakh rupee. That too, conditions were there. Loan borrowed after 1/4/1999. Loan borrowed for construction or purchase. The property construction or purchase must complete within 5 years from the end of the year in which loan was borrowed. When you borrowed the loan, year, end date you see. From that date, within 5 years, property acquisition should complete. Within 5 years, construction should complete. Then only the maximum interest will be 2 lakhs deduction per year. Per year. It is for every year. Now, by the way, from when I will claim deduction for interest, first of all, can I claim interest deduction during construction period? No. You can claim interest deduction only from the year in which you compute income from house property. From which year I will compute income from house property? From the year in which you completed the construction. From that year only you can compute income from house property. What about during the construction period interest? That is what PCP, no. You will claim deduction from which year? From year of construction you can claim deduction. That too in how many installments? 5 installments. Now, there is another limit, 30,000 only maximum limit, not even 2 lakhs. When, if any of these conditions are not satisfied, if the loan is borrowed before 1/4/1999, maximum interest is 30,000 rupees. If the loan is borrowed for repairs, maintenance, renovation, not for purchase or construction, maximum deduction is 30,000. If the property purchase or construction is not completed within 5 years, after 5 years only you completed, then also maximum deduction is 30,000 rupees. This is interest on loan point. I hope every one of you are clear. Got it? That's it. So this is interest on loan. Suppose if the property is a let out property where we computed gross annual value, some amount is there for gross annual value. Now in that case, interest on loan how much? 1/5 of PCPA how much? Plus current year interest how much? Whatever actual amount is there, that much you can claim. No limit of 2 lakhs, no limit of 30. Limit of 2 lakh, limit of 30 per SSE. These limits applicable only when the property is self-occupied, unoccupied, and NAV is equal to 0 benefit, you claim. Suppose I'm having 4 houses. I'm having, let's assume 3 house properties. I'm having 3 house properties. And I'm saying all the 3 were self-occupied. I'm only saying actually true. I'm not renting it at all. But any 2 house properties only, NAV is equal to 0. For these 2 houses put together, maximum interest you can claim deduction is 2 lakh if 3 conditions are satisfied. Otherwise, 30,000 is a maximum interest deduction. Interest deduction is equal to 1/5 of PCPI plus current year interest. Now, what about one balance house property? For 2 only we will give that benefit. For remaining 1 house property, we assume it as let out. We treat it as let out. We deem it as let out. Deemed let out property. If it is deemed let out, how to compute gross annual value? Step 1, I will compute expected rent. Step 2, actual rent is not there. Nah. Step 2 and all no need to compute. Expected rent is there. No, step 1, that itself is gross annual value for deemed let out property. Now for a deemed let out property, gross annual value you computed, which means NAV is equal to not 0. You computed gross annual value. You did not start straight away NAV is equal to 0. You computed GAV minus municipal taxes paid is equal to some NAV is there, or it may be 0, doesn't matter. Getting it? You computed GAV first of all. If you compute GAV, interest on deemed let out property, how much interest on loan related to deemed let out property you can claim deduction? Any amount, no limit at all. Whatever interest expenditure is there, 1/5 of PCPA plus current year interest, whatever is there, that much, whatever actual amount comes, you can claim deduction. Now, fine. We understood how to compute GAV, we understood how to compute interest on loan, all that. Now here, let us assume there is a loss. There is a loss of 3 lakh rupee. First of all, if it is a self-occupied or unoccupied property put together, for 2 houses put together, maximum loss cannot exceed 2 lakh. Because maximum reduction is what? 2 lakh. NAV is equal to 0, maximum reduction 2 lakh. So maximum loss is also 2 lakh in case of SOP or UOP, unoccupied property. Unoccupied property means what? In the same city, you are not staying. And in that city, you have a house which is rented, but nobody stayed, nobody occupied. That's an unoccupied property. Right. For a let out property, the loss can be more than 2. The loss can be, suppose interest on loan can be 7 lakhs, whereas net annual value is 3 lakh. 3 lakh minus 7, net annual value is some 5 lakh. Municipal tax is 2 lakh. So 5 lakh minus 2 lakh minus 7 lakh. So 5 minus 9. 4 lakhs loss can be possible for let out property or deemed let out property. 4 lakhs loss is there. Now what you can do with this loss? Set off with other heads. How much? Maximum 2 lakhs only you set off loss from house property with other heads of income. Loss under the head house property can be set off with other heads of income subject to maximum of 2 lakh. The restriction is clearly mentioned in section 71, inter head set off. So with this, I can say deemed let out property point is completed, let out property GAV computation is completed, all that. Now you might have some cases. Sir, house property is there, sir. For 6 months we stayed. For 6 months, tenant stayed, sir. Part of your let out, part of your self-occupied. No, that and all, no need to even think. Is it rented for, is it rented even for 1 month? Rented, sir. Compute GAV. How to compute GAV? Expected rent. Step 2, actual rent for how many months rented into so and so. Step 3, which case number 1, step 1 or step 2, whichever is higher. Case number 2, if step 2 is less than step 1, there is a vacancy. Because of vacancy, step 2 is less than step 1. Then step 2 is GAV. Simple logic. How many months you stayed, how many months tenants, that and all irrelevant. Is it rented for even 1 month? Yes, compute GAV. Sir, I have a property, sir. It has 2 floors. 1 floor I am staying, 1 floor tenant is staying. Then split and compute. For 50% or 40%, whatever, 1 floor, whatever the proportion they'll give you, for that proportion you compute. Simple. For self-occupied or unoccupied portion, NA visible to 0. Interest expenditure claim for only self-occupied portion. For let out portion, allocate interest. For self-occupied portion, when you are allocating interest, no limit you check 2 lakhs and all that. 30,000, 2 lakh, all that limits you have to check. Clear. Now there are some concepts called 26 and 27, co-ownership and deemed ownership. So in house property, whether you are actual owner or even deemed owner, it is taxable. Suppose you transferred house property for inadequate consideration or without consideration to spouse. Spouse is a owner, but still annual value will be computed in your hands. Suppose if the transfer is happened because of living in part separately, getting the point, or you transferred it for adequate consideration, then deemed owner concept will not apply. If you transfer house property to minor child, not minor married daughter, you transfer to minor child without consideration, you are deemed owner and house property income will be computed in your hand. Suppose you transfer to minor married daughter, so house property 27, clubbing 27 will not apply, but clubbing 64 1 year will apply. Getting it? That's it. So with this, house property is completely done. I think all the points I've covered. One more point is that 23 subsection 5. There is a point on 23 subsection 5. Suppose I'm a real estate person. I constructed a very big project. In that project, no, some 100 flats I sold. Still 100 flats were there. I am not involved in renting. I am not involved in let out business. And these 100 flats, I am not using it for my business. I am keeping it for selling. Now, should I compute annual value? Yes. You have to compute annual value in respect of house property building, even though you are holding a stock in trade. However, for 2 years from the end of the year in which you got completion certificate, right? End date you find out. From that date, 2 years. For 2 years, annual value of these properties can be 0. Once 2 years over, you have to calculate annual value and pay tax on the stock in trade, even though pay tax on that building, even though it is a stock in trade. Compute income from house property. Now remember, these 2 years benefit is given when, in these 2 years you should not rent these flats. By the way, they were just kept as stock in trade. You are waiting for selling it. If at all within these 2 years you are renting it, the moment you rent, it's a house property income taxable again. You should not rent it. They were idle, just you are waiting to sell them. 2 years time period is given. Okay, within 2 years you sell it. If you are unable to sell it, we assume that you are holding it for house property income and we tax it under house property tax. So that is what 23.5. So for 2 years, for a builder, for a construction developers, getting real estate dealers, for 2 years, the house property buildings which are owned by them as stock in trade, for them annual value will be 0 for 2 years. Provided they are not renting it at all. If at all they are renting it, this exemption will not apply. We will calculate annual value. How to calculate annual value? Step 1, step 2, step 3, same logic. This house property chapter is over. I hope I have covered all the points, confusing points. Clearly I have given you explanation. Remember, 2 lakhs limit, 30,000 limit is only for self-occupied, unoccupied, where you straight away took NA is equal to 0. Like that, you can claim this benefit for how many properties? 2 properties. Either they should be completely vacant throughout the 12 months or you must be occupying them. You are not renting, simply speaking. You are not getting any benefit from them. If at all you are getting any benefit from them, monetarily or non-monetarily, that's it. annual value will be applicable. 23 subsection 1, you have to compute annual value. Got it? That's it. This house property is over. The next chapter, either I will start PGBP or capital gain, something I'll upload. This is part number 5. So the next part I will upload part number 6, which is either PGBP or capital gain, something. Okay. So on 7th November, I'll upload this. So right now it is 6th November, almost night 10:40. I'm doing this recording. Okay. Tomorrow morning, 7th November, I will upload. 8th is exam, right, for you. That's it. I'll upload on 7th. Okay. By 7th afternoon, 2 or 3 o'clock, I will be finishing PGBP capital gains. Already some 10 days, 15 days back itself, I have already uploaded clubbing, setup, carry forward, chapter 6, all that. But once again, tomorrow I'll upload. Once again in the afternoon session, I'll upload all of them. Take care. So the amendment under Finance Act 2023 related to house properties, actually zero, no amendment at all. It's only 115 BSc clarification. I just want to remind you. That's why I kept in this amendments material. So what is this? If at all you're choosing 115 BSc for a self-occupied property or unoccupied property where you are declaring NAV is equal to 0. So for that property, you cannot claim interest on loan deduction. If at all you are planning to declare your income under 115 BSc. Just a minute. So if at all you are planning to declare under default tax resident, you can't claim interest. Suppose if at all you are having let out property or deemed let out property, if at all you are having a let out property or deemed let out property, you can claim interest deduction and all. But if at all the result of the deduction is a house property loss, you cannot set off this loss with other heads of income. So with respect to house property, 115 BSc impacts only with respect to claiming of interest deduction for SOP unoccupied, setting off of house property loss with other heads. So if at all you're having 115 BSc, if at all you're declaring income under 115 BSc, if at all you're not exercising the option of shifting out of the default tax regime, your house property loss cannot be set off with other heads of income. And for self-occupied and unoccupied property, you can't even claim deduction for interest itself. So let's start PGBP revision marathon. So the sections that are involved in PGBP will be 28 to 44 series. These are the sections which we have. Now, in this, all the sections are classified into few categories. Like there are two sections like 28 and 41 which are dealing with incomes and charging section. 28 is charging section. Anyhow, the charging section is talking about what incomes are taxable under PGBP. So I call it as income section. 41. This is also talking about income related. What are the incomes that are taxable under PGBP? It's in fact called as deemed profits. Getting it? So these two sections deal with income. 29, it is talking about computation format. So how to compute income under PGBP? That's it. Literally speaking, this is a very useless section. Next, 30 to 37. Now see how to compute business income. Income minus expenses. Business income minus business expenditure is equal to business profit. So what is the head of income? Income from business or profession, also called as PGBP, profits and gains from business or profession. So how to compute profit of a business? Income minus expense is equal to profit. So incomes are these sections. What about expenses? What about expenses? 30 to 37. So section 32, section 37, these sections talk about expenses. These expenses, what we should do? We should reduce. We can deduct from these incomes to arrive business profit income. That's it. Okay. Now, to claim these deductions, to get these deductions, there are some conditions, there are some disallowances. So the conditions are discussed under section 40 to 43B. People call it as disallowance sections, but I call it as conditions for deductions. In order to claim these deductions, there are some conditions. Example, everyone knows 40A subsection 3. Now, suppose I incurred some expenditure. I am paying salary to my employee. Section 37, salary is covered under 37, residuary item. I am paying salary. I paid to employee salary more than 10,000 in cash. 40A3 says it will not be allowed as deduction. So indirectly 40A3 says what? If any expenditure you want to pay more than 10,000 in cash, you must pay by other than cash. If at all you are paying any expenditure more than 10,000, you must pay by other than cash. Permitted electronic mode, account pay, that. So nothing but these 40 series sections, they are talking about conditions for getting these deductions. If you do not comply with these conditions, disallowance will attract. Disallowance means what? We will not give deduction. If at all you reduce a deduction, you claim a deduction, we disallow it, we add back it. Getting the point? Now 44AA, 44AB. AA and AB. I just simply wrote AB because of the space. It's actually 44 AA, 44 AB. They're talking about books of accounts and audit. Then 44 AD, 44 ADA, 44 AE. These are talking about presumptive taxation. So these are the broad sections that we have in PGBP. Now, what we are going to discuss now in this revision, we are specifically going to discuss the concept of depreciation, scientific research, 35 AD specified businesses and disallowances, and 44 series. Now you might have a doubt, sir, what about 41 deemed profit? I will be discussing along with the depreciation certain provisions of deemed profits already, and I will be discussing along with 35 one subsection of deemed profit. So don't worry, remaining sections also will be covered slightly along while we are discussing all this. So all disallowances, 40 series all I'm covering, 44 series complete I'm covering. Only in deductions, only 3 or 4 sections I am focusing. That's it. Now, without any late, so let's start depreciation. Now, section 32 is the section talking about depreciation. Remember, when you're listening to this video, I will also cover how you have to compute how you have to solve the problems. I will explain you the solving methodology. I will not solve any problem, but I'll explain you how to solve. Getting it? And there is a detailed video of me on concept of disallowances, which I uploaded some 1 month ago. Getting it? So you can watch that if at all you want to have full-fledged clarity on what do you mean by disallowance exactly. But anyhow, here I will be covering briefly. Now, 32, depreciation. You know, in income tax, we claim depreciation on block of asset approach. What is it? We claim depreciation on block of asset approach. First of all, there are two conditions. There are two conditions in order to claim depreciation. As on 31st March of the relevant previous year, whatever the year for which you want to compute depreciation, no, as on the date, block shall exist. Block shall exist means as on 31st March. Suppose right now in exam they are testing you on 22-23 previous year. As on 31st March 2023, block must exist. Block means what? Some asset in that block should exist. What is block? I will come back to it. So there must be at least one asset in the block. Block should exist, and there should be WDV for the block. There should be written down value of the block. So the value, written down value of the block should also be existing. In fact, I call it as not written down value. I call it as value for depreciation. What is it called as? Value for depreciation must exist. In order to calculate depreciation, there must be some value. So that value should also be there in the block. So value should be there, block, asset should be there. If both these conditions are satisfied, then you can calculate depreciation. If any of these conditions fails, entire block is not there. Opening date of the year, block is there. But by 31st March, block itself is not there. Entire assets in the block were transferred, which means short-term capital gain or short-term capital loss will apply. Suppose block is there, but value is not there. Then also you cannot calculate depreciation. In both the cases, section 50 will apply. If value is 0 or value is going to be negative, then depreciation will not apply. Section 50 capital gains will apply. If block itself is not there, section 32 will not apply. Section 50 capital gains will apply. And in the capital gains, part 1 video of the marathon, getting a revision, so which I have already uploaded, in that you will find how to calculate capital gains on depreciable assets. There I told once again all these points. Now, what do you mean by block of asset? If one or more assets which are used in your business, you are using many assets, right? Not stock in trade, not livestock. Getting the point? Normal assets, tangible, touchable, all that. Getting it? Intangible also, fine. So one or more assets, any assets, like I have a laptop, phone, all that, air conditioner, whatever. So all these assets which you are using in the business, one or more assets, falling under same category, carrying same rate of depreciation. One or more assets which are coming under same category and also having same rate of depreciation. These can be grouped into a single block. Now, what do you mean by category? In income tax, we have totally 4 categories. 1, intangibles. 2, buildings. 3, furniture. 4, plant and machinery. There are only 4 categories of assets. Under income tax, any asset you buy, you bought a mobile, it's classified as plant and machinery. You bought some computer, it's a plant and machinery. You purchased books, research related books. A lawyer purchased research related books. For him, what is the books consist of? In income tax, we call them as plant and machinery. You constructed road, it's a plant and machinery. Very simple. Now, you constructed a building, it's a building. Furniture means furniture. Getting it? Sorry, roads and all comes under building. All immovable structures, they come under buildings category. Getting the point? So mobiles, laptops, mic sets, touchpads, iPad, air conditioners, all that, books, that and all comes under plant and machinery. If you purchase a vehicle, car, that is also plant and machinery only. So 4 categories. In income tax, assets are broadly classified into 4 categories. Getting it? So immovable properties comes under building. Decorative items and all comes under furniture. Any other item which is not an intangible, which is not a building, which is not a furniture, any other item you purchase, it's a plant and machinery. Now, asset falling under the same category, carrying same rate, they come under, single block. Now, I will show you how many blocks were there. I will show you rates of depreciation. Getting it? Now, you see, here they have given, this is there in the ICA metal itself, you ignore this. This block numbering is wrong, absolutely wrong. Now, you see, what are all buildings? So, these are the rates which are important to remember. Getting it? Buildings which are used for residential purpose, the rate of depreciation is 5%. Buildings which are normal buildings, office buildings, 10%. Now suppose BSNL is there. BSNL purchased one building for work purpose, office purpose. So rate of depreciation is 10%. BSNL purchased another building for employee staff quarters, residential purpose. On the depreciation is 5%. Now here 2 blocks were there. One block is buildings coming under category buildings. Getting it? Carrying rate of depreciation 5%. That's block number 1. Another building they purchased for office, but it is not same block. It's a different block. Why? Rate of depreciation is 10%. So these 2 rates important. Suppose if I purchase any furniture, rate of depreciation is 10% for furniture, but furniture do not come under building. So I have to create a separate block for furniture. Very good. Next. Remaining all other assets are called as plant and machinery. You see what are all there in the plant and machinery. Cars are plant and machinery. Bus is plant and machinery. Aeroplane is plant and machinery. Pollution equipment, plant and machinery. Medical equipment, plant and machinery. Energy devices, plant and machinery. Computers, books, everything. All these items are called as what? Plant and machinery. I told you, all these items comes under plant and machinery category. But remember, they all do not come under single block. They don't come. Why? Yes, they all come under same category, but not same block. Why? The depreciation rates are different. Now, you see, all cars, motor cars, getting it, oil wells, and any other plant and machinery. Example, mobile phone is not covered in the above list. In the above list, no, mobile phone is not covered. So, mobile phone comes under general. Within the plant and machinery, remaining plant and machinery, residuary plant and machinery, we call it as 15. So, mobile phones, motor car. Which car? Car used for official purpose. Suppose, if I am renting the car, I am hiring the car, then rate of depreciation on that car is 30%. Suppose I am using the car for my business purpose only, normal, my business, to travel from home to office, to travel on business purposes and all. I am not renting car. I am not a car dealer. Getting the point? I am not a transport operator. So for a transport operator, if he purchase a car for renting purpose and all, hiring purpose and all, for him, the rate of depreciation on that particular car is 30%. So motor tax is used for business on hire, 30%. General motor car, 15%. Now here there is some dates. This point is irrelevant, not required. Getting it? Next, aeroplanes, 40%. Air pollution equipment, 40%. Water supply project related, 40%. Books, annual publication or normal books, 40%. Now you see computers, books, other normal books, as well as this aeroplanes, motor buses, aeroplanes, pollution control equipment and books, all these items I will group into a single block. Now this one, oil wells and normal car which I use for office purposes and all, and mobile phones, air conditioners, all that comes into a single block. That's it. That's block of asset definition. I hope you are clear now. Getting it? Now, so that's about the block of asset. Now, what are the conditions to claim depreciation? So now we understood when depreciation 32 will apply, we understood. Now, in order to compute depreciation, what are the provisions? Asset must be used. Suppose during the year, we purchased the asset. By the way, wait, I am going to show you the computation format. That is very, very important in this entire depreciation, because that is one point where generally some students do mistakes in computation of depreciation. I will give you the easiest technique of computation of depreciation. Fine. So during the year, if you purchase any asset, you must use it. If at all in this year, no, you did not use it at all. You did not install. If you did not install in this year, you will not get depreciation at all on that asset. Whenever you purchase, we add it in the block. But if you want to claim depreciation on the purchases also, new assets also, you must have used it for at least 1 day in this year. Use it means you must install it first. Suppose I purchased air conditioner. Box also I did not open. Means air conditioner is not installed. I purchased. It's there in my office. But I did not even unpack it, unbox it. No depreciation on that AC. Remember, you must use the asset, right? That condition is there only for the first year in which you purchase the machine. Second year onwards, whether you use it or not, you can claim depreciation. You can claim depreciation. The moment you purchase it, you add it in the block. First year we will see, is it used or not? If at all not used in this first year, no depreciation at all. Second year onwards, whether you use it or not, it is there part of opening WDV. I will show you competition format, don't worry. So second year onwards you will get. Now remember, in depreciation we have two types of depreciation: normal depreciation, additional depreciation. Again, for power sector, there is a concept called straight line method. I will discuss at last. So normal depreciation, I am talking everything about normal depreciation. Now how to compute this normal depreciation? Computation format very important. So for any block, generally opening WDV on 1st April 2022 will be there. Let us assume in exam 20 to 23 year only they will test you. So that's why I'm taking 1/4/2022. Now suppose, no sir, this year only I started business, means opening value will not be there. In that case, only additions. So opening value you will put 0, simple. Additions, actual cost of assets acquired and installed. Assets acquired and installed during the year. So how much is the actual cost of assets that you acquired? Now these assets acquired in this year, in this year you purchased assets or something, you should split into two categories. Assets used for more than 180 days. How much? I'm showing you, by the way, this format for a particular block. Let's assume this is a plant and machinery 15% block. Plant and machinery 15%, plant and machinery 40%, plant and machinery 30%, plant and machinery 45%. So all are plant and machinery blocks only, but rate is different. That's why they are categorized into different blocks. Next, now assets used for less than or equal to 180 days. Assets used for less than or equal to 180 days at both. So keep it outside. Now you will get, you will get subtotal. You will get a subtotal. Are you getting it? Now from this, any amount received, sale value, nothing but sale value or amount whatever you received because of transfer of part of a block. If you transfer any part of a block, suppose opening some 10 machines you have in this, 10 machines, it may be mobile phone, laptop, whatever, 10 items you have. During the year you purchased 10 items. You purchased 10. Totally how many were there in the subtotal? 20. Now part of it means what? As on after purchasing 20 were there. But in the same year you sold some items also. You sold, let's assume 10 items only you sold, or 12 items you sold. So 12 items you sold, which means part of a block only you sold, right? Suppose you sold entire 20 items, then full block is sold. If full block is sold as on 31st March, block itself is not there. All the assets in this block were sold completely, no depreciation at all. But part of a block, 12 items only sold. Opening 10, purchases 10, minus 12 means still 8 more were there. Getting it? Some value you sold, minus it. Now you will have this value, written down value of the block. What is it called as? Written down value of the block. This is called as written down value of the block. Getting it? On this value we calculate depreciation. On this value we calculate depreciation, which is working note number 1. So written down value of the block. So compute written down value. Now here there is an important observation. Suppose if this written down value is coming negative, suppose this subtotal let us assume 10 lakhs. Okay, let us assume this subtotal is 10 lakhs. Now minus part of a block you sold, right? Part of a block you sold for 12 lakhs. 20 assets you have, 12 only you sold, but the sale value of these 12 items were 20 lakh. So 10 lakh minus 20 is turning negative. Block can never be negative. WDV of the block can never be negative. Now if at all when you transfer part of a block or full block for a value higher than value of the block, this is called as value of the block. Value of the block means what? Opening plus additions. That's called value of the block. From that value of the block you sold some items. If the value of the part of a block transferred or full block, if it is more than value of the block, opening plus additions, the excess amount is treated as short-term capital gain. Suppose I sold it for 7 lakhs only, part of a block, which means WDV of the block is how much? 3 lakhs is there. Now check it, check the conditions. As on 31st March, is there a WDV of the block? Yes. As on 31st March, in this block, are there any assets? 8 assets were there, only 12 we sold. So assets were there, value is also there. So now can I compute depreciation? Yes. So we will compute depreciation in the working note. So that computed amount, you reduce it here. So balance is called closing WDV of the block. This will become opening value in the next year. Now you see here, very simple. So opening value, how much? Additions. When you are adding, no, additions, no, identify based on is it used for more than 180 days or less than 180 days. How to know whether it is used for more than 180 days or less than or equal to 180 days? When it is installed, check out. If the assets, if the machinery is installed, if the furniture is installed, if the building is installed, nothing but if the asset is installed before 4th October, it is used for more than 180 days. It is used for more than 180 days. If the asset is installed on or after 4th October or after 4th October, if the asset is installed, it is used for less than 180 days. It is used for how many days? Less than 180 days or equal to 180, less than 180, that's it. So less than or equal to 180 days. 4th October onwards, I told, right? 4th October means in October month 31 minus 3 days, 1, 2, 3, 28 days October, November 30, December 31, January 31, February 28, March 31. So totally 179 days only from October 4th to March 31st. 4th date is included, 31st March, both are included. If you install asset on 4th October up to 31st March, the number of days were less than 180 days. The number of days were less than 180 days. If you install the asset on 3rd October or before 3rd October, the asset is used for more than 180 days for sure. Are you getting the point? Just a minute. Just a small correction, ma. If the asset is used for less than 180, more than or equal to 180. If the asset is used for 180 or more than or equal to 180, I told date wise correctly, here I wrote wrongly, so you may confuse again. If at all you didn't observe, ignore it. If the asset is used for 180 days or more than 180 days, full depreciation we will claim. If the asset is used for less than 180, half depreciation will claim. Half means half rate we apply. Here we will apply full rate, but don't conclude. Directly we should not apply depreciation rate on these values. We should derive the value of depreciation based on the WDV of the block. Now I told, right, depreciation, working note 1. Now what is working note 1? Be careful, observe it. Working note 1. So WDV of the block, how much identify? 3 lakhs in our example. 3 lakhs. Okay. Now out of this, first allocate the value for assets purchased during the year but not installed or not used at all. So first allocate the value. So allocated value, some amount. Now still what is the balance? So what is the balance value after this allocation? Identify. Now this balance value then allocate for assets used for less than 180 days. Allocate the value. Still some value is there. Then allocate it for assets used for more than 180 days. If still some value is there, then allocate it for balancing figure. Now on these items, apply full rate applicable for the block. Apply here also full rate. Apply here half rate. Apply here zero rate, because if the asset is not used in the year of purchase, no depreciation, zero. Here it is half rate depreciation. Here it is. Now in this case, half rate means what? In this example, block 15% block. So half means 7.5%, 15%. So and 15% is, that's it. This is how you should allocate the value. First, you should allocate for assets not used. Assets you purchased, added in this block, not used at all. To that value you should allocate. Now assets purchased, installed, but used for less than 180, allocate to this. Then now I will give you a simple calculation. Suppose there is a opening WDV of a particular block was, let's assume 10 lakh opening value. Now you purchased the asset on or before 3rd October. On or before 3rd October you purchased some assets. Let us assume 3 lakhs is the purchase value. Now on or after 4th October. On or after 4th October, again you purchased some 5 lakhs worth of asset. Are you getting it? Now during the year, you sold part of a block only. You sold part of a block, not full block. Getting it? You sold part of a block. Let us assume you sold for some 7 lakhs. You sold from, let us assume, let us take some bigger value. Sale value, one example I will take is 15 lakh. Case number 1. Case number 2. Case number 1 is 15. Just a minute. Let me apply clear cut logic. So case number 1, 15 lakh. Case number 1. So this is situation 1. This is situation 2. This is situation 3. Right now itself I am giving you example here. Okay. Opening WDV same 10 lakhs. Okay. The information is same. Sale value only different in all the 3 situations. Okay. Now sale value is 17 lakh. Here let us assume sale value is only 10 lakhs. Better. Let us assume sale value is 10 lakh. Okay. Sale value is 10 lakh. Here sale value is 17 lakh. Whereas here sale value is 19 lakh. Fine. So let us say, and remember it's a part of a block. So opening is same. Now if you understood this example, I'm telling you any type of question in the exam in depreciation, you can do very well. Now how to now let us look at so let us assume this is the information. Now let us calculate WDV of block. Let us calculate WDV of the block. So what is it? By the way, all these are part of a block. So first 10 plus 3, 13 plus 5, 18 minus 10, 8 lakhs. 8 lakhs is the WDV of the block. Here it is WDV of the block is 1 lakh, and here it is going to be negative. So can WDV of the block be negative? So no, therefore no depreciation. The excess 1 lakh negative is that's a short term capital gain. Fine. Now minus depreciation, working note number 1. Now how to calculate? Case number 1. What is the WDV of the block? 8 lakhs. Now in this year, this 8 lakhs we should allocate. Is there any asset which is not used at all? No, 0. Is there any asset which is purchased for less than 180 days? Yes. How much value? 5 lakh. Now here we have 8 lakhs. No, I can allocate happily 5 lakhs. Suppose here instead of 8, 3 lakhs only there. Let us assume here only 3 lakhs is there instead of 8 lakhs. Now how much you can allocate less than 180? Sir, I purchased for 5 lakhs. So 5 lakhs I will allocate. No. If the value available is 3 lakhs here, you can only allocate 3 lakhs maximum here. Yes or no? Suppose here 8 lakhs we have. But can I allocate 8 lakhs here? No. Less than 180, the total value itself is 5 lakhs. So maximum total value of the assets purchased is 5 lakhs, whereas value available is 5. So which means another 3 lakh rupee. So after allocating this 5 lakhs, how much balance is left? Still 3 lakhs. Now can I allocate this 3 lakhs for assets purchased for more than 180? Yes, here 3 lakhs is there. Here value also 3 lakhs is there. So 3 lakhs I allocate. So full rate 15%. Here half rate 7.5%. Here it is 0. Is there any balancing figure by the way? So out of 8 lakhs, 5 lakh allocated here, 3 lakhs allocated here. So 8 lakh completely allocated. Is there any value? 0. But anyhow, balancing figure is 0 at full rate, which is 15. So depreciation 0. Here it is 45,000 rupees. Here it is 5 lakh into 7.5. Yeah, 37,500. Here it is 0. So what is the total normal depreciation? 37,500 plus 45,000. 82,500 is the normal depreciation. So that's it. 82,500. Understood? Now what is the closing WDV of the block? 82,500 is equal to 17,500. That's it. Now how to calculate depreciation in situation 2? Now if you understand. Now what is the value of the block here? 1 lakh. Now allocate it. Is there any asset which is not used at all during the year purchased but not used? 0. Now how much is the value that I can allocate for less than 180? Actually 5 lakhs value is there. But remember here I have allocation purpose only 1 lakh. So 1 lakh I will allocate here itself. Because up to 5 lakhs I have to allocate, but I have only 1 lakh. So 1 lakh only allocated. Now more than 180, nothing is there. Already 1 lakh fully settled. So 0. So at 15%, at 7.5% is equal to 7,500 at 0. So total normal depreciation how much? 7,500. That's it. Now remember here what you have to reduce is sale value, whatever amount you are receiving because of destruction, damage, demolition, transfer, sale, whatever reason, part of a block, some amount you are receiving. That amount received you should reduce. Understood? Now this is regarding normal depreciation computation. Remember, intangible assets, for every category of assets you should create a separate block. All intangibles except goodwill comes under single block. On goodwill, from 1st April 2020 onwards, no depreciation at all on goodwill. So up to 31st March 2020 you can claim depreciation on goodwill being a part of intangible asset. Are you clear? That's it. This is regarding normal depreciation. Now there is a concept called additional depreciation. There is a concept called additional depreciation. What is additional depreciation? Additional depreciation is available for the SSEs who are engaged in manufacturing sector. Additional depreciation is also eligible for power sector, provided they are following block of asset approach. You know, power sector has an option to either follow block of asset approach or they can follow asset wise straight line method depreciation. Asset wise, if power sector is choosing asset wise straight line method, they don't have additional depreciation facility. Additional depreciation facility is available only for SSEs engaged in manufacturing sector and are following block of asset approach, and SSEs engaged in power sector and following block of asset approach. What is additional depreciation? 20% of new plant and machinery installed in factory other than vehicles. Vehicles you don't get additional depreciation, and additional depreciation you will get only on plant and machinery. That too if you install it in factory, which means if plant and machinery AC purchased, installed in my corporate office, no additional depreciation. Car I purchased, vehicles, no additional depreciation. Are you getting the point? So additional depreciation is only in respect of plant and machinery. Now how much is additional depreciation? 20% of actual cost. They straight away told you 20% of actual cost will be the additional depreciation. 20% of actual cost. Now whatever the assets you purchase, during the year, plant and machinery, find out the actual cost, multiply by 20, that is equal to additional depreciation. In this example, let us assume this 3 lakhs is newly purchased, this 5 lakhs also new plant and machinery. Second hand plant and machinery, no depreciation. You see the words which I used, new plant and machinery installed in factory other than vehicle. Simple logic. It should not be a vehicle, it should be installed in factory, it should be new, which means second hand plant and machinery, no additional depreciation. Office machinery, no additional depreciation. Suppose if you purchase a machinery on which 100% deduction is there, no additional depreciation on that. If any machinery is eligible for 100% deduction under income tax law, on that additional depreciation will not be given. Fine. Now this 3 lakhs is new plant and machinery, 5 lakhs is also new plant and machinery, both are installed in office. On this 20%. What is additional depreciation on this? Because additional depreciation is calculated on actual cost, not on written down value. Normal depreciation we calculate on written down value, correct? Whereas additional depreciation we calculate on actual cost, 20%. Whereas for less than 180, suppose if any asset is purchased during the year but used for less than 180, then 10% only. 10% of the actual cost only can be claimed as additional depreciation. So what about balance 10%? You can claim in the next year. Are you getting the point? So now 20% means 60,000 and 10% means here 50,000. So total 1,10,000. Now here 82,500, right? 1,10,000 will also be reduced. Then revised closing block is how much now? In this case, 8 lakh minus 82,500 minus 1 lakh is equal to 6 lakh 17,500. This is a closing block. Are you clear? This is additional depreciation concept. Now remember, in order to claim additional depreciation, asset must be installed. Suppose this year I purchased asset, I did not install. Normal depreciation also you cannot claim in the first year. But second year, now I entered into second year. Now second year also I did not install. Normal depreciation you can claim in the second year even though asset is not installed, but additional depreciation until you install, until you actually use, you cannot claim. So in the year in which you used, in that year you used it for more than or equal to 180, then full additional depreciation 20%. Otherwise half additional depreciation, which is 10%. Are you clear? That's it. I'm doing this on 7th November. Tomorrow is exam for students. Getting it? So I'm uploading from yesterday so many videos for the benefit of various students. So I'm uploading anyhow. That's why in order not to make you wait, I'm uploading parts and parts. So capital gains I uploaded part 1, part 2. Now this PGBP I'm uploading in multiple parts. So I hope you understood regarding additional depreciation. So additional depreciation is available for whom? Power sector. Manufacturing sector and power sector. Service industry, trading industry, they don't get additional depreciation. That's it. So are you clear? So that's it. Predominant concept on depreciation I have covered. Almost we spent 30 minutes time. 30 minutes time we spent. So this is the block of asset format which I showed you. Getting it? So that's it. Enough. Remaining points are not required. Unabsorbed depreciation, all these points, no, I clearly explained in this one, set off and carry forward chapter. Okay, that revision is also there, which I uploaded long back. So after finishing this, part 2 PGBP will come, part 3 PGBP will come. So after that, you go to chapter 6 introduction. There is a video which I uploaded some 15-20 days back. There is a video on chapter 6A clubbing, setup and carry forward put together. Anyhow, I will attach to this video that video also. Getting it? So let us consider this as a part 1, section 32. Now you finish watching this, take some half an hour to 1 hour break. Again, another video will come. Are you getting it? So next video will be on 35 AD, 35 scientific research and 35 AD. After that, I will do a video on disallowances. After that, I will do a video on 44 series. We're literally speaking 4 parts. PGBP, I'm uploading in 4 parts. That's it. So listen continuously. Once this is over, take a break, just revise, go to the next video, just revise and go to that next video. I hope you are confident. That's it. Yeah. So the next one is deduction in respect of scientific research. I hope part 1 depreciation topic is completed. Okay, part 1. If at all you did not watch part 1, please watch part 1 first and then we'll come to this part 2 to PGBP. Now, so in depreciation, one point I forgot to mention, if you purchase any asset where if the amount is paid for more than 10,000 in cash, then on that asset you cannot claim depreciation. The actual cost is treated as 0. Only if the asset value is more than 10,000, if it is paid by other than cash, means account pay check, account pay bank draft, or any other permitted electronic mode, only then you will get deduction. Fine. Now coming to this one, scientific research expenditure. Getting it? Now we have these sections. Okay, we have a section called 35 and 35. Only one section, that is 35. Inside that, subsection 1. Getting it? This is dealing with direct scientific research expenditure. Nothing but if you spend directly for scientific research, whatever amount you are spending, you will get 100% deduction. So whether you're a normal person or a company, doesn't matter. You will get entire revenue expenditure 100% deduction, entire capital expenditure also 100% deduction under 35 subsection 1 clause 1. Now for capital expenditure, except land, you will get deduction. Not only that, before you started the business, past 3 years also you spend some capital expenditure. That capital expenditure also is eligible for deduction, 100%. Getting it? Then that, remember, the past 3 years expenditure is only for materials and salary. Getting it? Only on personnel, nothing but salaries and materials. In the past 3 years, if you spend revenue expenditure, that you will get deduction 100%. Capital expenditure, whatever you spend in the past 3 years before commencing the business, you will get 100% reduction in the year in which you commence the business. So the first year in which you started the business, you can claim 100% reduction of that year expenditure, revenue and capital. Last 3 years, revenue and capital, both you can claim. Are you getting it? Remember, land expenditure you will not get. Now, there is another section 35(2)(ab) which is exclusively created for company engaged in biotechnology. Now, here for land and building, you don't get deduction. But for building, there is a general section, no, 35. Under this itself, you can claim. Once upon a time, 35 subsection 2AB has a relevance. Now, 35 2AB section don't have any relevance at all. Anybody, whoever is directly incurring scientific research expenditure, they can claim directly under 35 subsection 1 itself. Next, not only that, if at all you don't have the capacity to spend, you don't have time to spend, you don't have time to research, but some associations are doing research, you want to donate them, you donated, you can claim deduction under 35. Remember, if you have PGBP income and if you are donating to scientific research association, social research association, national laboratory, all this, you will get deduction under PGBP. If you don't have PGBP head of income itself, you can claim deduction under 80 GGA. There is a section called 80 GGA which is applicable for SSC who are not having PGBP income, chapter 6A. If they are donating to a association, college, university for scientific research, getting it, or a company for scientific research, or for a college association for social research, or for laboratory IIT specified person for so and so scientific research, if you are donating without having PGBP income, then 80 GGA. If you are having PGBP income, all the donations for scientific research, social research, statistical research, 100% deduction you can claim. That's it. No need to discuss too in depth in this. No formalities, no confusion. Very simple. Are you spending directly scientific research expenditure? Yes, 100% reduction for revenue expenditure, 100% reduction for capital expenditure, except land. Are you donating for scientific research? If it's an approved research association, if it's an institution which is approved for scientific research, whatever amount you donate, it is eligible for deduction. You're donating to national laboratory, IITs, 100% reduction. You're donating for social research, 100% reduction. That's it. So if you just read this table, that's more than enough. Next, 35 AD. What is this 35 AD is all about? This section is specifically brought to give deduction for certain businesses in respect of capital expenditure. See, any business, revenue expenditure, whatever they are incurring, they can claim deduction under 30 to 37. Revenue expenses they can claim. On capital expenditure, what they can claim is depreciation. But since some businesses which are of national importance, okay, which are promoting tourism sector, which are promoting health, which are promoting agriculture, getting it? So, which are promoting infrastructure. So, the income tax has identified 14 types of businesses. They have identified 14 types of businesses. I'm not going into these 14 businesses. Okay. So, they have identified 14 businesses. If you started these businesses, getting the point, if you start any of these businesses, to start this business, you are spending so much of capital expenditure, right? Don't claim depreciation. Straight away, 100% of that capital expenditure, you claim it as deduction. 100% you claim it as deduction. Remember, if at all you are opting for concessional tax scheme 115 BAC, 35 AD is not there. Further, if you claim 35 AD deduction, 115 JEE, AMT, alternate minimum tax provision will apply. Remember, keep this point. Okay, fine. So, if you are doing any of these businesses, whatever capital expenditure that you are spending, 100% deduction you will get. Remember, you will not be eligible for land, goodwill and shares and securities. If at all you are buying shares and securities, financial instrument, nothing but goodwill or land, that is not at all eligible for deduction. Not only that, if at all any capital expenditure you spend 10,000 rupees extra, more than 10,000 rupees, single payment you paid in cash, you will not get deduction under 35 AD. In order to get 35 AD capital expenditure 100% deduction, you have to pay by other than cash. Electronic mode, account paying check, account paying bank draft. Getting it? Not only that, suppose you started business and after starting the business you are spending, you will get deduction. What about before starting the business I spent? Suppose there is a business called 2-star or above category hotel. 2-star or above category. First of all, I constructed the hotel. Only after construction I started hotel business. Yes or no? Right from the date of Bhumi Puja, can I do business of hotel? No. So even if the capital expenditure is spent before starting the business, that capital expenditure is also eligible for deduction. In which year? From the year in which you started the business, you can claim deduction for that capital expenditure also. Are you getting the point? By the way, in order to claim capital expenditure spent before commencement of business, in order to claim deduction for that, you must capitalize that in the books of accounts. You must capitalize. In order to capitalize, you must bring capital into the company. Able to understand? That's it. Now, first of all, this specified business, in order to start, you must freshly start. It should not be demerged from existing business. It should not be a second-hand business. In that business, entire plant and machinery completely should be new, completely new. Getting it? Up to 20% of the total plant and machinery can be second-hand machinery. And you know what? Under this 35 AD only, imported plant and machinery is not treated as second-hand machinery. Yeah, if you are importing from outside India, for the first time you are using in India, or first time we are claiming depreciation under section 32 of the income tax law. First time. Suppose you imported a mission from outside India. On that mission, nobody claimed depreciation under Indian income tax law and nobody used it in India. Then that mission is treated as new mission. Remember, for additional depreciation purpose, no, if the asset is imported from outside India or if the asset is purchased within India, somebody used it earlier. It's a second-hand machinery. Additional depreciation will not come on that. However, for specified business, no. Can I claim 100% deduction on that particular plant and machinery, even though it is a second hand? Yes, if it is used outside India but not inside India, okay, and nobody claimed depreciation under income tax section 32 on that mission, it is treated as a new machinery. It should be outside India, it should be imported from outside India, and no depreciation is claimed on that earlier. It's a new machinery for the purpose of 35 AD. But for the purpose of additional depreciation, it is always second hand machinery. It's second-hand machinery, not at all eligible for additional depreciation. Whether it is used outside India or India, doesn't matter. For 35 AD, if the asset is used outside India, it is treated as a first-hand machinery in India. Are you getting the point? That's it. And further, remember, in order, now what benefit they are giving, whatever capital expenditure that you are spending, whatever machinery, whatever asset, whatever furniture that you are buying, everything is eligible for 100% deduction. Now there is a condition. The machinery or asset, whatever, in respect of which 35 AD 100% reduction you claim would know, that machinery must be used for 8 years consecutive for the same business. For the same business, you must use it 8 years. You know, if at all you are using this asset for any other purpose within this 8 years, whatever deduction given to you will be taxed as income minus for whatever the years you are using, notional depreciation under 32 we will provide. Balance amount we will re-tax it under 35 AD subsection 7B. Are you getting it? Once you bought an asset for specified business, 100% deduction claim, some 4th or 5th year, you are using it for some other business, non-specified business. In such a case, whatever deduction earlier allowed, retax it minus depreciation, notional depreciation, claim it, balance amount will be retaxed. Further, this balance amount is treated as actual cost for the purpose of block because you transferred it to normal business. So in normal business, you need to add it in the block. Now, very simple. If any asset is purchased for scientific research, if any asset is purchased for specified businesses, single SSA, he is also having normal business. These assets are scientific research asset, specified business asset, don't add it in the block value. Able to understand. That's it. Now here in 35 AD 777B and 35 scientific research, there is one point. Suppose I purchased an asset for scientific research, 100% reduction I claimed. I purchased an asset for specified business, I claimed 100% reduction. Now if I transfer it to normal business, what is the consequence? What is the consequence? Suppose I purchased for scientific research mission, I used it for scientific research, 100% reduction I claimed. Now I transferred it to my normal business. So 43 subsection 1 explanation 1. There is an explanation 1. What it says, if any asset is used for scientific research and later brought into normal business. So now you need to add it in the block of asset value, right? How much value we will add in that particular block? 0. Actually, the provision says actual cost minus deduction claimed under section 35. Getting it? So actual cost 10 lakh, deduction also I claimed 10 lakh, so 0. That is the provision. Suppose if any asset which is purchased for scientific research, I sold directly. I did not bring it to normal business. After using it for certain number of time period, after using it for certain number of days, I sold it directly. Whatever sale proceeds were there, right? Whatever sale proceeds were there, right? They will be taxed as business or profession income. 41 subsection 3 deemed profits. What is it? 41 subsection 3 deemed profits. It is straight away taxed. Are you getting it? Suppose if you bring into normal business, add it in block 0, then you sold it. That sale value will be reduced from the block. See, once you bring it to normal business, scientific research asset, you will add in the block. After that you sold, which means you sold part of a block, means the value of sale will be reduced from the block. So this treatment will not apply. When 41 subsection 3 treatment will apply, if you directly sell from scientific research operations, you directly sold, sale proceeds will be taxable under business or profession. Suppose you sold it for more than original cost. The excess amount beyond original cost is taxed as capital gains. The amount which is beyond the original cost is taxed as capital gains. In fact, it is called a short-term capital gain. Very simple. Able to understand. Now, 35 AD. Suppose I purchased a machine or some asset for 35 AD from 10 lakhs. I claim a deduction 100%. Suppose for 8 years, I must use that asset for the same activity. After 8 years, if I sell also, no problem. After 8 years, I brought into my normal business. No problem at all. Within 8 years, if you bring it into your normal business, what happened? Earlier given deduction minus whatever number of years, claim depreciation. So balance amount will be retaxed. Balance amount will be retaxed. Suppose after 8 years, I bring it to my normal business, nothing will be retaxed. Now, when you are bringing scientific research, 35 AD item into normal business, what is the actual cost? 0. After 8 years. If you bring within 8 years, whatever you are retaxed, that will be treated as actual cost in the block. Suppose if I purchase an asset for specified business, I sold it. Whether you sold within 8 years or after 8 years, it doesn't matter. You sold it. Amount you received under section 28 charging section, whatever amount received is treated as PGBP income. That's it. So this is 35 AD. I hope you are clear. So with this 35 AD theme, entire theme I told, except remember what are the businesses I did not tell. Rest all other provisions I have covered. Even 35 scientific research also I have covered everything in depth. Are you confident? So with this 35 and 35 AD is completed. So now we are having another section called 35D, preliminary expenditure. Preliminary expenditure. So preliminary expenditure is whatever expenditure. Preliminary expenditure is something that we spend in order to start the business, or preliminary expenditure is something that we spend in order to go for expansion. Getting it? So an enterprise, before they go for expansion, they will have preliminary expenditure, or an enterprise when they are about to start a business, they will have preliminary expenditure. Now, under income tax law, preliminary expenditure is not deductible. Whatever you spent, there is a limit. 5% of cost of the project. So maximum preliminary expenditure can be 5% of the cost of the project. So a preliminary expenditure, suppose you spend 10 lakhs. Cost of the project is 1 crore. 5% means what? 5 lakh. So maximum preliminary expenditure permitted for deduction is 5 lakhs. And remember, the preliminary expenditure, entire amount 5 lakhs, whatever permitted, entire amount you cannot claim in single year. You have to claim in 5 assessment years in equal installments. So the preliminary expenditure, whatever incurred at the time of incorporation or at the time of expansion, will be restricted to 5% of the cost of the project only, and that amount further can be claimed as deduction only in the 5 installments. Further, in case of company, 5% of capital employed or 5% of cost of the project, whichever is higher. So this limit is there only for the companies. Suppose if it's a company which is spending preliminary expenditure, what is the maximum permitted preliminary expenditure? 5% of capital employed, 5% of the cost of the project, whichever is higher. Getting it? So actual amount, how much identify, compare with this. So actual amount is higher than 5%, then 5%. If the actual amount is less than 5%, then actual amount only. Suppose if my preliminary expenditure is 3 lakhs, so permitted is 5 lakh, then 3 lakhs only can claim. Suppose if my preliminary expenditure is 13 lakh, but permitted as per law is 5 lakh, then 5 lakhs only I can claim. Remember, whatever is eligible, whether it is 3 lakhs or whether it is 5 lakhs, you can claim that in 5 installments only. Are you getting the point? From the year in which expansion is completed, from the year in which business is started, from that year 5 installments you can claim. Same 5 installments logic is applicable for any payment made under voluntary retirement scheme. So if any entity is paying any amount under voluntary retirement scheme, that amount is also eligible for 5 installments. Now there is another thing called family pension. Capital expenditure on family pension can be claimed as deduction by a company SSE in 5 installments. Remember, if any enterprise, if any business organization spend on family planning of the employees, that is eligible for deduction only for company SSE. Revenue expenditure, 100% deduction. Capital expenditure on family planning, only 1/5 of the expenditure. In 5 installments, you can claim 1/5, 1/5, 1/5. So capital expenditure on family planning by a company can be claimed as deduction in 5 installments. The section is section 36. Clear. Now in 36, there are many more deductions. So all business expenses, whatever comes under 30 to 36, except this, if any other business expenditure is there, you can claim deduction under 37. Under 37, what are all covered, you know? A salary expenditure comes under 37, electricity comes under 37, maintenance expenditure comes under 37, any general expenses, puja expenses, all that can be claimed under 37. Car expenses can be covered under 37. Able to understand? Stationery, you can claim under 37. Fines and penalty you paid during the course of business, you cannot claim because it's an offense. If you pay any amount for offense, you cannot claim deduction. Income tax, first of all, income tax is not a business expenditure. Income tax is something which is there for every SSE. Salaried employee income tax is there, capital gains income tax is there. So it's not something for business people. Income tax is general obligation for everybody. So income tax is not a business expenditure. I hope you understood. So with this 35 AD, 35D preliminary expenditure, 35 TDA VRS, and 36 1 or 2 points, and 37 1 or 2 points have covered. So that's it. You see, very simple. These are deductions part. So with this, deductions part is complete. In the next video, I will discuss disallowances part. Getting it? Where I will give little bit focus. Especially, many students are having confusion on 40B, assessment of firms, partnership firms. So how to compute income for partnership firms? This many students are having confusion. So by the time you finish watching this video, 40B, 40A, 40A1, 40A1A, 43B, 40B, all these sections I will upload. After that, I will upload 44 sets. So this is part 2 PGBP. If at all you haven't watched part 1, go and watch part 1 and then come back to this. That's it. Take care. So without any delay, let's discuss on disallowances. So we have various disallowances. That is one section which talks about disallowances is 40 subsection A. 40A. Inside this we have many subsections. 40A2, 40A3 and 40A7 and 40A9, which are not that important. Then we have another section 43B. Apart from all this, there is another separate section which is 40 subsection B, which is talking about partnership firms. Okay, I'll come to 40B at last. Now, 40A. In this, there are 2 important subclauses, subsections, subsection. Getting it? Section 40, subsection A, clause 1, clause 1A. So 2 important clauses were there. So first of all, what is a disallowance? Nothing but these disallowances are nothing but certain expenses. No, if the condition given under these sections, if it is not satisfied, those expenses, those deductions you cannot claim. Now, how the disallowances and all will work exactly? There is a detailed video made by me. Concept of disallowances, there is a video. If you watch that, you will understand when to add back, when to reduce, all that very clearly. So I took one P&L dummy. I explained in direct method, indirect method. In exam, which method you have to follow, all that I clearly explained in that full video. I will attach to this video concept of disallowances, or you can simply type on YouTube caramharsha space concept of disallowances. If you just type these words, you will find that video. It's somewhere around 40 minutes to 1 hour, some video, getting it. So it's purely concept only we explained. We didn't even discuss these sections. Now in this revision class, we are discussing sections. Okay. Now, so what 40A1 says, if at all you are paying any royalty fees for technical services or any other sum which is chargeable under income tax, getting it? If at all you are paying these money to any person outside India or to a non-resident, without compliance with the TDS provision, without compliance with the TDS provisions, you have not complied with the TDS, you paid directly the amount. It's a business expenditure for you. Remember, first of all, it's an expenditure for you. Okay, you paid directly to person, but without complying TDS, then whatever amount you paid, 100% no deduction at all. 100% of the amount will be disallowed. Now, the question is, what do you mean by TDS compliance? TDS compliance means you must deduct a TDS as per TDS provisions and you should remit to the department within due date for filing IT return. Within due date for filing IT return. What is the due date for filing IT return? It may be 31st July or it may be 31st October of assessment year. So you have to deduct a TDS within the same previous year. Within the same previous year in which expenditure is accrued. Whatever the financial year or previous year in which you spent the expenditure, to which year it belongs to, in that year you should deduct. Nothing but suppose if the expenditure is belonging to 20 to 23, in the same financial year, deduction should be there. And remittance must be, just a minute. Yeah, the remittance must be within the due date for filing IT return. Generally, as per TDS provision, current month TDS, whatever we deducted, next month 7th you should pay. But here, for disallowance, up to due date, they have given time limit. So if you deduct any TDS within the year and remit the TDS within the 31st October or 31st July IT filing due date, we assume that you complied. We assume that you complied with the TDS. Suppose you did not deduct in the same year, or you deducted in the same year, but not paid within the due date for filing IT return, which means you have not complied with the TDS. Non-compliance with the TDS provisions, what is the consequence? Whatever expenditure you incurred for the non-resident, completely disallowed. Suppose if this expenditure is paid to a resident individual, to resident person, individual HF whatever, the amount what you paid is to a resident, then and TDS non-compliance. TDS is non-compliance. Non-compliance means what? Either you failed to deduct or deducted in this year but not remitted within the due date. So this is called non-compliance. So if there is a non-compliance with the TDS provision while you are paying any expenditure to a resident, then disallowance percentage is 30% only. Clear. Now remember, this is a temporary disallowance, not a permanent disallowance. Disallowances are broadly again two types. This is temporary disallowance. This is also temporary disallowance. These two sections. Whereas disallowance given under 40A, this is permanent disallowance. Means once you disallow, that's it. No more attachment later on. Once it is disallowed, that's it. No more change later on. Whereas in 40 subsection A, clause 1, clause 1A, 43B, there is a section. In these two sections, you can rectify the disallowance. Like what? Suppose in previous year 22-23, I paid some salary expenditure to a resident, let us assume. Or I'll take some other expenditure, or else let us take some maintenance related fees, or some remuneration, or some professional fee I paid, some professional fees. So audit fees I paid. Audit fee deductible under section 37, residuary expenditure. Now, you know what? Under audit fee, I have to deduct a TDS under 194J. Getting it? But I did not deduct TDS. I did not deduct. Or maybe I deducted in the same year, but remitted on or before, but not remitted on or before due date. Now, if at all the auditor is non-resident, 100% is allowed. If the auditor is resident, 30% of the expenditure I cannot claim. Means 70% I can claim if it is a resident. Are you getting the point? Now, non-compliance means what? You have not deducted in the relevant previous year, or you deducted but not remitted. within due date for assessment year, within due date for IT return. Are you clear? Now suppose you deducted in 22-23, you deducted, getting it, by 31st October or by 31st July you paid that to department also. TDS is complete, no disallowance. Suppose you did not pay, non-compliance. So while filing IT return, this expenditure 30% or 100% you will disallow. Suppose in 22-23 itself you did not deduct, you deducted in 23-24. Then for 22-23 year IT return you file, right? See, let us assume 22-23 originally you spent expenditure, but you deducted in 23-24 and you paid within 31st October, which is 22-23 due date itself you paid. Still, since the deduction is in 23-24, the expenditure will be allowed as deduction for 100% in that year. For this year, 100% is disallowed, 30% is disallowed if it is for non-resident, if it is for resident, as the case may be. Because deduction itself does not happen. When you deducted ultimately 23-24, so when you ultimately deducted and complied with the law in 23-24, you deducted, of course you paid, getting it. In this year, that 100% will be once again allowed, that 30% will be once again allowed. Suppose 22-23 expenditure and you deducted in this year only, but 31st October or 31st July, whatever the due date for IT return, you did not remit. You remitted after these dates. You deducted correctly in the same year in which you incurred the expenditure, but you paid after the due date. Now, suppose you paid on November 2023 you paid. November 23 comes under which previous year? 23-24. For this year again you will file IT return in assessment year 24-25. At that time you claim that 30%. At that time you claim that 100%, whatever it is. But for the original year, 30% will be disallowed, 100% will be disallowed. Why? Because you deducted but not remitted. Suppose you did not deduct itself. You deducted late. You deducted after the year. You deducted in the next year. Then deduction will be for the next year. 30% or 100% deduction will be for the next year only. This year that 100% or 30% will be disallowed. If deduction is in this year, within due date you paid, this year only you will get complete deduction, no disallowance. But within the due date you did not pay. Then in the year in which you actually pay, getting the point, after due date if you paid to the department the TDS, the date comes under which year you check out. The date for that year you compute income rate, once again PGBP, that time whatever is disallowed in this year, no 100%, 30%, that year you can claim deduction. Are you clear? Now here there are 6 sections: 194A, 194C, 194J, 194I, 194H and 194R. In these 6 sections, there is a provision. There is a provision. What this provision says is, suppose in the previous year, preceding the previous year, correct? Suppose let us assume 22-23 is the year for which we are doing the problem. If 21-22, if the turnover is less than 1 crore, not exceeding 1 crore, if the turnover is not exceeding 1 crore and the SSE for whom PGBP income we are computing, if that SSE is an individual or HUF, if the SSE is an individual or HUF and turnover in the last year, from 22-23 previous year point of view, last year is 21-22. So in the last year, if the turnover is not exceeding 1 crore, these 5 TDS provisions do not apply. These 5 TDS provisions do not apply. Now tell me, 194I know, one example is rent. 194J no, some professional fee. 194C no, contract. This is interest. So if in the last previous year, if the turnover is not exceeding 1 crore from the business, in this year, these 6 TDS sections will not apply at all. Which means if I pay any amount belonging to these TDS sections, I no need to deduct any TDS. Now 22-23, I paid some 5 lakh rent. Actually 10% TDS 50,000. You know what? I did not deduct. I did not deduct. Why? In 21-22, my turnover is less than 1 crore. Therefore, in this year, 194I provision will not apply for me. So I did not deduct. Now here the SSE did not deduct TDS. Is it a non-compliance? No. It's not a non-compliance. What is a non-compliance? If TDS provision is applicable, but you have not deducted. TDS provision is applicable, you deducted and failed to pay within the due date. Then only it is called non-compliance. Here, these 6 sections, 194R is perquisite for business. Okay. In these 6 sections related amount, TDS itself will not apply. And you did not deduct. So where is the question of non-compliance? So disallowance will not arise. Why? TDS provision itself do not apply. If TDS provision itself do not apply, disallowance provision also will not apply. Disallowance under 40A subsection 1A, 40A subsection 40 subsection A clause 1A. When this is applicable, TDS is applicable. You failed to deduct, or you deducted but failed to remit. Then only non-compliance, then only disallowance will apply. Understood or not? On this, there is a problem in PGBP, and many times on this a question has been asked in CA final as well as CA inter also. Yes or no? Many students do wrong. Why? Because they don't understand exactly the compliance word under TDS, under 40A, 140A, 1A. And here there is one more discussion on SSA in default provision. Okay, which is again a very big discussion. It's not required at this CA inter level. It is not required. I hope you are clear with respect to 40 subsection A clause 1, 40 subsection A clause 1A. Next, 43B. 43B is what, you know, the section heading is like certain payments, certain expenses allowed as deduction, only on actual payment, within due date for filing IT return, only on actual payment within due date for filing IT return. Certain expenses, they are allowed as deduction only if they are actually paid. You know, in PGBP, how income is computed under income tax? Income is either computed on accrual or cash, whichever the SSE regularly follows for accounting. Suppose if the SSE is maintaining books of accounts on accrual, PGBP income is also computed on accrual basis. If the books of accounts are maintained on cash, then PGBP incomes and expenses are maintained. Deduction will be given only on cash basis. Now remember, 43B section is applicable only for the SSE who is following mercantile basis of accounting. This section is not applicable for an SSE who is following cash basis. Cash basis means what? Within 31st March, if I pay any expenditure, irrespective of period it belongs to, irrespective of the year for which it belongs to, doesn't matter. I paid some expenditure, I can claim deduction. I received some money, it is taxable. That is cash basis. So in cash basis, from 1st April to 31st March, whatever incomes I received, taxable. Whatever expenses I paid, deductible. Of course, disallowances, provisions and all common. TDS, compliance, everything we need to check. Now 43B, this section says this is applicable for those SSEs who are following mercantile. What does it mean? Mercantile means what? If you incur expenditure, you can claim deduction under PGBP. Whether you actually paid or not, doesn't matter. That's what mercantile. However, there are 7 payments, 6 to 7 payments were there. These 7 expenses, you will get deduction only if it is actually paid. Remaining all other deductions, you can claim on accrual. Rent expenditure, you claim on accrual. Salary, you claim on accrual. Electricity bill, you claim on accrual. Telephone expenses, you claim on accrual. You incur, you claim. Whether you really paid or not, we don't even check. But these items which are covered under 43B, the SSE will get deduction only if we actually pay. Only if we actually pay. Pay within 31st March. No. Pay within the due date for filing IT return. If the SSE cleared these expenses within due date for filing IT return, okay, fine. We assume that SSE really spent, we will give deduction. So what are those expenses? What are those expenses? I will directly show you. Taxes, bonus or commission, like that. There are railway expenses, employer contribution to welfare funds. I hope you remember already. I'm just reminding you. So taxes and duties, other than direct tax, nothing but GST, all that. First of all, GST is not an expense, not an income. But why it is, why that discussing anyhow, that is not important right now. But I have discussed this in regular class. Now we don't have that much time. Employer contribution to provident fund of the employee, employer contribution to approved superannuation fund, employer contribution to gratuity fund. Getting it? Gratuity fund is covered under 48(7). That is not covered here, by the way. Okay, gratuity fund is not covered. Provident fund, employee state insurance, superannuation fund, all that were covered here. Getting it? Employer contribution. Getting it? Bonus or commission. Remember, there is also something called employee contribution. Employee, I hope you know employee contribution, all that. Employee contribution, what we will do while we are paying salary, we deduct from that. Means we collect the employee contribution from employee and we pay to the department. Suppose no, amount of contribution from employee we collected. We did not pay to the department within the respective law due date. It is treated as income. 36 subsection 1 clause 5A, read with 2 subsection 24 income definition. So this section which I wrote right now, this is talking about employee contribution. If a business person collected employee contribution from employee, failed to pay to the concerned statutory department within the respective due date mentioned there. Generally, as per Provident Fund law, current month Provident Fund contribution we should pay by next month 10th or 15th or 20th. If at all you don't pay, employee contribution you collected but you don't pay, it is treated as income taxable in the hands of the employer, business person. For employer contribution, my contribution is 0. If I pay not within the next month due date, I have due date up to 31st July, 31st October, IT filing due date. For employer contribution, due date means IT filing due date. For employee contribution, due date means next month, statutory, that provident fund law due date. If employee contribution is collected but not paid to the respective department within the due date mentioned in that respective law, it is treated as income. It's not disallowance, it is treated as income. Employer contribution, which is an expenditure for him, which he want to claim deduction under section 36. In order to claim deduction, he must remit that amount to the provident fund authorities, to the ESI authorities within the due date for filing IT return. I hope you understood this difference. Bonus or commission. Interest on loans from financial institutions, NBFCs, banks. So whether if you borrow any loan from bank, FIs and NBFCs and all, whatever interest expenditure that you are incurring for business purpose, you can claim deduction only if it is actually paid within the due date for filing IT return. Leave encashment. Suppose your employee submitted leave encashment application, you created a provision in the books of accounts for leave encashment. You will get deduction only if you pay within 31st July, within 31st October. Payment for railway assets. You are continuously using some railway assets of Indian Railways. If you pay that amount within the due date only, then you will get deduction. Otherwise, no deduction for this year. So for a respective year, for relevant year, whatever expenditure you spend on accrual basis, getting the point, you will not get deduction only until you pay within the due date. If you pay within the due date, you claim deduction. If you do not pay, no deduction. Subsequently, next year you paid, you will get deduction for that year. After due date, you paid. After due date, you paid. So for the original year, we disallow. The year in which you ultimately paid, we will give deduction to you. You clear? That's 43B. See, 43B, 40 subsection A, clause 1A, these are temporary disallowances. Why? In the year in which you did not comply, we disallow. Subsequently, after due date, if you ultimately paid, we will allow deduction for that year again. Whatever we disallowed, we re-allow it. So that's why I call this as temporary disallowances. I hope you are clear. Next, we have 40A3. So in this, we have 40A3. So 40A2, if at all you are incurring any expenditure, where the amount is paid to related person, relative. If at all any amount is unreasonable, income tax officer, assessing officer will disallow it. 40A subsection 3. This is regarding cash expenditure. Suppose you are having so many expenses, from 30 to 37, so many expenses, so many revenue expenses which are deductible under 30 to 37. Generally, whatever expenditure you incur, you can claim deduction subject to TDS compliance, subject to 43B, all that. Further, there is one more condition. If at all that expenditure is paid in other than, if at all that expenditure is paid in cash or bearer check for an amount exceeding 10,000 rupees in a single day to a single person. Getting it? On a single day to a single person, if you pay any amount more than 10,000 rupees, which is an expenditure for your business, entire amount is disallowed. Once disallowed, that's it. You can't even rectify later. This is very simple. Department want to bring transparency. If you pay by cash, how do we know that you really spent? How do we know that other person has got the income? If you pay by bank, what happens? You show it as expenditure. Other person also, it is bank, white money. Yes or no? Department can trace it. So with that logic, department put this 40A3. Are you getting it? So 40A3 simply says, if you incur any expenditure and that expenditure is for more than 10,000 rupees, on a single day you paid that money to a single person, exceeding 10,000 rupees in cash, disallowed completely. If you do not want this 40A subsection 3, if you don't want this to attract, pay by account pay check, pay by account pay demand draft, pay by electronic mode, UPI, BeamPay, RTGS, NEFT, any of these methods is permitted. Wherever the other person is traceable, that is permitted. Now, here for transport operator, suppose if you are paying any amount expenditure to a transport operator who is hiring, leasing goods carriage vehicles, transport operator, instead of 10,000, the limit is 35,000 rupees for a single day. You have to pay freight charges to transporter up to 35,000 rupees on a single day. You can pay by cash. The moment it crosses 35,000, entire amount is disallowed. It's a threshold limit. Suppose I paid 20,000 in cash. Up to 10,000, leave it. 10,000 disallowed. Wrong. It's a threshold limit. If I pay 20,000 in cash to somebody, since it is exceeding 10,000, entire 20,000 is disallowed. It's a threshold limit. So for transport operator, what is the threshold limit? Suppose I am paying to a transporter. So to a transporter, how much I can pay? Up to 35 you can pay. The moment it exceeds 35, entirely disallowed. Now there is a rule called Rule 6DD where they have given certain exceptions. Bank holiday. On the day you paid expenditure, this section will not apply. So like that they have given certain exceptions. So on those exceptions, even if you pay by cash more than 10,000, more than 35, doesn't matter. Disallowance will not attract. Are you clear? So that's it. So disallowances are completely done. I hope now you understood 40 subsection A clause 1 clause 1A 43B. Both these are temporary. You may disallow now for this year because you didn't comply. Later on if you comply, again elements will be there. There is 48.2 once disallowed. Now let's look at 40B. This 40B is talking about limit on interest on capital paid to partner. Interest on capital paid to partner by a partnership firm, and this is also talking about remuneration to working partner. Now very simple, how to compute income. First compute income of the firm, PGBP income of the firm before interest and remuneration to partners. Don't reduce interest paid to partner, remuneration paid to partner at all. Calculate incomes minus all the expenses you reduce, all the disallowances, 40 subsection A clause 1 clause 1A, 43B, 40A2, 40A3, 40A7, 40A9, all disallowances, all deductions, everything you consider. But interest paid to partner, remuneration paid to partner, don't consider. All other expenses you reduce, all disallowances you apply. Like that, compute income of the firm under PGBP. First compute. On that, first interest on capital you can claim deduction. How much? Up to 12% per annum simple interest you can claim. Reduce it. To the partners, no, you can pay interest on capital, right? That interest on capital you can reduce. Whatever interest you are paying. Maximum limit is 12% per annum. Provided partnership deed should have that condition. Getting the point? If partnership deed is not having interest on capital condition, the firm cannot claim this deduction. So the partnership firm should have, and maximum deduction is how much? Up to 12% per annum only interest can be claimed as deduction. Suppose if the firm is paying 17%, 18% interest, no deduction. Only 12% of capital, simple interest, that too. Only that will be given as deduction. Now, first, what we have calculated? First, we have calculated income under PGBP as per PGBP provisions of the PGBP provisions for the partnership firm before reducing interest, before reducing remuneration. First compute that. Getting it? From that first reduce interest. Now what you will get, this is called as book profit. Whatever the figure that you get is called as book profit. Many students have doubt about book profit definition. Book profit definition, you see, it is nothing but income computed by applying all the provisions under chapter 4D, nothing but PGBP. Yes or no? Before reducing interest on capital, after reducing interest, but before reducing remuneration. So that this amount is called as book profit. Now from this, just a minute. Now, so PGBP income of the firm. So first compute PGBP income of the firm before reducing interest, before reducing remuneration, but after reducing all the deductions, depreciation, additional depreciation, 35 AD, disallowances, everything you apply. Compute income of the firm, PGBP income of the firm. Now reduce interest on capital up to 12%. Suppose if the firm is paying 10%, then 10% only. If the firm is paying 14%, then 12% only. Then what you get is book profit. What you get is, we call it as book profit. Now from that, the firm can claim deduction for remuneration. From this, the firm can claim deduction for remuneration to only working partner. If at all the firm is paying remuneration to non-working partner, no deduction. Only to working partner, if the firm is paying remuneration, firm will get deduction. Now, to this remuneration, there is a limit. What is the limit? There is a limit on deduction for remuneration. See, for interest, 12% is the limit, right? For remuneration also, there is a limit. How to identify the maximum limit? It is depending upon the book profit of the firm. Up to 3 lakhs. Up to 3 lakhs of the book profit, identify. Balancing figure. Suppose if the book profit is 2 lakhs, then here 2 lakhs. So balancing figure. Now, like let us take an example. Suppose if this book profit value, let us claim it is 10. How to split 3 lakhs we will allocate here, 7 lakhs I will allocate here. Suppose this is only 2 lakhs, then I will allocate up to 3 lakhs means 2 lakhs here. Here it is 0. Got point? Now, up to first 3 lakhs, 90% of the book profit or 1,50,000 rupees, whichever is higher. On the balancing figure book profit multiplied by 60%. So here you will get some amount, here you will get some amount. So these two put together is the maximum permitted remuneration to working partner. Are you getting the point? Now compare this maximum amount with actually how much we pay to working partner. Suppose, I'll take one example. Suppose the firm book profit is, let us assume 10 lakh. So I will split first 3 lakhs into 90% is equal to 2,70,000 or 1,50,000, whichever is higher, is equal to 2,70,000. Now what is the balancing figure here? 7 lakhs. Out of 10, 3 allocated here, 7 into 60% is equal to 4,20,000. So if the firm book profit is 10 lakh, 6,90,000 is the permitted remuneration. Now suppose how much firm actually paid? Firm actually paid 8 lakhs remuneration to working partner. So deduction is 690. Suppose if the firm paid 5 lakhs only remuneration to working partner, then 5 lakhs only the deduction. Suppose if the book profit of the firm is, 2.5 lakh only. Now up to first 3 lakhs means 2.5 only we have into 90%. Getting it? So 2.5 lakh into 90% means 2,25,000. Balancing figure, nothing, 0. So this is the permitted. Suppose if the book profit of the firm is negative, book profit of the firm is loss 10 lakhs, up to 3 lakhs, nothing, 0, 0. Getting it? Now first point, 90% of 0 or 1,50,000, whichever is higher, 1,50,000. So if the book profit is negative, minimum remuneration firm can pay is how much? 1,50,000. Even if the firm is having loss, book profit is minus book loss. Getting it? Firm can pay up to 1,50,000 rupees remuneration to working partner. If the remuneration paid to working partner is beyond 1,50,000, then apply these limits and check out what is eligible remuneration. Compare with actual remuneration, whichever is lower, you claim deduction. So that's 40B. Further remember, so this is how. So remuneration to working partner calculate like what I told. Then whatever final amount which you get is called as income of the partnership firm. Income of the firm. So on this income, firm will pay 30% tax, and after that whatever balance profit is there, partners will distribute, and that's called share of profit, which is exempt in the hands of partners under 10(2)(a). Now here partners are receiving interest on capital and remuneration from the firm. No. What about this in the hands of the partner? It is taxable in the hands of the partner under PGBP. Salary received by partner from the firm, salaries income. No, it's PGBP. Even salary charging section 15 clearly says that. Provision clearly says that. And even 28 charging section clearly says any remuneration or any interest received by a partner from the partnership firm is taxable in the hands of the partner under PGBP. How much is taxable? Firm, how much deduction they claim? That much is taxable. Suppose partner received 10 lakhs remuneration, but firm we gave deduction 5 lakhs only. 5 lakhs only taxable for partner. How much deduction came for the firm? That much only taxable for the partner. For firm, how much we showed expenditure under income tax? For somebody it's expenditure, means for somebody it is income. Whatever is showed as expenditure, that is only allowed as income. How much actually paid doesn't matter. How much firm claimed, that is only taxable in the hands of the partner. So that's why they say 28. Any interest on capital or bonus or commission or remuneration, salary pay, whatever name called, received by a partner from partnership firm is taxable in the hands of the partner under the head income from PGBP to the extent allowed for the firm. That's it. So with this 40 subsection B is also completed. Now whether the remuneration to working partner, interest on capital to the firm, interest on capital to the partner, both are allowed as deduction only if the terms are contained in partnership deed. Remember, if at all partnership deed do not contain, now fresh partnership deed is drafted with retrospective effect, no, it is not considered, no deduction at all. Partnership deed is there. Now the firm is paying interest. Now the firm is paying remuneration. Allowed as deduction, subject to maximum limits given under 40 subsection B. I hope you are clear. That's it. 40B is also completed. All the disallowances I completed within just 30 minutes. In the next video, I will talk 44 series, where I will cover 44 AD, 44 AE, 44 ADA. I hope you are clear. In the next video, PGBP is over. predominantly theme of the PGBP, concept of the PGBP I clearly explained, especially the computation mechanisms. This particular computation mechanism, please observe carefully. Many students do not understand how to compute book profit because they confuse. If at all you're benefited, put it as a comment. Just put a comment below. I'll feel very happy for you. Okay, take care. So let's start the final part of the PGBP marathon. This is the 4th video. Before this, 3 videos I have uploaded. Please watch it if at all you missed to watch. PGBP. Almost I can say 70% of the syllabus I uploaded in the form of revision videos for income tax. Fine. Presumptive taxation. What is presumptive taxation? Generally in PGBP, how income is computed? There are various sections, 30 to 37 deductions. There are various disallowance sections, 40 series, 40A, 43B, 40A3, 40A2, 40A subsection 1, 40 subsection A, clause 1, clause 1A, so many. So we claim deductions subject to disallowances, all that, partnership firm, so many. So that's how we compute income under the head PGBP normally. But you have an option to pay directly. Getting it? You have an option to compute income from PGBP very simply. No need to look at what is your actual expenditure. No need to look at depreciation, additional depreciation, scientific research, specified business. Nothing. Straight away on turnover, some percentage can be applied. That itself is treated as presumptive income by the department. You know what? As per 44 AD, as per 44 AD, as per 44 ADA, as per 44 AE, in all these 3 sections, whatever the presumptive income, minimum income that you should declare, this is minimum you should declare. If at all you are doing business of plying, hiring, leasing of goods, carriage, this much income minimum you must show, you must offer for income tax. This much income for a profession, you are a notified profession like a lawyer, medicine, doctor, chartered accountant, company secretary, film artist, representative. This is the minimum amount you must offer. Suppose if you want to say, see, this is, these are the minimum amounts which SSC has to offer, minimum. If at all you want to offer less than this, if at all you want to say that your income is actually lesser than this, you must go for tax audit under section 44A. Presumptive income, many assume that it's optional. No, that's a minimum income that you must show. If at all you're showing this much, department cannot question anything further. You need not maintain books of accounts. You need not follow all the disallowances, deductions, nothing. Straight away declare presumptive income, happily file ITR 4. There is a return called ITR 4. File that, over. No tax audit, no books of accounts, nothing. Now, in order to go like this, there are some conditions to be complied. Now, like there are 3 sections. One is 44 AD, another is 44 AE, another is 44 ADA. AD and AE both are talking about business people. ADA is talking about notified professions. So if the SSC is engaged in normal profession, presumptive taxation is not applicable. Very simple. Now, suppose if you are a chartered accountant, lawyer, doctor, film artist, authorized representative, interior decorator, engineer, technical consultant, software, like getting it. So for all of you, if your total gross receipts, not exceeding 50 lakh, maximum gross receipts in that year is less than or equal to 50 lakh. Happily, suppose if your gross receipt is 40 lakhs, what is your PGBP income? How much is my actual expenditure? How much is depreciation? What are the blocks? That and all no need to see. 50% of 40 lakhs is equal to 20 lakhs. This is your income from business or profession. Show it, file the ID return. Over. Oh, so simple, no? All in the previous 3 parts we discussed so many deductions, depreciation, additional depreciation, 30 deduction, 31 deduction, 31 deduction, 37 deduction. So many were there, so many disallowances, that and all headache you can ignore. Happily on the gross receipt, nothing but turnover. For professions, we use the word gross receipt instead of turnover. On the gross receipt, straight away declare 50%, which is 20 lakh in our example. Maximum up to 50 lakh turnover only you can go like this. Suppose the moment your gross receipt crosses 50 lakh, you cannot come to 44 ADA. Able to understand? You cannot come to 44 ADA. If at all your gross receipt is more than 50. If it is up to 50, flat 50% of the gross receipts you can show and then happily file the IT return. Every year you check. Suppose this year, first year, some 40 lakhs is here, 20 lakhs. You declare income, profit, file IT return, pay tax on 20 lakhs. Fine. Next year, your actual income is 10 lakhs only, but presumptive income is coming 25 lakhs. File 10 lakhs only, get tax audit, maintain books of accounts. If you want to declare income less than presumptive income under 44 ADA, under 44 AE, if you want to say your actual income is less than these two, section 44 AB tax audit provision says audit is mandatory. If audit is mandatory, you have to maintain books of account. That's about 44 ADA. Now 44 AE. 44 AE is the presumptive taxation section applicable for SSE engaged in flying, hiring, leasing of goods carriage vehicle. You are simply a transport operator. You are a transporter, or you are renting. You are hiring goods carriage vehicles. You are renting goods carriage vehicles. So you also can have presumptive taxation. Now, how much is presumptive income? Vehicles, carriage goods vehicles, they will be classified into two types: light good vehicle, heavy good vehicle. Light good vehicle, what is the presumptive income? 7,000 rupees per month, 7,500 rupees per month for ownership period. How many months you use, that and all doesn't matter. You are owner for 11 months, that's it. For 11 months, 7,500 per month you have to declare income. Or even suppose you are owner for 11 months 3 days, still 12 months it is considered into 7,500. Remember, 7,500 is per vehicle. This is per vehicle. Further, under 44 AE, this presumptive income can be declared by a transporter who does not own 10 goods carriage vehicle at any point of time. 1st April to 31st March, 365 days. Every day, how many vehicles he is having? Check out ownership. On any single day, if at all the SSE is owner for more than 10 vehicles, is owner. Which vehicles? Goods carriage vehicle only you should check. If at all the SSE is owner even for 1 day, even for 1 hour, more than 10 goods carriage vehicles, 44 AE will not apply. So in order to apply 44 AE, the number of goods carriage vehicles owned by you throughout the year at any point of time shall not exceed 10. If so, you can declare presumptive income under 44 AE. How much? 7,000 rupees per month or part of a month for every month of ownership for each vehicle. Suppose if it is heavy good vehicle, then heavy good vehicle, vehicle capacity will be given in gross vehicle weight. So they will give some tons. 1,000 rupees per ton per month, or even part of a month. Suppose you are having 5 heavy goods vehicle. You purchased on 29th April, 2022. And you sold, you only have 5 vehicles. You purchased on 29th April. You sold all the 5 vehicles on 30th April, next day itself. 1 day only your owner. Still, for 5 vehicles, 1 month multiplied by these 5 vehicles, light good vehicle will be 7,500 per month. This much is presumptive income. Sir, I am owner for 1 day only. Still, it is considered. Even if you owner for 1 month in a day, 1 day in a month, if we consider that you are owner for full months, for entire that month, presumptive income at 7,500 per vehicle will be computed. Now, by the way, 7,500 is for light good vehicle. Suppose if the vehicle is heavy good vehicle, suppose these 5 vehicles are heavy good. Each vehicle is having 20 tons carrying capacity. So 5 into 20 tons into 1 month multiplied by 1,000 rupees per ton. 1,000 rupees per ton per month is equal to that much is the presumptive income. Able to understand. Suppose, by the way, I have highlighted here some words I will discuss at last. Suppose you are doing any other business, not profession, business, some other business, but not flying, hiring, leasing of goods carriage. Now, how much is presumptive income? Suppose you are doing some business, right? You will receive consideration, right? If you are receiving through bank turnover, or you may be receiving in cash also, cash turnover. On cash turnover, 8%. What is it? On cash turnover, 8% is the presumptive income. On bank turnover, 6% is the income. By the way, these are not tax amounts, man. These are income under PGBP. Remember, these are treated as income under PGBP. 6% of turnover. Suppose I received in bank 90 lakh, whereas I received in cash 10 lakh. 10 lakh into 8% is 80,000, and 90 lakh into 6% is 5 lakh 40,000. So totally my income is 6 lakh 20,000 from the business as per presumptive taxation. That's it. Got clarity? So this is presumptive. Now for 44 AD there is a condition. If you want to claim 44 AD, so simple, directly on turnover apply 6%. If it is bank mode of turnover, if it is cash mode of turnover, apply 8%. So simple, that itself is income, final income under PGBP. Then calculate other heads, set off and carry forward, clubbing, gross total, minus deductions, total income, compute tax, file ID return, over. Now, in order to go for 44 AD, see, when I can choose 44 ADA and I should be professional, my gross receipt shall not exceed 50 lakh. When I can go for 44 AE, I must be engaged in this business and my number of vehicles shall not exceed 10 at any point of time. Same way for 44AD, the turnover shall not exceed 2 crore in that year, not last year, in the respective year. Suppose 22-23, my turnover is less than 2 crore. For 22-23, whatever turnover is there on that 6% or 8%, as the case may be, I can apply and compute my income. It's not last year, preceding year turnover, it's current year turnover, relevant year turnover only we should see. So in that year, if your turnover is less than 2 crores, you can come for 44AD. You know, there is one more condition in 44AD. Once you choose 44AD, you know, assessment year, nothing but previous year 22-23, nothing but assessment year 23-24. So in this assessment year, on this income, you declared under 44AD. For the next 5 years also, nothing but 23-24, 24-25, 25-26, 26-27, 27-28 also, you must declare under 44AD. This is a compulsory condition. Suppose if at all any 1 year 25-26 you failed, you felt 6%, 8%, I have a loss, I don't have profit. So you felt 6%, 8% coming to some income profit, but you actually have loss. So you don't want to go with 44AD. You violated this 5 years condition. What happened? For this year, you have to maintain books of accounts. You have to get them tax audited. And the next 5 years means 26-27, 27-28, 28-29, 29-30, 30-31. For these 5 years, you cannot claim 44AD again. You cannot come back. So once you choose 44AD, presumptive taxation, only for 44AD, this 5 years logic is applicable. Once you choose presumptive taxation under 44AD and declare 6% of the bank turnover, 8% of the cash turnover as presumptive income, next 5 years also declare as per 44AD. If you couldn't declare as per 44AD in the next 5 years, any 1 year you break, that year audit is applicable, books maintained. Next 5 years also, you cannot come back 44AD at all. This is the prohibition. So this prohibition is kept under 44AD subsection 4. Able to understand. Now, this 44AD, this is very important. 44AD can be claimed only by a resident individual or HUF or a firm, but not LLP. Company cannot claim 44AD. 44AE, like plying, hiring, leasing, goods carriage. Any SSE can claim this provision, this benefit. LLP, company, everybody. Again 44AD, only individual, firm. Again LLP is not covered. So presumptive taxation, basically individual, HUF, partnership firm, but not LLP. Whereas 44AE alone, any SSE can claim. Be able to understand. So this is presumptive taxation. Very simple. 44AD, if the SSE is engaged in any business, getting it, other than commission business, agency business, other than these businesses, getting it, and applying, hiring, leasing of goods carriage. Other than these 3 business, any business SSE can declare income under 44AD. Now how much you can declare? PGBP income, 6% of bank turnover plus 8% of cash turnover. That is a presumptive. What is the condition? Turnover in that year shall not exceed as a whole 2 crore. Getting the point? Further, once you declare income under 44AD, all the succeeding 5 years also you should go with 44AD. Any 1 year you fail, that year audit is applicable, books you have to maintain. Next 5 years, you cannot come back to 44AD once again. Then 44AE, SSE is engaged in plying, hiring, leasing of goods carriage vehicle. And the number of goods carriage vehicles owned by the SSE throughout the year, not even 1 hour, not even 1 day, more than 10. Then 44AE he can opt. As for that, for light good vehicle, 7,500 rupees per month straight away or part of a month is presumptive income for the period of ownership. For heavy good vehicle, 1,000 rupees per ton per month or part of a month for the period of ownership will be treated as presumptive income. 44AD, 50% of the gross receipt is presumptive income, provided turnover shall not exceed 50 lakh. Now, if the SSE is declaring presumptive income under 44AD or under 44AE, they can simply pay advance tax in single installments, 15th March itself. Generally, advance tax is to be paid in 4 installments, 15th June, 15th September, 15th December, 15th March of the relevant previous year. But SSEs who are following these 2, getting it, they can pay advance tax by 15th March itself, single installment. Whereas 44ADA, no exemption for advance tax. They have to pay all the 4 installments. Getting it? All that points were covered here. All that points were covered here. Getting it? So advance tax points is covered here. I think, sorry, I said ulta. I'm sorry. Here 44AD, 44ADA. For them, advance tax is single installment. 44AD, all the 4 installments they have to pay. Remember, this is important for MCQ. They may be testing it. So if the SSC is engaged in plying, hiring, leasing of goods carriage, they have to pay 4 installments of advance tax without fail. Whereas 44AD a person, they can simply pay single installments of advance tax. That's it. Further, for, in case of 40AD, 44AD, in these two cases, all the expenses under 30 to 38, no more deduction at all. Even in case if it's a partnership firm, remuneration, interest paid to partner, no deduction at all. 44A, that provision is missing. They can claim deduction in respect of interest on capital, remuneration paid to partner, they can claim deduction after computing presumptive income. So 7,500, 1,000 rupees per month, you compute income. From that, you can still claim minus interest. Then you get book profit. From that, you can again claim remuneration. I told you how to calculate remuneration, eligible remuneration. So in case of 44AE, how to compute book profit? That 1,000 rupees or 7,000, that amount you calculate, right? From that amount, interest on capital to partner you reduce. So whatever the amount you get, no, this is called as book profit. On this you apply up to 3 lakh, 90% of book profit, or 1.5 lakh, whichever is higher, balancing figure, 60% of book profit, yes or no. This is the eligible remuneration. Compare with the actual remuneration. So if actual is less than eligible, actual. If actual is more than eligible, then eligible. That's it. So clearly, I hope I clearly explained to you all the entire points. So there is an illustration which is given here. If you want, you can solve it. Okay. Oh my God, PGBP took 1.5 hours. Better. In 1.5 hours, we could be able to complete only concepts. That too, I can say 60% of the PGBP concepts we covered. Important concepts we covered. Some 30 to 40% we didn't cover. Okay, not even 30, I can say 20% only, because remaining provisions are jujube, small provisions. 80% of the PGBP provisions we covered, main important provisions. With this, PGBP presumptive taxation is over. I hope you are clear with presumptive taxation. All the points I've covered here. So now, just once again you listen to this video. Just it is 15-16 minutes we write. Once again listen to it. You will have more clarity. Okay, take care. So with this, PGBP marathon is also completed. By the way, PGBP marathon has another 3 parts. This is 4th part. So past 3 parts also you watch it. Just to go to caramharsha YouTube channel, playlist you open, income tax revision you will find. Inside that you will find. Okay, take care. So let's discuss the amendments on business or profession chapter. In this note, there are 2 major amendments. One is regarding 43B, where in the Finance Act 2023, another clause has been inserted, that is clause number H. And another amendment is regarding presumptive taxation monetary limit. In order to go with presumptive taxation under 44AD, 44ADA, the monetary limit has been increased for those SSCs whose predominant transactions are in other than cash. So these are the 2 major amendments. So first thing I will cover with 44AD, ADA related amendment, which is a very simple amendment. We all know the SSC can offer income under the business or profession straight away as per 44AD for all businesses except plying, hiring, leasing of goods carriage vehicles, for which 44AE is available. So except an SSC engaged in plying, hiring, leasing of goods carriage vehicles, all other SSCs can declare straight away 6% of turnover or 8% of turnover if the turnover is received in cash. If the turnover is received in other than cash, 6% of turnover as presumptive income. So the SSC can directly declare a presumptive income. So no further, no deductions, no disallowances, nothing. Straight away that is treated as income under the head PGBP. So we all know. Now, in order to declare like that, the maximum turnover the SSC shall have is 2 crore. Maximum turnover. If at all the SSC is having more than 2 crore turnover, 44AD option is not available. Accordingly, if the SSC overall turnover is more than 1 crore, then he must go for tax audit. If at all the overall turnover is more than 10 crore, then also tax audit is required. If at all 95% of the receipts and payments are in other than cash. Are you getting it? Now, now you see. So a similar logic is introduced in presumptive taxation. So generally, what is the limit to go for presumptive taxation? 2 crore. And in 44AD, we all know once 44AD is chosen, next 5 years also we must declare with that. If at all we break the chain, 5 years we are prohibited to come for 44AD. So this provision and all, and I also covered that in the marathon. Now let me discuss only amended part of it. Now, this 2 crore limit is increased to 3 crore rupee. Not for every SSC, not for every business person, only for those business SSCs whose 95% of the receipts. Remember here, they are only covering receipts part. They are not covering payments. Why? In presumptive taxation, we are not worried about payments. We are only worried about receipts. Yes or no? We straight away declare income as a percentage of receipts. Straight away, yes or no? So department want which criteria? Obviously to be very strong, receipts only. So here 95% of payments is not covered. So the transactions in receipts, the receipt transactions in cash shall not exceed 5%. In other words, minimum 95% of the total receipts must be other than cash. Here payments is not covered. Please remember this, payments is not covered. If you look at 44AB, the normal turnover is 1 crore. Suppose if 95% of receipts, 95% of payments, both are in other than cash, then tax audit limit applicable in this case is 10 crore. I hope you are aware of this. In this case, both receipts and payments in both of this 95% must be other than cash. Whereas in presumptive, 2 crores limit is there, right? That is increased to 3 crore for which assessees? For those assessees, if 95% of receipts, there is no payment condition. 95% of receipts, if it is in other than cash, the limit applicable is 3 crore. So up to 3 crore turnover, you can go with the presumptive taxation and declare just 6% or 6% or 8% as the case may be. Of course, 8% will not be possible. Why? Because majority of the receipts are other than cash, which means you just have to declare minimum 6%. This is the minimum income. And we all know, if at all you want to declare lesser than this, audit is required, all that, that's a different story altogether. Then, with respect to professions, with respect to notified professions, standard limit is what? 50 lakhs. So, any notified professional, if is present, if at all gross receipts are not exceeding 50 lakhs, straight away, he can declare 50% of the receipts as business income. Correct? Huh? Now, this 50 lakhs limit is increased to 75 lakh. The 50 lakh limit is increased to 75. For which professionals? Only those professionals whose 95% receipts are in other than cash. Remember, that is minimum 95%. If 100% are in other than cash, well and good. But minimum 95 must be other than cash. And the same, whatever in the ICS study material is there, the same is reproduced here. Any business other than 44AE business whose total turnover or receipts in the previous year is not exceeding 300 lakhs, if aggregate cash receipts in the previous year is not exceeding 5%. For professionals, not exceeding 75 lakhs. Getting it? Actually, here there is a slight mistake. So, whose gross receipts here? Actually, it's a diagrammatic mistake. It's 75 lakhs. Getting it? So, for those assessees whose 95% of receipts, 95% of the receipts are minimum in other than cash, 75 lakhs is the limit. Normal assess is 50 lakh. So this is the amendment under business or profession. Just a minute. Yes. So that's it. So this is 75 lakh is the limit. Fine. I hope you are clear on this. Very simple. Nothing. No other changes in 44AD. No other changes in 44ADA. That's it. So here in the institute book itself, there is a mistake. It's actually 75 lakh. Standard limit is 50 lakh. But increased limit is 75 lakh. So institute while copying itself, they made a mistake. But of course, they gave in the subsequent clarification that 50 to 75. The limit will be from 50 to 75 if at all minimum, if the cash receipts are not exceeding 5%. So they clearly gave a clarification later. Fine. Next, then we have one more amendment, very important amendment, which is clause number H, insertion, 43B section. This is very carefully, you need to observe this amendment very carefully because this clause number H, the treatment of disallowance for clause number H is completely different from clause number A to I. Getting it? From the remaining 6-7 clauses, whatever we have, this 8th clause is completely different. What is 43B? We all know. 43B means here, whatever expenses covered under this section, like indirect taxes, interest on loan, bonus or commission, leave encashment, like this, payments to railways, So like this, they have covered certain payments. One more payment which they have added is payments to, one more expenditure that is covered is payments to MSMEs for goods and services procured from them, purchased from them. Whatever, suppose if our business organization is purchasing goods and services from MSME, getting it? Now, clause number H is applicable to us. So generally, what is 43B? What the section says actually? The section says, if at all any expenditure is incurred during the year, mercantile basis. So this 43B section is applicable only for SSCs who are following accrual basis, obviously. So if an SSC who is following accrual basis only, 43B is applicable. So if an SSC who is following accrual basis under income tax for PGBP purpose, all expenses you can claim deduction under accrual basis. Means if you incur, you can claim deduction. But 43B expenses alone, you can claim deduction only if those expenses were actually paid. When it should be paid? By 31st March? No. By due date for filing ITR. For due date for filing ITR under 139 subsection 1. What is the due date applicable? For companies and other persons for whom audit is applicable, or for a partner of a firm which is subjected to audit, for all of them 31st October. For transfer pricing cases, 30th November. Any other SSC, 31st July. These are the due dates that are applicable for filing IT return. So for a particular previous year, return has to be filed by 31st July or 31st October or 30th November. These are the 3 due dates we have. Within this due date, if you pay that expenditure, if you clear the liability enough, you can claim deduction on the accrual basis for that previous year itself. Suppose, if at all you paid that, you incurred expenditure in 23-24, but by 31st July, 30th November or 31st October, you did not settle that liability. You didn't pay that amount. You paid after the date. Then what is the actual year in which it comes under? That year you can claim deduction. You cannot claim deduction under the relevant year where it is disallowed. This point in detail, I clearly explained in the marathon. Please watch the marathon. Now, this clause number H, slightly different. In clause number H, what are they saying, see, MSMEs, there is a law. There is an MSME law. In the MSME Act itself, there is a point. For MSMEs, whatever goods and services you purchased, you must pay them within 15 days. This 15 days is called as appointed day. What is this 15 days is called as appointed day. So whenever you're transacting with MSMEs, whenever you're purchasing any goods and services from them on credit, you must settle the liability within 15 days if there is no written agreement. Suppose if at all you entered into a written agreement to pay the liability, maximum tenure is 45 days if there is a written agreement available. Suppose if at all you entered into a written agreement with MSME that you will be paying within 45 days, happy, you have 45 days time. If at all there is no written agreement, you just bought and you just have to pay. It's like a word of mouth. Getting it? So if at all you want to pay oral contract, you must pay the liability within 15 days. We call this 15 days time limit or 45 days time limit as appointed day. Now very simple. Suppose right now we are talking about which previous year? 23-24. Nothing but assessment year is what? 24-25. Suppose in previous year 23-24, March 10th, I purchased goods from MSME for 10 lakh. I purchased goods from MSME 10 lakh. Observe this example very carefully. This clause number H alone has a different treatment from the entire 43B. From the entire 43B, the treatment is different. For clause number H, the treatment is different. The section treatment is different. Now 10 lakhs I have. Now I purchased this on a written agreement. I purchased this based on written agreement. Okay, there is an agreement. 45 days time I have, which means I have time up to April 25th to settle this liability. April 25th, 2024, I have a liability to settle. Suppose if I paid within April 24, what happens? You will get deduction for the actual year. What is the actual year? I incurred this in 23-24. I purchased goods in 23-24, accrual basis. So for the same year, you can claim deduction. You already debited to P&L, no treatment. You are allowed with the deduction. Suppose if I paid on April 26th or later, if I paid this amount on April 26th or later, but you know what? I paid within the 31st October 2024. For me, the due date for filing IT return. For due date for filing IT return 139 subsection 1 for my entity is 31st October. I paid somewhere on 10th May. I paid from the due date after 45 days. From the due date after 45 days, but I paid it within the due date applicable for IT return. No problem at all. Still, you will not get deduction. Still, you will not get deduction for the 23-24 year. You paid on 10th May, right? Here, 10th May means what? What is 10th May? In our example here, in this case, what is the meaning of a 10th May? You paid the MSME the liability after 45 days of the agreement. As per the agreement, within 45 days you have to pay. Even without agreement also. In agreement, suppose if at all you entered into agreement, where agreement says 90 days time, that's invalid. With an agreement, if you want to pay, 45 days is a maximum criteria, credit period allowed. The maximum credit period allowed for the customers of MSME to pay the liability to the MSME is 45 days. That is a statutory limit. Getting it? If you pay within 45 days, whatever year for which you spent the money, right, for that year you will get deduction. If you pay after 45 days, you will get that as a deduction for the actual year for which it is paid. For example, I paid on 10th May. In our example, 10th May means what? March 10th is a transaction. 10th May is after 45 days, which means you will get it as a deduction under 24-25 previous year. Generally, Remaining 43B section items, what, payments to Indian assets, payments for using railway assets, payments to, payment of interest on bank loan, leave encashment, bonus or commission, taxes. In all these cases, what is the rule, generally? 10th May, if at all you paid those payments, forget about MSME. If at all I made payment on 10th May, taxes or some interest on bank loan I paid on 10th May, or leave encashment I paid on 10th May, belonging to 23-24. We will just think, is it paid within the due date for filing IT return? Is it paid within the due date for filing IT return? Yes. So it is allowed as deduction for the same year. No disallowance is required. For all payments under 43B section, you will get deduction if the amount is paid within the due date for filing IT return. Though you incurred in 23-24, but you pay within the due date, enough, you will get deduction. If at all you paid after the IT return filing due date, you will get deduction for that year. But for MSMEs, what is the criteria that we see? We don't see IT return filing due date. We see 15 days criteria, 45 days criteria. Suppose, I purchased goods from MSME on 10th February. 25th March is the due date, 45 days. I paid on 27th March, but you paid within the same year, right? 27th March also comes in within the same previous year. Though you paid after due date, though you paid after appointed day as per the MSME law, but it comes within the same financial year, you will get deduction. But what if you purchased some goods and services from MSME and the amount is outstanding as on balance sheet date, and then you need to check whether that amount is settled to the MSME within 15 days from the transaction date or within 45 days from the transaction date, check out. If at all it is paid within 15 days or 45 days from transaction date, you complied with the MSME law, you will get deduction for the same financial year for which you incurred. If at all you paid after 15 days or after 45 days from the transaction date, you will not get deduction for that financial year. If at all the amount is outstanding as on the balance sheet date and you did not pay within the 15 days or 45 days, you paid after that, and that date comes under the next financial year, you will get deduction for the next financial year. For that itself, we have given an example here. Mr. A purchased goods worth of 10,000 from A and Co, a MSME, on 1st March. As per the written agreement between them, the payment has to be made by 5th May. Oh, in the written agreement, no, they only have given 35 days time. They only have given 35 days time. Very good. Maximum time is 45 days. If there is a written agreement, as per the agreement time period you have to pay, or maximum worst case 45 days. Suppose if the written agreement contains 90 days, then agreement is not valid. 45 days only considered for law purpose. Getting it? So 35 days only you have to pay. Mr. A follows mercantile method of accounting. What is your answer? He is following mercantile. So he incurred expenditure for which financial year? 23-24 accrual basis. But can he claim this as on 31st March is outstanding? He, as per the agreement, 5th May he has to pay. Suppose he paid on 2nd April he paid. 2nd April means he paid on or before the agreement date, right? As per the terms of MSME he paid, right? The deduction will be allowed for the respective year. Suppose he paid on 20th April. Since he paid after the due date mentioned in the written agreement. For that respective year, he will not get deduction. Mr. A paid the amount beyond the time limit. So deduction would be allowed in the actual year of payment, 24-25. Therefore, for previous year 23-24, that expenditure will be disallowed and that expenditure will be allowed as a deduction in the previous year 24-25. Getting my point? Now, what is a micro enterprise? Investment in plant and machinery, if it is not exceeding 1 crore, turnover is not exceeding 5 crore. Small enterprise means investment in plant and machinery is not exceeding 10 and turnover is not exceeding 50 crore. So you see, and remember here, medium enterprise is not covered, only micro and small enterprises are covered. Medium enterprises are not covered, but actually the law is micro, small and medium enterprises, MSMED Act. So only 2 enterprises are covered, micro and small, only these 2 are covered. So any sum payable by SSE to micro and small beyond the time limit given under section 15 of MSMED Act would be allowed as deduction only in that previous year in which it is actually paid. If that previous year is same relevant previous year, no problem, happily claim deduction. If that previous year comes after the relevant year, then for that year you will get deduction. Now section 15 of the MSMED Act, it mandates payment for goods and services to supplier who is a MSME. MSME by the buyer on or before the date agreed between them in writing, that is as per the agreement, which cannot be more than 45 days from the acceptance or deemed to be acceptance, nothing but which cannot be more than 45 days from the transaction date. So through agreement, you can have a lesser duration. lesser days or maximum 45 days. Getting it? If there is no such agreement, if at all there is no written agreement itself, then the payment must be made within 15 days. That 15 days is called as appointed day. If at all some payable, if at all any amount you have to pay to a micro or small enterprise, if at all it is paid as per the agreement within 45 days or within 15 days, in case there is no agreement, you will get deduction on accrual basis if mercantile basis is followed. If the sum is payable to MSME is not paid within the agreement date or 15 days, then the deduction would be allowed in the previous year in which it is actually paid. Suppose no, year beginning I did a transaction, 45 days later I paid, but in the same year I paid. I will get deduction for the same year. But year end, the amount is outstanding. Transaction happened in the year March month, but the amount is outstanding on March 31st, and you paid in the April or May month. But if it is coming within 45 days or 15 days, as the case, maybe you will get deduction on the accrual basis. If you pay after the 45 days or 15 days, you will not get deduction for the respective year. You will get deduction for the next year. So this is the major amendment 43P clause H. So try to listen to this particular part of this video once again, so get clarity. Remember 43B clause H, for that alone due date means what? 15 days or 45 days as per MSMED law, not due date for filing IT return. For remaining all other payments that are covered under 43B, you incur expenditure in the current previous year, you have to pay that, you have to settle the liability within the IT return due date. If you settle it, you will get deduction. But for MSMED payment only, not IT return due date is the cutoff. The due date is 15 days or 45 days is the cutoff. I hope you understood the difference. You found the difference between the remaining 43B payments and this payment. Next. And whatever remaining amendments, whatever I'm showing you here are just 115 BAC, 32 section under default tax regime. No, if at all you're going for default tax regime, no, you cannot claim additional depreciation. And you cannot claim deduction for contributions to scientific research association for scientific research, to a company for scientific research, to a research association for social or statistical research, to a national laboratory, IIT, universities. You cannot claim deduction. But remember, you can still claim deduction for in-house research, for revenue expenditure, in-house research, for capital expenditure. For these two sections you can claim, because you are spending on your own. You can claim deduction for spending on your own. You can't claim deduction for contributions. If possible, no, open ICA material and solve illustration 5 on this. It's very easy illustration. Okay. And remember, in the new scheme study material, there is another section called 35(2)AB, nothing but expenditure incurred by an Indian company on scientific research which is engaged in biotechnology business. That section is removed. In the old scheme material it is there, in the new scheme material it is not there. But whether this section is there now or not, it doesn't make any difference, because 35 subsection 1 clause 1 is also dealing with the same 35(2)AB. Once upon a time, 4 or 5 years before, no, 35(2)AB has some relevance. Now there is no relevance. That's why Institute removed it from the study material. Next. 35AD, same 35AD, no, here this is just a clarification purpose. I kept this clarification purpose. I think most of you probably know this. Okay, 35AD is what? Under default tax regime, you cannot claim 35AD deduction. If at all you want to claim 35AD deduction, default tax regime 115 BAC will not apply. Further, alternate minimum tax provisions 115 JC, all that is applicable. Next, and we all know the loss of an SSE who is claiming deduction under 35AD, that loss can be set off against another specified business, even though it is not eligible, irrespective of whether the latter is eligible for deduction or not. So whether 35AD, so suppose you have one business that is not eligible for 35AD deduction, but that business falls under that 14 list, you can still set off. So whether you follow, the default tax regime scheme or not, doesn't matter, you can set off. But of course, if you follow default tax regime, you can't claim 35AD set off. Suppose this year, no, for example, this year, no, it's okay, leave it. Let's not make it complicated. Enough. That's 35AD. Now look at the supplementary material 35D. Very basic provision, ma. It's not a big deal. In the supplementary material, no, they have added this. A notification came on 1st August 2023. Remember, all the amendments up to 31st October are applicable for May 2024 exam. So 35D, what is 35D? Preliminary expenditure. Preliminary expenditure can be claimed by domestic company as well as a resident Indian citizen, if at all they incurred for starting the business or expansion of the business. Whatever expenditure that qualifies for preliminary expenditure, 5% of the cost of the project or 5% of the capital employed, whichever is higher, like that, some points were there. So that amount, no, you can claim it as deduction in 5 installments, right? Now, in order to claim a deduction, you need a CA certificate. CA has to certify this. Further, you need to give some documents. As per 35D, the SSE has to furnish a statement containing particulars of the expenditure. How much for feasibility report, how much for project report, how much for market survey report and other survey, how much for engineering services. Like this, you need to give some documentation to the department. What documentation you should give? You should give this documentation to the department. So that's what the notification says. Technically speaking, from exam point of view, not a big deal. This is not a big important amendment at all. So in PGBP, this is not a big amendment or not an important amendment, but which is covered in the supplementary material. So only if you submit all these statements, no, you are eligible for amortization within the prescribed period. So you are eligible for amortization. You are eligible to claim 5 installments deduction only when you give these information to the department. So accordingly, Central Board of Direct Taxes, they have inserted a rule 6A BBB to prescribe that the statement containing particulars of above expenditure is required to be furnished 1 month. When you have to furnish 1 month prior to the due date of furnishing of the return of income, nothing but tax audit due date. This is something similar to tax audit due dates, 30th September maximum. Generally, it is 30th September. Or if at all you don't have a tax audit, then 30th June, 31st July is the due date, right? If you don't have tax audit, 31st July is the due date. 1 month prior means 30th June. So you need to submit this information to the department within 1 month. 1 month prior to the due date for filing IT return, you must submit. Probably this might be tested as an MCQ. Maybe we don't know. This might be tested as an MCQ. This 1 month point might be tested as an MCQ. I don't think so. But if at all tested, you will not be missed. So with this, PGBP amendments are over. Next, no, we have capital gains related amendments. Capital gains related. That's it. This is PGBP. So let's start capital gains revision. So capital gains is the 4th head of income, we all know, and the charging section for the capital gains is section 45. And in 45 we have various subsections. Generally, subsection 1 is predominantly recognized as charging section, primary charging section for capital gains. So what the charging section says? So directly we'll open the book and then read. So any profits and gains arising on transfer of capital asset, getting it, is taxable during the previous year in which transfer takes place. So this is what the charging section conveys. Correct? Just a minute, I'm opening simultaneously so you can, along with me while we are listening to the concept, we will simultaneously revise. So what is there? So the charging section says any profits or gains which are arising on transfer of capital asset in the previous year will be chargeable to tax. Now you see, capital gains is taxable when in the previous year when the transfer is effected. So whatever the year in which we transferred, what you transferred, capital asset you transferred. So when you transfer the capital asset in a particular year, suppose I transferred capital asset on 4th February 2023. 4th February 2023 comes under which previous year? It comes under previous year 22-23. So in this year, on that capital asset, since you transfer, getting it, capital gains will attract. So in this year it is taxable. Accordingly, in the assessment year, you have to file IT return and pay tax on that capital gain. Understood? Now you see in the charging section, there are two important elements. That is, one is transfer, another one is capital asset. So now capital asset is defined under 2 clause 14, whereas transfer is defined under 2 clause 47. Now immediately we have given here also what is a capital asset. And if you observe, capital asset definition starts with the capital asset means. Getting it? See, in capital gains, we have computation formats. So the process of computing capital gain for non-depreciable assets, for depreciable assets, for slump sale, the process of computing capital gains is different. Getting it? Again, for depreciable asset, the SSE is following block of asset approach under income tax law. The computation logic is different. For the SSE who is following SLM method, the computation logic is different. Anyhow, I'll come back to it. Let's first focus on the charging section. So capital asset means what? Capital asset means it's property of any kind. Anything is a capital asset. Getting it? The pen which I am holding, the digital pen. Getting the point? This is Apple Pencil 2. Getting it? So this is a capital asset as per the definition, which is held by an SSE. Whether or not connected with business or profession, it doesn't matter whether it is connected with your business or personal. So even every personal asset of you, every business asset of you, everything is a capital asset. Everything. However, stock in trade is not a capital asset. What is it? Stock in trade is not a capital asset. So if at all you are having any assets in business, with which you are buying and selling commodities. So So trading, you are trading in some goods. Those goods are not capital assets. However, there is a point. Any securities held by foreign institutional investor, or we also call them as foreign portfolio investor. If at all a foreign institutional investors are holding securities in accordance with some SEBI regulations, the securities in the hands of foreign investor is always a capital asset. What is it? Always a capital asset. That's why you see here, stock in trade is generally not a capital asset, right? What they mention, other than securities held by foreign institutional investor, which means suppose I'm a foreign institutional investor. Suppose my organization is a foreign institutional investor. I am buying and selling securities regularly. It's my trading activity, it's my business, but still we call it as capital asset only. Maybe the foreign institutional investors may record that in stock in trade in his books of accounts, but under income tax, the securities held by foreign institutional investors are declared as capital asset. Whether he is trading in them or not doesn't matter. It's a capital asset. So for him, whenever any profit or loss that is arising on these securities, they are accessible under which head of income? Capital gains, not PGBP. Next, any unit linked insurance policy issued on or after 1st February 2021. If any ULIP policy is issued on or after 1st February 2021, which ULIP policy? That ULIP policy where 10 clause 10D exemption do not apply. If that policy, that's an ULIP policy issued on or after 1st February 2021, on that exemption under 1010D do not apply. Why? Because the premium payable on that policy in any 1 year during the tenure of the policy. Suppose the policy tenure may be 10 years or 15 years or 5 years. For any 1 year, if the annual premium payable exceeds 2.5 lakh, then that ULIP policy is not exempt under 1010D. Maturity amount is not exempt under 1010D, and that ULIP policy is treated as capital asset. That ULIP policy is treated as what? Capital asset. For ULIP policy, how to tax capital gains, that is covered under 45(1)(b), but we don't have in our syllabus at CA Inter. Getting it? So just you need to recollect this point. You just have to remember. So unit linked insurance policy is also treated as a capital asset. Actually, ULIP policy is not a property. First of all, understand, it's not a property. Insurance policy cannot come within the definition of immovable property, movable property, no way, because it's an insurance policy. Getting the point? That's why they specifically mention any unit linked insurance policy issued on or after 1st February 2021, which is not exempt under 10 clause 10D because of the premium payable on that policy exceed 2.5 lakh in any 1 year during the tenure of the policy. So these are capital assets, and stock in trade is not a capital asset. And personal effect, what is it? Personal effect also not a capital asset. What is a personal effect? Personal effect must be movable and it must be used for personal purpose. If I am using some asset which is movable, held for personal use, then that comes under personal effect. Suppose I have a car which I am using it for my personal purpose. It's movable. It's a personal effect. What is it? It's a personal effect. Suppose I'm having a phone and it's my personal purpose, I'm using it. It's a personal effect. Remember, suppose if I buy a laptop which is for my practice, nothing but for my profession. Getting the point? So laptop is a movable item, but am I using it for my personal purpose? No, it's a profession, business or profession purpose you are using, which is not personal. It's a capital asset. So in case of business or profession, all movable items which are used for business or profession, they are capital assets. They are depreciable assets. They are capital asset. Only those movable items which are used for personal reason, they are only treated as personal effect. And remember, a personal effect is not a capital asset. Accordingly, whenever you buy and sell personal effect, capital gains provision will not apply. Please make a note. Capital gains provision will not apply on personal effects. Now, there are some, items which are excluded from personal effect definition. There are some items which are excluded from personal effect definition. What are they? So jewelry, archaeological collection, drawing, painting, sculpture, any work of art. These items are movable. These are used by you for personal purpose only. But still, they are not treated as personal effect. Remember, capital asset excludes personal effect. Personal effect excludes these items, which means if these items are not personal effect, if these items do not come under personal effect, it do not come under exclusion from capital asset definition, which means these items are treated as capital assets. So if at all you are wearing some gold jewelry, you or your wife or your family members, if they sell that gold jewelry, even though it is personal used, it is liable for capital gains. Not only that, rural agricultural land is not a capital asset. See, in income tax, they don't use the word rural agricultural land, urban agricultural land like that. They use the word agricultural land not situated in specified area. They have given a word called specified area. Specified area is nothing but what? Urban area. If the agricultural land is situated in urban area, nothing but specified area, it's an urban agricultural land. If the agricultural land is not situated in specified area, that means it's not an urban land, which means it's a rural agricultural land. So if a land is there, you are using it for agriculture purpose, and that agricultural land is situated within the specified area, it's a capital asset. If it is not situated in specified area, means it is there in the rural area, then it is not a capital asset. Now, how to decide what is specified area exactly? Specified area means generally getting it within a jurisdiction of municipality or cantonment board. So within a municipality, municipal corporation or cantonment board, if at all you are having one agricultural land, that's always a capital asset. That's always an urban agricultural land. It's always a capital asset. Suppose you are having the agricultural land outside the municipality limit, outside the cantonment limit. Getting the point? But you know what? From the limit of the municipality, within 2 kilometers you have that land. From the limit of the municipality, within 2 kilometers you have that land. Now you are having a land within 2 kilometers from a particular municipality limit. If that municipality or cantonment board population as per latest census published, if it is more than 10,000, if it is more than 10,000, if any land is situated within 2 kilometers, getting the point, it's an agricultural land, it's an urban land, it's an urban agricultural land, it's a capital asset. Suppose your land is situated beyond 2 kilometers, nothing but, you see here, this is the municipality limit, this is the municipality limit. You are having a land within 2 kilometers. Suppose somewhere here you are having the land which is within 2 kilometers from municipality limit. Getting the point? Now if this municipality population is 10,000 minimum, getting it, then this land is capital asset, urban land. We call it a specified limit. Suppose if your land is situated within 6 kilometers, suppose this is 6 kilometer radius, 6 kilometer border, municipality limit. From the municipality limit, your land is almost beyond 2 kilometers, but less than 6. So your land is very far away from the municipality. If at all, this municipality population is more than 1 lakh, which means the population is very huge, which means 6 kilometers is not a big distance from that particular limit, because population is very huge. So up to 6 kilometers from the municipality limit, definitely people will be traveling frequently. Therefore, it's an urban agricultural land. Therefore, it's a capital asset. Suppose if your land is situated in the 8th kilometer, within the 8 kilometers radius, from the municipality limit, the municipality limit is this. From this limit, your land is situated within 8 kilometers. Somewhere here it is situated beyond 6 kilometers, but not exceeding 8. So here it is beyond 2, but less than or equal to 6. Here it is beyond 6 kilometer, but less than or equal to 8 kilometer. In such a case, is this, can I call this as urban area? Can I call this as specified area? Yes, you can call it a specified area. Suppose if this municipality population is minimum 10 lakh. If this municipality corporation, if this municipal limit, if that municipality or cantonment population is minimum 10 lakh, then the land situated in this particular, even if it is within 8 kilometers, we can call it as what? Capital asset. It is urban area. Suppose if the agricultural land is situated outside 8 kilometer, even though this municipality population is 1 crore, doesn't matter. From the limit of the municipality, from the limits of the municipality, beyond 8 kilometers, any land is there, agricultural land, we call it as rural agricultural land. Accordingly, it's not a capital asset. So any land which is situated beyond 8 kilometers, we always call it as what? Rural agricultural land. Accordingly, we cannot call it as a capital asset. Suppose you are having a land here, somewhere which is our 10th or 11th kilometer after the municipality. But if this comes under another municipality 8 kilometers below, suppose if this land, it's very simple. Let us assume we have some cities like Guntur and Vijayawada. Getting it? So you are having a land here which is 8 kilometers away from Guntur, but this is within 8 kilometers from Vijayawada. See, 8 kilometers, 6 kilometers, 2 kilometers from which municipality? From any municipality. So I have agricultural land at one place that is not falling within 8 kilometers of any municipality or cantonment board. Then only it's a rural agricultural land. I hope you understood these this one. Then what else? Then what else is not a capital asset? The following: specified gold bonds is not a capital asset. Special bearer bonds is not a capital asset. Gold deposit bonds which are issued under gold deposit scheme, gold monetization scheme 2015 or 2018, gold monetization bonds or gold deposit bond, they are not capital asset. And you remember sovereign gold bond, what is it? Sovereign gold bonds, they are always capital asset. Sovereign gold bond is capital asset. Suppose when I purchase, I deposited my gold and I obtained gold deposit bond, I sold this gold deposit bond to somebody, or gold monetization scheme bonds to somebody. This is not at all capital asset. Accordingly, capital gain will never apply to me. Suppose I purchased the sovereign gold bond. Sovereign gold bond means why? Who will purchase sovereign gold bond? Suppose you have money, you want to invest in gold, but you don't want to carry the physical gold with you. But you want to invest in gold, but you don't want physical gold. So you can buy a bond. Getting it? Suppose you want to buy 10 grams of gold, right? You buy this bond, pay the 10 grams equivalent money to the government. Government will give a sovereign gold bond. On that bond, they will mention 10 grams clearly. So this bond is having some 5 years to 10 years duration. So at the time you redeem it. So whatever market value is there on the date of redemption of the gold value, that much only you will get back. Sovereign gold bond is a substitute for physical gold. So sovereign gold bond is a capital asset. Remember. Able to understand? And remember, sovereign gold bond, if you transfer, you are liable to pay capital gains tax. Suppose you purchase sovereign gold bond, you did not sell it to anybody, you waited until its maturity time, you redeemed it with the government itself again. Getting the point? Redemption of sovereign gold bond is covered under section 47. Sir, what is 47? 47 talks about transactions that are not treated as transfer. You see the charging section. As per charging section, what is it? Only if there is a transfer of capital asset, then only capital gains apply. So what you transfer must be capital asset and there must be transfer. If at all it is not a transfer, suppose sovereign gold bond I redeemed, it is not a transfer. It is not treated as transfer. Section 47 clearly says that. Therefore, capital gains will not apply on that. Suppose if you sell sovereign gold bond to somebody, it is liable for capital gains tax. If you redeem sovereign gold bonds on maturity, that is not treated as transfer. Accordingly, any profit you get because of the gold value appreciation, getting it, not at all liable for capital gains tax. That's it. This is 2 clause 14 capital asset definition. Now 2 clause 47 transfer definition is given. That is not a very big deal. Sale, exchange, relinquishment of an asset, extinguishment of an asset, compulsory acquisition of any capital asset, conversion of capital asset into stock in trade. All these items were covered under 2 clause 47. So transfer is an inclusive definition. Getting the point? So 2 clause 47 is not a big deal. Fine. So now only when there is a transfer of capital asset, capital gains apply. Correct? Now you see how to compute capital gains. Now if you recollect, we have computation. For the purpose of computation, we have 4 sections. One is 48, 50, 50A, 50B. Getting it? So how to compute capital gains in all these cases? For depreciable assets, let us look at depreciable assets. So for depreciable assets, how to compute capital gains? Section 50 talks about capital gains. Now, if you recollect, suppose section 50 talks about which assets? Depreciable assets, where the FSC is following block of asset approach. So block of asset approach. If the SSC is claiming depreciation under PGBP for depreciable assets under block of asset method, so for them, how to compute capital gains? There is a format. Now there is a block of asset format, right? Generally, what is the format for block? For each block, opening WDV of the block. Opening WDV of block. So something plus additions in that block. So actual cost of additions. So we will generally split more than 180 days, less than or equal to 180 days. So we will mention like this. Getting it? So we will get some value. Now you have this, this is called as gross block value. This is called as what? Gross block value, or we can also call it as value of block. What we can also call it as value of block or gross block value. So how to compute gross block value? How to compute value of the block? Opening value will be there. Additions in that year, in that block, if at all any assets were purchased, no. If any machineries are purchased, no. If any furniture is purchased in that furniture block, no. Then that is treated as what? Additions. So opening plus additions is equal to, we call it as what? Value of block. So you compute value of the block. Now from that, I'm telling you block of asset format, which is covered under 43. Getting it? Which is covered under 43 subsection 1. So from that, amount received on transfer, destruction, demolition of part of a block. Amount received on transfer, destruction, demolition of part of a block. You reduce that amount. Then if you have some value, this is called WDV of the block. What is it called as? WDV of the block. If this value is there, and as on 31st March of the respective previous year in that block, some asset is physically there in the organization. As on 31st March, that is closing date of the relevant previous year, in respect of a particular block, some asset is there. And there is a value, WDV of the block, it has a value. Then you will claim depreciation under section 32. You will calculate depreciation. So there are two conditions to calculate depreciation under section 32. One, in respect of a particular block, as on 31st March, there must be some written down value. So for the block, written down value should be there. How to calculate the written down value? How do I calculate this written down value? The written down value is calculated very simple. Identify what is opening written down value of that block. How to get this opening? So WDV of the block of the last year minus depreciation for last year, you will get closing WDV of the block in the last year. That itself will be opening WDV of the block in the current year. To that, add additions, whatever purchases you made in that block. So purchase cost you add, you will get gross block value. From that, any part of a block either transferred by you or destroyed or demolished, because of you are selling it or destroyed, whatever you received sale value or you received compensation from insurance company, whatever amount received, you reduce it. Amount received, you reduce it. Then the balance is called as WDV of that block. Now, if this value is positive, if WDV of the block is positive, and as on 31st March of that particular year, relevant previous year, getting it, there is physically an asset, then depreciation will apply. What will apply? Depreciation will apply. So how to calculate this depreciation? Anyhow, when I'm doing PGBP revision, once again I'll be repeating that. So now working note 1, let us assume. So written down value of the block, this is also called as value available for depreciation. What is it also called as? Value available for depreciation. So this value split into 4 parts. Split into four parts. Allot this value, appropriate this value, apportion this value. First, we will allocate this value for assets acquired during the year but not used during the year. So some value, getting it, out of this the value allocated. So then some balance value will be there. Now this balance value then allocate to this one, assets acquired during the year but used for less than 180 days, then allocate. If still some value is there after allocation, then allocate to assets which are purchased during the year but used more than or equal to 180 days, allocate. If still some value is there in this, getting it, then balancing figure, allocate here. So here depreciation is 0%, here depreciation is half rate, here depreciation is full rate, here depreciation is full rate. Like that, if you apply the value into rate, you will calculate normal depreciation. That normal depreciation, if you reduce, you will get the closing WDV of the block. And remember, depreciation computation we have not discussed yet. I'm just giving you a brief idea. What is important for capital gains chapter until now is only this particular, only up to this. Only in capital gains relevant to remember this format, getting it. So now if there is a positive value for this block and there is a asset as on 31st March, block is existing, it is not seized. The block is not ceased to exist, block is existing and value is there, then you calculate what? Depreciation. Suppose either as on 31st March block is not there or this value is turning negative, you don't calculate depreciation, you calculate capital gains straight away. Nothing but we'll see one small example. Suppose there is a plant and machinery, 15% block, there is a block. So this opening WDV, this plant and machinery opening WDV is 10 lakh, during this year. So let us understand, it is 22-23 previous year. So during this year, we purchased some additions of plant and machinery, which are carrying 15% rate of depreciation. We purchased 5 lakhs worth of plant and machinery. Now tell me, what is the gross block value? 15 lakh. In the same year, we transferred part of a block. We transferred what? Part of a block. Suppose I transferred it for 5 lakhs. Now what is the balance? Only part of a block I transferred, not full block. So what is the WDV of the block then? 5 lakh, 15 lakhs minus 5, 10 lakh. So WDV of the block is there and part of a block only we transfer. Means part of a block is existing as on 31st. We calculate depreciation. Suppose part of a block only I transferred, but I transferred for 25 lakh. At what price I transferred? 25 lakh. This is not 5 lakhs. I transferred for 25. Now value is turning negative. See, part of a block is there as on 31st March. Block is still existing, but I transferred part of a block higher than the gross block value, higher than the value of the block. What is gross block value or value of a block? Opening plus additions, purchases cost. So total it. Beyond that value, my sale value is increasing. Then the difference, directly how much excess is there. See, now block you have to make it 0. The block value you have to make it 0 because block is existing. So you cannot close this block. You cannot close this or strike this block. Block is existing. You are continuing the block, but block value will become 0. Sir, what about remaining 10 lakhs? Remaining 10 lakhs is treated as short-term capital gain. So when you transfer part of a block, either you compute depreciation or short-term capital gain, you will get it. Understood? Suppose same opening 10 lakhs, additions 5 lakhs. Value of a block how much? Value of a block 15 lakhs minus full block transferred. If full block is transferred, I don't even think about depreciation. I straight away compute capital gains. At what price? I sold for 10 lakhs. Now, since value of the block is 15, you sold it for 10 lakh, 5 lakhs, there is a loss. 5 lakhs, there is a loss. Suppose I sold it for 25 lakhs, 10 lakhs, there is a profit. If it is a loss, it's a short-term capital loss. If it is a profit, it's a short-term capital gain. Understand? In respect of depreciable asset, if full block is transferred, either you get short-term capital gain or short-term capital loss, which means there is no question, there is no possibility of depreciation in respect of full block sold. As on 31st March, block itself is not there. Whereas in part of a block sale, if you sell part of a block for an amount less than block value, then value will be there, return on value, asset is there, depreciation. If you transfer part of a block for higher than, the amount received is more than value of the block, the excess amount is short-term capital gain. I hope you are clear. And remember, in respect of depreciable asset, block of asset approach or even SLM approach, whatever it is, in respect of depreciable asset, the capital gain or capital loss that we compute is always treated as short-term. Generally, whether, see, capital gains itself means immediately you should recollect there are two types of capital gains. One is long-term capital gain, another one is short-term capital gain. Why we need to discuss like this? Because the tax rate for long-term capital gain is different from short-term capital gain. So how to determine, how do we know whether a gain is a long-term gain or short-term gain? How do we know? It depends upon nature of capital asset. What is it? It depends upon nature of capital asset. Wait, I'll come to that later. First, let me close this block of asset approach. I hope you understood depreciable asset, block of asset approach, how to compute capital gain. Clear? Now, let's look at section 50A. How to compute capital gains in respect of electricity company which are following SLM method. Electricity companies following SLM method. Let's assume SLM method means asset wise they follow, not block. Suppose electricity company is having a particular plant and machinery, you know, some code is here, 15 plant and machinery, some 25. It's not rate, just plant, that number of plant and machinery, number is what? 25th plant and machinery. So that plant and machinery is there, opening WDV, some value 10 lakhs is there, opening WDV is what? 10 lakhs. You know, this plant and machinery was originally purchased for what price? 20 lakhs. Originally it was purchased for 20. So every year straight line method they are claiming depreciation 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh, like that 10 years over already. Right now the opening value of that particular machinery of that asset is 10 lakhs. Now current year we want to calculate depreciation. Check as on 31st March. As on 31st March is the asset is available? Yes, available. Calculate depreciation, find out closing value, go to the next year. Suppose as on 31st March this asset is sold. This asset is sold as on 31st March. Okay, asset is not there as on 31st March, which means no depreciation. So in income tax, whether it is block of asset approach or not SLM approach, you will calculate depreciation only on the closing date, 31st March. As on the date, block is there, value there, calculate depreciation. SLM, asset is there, calculate depreciation. Otherwise, we don't calculate depreciation. Straight away, we calculate capital gains. Now, so as on 31st March, this 25th plant and machinery sold by the company. At what price? The company sold it for 5 lakhs. Second case, company sold it for 15 lakh. Third case, company sold it for 25 lakh. Okay, so one case, company sold this asset for 5 lakh. Another case, company sold it for 15. Another case, they sold for 25. Suppose suppose in this case, you see, case number 1, what is the value of that particular asset as on 31st March before providing depreciation? 10 lakhs. Asset is sold for 5 lakhs, which means 5 lakhs is a loss, right? It is treated as terminal depreciation. It is treated as terminal depreciation under section 32. Directly this 5 lakhs you can claim deduction in PGBP. Now suppose this value of the asset is what? 10 lakh. Now you sold it for what? 15 lakh. Now there is a 5 lakh profit, no. Profit, no. When there is a loss, you are reducing under PGBP. When there is a profit also, this is treated as balancing charge. What is it called as? Balancing charge. Nothing but profit on sale of asset. Profit on sale of asset. Now here the sale price is less than original cost. So any profit which is less than original cost is a revenue profit in accounts also. Yes or no? So this 5 lakhs is taxable under PGBP. Here 5 lakhs loss is deductible under PGBP under terminal depreciation word. 5 lakhs profit is taxable under PGBP under balancing charge word 41 subsection 2. What is it? 41 subsection 2 or 41 clause 2. Understood. Suppose I sold it for 25 lakh, which means I sold this asset 10 lakhs worth of asset beyond its original cost. Original cost is 20 and I sold it for 25 lakh. 5 lakh capital profit. That's short-term capital gain 5 lakh and balancing charge is 10 lakhs. Actually 10 lakhs worth of asset you sold for 25, which means 15 lakhs profit. Out of that 15, any profit up to original cost, we call it as balancing charge, which is taxable under PGBP. Any profit beyond original cost, that is 5 lakhs, it is taxable as short-term capital gain, and that's what section 50A says. Are you clear? Now you see here also if there is a profit, it's only short-term capital gain. So for an electricity company which is following SLM method for an asset, there is no question of short-term capital loss. You see here there is no short-term capital loss. Either terminal depreciation or balancing charge, both are coming under PGBP, or short-term capital gain in the point. So that's 50A. Now let us understand further. So we understood now computation, we understood now the section 50 is over, 50A is over. Now how to calculate capital gains for non-depreciable assets. This is where entire capital gains discussion is about. Major part of the capital gains chapter is discussing about how to calculate capital gains on non-depreciable assets. Now, I hope until now you are clear. Just a minute. Now, before I continue to talk about non-depreciable asset, first of all, we are having two types of capital gains. One is short-term capital gain, another one is long-term capital gain. How to decide whether capital gain, capital profit or capital loss, is it a long-term or short-term? How to decide? It depends upon nature of capital asset. Capital asset means what? We know a property of any kind, whether or not related to the business. Getting it? That's a capital asset. Now, nature of capital asset means what? Capital assets are broadly classified into two categories: long-term capital asset, short-term capital asset. What is it? Long-term capital asset, short-term capital asset. 242A, 229AA. So these are the sections which are talking about the definition of long-term capital asset, definition of short-term. What is a long-term capital asset? Which is not a short-term capital asset, is a long-term capital asset. What is a short-term capital asset? Short-term capital asset, no. So when an asset is coming under short-term capital asset, see, whether an asset is a short-term or long-term, it depends upon period of holding. How long I am the owner for that asset? For how long I am the owner? How long I am holding that asset as a owner? Is important. Now they have given three criteria: 12 months criteria, less than or equal to 12 months, less than or equal to 24 months, less than or equal to 36 months. There are three criteria which they have given. Getting it? Less than or equal to 12 months. Only two assets were given: unlisted shares, immovable. Why to write unnecessarily time waste? So I'll directly show you in the book itself. Just a minute. Yes. There are three categories. So there are some capital asset for whom holding period is 12 months. For whom the criteria for holding period is what? 12 months. For some capital asset, the holding period criteria is what? 24 months. For some capital asset, 36 months. What is this 12, 24, 36? Very simple. When I purchased, when I sold. The gap. If the gap is more than 12 months for certain assets, it's a long term. If the gap is more than 24 months for certain assets, it's a long term. For some other assets, remaining assets, the gap between purchase date and sale date must be more than 36 months. Then only they are long term. What is the purpose of knowing whether it's a long term or short term? Because long term capital gains are subject to tax under section 112, 112A. Whereas short term capital gains are subject to tax under 111A and normal rates. All short term capital gains are generally taxable at normal rates. However, if at all you are selling, if at all you are transferring listed equity shares, unit of equity oriented mutual funds, units of business trust, for these three assets, if USTT is paid, the tax rate is straight away 15%, concessional tax rate, we call it as. If the same asset is long term, 1128, 10% tax rate. Getting it? If it is any other long term capital asset, if you sell, generally tax rate is 20%. Anyhow, not just this, there are many provisions on this. I'll come to that later. So now, holding period. What is important to decide whether an asset is a long term or short term? Holding period. If the asset is long term, if I sell that asset, if I get any profit, that's a long term capital gain. If the asset is short term, if I sell that asset, if I have a capital gain, that's a short term capital gain. Getting it? Now, so what are the assets that comes under 24 months criteria? 24 months criteria will be applicable on unlisted shares, land, building, or both. By the way, if any of you want to download this particular PDF, you can download it in the Shrestha application. So Shrestha for CA and CM, there is an application is there in the Play Store. You download that. In that main menu is there. Another option is website. You just open Shrestha for CACMA.com website. PDF resources is there. CA interview select. Group 1 you select, paper 4 you select, you will find income tax book, complete income tax book you will find. Getting it? So in that I am just using capital gains chapter. Now, so for unlisted shares and land, building or both, right, I can call it as immovable property. What is it? Immovable property. So for unlisted shares and immovable property, the criteria to decide whether an asset is a long term or short term is 24 months. So up to 24 months I am holding and selling immediately. Within 24 months gap I am selling. It's a short term. Otherwise, it's a long term. Very simple. Suppose I purchased an immovable property on 1st May 2020 and I am selling it on 30th April 2022. Now, this is a short term capital asset. Why? From 1st May to 30th April. So, I purchased on 1st May 2020 and 2020 to 30th April. Exactly 24 months. Exactly 24 months. The gap is, it's a short term. Suppose if I sell it on 1st May 2022, if at all I sell it on 1st May 2022, then it is more than 24 months. It's a long term. So that's what. Getting it? So for unlisted shares and immovable property, the criteria is 24 months. Whereas for listed securities other than units means what? In case of mutual funds, in case of business trust. So whenever we want to buy, we buy units, not shares. So there the instrument is called as unit. Whereas in a company, if I want to get ownership, I need to buy certain instruments. That instrument is called as what? Share. Getting it? So any listed securities means what? Shares, debentures, bonds, everything will come except unit. Getting it? So which are recognized, which are listed in recognized stock exchange, 12 months is the criteria. Units of equity oriented mutual fund or units of unit trust of India. Remember, only equity oriented mutual fund. What is it? Equity oriented mutual fund units is only treated as for that only 12 months criteria. Suppose suppose the capital asset is debt oriented mutual fund. Any other unlisted securities other than shares. All unlisted securities comes here. However, unlisted shares comes under 24 months category. Getting the point? Remaining all other unlisted securities like unlisted debentures, unlisted bonds, everything comes under what? 36 months criteria. Getting the point? Then zero coupon bonds. So all listed securities other than units of equity oriented mutual fund, units of unit trust of India, zero coupon bonds. For these four assets, 12 months is the criteria. For unlisted shares, land and building, 24 months is the criteria. What about remaining unlisted securities? Listed securities 12 months. Unlisted shares 24, remaining unlisted securities 36 months, debentures, debt oriented mutual funds, unlisted bonds, unlisted debentures, all that, and any other capital asset means jewelry, units of business trust, jewelry, units of business trust, all that comes under other capital assets, which is 36 months is the criteria. I hope you are clear. I hope you are clear on this. Getting it? No. So this is the criteria to decide whether an asset is a long term or short term. So that is what, in depth, it is once again clearly explained here. So what all comes under 36 months criteria, what all comes under 12 months criteria, what all comes under 24 months criteria, I have clearly explained. Now what do you mean by equity oriented fund? Suppose if I buy units of a mutual fund. Now whatever the amount I gave, out of that amount, 90% of that amount is invested by that mutual fund company in another mutual fund scheme. From that scheme, 90% is invested in equity shares. Then it's an equity oriented mutual fund. Or I gave to mutual fund some money, right? That mutual fund directly using 65% minimum at least for directly buying in equity shares. If they directly buy equity shares, minimum 65% investing in equity shares, then it's equity oriented mutual fund. Suppose they did not buy shares directly, they invested in another mutual fund. 90% of this amount is invested in another mutual fund. That mutual fund, another mutual fund, if they also invest 90% in equity shares, then it's a equity oriented mutual fund. That units, if I'm having, for them, the criteria to decide whether it's a long term or short term, 12 months. Clear or not? Now, okay, I decided whether it's a long term or short term. Now I understood. Now, what is the tax rate? Suppose the tax rate is as below. The tax rate is as below. Suppose if I am selling listed equity share, remember, not listed shares, listed equity, not preference share. If listed equity shares, units of equity oriented fund, units of business trust. If at all I am transferring listed equity shares, units of equity oriented mutual fund, units of business trust, and STT is paid on transfer. Whereas for listed equity shares, STT is paid on buying as well as at the time of sale. So when I purchase the equity shares, I paid STT. At the time of sale also I paid STT. Whereas for equity oriented fund, business trust, no, at the time of purchase I may be paying or I may not be, but at the time when I'm selling, no, I paid STT. If that is the case, if at all it's a long term capital asset, if it's a long term capital asset, then the gain is what? Long term capital gain. Sir, how to compute gain? I will come back to it. First, let us understand the rate of tax. So if there is a long term capital gain on transfer of listed equity shares provided at the time of purchase and the time of sale, STT paid. On transfer of unit of equity oriented mutual fund, on transfer of unit of business trust, STT paid in both the cases. Then the long term capital gain is taxable at 10%. The tax rate is 10% only for the gain if it is exceeding 1 lakh. Means up to 1 lakh, tax amount is 0. Remember, entire capital gain is taxable. Suppose 2 lakhs is treated as income. 2 lakhs is treated as a long term. Suppose I got 2 lakhs capital gain, entire 2 lakhs is treated as income in total income computation. But while computing tax on that, the tax is levied only on the capital gain portion which is more than 1 lakh. So since capital gain is 2 lakhs, up to 1 lakh no tax rate. Beyond 1 lakh tax is only, beyond 1 lakh if you have a gain, only on that amount tax is levied at 10% flat rate. Able to understand? And you know what? When you are computing long-term capital gain under 112A, when you are computing long-term capital gain under 112A, getting it, indexation benefit is not available. You cannot claim indexation. Sir, what is indexation? Don't worry. Generally, as per provision number 2 to section 48, whenever the asset is a long-term capital asset, the cost of acquisition while computing capital gain, indexation facility is there. You are, if at all you are not able to remember, don't worry, I'll slowly come to that. Getting it? Next. So that's it. Suppose no, if the same assets I am selling, same listed equity share, units of equity oriented mutual funds or units of business trust I am selling, and STT paid at the time of transfer in all these cases, but they are not long term. They are short term. Now short term capital gain I got. Now what is the consequence? Straight away, triple 1A will apply. What is it? Triple 1A will apply. As per triple 1A, short term capital gain is taxable at 15%. Sir, here also do we have 1 lakh exemption? No, only if it is a long term capital gain. Beyond 1 lakh, the extra gain is taxable at 10%. What is short term capital gain? Short term capital gain, even if it is 10,000 rupees, flat 15% tax rate will apply. Whether the SSE is a company, whether the SSE is an individual, whether the SSE is a partnership firm, doesn't matter. Straight away 15%, which is a concessional, beneficial rate. Even if it is a long term, tax rate at 10% is a very beneficial rate, which is a very good rate. Getting the point? Now, suppose I am selling listed equity shares. I am selling units of equity oriented mutual fund, and I am selling units of business trust. But where am I selling? I am selling through a stock exchange, where the stock exchange is located in International Financial Service Center. Where the stock exchange is located where? IFSC, Gift City, Gujarat, example. So in that stock exchange, I sold this. And in that stock exchange, STT itself do not apply. It's a listed share, but STT itself do not apply because it's an IFSC zone. It's something like a special economic zone. So STT is not applicable on that particular zone since I did not pay. Now tell me, short-term capital gain is a taxable normal rate. Remember, for a company, normal rate is 30%. For a partnership firm, normal rate is 30%. For an LLP, normal rate is 30%. So that short-term capital gain, will it be taxable 30% because STT is not paid? No. If at all you are selling in IFSC, because of that STT is not applicable. Because of that STT is not paid. Because in an IFSC zone, special economic zone, STT will not apply. Even then, even if STT is not paid on that short-term capital asset transfer, still 15% benefit you can claim. 15% tax rate, concessional tax rate benefit you can get. Same way for long term also. If at all you sell a listed equity share, units of business oriented fund, units of equity oriented mutual fund, units of business trust in a special economic zone like IFSC, International Financial Service Center, in that case, STT is not applicable and you didn't pay. Still, the capital gain is taxable at 10%, exceeding 1 lakh rupee. For clarity. Now, what about remaining capital assets? Very simple. Remaining capital assets. Suppose I am selling unlisted securities. Unlisted securities. Getting it? Unlisted securities means simply they are called as shares of closely held company. You may call it as unlisted security or you may call it as shares of closely held company. In income tax, they don't use the word closely held company. We are using it for benefit, for our understanding closely held. Closely held company means it is a company in which public is not interested. Public is not substantially interested. Getting the point? So it is not a widely held company. It's a closely private limited company, unlisted public company, like that. So if you are selling unlisted shares, straight away tax rate is 20%. If any capital gain you have got, long-term capital gain, 20%. Suppose if the same unlisted securities you are selling, it's a short-term, normal rates. If it is short-term, normal rates. If it is long-term, straight away 20%. Suppose the same unlisted securities or shares a non-resident is selling, or a foreign company is selling, for them the tax rate is just 10%. But you know what? They don't have indexation benefit. For a resident and ordinary people, when we are selling unlisted security, we can calculate capital gain using indexation methods, all that, and we have to pay 20% tax rate on the capital gain. Since indexation is not there, tax rate is high. If indexation is there, tax rate is high, 20%. If indexation is not there, capital gain will be higher, tax rate is lower, that is 10%. Suppose we are residents or non-residents, whoever it is, we are selling listed security. Now, what is the tax rate? So you have given an option. What is the option? Compute capital gain without indexation. Don't take indexation benefit, calculate capital gain. And on that gain, calculate 10% tax and see how much is the tax. Compute another method. Compute capital gain after availing indexation. On that, apply 20% tax rate and see the tax amount. Wherever tax amount is lesser, that option you choose. So when you are selling listed securities and zero coupon bond, you have an option. So 10% without indexation, 20% with indexation. Any other assets, 20% is the, any other capital asset we are selling long term, the tax rate is straight away 20% on the long term capital gain portion. Of course, indexation facility is there. Remember, whenever you are having a capital gain, all the capital gains are taxable at what rate? Special rates. These capital gains are not having basic exemption limit exemption. Getting it? So if you are an SSE having normal income and capital gains income, keep capital gain separately. Only short-term capital gain taxable at normal rate. That is normal income. Remaining 112 capital gain, 112A capital gain, 111A capital gain, they're all taxable at special rates. Now I have basic exemption. My normal incomes are very less. Suppose I'm a super senior citizen. My basic exemption is 5 lakhs. And my normal income is just 1 lakh only throughout this entire year, including short-term capital gain, normal short-term capital gain. I have 4 lakhs basic exemption, which I'm not using. If you have unutilized basic exemption limit, that unutilized basic exemption limit can be fast utilized for long-term capital gain taxable at 20%. Set off long-term capital gain taxable at 20%, that amount comes zero after setting off with basic exemption. Still you have unutilized basic exemption limit, then set it off against short-term capital gain taxable at 15%. If you still have the amount, then set it off against 112 capital gain, 112A capital gain, which is taxable at 10%. If at all you are having basic exemption limit free, unutilized limit, first use it for, if at all you are having long-term capital gain taxable at 20, then use for that, set off. Still exemption is limit is there, then use it for 15% criteria. Still limit is there, then use it for 10% criteria. Getting it? Then after set off, still 10% gain is there. Beyond 1 lakh, tax it at 10%. Simple logic. Getting it? Then, and you know, on special incomes like capital gains, long term, short term, 111A, 112, 112A, the maximum surcharge rate that is applicable is 15%. We have seen this in introduction chapter also, basic concepts. Getting it? Probably in revision, I am uploading it first capital gains revision. So slowly I'll upload PGBP revision, all that. Maybe, you know, once I record all this, I will merge all this and then upload it as a single video. Maybe initially I will be uploading each chapter wise like this. I hope you are clear on rates of capital gains tax. Once again, frequently by the time we complete this revision, many a times rates of capital gains tax we will be discussing. Clear? So by the way, what are we discussing? So we are now we understood in capital gains we are having two types of capital gains, so long term, short term. How it is decided? It depends upon the nature of the capital asset. If I transfer long term capital asset, then the gain is long term. Otherwise, it's a short term. So what is the long term capital asset? What is the short term capital asset? We discussed. Now, how to tax long term capital gain? How to tax short term capital gain? So what is the tax rate? We discussed. Now, how to compute these capital gains, non-depreciable assets? Now let us understand. So how to compute capital gains for non-depreciable assets? You know, there is a note, there is a format for computation of capital gains for non-depreciable assets. You see here, this is a format. What is the format? This is the format. Getting it? That itself is given in this book. So first, see, how to compute capital gains? Very simple. I sold at some price, so sale value minus I purchased it. No, acquisition cost is 0. Reduce it. The balance is what? Capital gain. The same format is given, but little bit detailed mode. So you received consideration, no, sale consideration, keep that amount. Now here in capital gains, no, instead of calling it as sale consideration, they are calling it as full value of consideration. They are calling it as what? Full value of consideration received by you. How much? Sometimes you receive consideration non-monetarily plus monetarily. So in that case, only monetary amount you are putting. How come? You receive non-monetary also, no, that has a value, no. Then put value. So total consideration you receive. No, what is its total value? Put that value. So full value of consideration, how much? Minus expenses incurred on transfer. Nothing but transfer. Selling expenses. We call it as example brokerage. That you reduce. Remember, STT paid. Just I told no, listed equity shares if you sell, no, STT you paid. So that STT paid, can I take it as transfer expenses? No. So STT paid is not treated as transfer expenditure. So from the full value of consideration, if you reduce transfer expenses, you will get net sale consideration, or you may call it as simply net consideration. Now from that, reduce cost of acquisition. Reduce cost of improvement. Suppose you purchased this asset for some price, you know, very simple. Suppose, no, I purchased, a particular house. I purchased a house for 10 lakhs. I sold this house during this year for 30 lakhs. So what is the full value of consideration? 30 lakhs. Minus what is the cost of acquisition? Let us assume there are no brokerage and all transfer expenses. 10 lakhs. So what is the capital gain? 20 lakhs. Very simple. As simple as such. Suppose if this is a long-term capital asset, this cost of acquisition indexation is available. If this is a long-term capital asset, the cost of acquisition is having indexation facility. For long-term capital asset, the cost of acquisition will be indexed. Cost of improvement will also be indexed. So what is cost of acquisition? What is cost of improvement? Suppose, no, I purchased a house for 10 lakhs. On that, I spent 5 lakhs and constructed additional floor. So I purchased it in 2003-04. I constructed additional floor in 2007-08. Again, I constructed third floor. This is actually G+1. Thereafter, I constructed second floor. Thereafter, I constructed third floor. So this third floor is constructed in 17-18. Getting it? Finally, in 22-23 year, I sold this house for 1 crore. So what is the full value of consideration? 1 crore. What is normally without indexation? Let us see. What is cost of acquisition? You acquired it for 10 lakhs. how much improvement you spent. I constructed second floor and third floor. This is improvement I did. So which is 15 lakh. So balance is what? 75 lakh capital gain. Now actually, you purchased this house in when 2003-4. You are selling this in when 2022-23. The gap is what? More than 24 months. What is this asset? Long-term capital asset. If the asset is long-term, what is this? You have indexation facility. Cost of improvement can be indexed. So cost of acquisition can be indexed. Cost of improvement can also be indexed. So let us understand. So 1 crore is full value of consideration minus indexed cost of acquisition. How to index? So what is the cost of acquisition? 10 lakh. Getting it? Multiplied by CII of year of transfer. In our example, 22-23 is the year of transfer. So cost inflation index of year of transfer, numerator, divided by cost inflation index of the year in which asset is first held by the SSE. So denominator is what? Cost inflation index number you have to keep. For which year? For the first time when you become the owner. For that year you should keep index number. Able to understand. So now, we purchased it in 2003-4, right? In exam they'll give you what is index number for 3-4 year, what is index number for 22-23. If the transfer year is 23-24, what is index number for that year? So for their year of transfer, for all the years whatever they use in that problem, they'll give you index number. You should pick the right index number. Getting the point? So in this example, indexed cost of acquisition is equal to 10 lakh multiplied by 22-23 index number divided by 2003-4 index number. Suppose you purchased this asset before 1/4/2001. Suppose you purchased this asset before 1/4/2001. Denominator is only from 0102. Index numbers were given only from 2001-2 onwards, because 2001-2 is the base year. So for base year, index number is 100. Able to understand. So for 22-23 index number is 331. For 23-24 index number is 348. So these index numbers will be notified by the CBDT itself. Don't worry, you need not remember index numbers, all that. In the book also we have given index numbers clearly. So getting it. So now, indexed cost of acquisition. What is the formula? You see here, what is the formula? So what is actual cost of acquisition? Identify. CII, cost inflation index, for the year in which asset is transferred. So what is the year in which you transferred the asset? For that, what is the index number? What is the year in which you first purchased this asset, or 1/4/2000 or 2001-2, whichever is later? Suppose you purchased this asset in 2003-4, then 2003-4 number. You purchased this asset in 95-96 year, then 2001-2 number, because 2001-2 itself is the base year from which indexation is available. So denominator can be least number in the denominator is 100. That is the least number. Less than 100 is not there in the denominator. Able to understand. So like this, if you compute now, you will get cost of acquisition, indexed cost. Now what do you mean by cost of acquisition? The cost of acquisition is discussed under section. The meaning of cost of acquisition is given under 45 and 49. Sorry, 55 and 49. The definition for cost of acquisition is given under 55, and further discussion on the cost of acquisition is given under 49. Now, so how to like what is 55, what is 49? What 55 says, as per section 55, what is cost of acquisition? Actual cost. Suppose if at all you acquire the asset, on or before 1/4/2001, then cost of acquisition shall be actual cost or FMV on 1/4/2001, whichever is higher. Actually the section says at the option of the SSE. Suppose actual cost is 10 lakhs. I purchased the asset in 95-96 for 10 lakhs. I purchased a land in 95-96 for 10 lakhs. Market value as on 1/4/2001 was 30 lakhs. Now I sold this land in 22-23 for some 1 crore. Now minus what is cost of acquisition? Since I purchased this before 1/4/2001, there is an option given to me. Actual cost you take or market value on 1/4/2001, whichever is optional. Whatever you want to choose, you choose that. Suppose 10 lakhs is the actual, 30 lakhs is there. Which one I will choose? 30 lakhs I choose. Why? If the cost is high, my capital gain will be lesser. Then my tax amount will be lesser. So that value I will choose. So actual cost or fair market value on 1/4/2001 at the option of the SSE. So simply which one I will choose? Whichever is higher, that value I will choose as cost of acquisition. Suppose you purchased this particular building somewhere in 1992-93 year. Then after in 95-96 you constructed additional 4. Then after in 98, 99, you constructed another additional 4. So cost of improvement is also there. The section 55 clearly says, any cost of improvement before 1st April 2001. What is it? Any cost of improvement before 1st April 2001 shall be ignored. Any cost of improvement before 1st April 2001 shall be ignored. So getting the point. So what is cost of acquisition? Generally, how much ever amount you paid. Suppose if you purchase this capital asset before 1/4/2001, then cost of acquisition is actual cost you paid, when you purchase, or market value on 1/4/2001, whichever is higher. Any improvement you spent before 1/4/2001, ignore. Suppose you spent improvement on that asset before you sell this asset, you did some improvements to it. Capital expenditure you spent on that. Whatever improvement in whatever the year in which you spend improvement, that much you can claim deduction. If it is long term, indexation can also be claimed. So indexed cost of improvement, what is the formula? What is the cost of improvement? Which cost of improvement? On or after 1st April 2001, only that will be considered. That cost of improvement multiplied by CII of year of transfer. When you sell up to the year of transfer, you have indexation facility. CII of year of improvement. CII of year of improvement. So when the improvement happened, so that year number. Numerator, when you transferred, that year index number. So which means up to year of transfer, inflation benefit is given. So your cost can be inflated using index numbers. That inflated cost can be reduced from the capital gains. This indexation benefit is only for long term, not short term. If it is short term, what is cost of acquisition? At what price I acquired? Reduce it. At what price I improved? Reduce it. Balance is the short term capital gain. For a long term capital asset only, we have indexation facility. And remember, indexation facility is not available for the following long term capital asset. So bonds, debentures, we don't have indexation. Even for 112-year long term capital asset, indexation is not available. So indexation is not available for bonds and debentures. For 112-year capital asset, indexation is not available. Indexation is not available for non-residents on transfer of unlisted securities. Non-resident is selling some unlisted, shares or securities. For him also indexation is not available. Straight away 10% tax rate on the capital gain. So 20 lakhs is sale price. You purchase it for 10 lakhs. 10 lakhs is profit. 10% tax rate for the non-resident. For bonds and debentures also indexation is not available. However, capital indexed bonds, sovereign gold bonds, getting it, capital indexed bonds, sovereign gold bonds, they are eligible for getting indexation benefit. Zero coupon bond, no indexation benefit. Continuously past 1 hour we are revising, still not yet over. Now, sometimes no. I did not purchase the capital asset. My ancestor, my father purchased the capital asset, or I got a land and building from my father. My father got the same land and building. He didn't purchase. He got it for my grandfather. Getting the point. Now tell me, suppose, today I sold one land and building. I sold one land and building for 20 crore. I sold one land and building for 20 crore. At what price you purchase? Cost of acquisition. Well, I paid zero, nothing. I did not pay anything because I got it as an inheritance from my father. So what is the cost of acquisition? Zero. Wrong. There is a section called 49 subsection 1. What is cost of acquisition in certain special modes of acquisition? What is cost of acquisition under special modes of acquisition? Under 49 subsection 1, they have given certain modes. Any capital asset, if I am getting as a gift, will, inheritance, succession. Getting the point? Gift, will, inheritance, succession. Any capital asset, if I receive under these methods, getting it. So, previous owner holding period will also be considered. Whether an asset is a long term or short term, how to decide? Generally, when I purchased, when I sold. I already told, if the gap is more than 12 months, more than 24 months, more than 36 months, it's a long term. Otherwise, it's a short term. Sometimes, not from acquisition date. When I acquire this asset, not from date we consider duration. We consider the duration from previous owner purchase date, previous asset purchase date. Getting the point? So, the 2 clause 42A no, which defines short-term capital asset, it has given certain cases where for determining the capital asset nature, previous owner holding period will also be considered. Previous asset holding period will also be considered. Like what are they? Very simple. So I'll directly open that text. This you ignore. 49 clause 1. Yes. Suppose no, you actually sold one land and building. How you got this land? You sold it now. But before you sell, you got this land now. How you got? You got it on distribution of assets by HUF in partition. You are actually a member of the family, HUF. HUF got partitioned. On partition, you received an asset, or you got it as a gift or will, or you got it under succession or inheritance, or you got it because of the distribution of asset on liquidation. Company liquidated and they distributed the asset, and now you received the asset. That asset you are selling subsequently, or you got it from a trust. Getting it? To the trust, somebody given that asset. Now, or you are a holding company having 100% shares in one particular company. So you are a holding company of a company which is 100% subsidiary. So from that subsidiary, you acquired this asset. Or you are a subsidiary company. You acquired this asset from holding company. In both the cases, the recipient transferring must be Indian company. Or you are an amalgamated company. Suppose Syndicate Bank amalgamated with Canara Bank. So Syndicate Bank is closed. Canara Bank has received all the assets and liabilities of Syndicate Bank. Now Canara Bank sold one of the land. So from when holding period we will consider, from when we consider holding period, when the Syndicate Bank originally purchased, from that date we consider holding period. Previous owner holding period shall be considered. What are all the cases where previous owner holding period will be considered? If the capital asset is received under gift, will, inheritance, succession. Getting it? If the capital asset is received on partition of HUF, if the capital asset is received by a holding company from 100% subsidiary company, or if a capital asset is received by a 100% subsidiary from holding company, provided in these two cases, recipient transferring must be Indian company, or if a capital asset is received by amalgamated company from amalgamating company because of amalgamation, in a scheme of amalgamation, provided the recipient amalgamated company is an Indian company, or if a capital asset is received by a demerged company, if a capital asset is received by a resulting company from the demerged company in a scheme of demerger, provided the resulting company is an Indian company. If any equity shares are received on conversion of preference shares, if any shares and securities or debentures are received on account of conversion of debentures and deposit certificates, in all these cases, what happened, somebody purchased and I got it, or I purchased one asset, that asset converted into another asset, that new asset I sold. Now, whether the asset which I sold, what is the holding period of this asset? From which date I should consider? From the date when I held this asset, or from the date when the previous owner purchased this, or from the date when the previous asset I purchased? From the previous owner holding period, previous asset holding period, both will be considered. Very simple. Very simple. Suppose I am a shareholder in Syndicate Bank. I am actually a shareholder in Syndicate Bank. In 2003-2004, I purchased Syndicate Bank shares and I am not selling it at all. In 2022-23, the Syndicate Bank is closed. Canara Bank has purchased this entire bank assets and liabilities. Now what happened? I am having shares. No, the shares were cancelled. For me, Canara Bank shares were given. When they gave? 22-23 year they gave. I sold it in 23-24 immediately. Now what is the holding period? From 22-23 in which I got this Canara Bank shares till 23-24. The gap is less than 12 months. No. From the date when you purchase syndicate shares, no, from that date you consider holding period. From which date? Previous asset holding period will also be considered. So earlier you are having shares in Syndicate Bank, 2003-4 to 2020-23. So that entire holding period will also be considered as holding period of Canara shares. For how long you are holding Canara shares? You can confidently tell that I am holding it from 2003-4. Hey, you are holding it Syndicate Bank shares? No. Yes, that company got amalgamated with Canara Bank. So it's an amalgamating company. I am a shareholder of amalgamating company, receiving shares of amalgamated company in a scheme of amalgamation in lieu of shares cancelled in amalgamating company. Able to understand? Same way demerger also. So in all these cases, previous owner, previous asset holding period will be considered. Now what is cost of acquisition? Canara Bank shares I sold for some 10 lakhs. What is the cost? I did not purchase Canara shares, but you purchased syndicate shares, na? So at that time you paid some money, na? So the cost of acquisition in all these cases, these are all covered under 49.1, 49.2b, 49.2c. Like that, there are multiple sections were there. In all these cases, the summary is very simple. You got this asset from previous owner. You got this asset because you are having another asset previously. That asset is converted into this asset. So whether you got it from previous owner or you got it as a conversion of previous asset to current asset. Now this asset you sold subsequently. Is it a long term or short term? Previous owner holding period you consider, previous asset holding period you consider. This is what the logic is. Able to understand. Getting it? So now what is the cost of acquisition of these assets? Cost of acquisition is nothing but cost to the previous one, or cost of the previous asset. Whatever previous asset is there. Suppose I purchase Syndicate Bank shares for 10 lakhs. The shares were cancelled. Canara Bank shares allotted. Now I sold Canara Bank shares for 20 lakhs. What is the cost of acquisition? Cost of acquisition of Syndicate Bank shares, amalgamating company shares. That's it. Able to understand? So now on this cost of acquisition, I already made a video on the YouTube. You just type caramharsha cost of acquisition. You will get an exclusive video for more than 1.5 hours is there. So we are already talking about cost of acquisition point. Getting it? So you watch it, you will understand better. So in all these cases, cost of acquisition means cost to previous owner. Suppose previous owner purchased the asset before 1/4/2001. What? Previous owner purchased the asset before 1/4/2001. Then what is the cost of acquisition? Previous owner purchased at some price, actual cost. Compare it with 1/4/2001 market value, whichever is higher. That itself is cost of acquisition in the hands of the current owner. So what is cost of acquisition? Suppose I purchased the asset before 1/4/2001. Purchase price, compare with market value on 1/4/2001, whichever is higher. Suppose previous owner purchased the asset before 1/4/2001. What is actual cost? What is 1/4/2001 market value? Whichever is higher. Suppose you or previous owner, whoever it is, you purchased it. The asset is purchased after 1/4/2001. Then purchase price only, the cost of acquisition. If it is long term, index it. How to index it? Multiplied with CII of year of transfer number divided by CII of year of first held. So when you held the asset for the first time, so from that year. Now there is a Bombay High Court judgment which says, suppose example, my father, he purchased an immovable property in 2004-05. I inherited in 2022-2023. Immediately I sold it in 2023-2024 to buy some new model, very modern house. Getting it? To buy that I sold this old house in 23-24. Now when my father gave me 22-23, when I sold 23-24, the gap is less than 21. Can I call it a short-term capital asset? Wrong. Previous owner holding period 4-5 to 22-23, almost 9 years is there. Count this also. Now you are holding 1 year plus 9 years. Totally 10 years is the holding period. More than 24 months. It's a long-term capital asset. Now it's a long-term capital asset, right? Yes or no? What is the cost? My father purchased it at 10 lakhs. So cost of acquisition is cost to previous owner 10 lakhs. Now CII of 2023-24, 348 is the number divided by when I first held this asset. 22-23. So 22-23 number only you should put CIA number. But there's a Bombay High Court judgment, Manjula Jaisha case. What happened there? Of course, in income tax there's a denominator, inflation number of first held by the SSE. Inflation number of asset first held by the SSE. This is what they used. Getting the point? So in income tax they used the denominator first held, which means in this example, when the asset was first held, 22-23 previous year is the year in which the asset is first held. But tell me whether this is a long term or short term. From which year we are counting? From 2004-05 onwards we are counting. Which means in my hands, whether this is a long term or short term, you are considering from 4-5 holding period. You are saying that I am holding this asset from 4-5, which is not. Previous owner is holding, but you are treating that I am only holding. No. So now why can't I claim 245 index number here, so that my cost will increase, so that my capital gain will decrease? Bombay High Court agreed that. Bombay High Court said, yes, correct. For determining whether it's a long term or short term, previous owner holding period you are considering. No, you are saying that SSE is deemed to be held. SSE is deemed to be holding that property from 2003-04. You are saying that. So why can't you give indexation from 2003-04? Beneficial, no. So on that benefit, 2003-04 index number can also be taken, alternative answer. But in exam, always keep denominator first when you acquire this asset in your control. That year number only you put denominator. But alternative answer, Bombay High Court judgment, when previous owner purchased, denominator that number. See, if the denominator is old number, smaller number, indexed cost will be higher. If indexed cost is higher, consideration minus higher cost is equal to capital gains will be lower. That's a benefit. Are you clear? So now we understood about cost of acquisition point. Now, if at all you are transferring long-term capital asset, which is referred under 112A. Remember, 112A long-term capital asset. Suppose if at all you are transferring this long-term capital asset referred under 112A, and you know what? You purchased this before 1st February 2018. You purchased when? Before 1st February 2018. Then what is cost of acquisition? Cost of acquisition is cost of acquisition or A, B. Cost of acquisition Just a minute. Cost of acquisition or B. What B point is saying? Fair market value on 31st January 2018 or full value of consideration on transfer of those shares, whichever is lower. So identify this lower value, compare it with cost. Suppose if these shares are acquired before 1/4/2001, then market value on 1/4/2001 you take it. Actual cost you take it. Among these two, whichever is higher, you take it. So you get some value. Getting it? Here you are having some value. Among these two, whichever is higher. Not understood? Very simple. Suppose I purchased one listed company shares, Tata Consultancy Services. These company shares I purchased in 1998-99. 100 rupees I purchased. Fair market value on 1/4/2001. Fair market value on 1/4/2000 is 500. Now these Tata company shares, I sold for 5,000 rupees in when 2023-24. By the way, when I purchased these shares before 1/4/2001, now very recently in the Finance Act 2018, they added one more provision. Suppose if at all you purchased any shares before 1st February 2018. By the way, this is a long term. Yes, only for long term this logic we have to apply. If the equity shares which you sold for 5,000 rupees now, if it is a long-term capital asset, and these shares you acquired before 1st February 2018, then what is the cost of acquisition? Cost of acquisition is, find out cost of acquisition using normal provisions. Normal provisions means what? Actual cost is equal to 100 rupees. And since you purchased this before 1/4/2001, then 1/4/2001 market value will apply, 500 rupees, whichever is higher, is equal to how much? 500 rupees. Compare this value with the fair market value on 31st January 2018 is equal to 3,000, let us assume, and you sold it for sale value is how much? 5,000 you sold, whichever is lower, is equal to how much in this case? How much? The result is 3,000. Now cost of acquisition under normal provision, cost of acquisition under beneficial provision, whichever is higher, 3,000 is treated as cost of acquisition. So 5,000 is sale value, 3,000 is cost, only balance 2,000 is capital gain. So this is a beneficial provision given for long-term capital asset referred under 112A for these shares. If at all you acquired before 1st February 2018, now you are selling it and it's a long-term. Then find out cost of acquisition under normal provision. Compare it with the beneficial provision. What is beneficial provision? Fair market value on 31st January 2018 or actually at what price you sold now. Compare with these two, lower that amount, compare with the cost of acquisition under normal provision, whichever is higher, that cost you take. Why this benefit is given, I have explained in cost of acquisition video. It's a regular video which I uploaded on my YouTube channel. Exclusively this point I covered for half an hour. Getting it? So this point is what covered here. This point is what I am covering it here. This is what. So what is the cost of acquisition? The cost of acquisition in relation to long-term capital asset being listed equity share, unit of equity oriented fund or unit of business trust. The cost of acquisition is cost of acquisition of such asset. What is cost of acquisition? Generally actual cost, or if the asset is acquired before 1/4/2001, then FMV or actual cost, whichever is higher. So that value you compute. Compare it with FMV of that asset on which date? 31st January 2018. FVC received on that. So in our example, FMV is what? 2,000, 3,000. FVC is what? 5,000. Whereas original cost I purchased in 1998 is for 100 rupees. Fair market value on 1/4/2001 500. So this will come 500. 500 between these two lower means 3,000. So 500 or 3,000, whichever is higher means 3,000. Getting it? So listen to this video in the past 10 minutes. You listen to it once again, you will get clarity. So in fact, I clearly gave explanation on one specific video. You just type it in the YouTube, caramharsha cost of acquisition video, you will find it. So that's cost of acquisition, we understood. Now you see, we are understanding capital gains computation. So how to compute capital gains on non-depreciable assets? How to compute capital gains on non-depreciable assets we are understanding. How to compute capital gains on non-depreciable assets? So what is full value of consideration? First identify consideration. From that eliminate transfer expenses. From that reduce cost of it. What is cost of acquisition? Generally, if I purchase the asset, I am only selling it. Cost of acquisition is purchase price. If I purchase before 1/4/2001, actual price or fair market value on 1/4/2001, whichever is higher. Suppose if these are listed shares, which are referred under 112A, and I purchased them before 1st February 2018, then cost of acquisition means identify cost normal. Normal means what? Actual cost. Or if I purchase them before 1/4/2001, then FMV on 1/4/2001, whichever is higher, that is cost of acquisition under normal provision. Then look at beneficial provision. What is beneficial provision? Fair market value on 31st January 2018. Amount at which you actually sold, full value of consideration, whichever is lower. That amount you compare with normal provision cost of acquisition, whichever is higher, that much you take. Why this entire logic has been constructed? What is the logic behind this? I clearly explained in my regular video of 1 hour, which I uploaded on YouTube. So just type caramharsha space cost of acquisition. You will find the video. Then cost of improvement. So if it is a long term, improvement cost can be indexed. So if at all any improvement expenditure is incurred by you or incurred by previous one, whoever it is, before 1/4/2001, 0. So if any improvement is spent before 1/4/2001, 0. Now how to index it? CII of the year, transfer year number, denominator, whenever improvement took place, no, that improvement. Suppose if previous owner spent improvement in 2003-04, then 2003-04 number. If you spent some improvement in 2017-18, then that improvement number 1 by previous owner, improvement number 2 by you, improvement number 3 by you. So in all the 3 improvements you can claim. If it is long term, in all the 3 indexation is available. Very simple. So if you reduce that, you will get long term capital gain. Suppose if at all it is not a long term, then only direct cost, direct acquisition cost, direct improvement cost you reduce, no indexation. Then the gain you get is short term capital gain. Able to understand. So all these, so whatever I have told right now in the past, half an hour to 1 hour, whatever I covered, almost I covered 1 hour 20 minutes till now. Getting it? So all that provisions I have covered here. Still another 1 hour will take for covering this capital gains revision. So I am slowly explaining you all the things. So revision capital gains revision. So it's not that easy to revise. The topic is easy provided you are clear, you are having clarity on this. So remaining provisions, no, I will be discussing in the next, I will be continuing in the remaining. Getting it? So in the part 1 revision, capital gains, we are in the discussion of cost of acquisition, where we have completed predominantly many topics. So still we are left with cost of acquisition in certain cases. And we need to discuss 45 series where capital gains is taxable not in the year of transfer but in some other year. Slump sale we need to discuss. And what is 50C? One of the important provision in case of immovable properties. So that we need to discuss. And exemptions, capital gain account scheme, extension of time limit. If these items are discussed predominantly, I can say 80% of the topics in the capital gains we have covered. Okay, now, so what is cost of acquisition in certain special cases? Distribution on account of liquidation. Now you see when a company distributed any assets on liquidation, there is a section called 46. What that section says is, if a company on account of liquidation distributing any assets, not cash, distributing assets, transferring physical assets to the shareholders directly. Generally, this happens in closely held companies. Getting it? So if a company distribute any asset on account of liquidation, it amounts to transfer, but company is not liable to pay any tax on that particular transfer. Instead, shareholders has to pay tax on transfer made by the company. How? Shareholders are redeeming the shares. Whatever the shares they are having, they are redeeming with the company. In return, they are cancelling the shares. They are relinquishing the right in the company. Yes or no? So they are cancelling the shares and getting the consideration from the company in the form of assets. Getting the point? Now, how to compute capital gains in the hands of shareholder on liquidation? Section 46 clearly says it is taxable for shareholder only, not for the company. So full value of consideration is nothing but fair market value of assets distributed minus deemed dividend under section 2 clause 22 subclause C. Getting it? So for shareholder, full value of consideration is fair market value of assets on distribution date minus deemed dividend under section 2 subsection 22 clause C. So that is full value of consideration minus cost of acquisition is what in the hands of shareholder? He purchased shares, that cost of acquisition. If it is long term, then index it. So indexed cost of acquisition that you reduce. So final amount, whatever you get is called as either long-term capital gain or short-term capital gain, or long-term capital loss or short-term capital loss. That's it. Now remember. Now shares company liquidated. So the shareholders have received some asset. Market value of the asset minus deemed dividend, that itself is considered as capital receipt, capital consideration. For that, cost of acquisition is this much. So balance is taxable as capital gains, right? Now I am holding this asset in my hand right now because company liquidated and they distributed me. This asset I am subsequently selling to somebody else. Suppose, when company got liquidated, I am one of the shareholder. I received 10 lakhs worth of market value of the asset in my hand. Deemed dividend considered by the company was 2 lakh. So total consideration was 8 lakhs. This is what considered for the purpose of capital gain taxation. Minus cost of acquisition, let us assume 4 lakh. So I made a profit totally 4 lakh because of the liquidation and I got asset distributed. Fine. Now this asset, which I got, market value of the asset, which 10 lakhs, which I got, I subsequently sold this asset to somebody else. I sold it for some consideration of 25 lakhs. I sold after some 5 years or 6 years. I sold these assets for 25 lakhs. Now, what is cost of acquisition? This is the question. The cost of acquisition is fair market value of the asset distributed on the date of distribution. Now, I got this asset. How? Did I purchase this asset? No. This asset is something company distributed me. At the time, I already paid capital gains tax. Remember. So, the asset which is distributed to me, that asset market value is treated as cost of acquisition. So 10 lakhs is the market value rate when the company distributed me. That is considered as cost of acquisition. Now I sold this for 25. So balance is capital gain or loss, whatever it is. Now here you see, now whatever asset company distributed me, right, that I am selling it, right? Now is it a long term or short term? From which date you will consider? You will consider this tenure from the date company acquired. From which date? From the date company acquired. Anyhow, that is not a very big important provision also. So until now you can understand. Are you clear? Next. So that is one provision. So this I completed. Now, so this we completed. Now, what is cost of acquisition of the asset which you received as gift? If at all a shareholder received any SSE received any asset as gift, no. And that gift which suppose very simple. My friend gifted me land. Okay, on some occasion he gifted me this land. I am subsequently selling. I am selling it to somebody else subsequently. What is the cost of acquisition? What is the cost? This is a provision where many will confuse. Now, first of all, you received gift na. So in the year in which you received gift, no. At the time, is it liable for gift taxation? Check out. Is the gift received taxable at the time of gift? Check out. Yes, 56. Under 56 subsection 2 clause 10, or earlier we have something called clause number 7. Some amount is taxed already when you received this gift. Then this gift, if you subsequently sell it, the cost of acquisition is different. Suppose you received gift, no. At the time when you received the gift, it is exempt for you. At the time when you received this gift, no, nothing is taxable. You just received it as a gift. Nothing is taxable. Now you sold it. Now, what is cost of acquisition? Getting it? Simple. You received gift, ma. Getting it? You received a gift. I'll just move it. So, you received the gift. Now, the point is the gift taxable under 56 subsection 2 clause number 7 when you receive? If the answer is yes, how much is taxed? Identify. Now, suppose the gift is exempted when you received. Getting it? Now, in these two cases, subsequently what happened is this gift you sold to somebody at 25 lakh. I sold this gift ultimately to somebody else. I received gift and I sold it. Now, what is cost of acquisition? Now, when you received the gift, no, at the time it is exempted. Let us assume you received this gift on the occasion of marriage. Let us assume you received the gift from relative. Let us assume you received this gift from trust or association or university, somebody. Getting the point? Exempted. Now, the cost of acquisition is 49 subsection 1 mode. As per that, cost to previous owner. So, whoever gifted me, no, at what price he purchased, that is cost of acquisition. Understood or not? See, when I received a gift, no, on the date of gift, the market value is 10 lakh. The market value is 10 lakh. But the fellow, no, whoever gifted me, at the time when I received this gift, no, it is exempted. So 49.1, what it says? Cost to the previous owner, not market value. Now, previous owner purchased it for 5 lakhs only. The one who gifted me, he purchased it for 5 lakh and gifted me. So cost of acquisition is 5 lakh. Are you clear? Suppose when I received a gift, some 3 years, 4 years back, I received a gift on the occasion of something, but it is not exempt. Whatever the gift I received, not a relative, not on the occasion of marriage, not an exempted source, taxable source. Now at that time when I received the gift, entire market value is taxed. Entire market value is taxed under income from other sources because it is exceeding 50,000 rupees. Now, what is the cost of acquisition? Fair market value at the time of 56 subsection to clause 10 taxation, whatever market value is there, at the time of gift taxation, that market value will be treated as cost of acquisition. So now, what is cost of acquisition? 10 lakhs. If you receive gift which is exempted, subsequently you sell this gift. Now computing capital gains, what is the cost of that gift? You received it as a gift which is exempted earlier. Getting it? Cost to previous one, 49.1. You received a gift that is taxed under other sources, under gift provision. That gift you subsequently sold. What is the cost of acquisition? 49 subsection 4 says the cost of acquisition is fair market value or the value that is considered for the purpose of calculation of income under 56 subsection to clause 10. The value of the gift that is considered for gift calculation under 56 subsection 2, that is treated as cost of acquisition. That's it. So with this entire cost of acquisition, non-depreciable assets, entire the discussion is completely over. We understood what is capital asset, we understood what is transfer, we understood what are various depreciable assets, how to compute capital gains, electricity company, how to compute capital gains, non-depreciable assets, how to compute capital gains, improvement means what, acquisition means what, all that issues we understood. Now we still have to understand special issues under capital gains. What are the special issues? First one, 45 subsection 1A. 45 subsection 1A, or you can also call it as clause 1A. Let us call it as subsection issue because they are somehow related. Getting it? So 45 subsection 1 is charging section. 1A is exception to charging section. Nothing but. Generally, capital gains is taxable when in the year in which you transferred. Suppose I have a very big some jewelry I have, or let us assume some plant and machinery was there in my godown. Suddenly fire accident happened. Complete plant and machinery was destroyed. Getting it? Completely it was destroyed. Now I received insurance compensation, and you know what? The value of the machinery which was destroyed, the depreciable asset value, block value, just 10 lakh. But I received insurance company compensation 25 lakh. In spite I suffered a loss, in spite there is a damage happened, still I made a profit. Department want to tax that profit. That's why they brought a provision called 45 1A. If you receive any compensation or on account of demolition, destruction, whatever reason, getting it, you are liable to pay capital gains. But when? Not in the year in which it is destroyed, but you will receive compensation within some 1 year or 2 years or 3 years, something. You receive compensation right at the end of the day. Somewhere in some financial year, in some previous year, you will receive right. In the year in which you received compensation, in that year, you have to pay capital gains on that particular asset which was destroyed. Now, for the purpose of 45 1A, what is full value of consideration? Whatever compensation insurance company paid me, money they paid me, no money. They paid asset only. Market value of the asset received. Getting the point? Minus what is cost of acquisition? The asset which was destroyed, no? Yes or no? If it is a block of asset, depreciable asset, cost of acquisition is block value. What is the block value? I have already told you. Value of the block. Yes or no? So written down value, nothing but. So what is the cost of asset? We know. So depreciable. Non-depreciable assets, cost of acquisition. What is cost of acquisition? You purchased. Then whatever the price you paid, previous owner, you got it from previous owner, then cost to previous owner. So cost of acquisition provision is same. If it is long term, from which date you will consider? Long term or short term? From the date when you purchase or from the date when previous owner purchased? From that date till the date of destruction. Remember, once the asset got destroyed, the asset is no more. So period of holding will be only up to year of destruction. Year of transfer is year of destruction. Indexation is available only up to year of destruction. Able to understand. But capital gains is taxable. Let us assume in 22-23 financial year accident happened. But insurance company paid me compensation in 24-25 previous year. Capital gains we compute in 24-25 year only. We will not compute in 22-23. Getting it? But indexation facility, year of transfer, up to year of transfer, 22-23 only. Period of holding will be up to 22-23 only. That's it. That's what 45 1A says. Next, 45 subsection 2. What 45 subsection 2 says? It's nothing but it is talking about conversion of capital asset into stock in trade. Capital asset converted into stock in trade is also treated as transfer. Now, when capital gains will be computed? Not in the year of conversion. Year of transfer is year of conversion only. The moment you convert, you transfer the capital asset by default. But capital gains we will not tax immediately. Capital gains we will collect. Capital gains we will tax when you subsequently sell the stock in trade. You will sell that item in the form of stock in trade. Whenever you are selling, at that time we will compute capital gains. What is the full value of consideration? How much? Whatever the price at which I sold, at that price will you tax it? No. Very simple. Let's look at the calculation. I purchased some land and building, non-depreciable, personal land and building. I purchased it for 10 lakhs. Somewhere in 2004, 2005. Getting it? Now in 2021-22, I started real estate business. Getting it? This land and building I converted into my stock in trade. I want to sell this land and building. I converted. As on this date, market value, fair market value, as on the date of conversion, the fair market value of this particular capital asset is, let us assume, 1 crore. Getting it? 1 crore. When I purchased it is 10 lakh. When I converted it is 1 crore. Now in 23-24 financial year or 22-23 financial year, I sold it for 2 crore. Sudden rise in the real estate, I sold it for 2 crore. Now what are the implications? Very simple. In my business, so sale value in my business is what? 2 crore minus what is the purchase price in my business? My PGBP income. Purchase price is market value on the date of conversion. The moment you convert, that is cost of acquisition. That is purchase price for the business. So what is the price at which you consider this as a purchase price? Market value on the date of conversion. So the moment you converted capital asset into stock in trade, it becomes a business asset. It becomes a business purchase. So at what price you will record in books of accounts as purchase cost? Market value on the date of conversion. So 1 crore. So 1 crore profit. This is taxable under PGBP. Not only this. Now you see here, actually you purchased it for 10 lakhs, but you are ultimately selling it for, you purchased it for 10 lakh, you are ultimately selling it for 2 crore. So 1.9 crore profit actually, but here we taxed only 1 crore. What about remaining 90 lakhs? They are liable for capital gains. How? Now conversion happened when 21-22. In this year, this is year of transfer. Getting it? Period of holding. Just a minute. So period of holding will be considered up to conversion date. Indexation will be given up to conversion date. Now first of all, to compute capital gains, what is full value of consideration? Fair market value on date of conversion, 1 crore. Minus cost of acquisition, as usual, 10 lakh. If it is indexation, index it. So balance is 90 lakh. Now when you are indexing, up to which year you will index? The asset is sold in 22-23, but conversion happened in 21-22. Indexation will be only up to year of conversion because that is only treated as year of transfer. But taxability will be in the year in which stock in trade is ultimately sold. So that's about this one. Subsection 2. Now subsection 5. Compulsory acquisition of capital asset by government. If government has compulsorily acquired any capital asset, what is the consequence? Very simple. Whenever asset is compulsorily acquired by the government, that is year of transfer. But capital gain is not taxable in that year. Capital gain is taxable in the year in which you received the compensation. Getting the point? In which you received the compensation. Suppose government compulsorily acquired my land. So in 21-22, my land has been acquired by the government. Compulsory acquisition. Under Compulsory Acquisition Act, government acquired my land in 21-22. But 22-23 only, they paid me compensation of 25 lakh. Let us assume they paid me a compensation of 25 minus. What is the cost of acquisition? This land I only purchased, not previous owner. Let us assume. So I purchased it for 5 lakh. So that's it, 5 lakh multiplied by indexation. Base theory, denominator is what? When I purchased. Some 4-5 year I purchased, that index number you put. Now when I received compensation, 22-23 I received. No. You transfer the land to government in 21-22. So 21-22 compulsory acquisition year. That year index number only you should put. So indexation is available only up to year of compulsory acquisition because it is only treated as year of transfer. Period of holding will be computed only up to year of acquisition, date of acquisition, compulsory acquisition. Are you getting the point? Now that's it. Now in this 45 subsection 5, many students are having doubt regarding final order, interim order, all that queries. So what is that regarding? I'll tell you. Now you see here, this is important for MCQ, final order, interim order, 45 subsection 5. So my land is acquired by central government in 21-22, right? Yes. But but they have to pay me compensation in 22-23. They have to pay me. But it was not yet decided. Compensation, how much to pay? Government not yet decided. But what they did, 10 lakh rupee amount they paid me through an interim order. through an interim order, they have paid me 10 lakh rupee advance. Just immediately in 21-22, somewhere in the March they compulsorily acquired, somewhere in the April or May 22-23, they paid me compensation some 10 lakhs advance only. That is not full compensation. In 23-24, they released a final order. In this final order, the compensation is fixed at 1.2 crore. Already 10 lakhs paid. So 1.1 crore they have paid to my bank account in 23-24 ultimately. Now, when the capital gains is taxable, technically speaking, the moment you receive even part of the original compensation, in the year in which you received compensation, that is taxable. Now, if I want to tax in 22-23 itself, I got 10 lakhs, right? Now, can I compute capital gains? You don't know what is the full consideration. First of all, remember, as on this year, you don't know how much is the consideration. You received 10 lakhs as a token. That's it. What is the consideration you received? Full value of consideration. To compute capital gain, what is the consideration you received? You must know, right? So 10 lakhs only you received as an advance. Ultimately, in 23-24 only you came to know, my consideration is 1.2 crore. Now tell me, in this year, consideration is 1.2 crore. But you know, this 1.1 crore government paid in 24-25 year. Let us assume the 1.1 crore pending amount government paid in 24-25 year. Ultimately, when the capital gain is taxable, 23-24 only capital gain is taxable. Why, sir? We have not received fully. No, you received part of it already. In 21, in last 22-23 itself, you already received part of it. But we didn't tax. No. Why we didn't tax? Because we don't know full consideration is how much. Only through final order we came to know. Okay, so once final order comes, part of a consideration, if at all, already received. Whenever final order comes, it is taxable. Suppose, no, I did not receive this 10 lakhs, 22-23. In 23-24, final order came 1.2 crore. Directly consideration I received in my hand only in 24-25. Then in 24-25, capital gains is taxable. If at all you receive compensation partly also, whenever you receive compensation partly, in that year itself, full compensation, whatever is there, we will tax it. If at all, full compensation, you don't know, then we will wait until final order. Once final order comes, in that year, we will tax it. Whether you received full compensation fully or not. Now, in addition, what is cost of acquisition? Cost of acquisition is nothing but whatever cost of acquisition, cost of improvement, all that indexation, everything you claim. Fine. Suppose after 2 years, you filed a case against the government and you got additional compensation, enhanced compensation. You received enhanced compensation also. That is also taxable in the year in which it is ultimately received. So if any enhanced compensation is received, it is taxable in the year in which it is ultimately received. Clear? Now, what is cost of acquisition or improvement for enhanced compensation? Zero. For enhanced compensation, can I claim transfer expenses? No. However, you can claim legal expenses to get this compensation. So you reduce it. Balance amount is treated as balance amount is only treated as a long term or short term, as the case may be. If when you compute original compensation or when you got original compensation, you computed capital gain rate, that time if it is long term. Enhanced compensation also, long gain, whatever gain is there, that is long term. Are you clear? See, I'm not going in depth because this is not the time to go in depth. You must know all this. I'm just making you to recollect all the concepts. This is a recollection. This is a revision for recollecting everything. Getting it? Then, sometimes along with compensation or enhanced compensation, you will also receive interest because government is paying you late. That interest is taxable under other sources. Flat 50% deduction is there. Next. So 45. Subsection 5 is also completed. Now 45.5a. 45.5a is regarding specified agreement cases. What is it? Specified agreement. Very simple. You are having a very big land. So let us look at this example. So you'll understand, very simple. Okay, on this there is no problem. You are having a very big land. So one builder approached you. So he told he will construct a very big building. Like this, 2 buildings he will construct on this land. Land is yours only. Okay, but the investment on this land, 2 buildings, building 1, building 2, like this, a builder will come and construct everything. Once everything is over, once completion certificate comes, what builder told is entire building 2 plus land put together, you only keep it. Now this building and this land portion, I will take it. So you are the owner of the land fully. First of all, entire land you are only owner. But after I constructed 2 buildings, 1 building I gave it to you. In return, what you did? You gave me land. In return, what you did? You gave me the land portion. So this land is not mine of 50%, but building is mine only. So that you gave me. In return, what I gave you? I gave you 1 building. Earlier, yours is an empty land fully. Half the land you gave me. Remaining half the land, I constructed building and gave it to you. This is coming under 45 subsection 5A. What this section says, if a landowner entered into a specified agreement with a builder, getting it, and the builder has constructed a building, getting it, only on receiving completion certificate, you are getting consideration. You transferred land indirectly. Here, 50% of the land you transferred, actually speaking, in the name of the builder. But in return, what you got? You got a building. You got a share in the project. Yes or no? Share in the development project. So this is a real estate development project. In this, you got 50% share in that. Getting it? Now, suppose this project started in 21-22. You hand over the land in 21-22 or 20-21. You hand over the land that time itself. But at that time, we will not tax it. At that time, we will not tax capital gains. When we will tax, the completion certificate was issued in 22-23 financial year. In this previous year, completion certificate is issued. In this year, completion certificate is issued when 22-23. So now once completion certificate is issued, at that time for you capital gains will apply. Now what is the consideration you received? Consideration is nothing but stamp duty value of project value you received. Whatever the stamp duty value of the project that you received, now building stamp duty value, that value on date of completion certificate. So that will be the full value of consideration minus cost of acquisition is what? Now earlier you are the owner of 100% of the land. Now 50% you transferred. So whatever that 50% land you transferred, no, that cost only you should reduce. So because that 50% land you transferred, on the balance land you got a building. Very simple. Simple example I'm telling you. So that cost of acquisition you claim. So balance will be the capital gains. Are you clear? Now, this entire capital gains, 45(5)(a), what it says, this is taxable in the year in which completion certificate is obtained. Now, what is the full value of consideration? Stamp duty value on the date of completion certificate plus, if at all builder pay you extra cash also, that also we will add. So, both together is called as consideration received by you because of the transfer of land. Are you getting it? Suppose, before completion certificate issued by the local authority, before that itself, you sold the share in the project. See, what are you getting? What builder promised? Dear so-and-so landowner, out of your land, give me your land. I will construct 2 buildings. 50% of that land and building, I will give it to you back. 50% I will keep it. This is the agreement. Now, completion certificate is coming in 22-23. But in 21-22 itself, the landowner, he sold his 50% share to somebody else. At that time, 45(5)(a) will not apply. Getting the point? 45(5)(a) will apply only if the landowner keeps his ownership in the project on the date of completion certificate. On the date of completion certificate, still you are the owner only. You did not transfer to anybody. You waited for real estate share project. So that time this logic will apply. That's it. Now fine, right? Everything now you understood, right? Subsequently, 20-23 year completion certificate is issued. At the time, still in the particular land, 50% of land and building, I am only keeping it with myself. So stamp duty value of the building, whatever on the completion certificate, whatever I received, that is consideration plus cash amount minus 50% of the land I transferred. No. So what is the cost of acquisition of 50% of the land which I transferred? So that I reduced. So balance is the capital gains. Fine, very good. Now you know what happened in 24-25 year. In 24-25, this whatever 50% of the land and building which I am having in that project, I sold to somebody. I sold it for 5 crore. Now, what is the cost of acquisition of that 50%? What is that? What is cost of acquisition? That is nothing but the cost of acquisition, nothing but stamp duty value on the share of project. Stamp duty value in the project. Stamp duty value of your share, whatever is considered for 45 subsection 5A. For 45(5)(a) taxation, whatever stamp duty value that is considered, that itself is treated as cost of acquisition. Are you clear? That's it. So with this, another special issue is also over, which is 45 subsection 5A. Next, slum sale. Slum sale means very simple. Suppose you started some business, some 3-4 years completed or 5 years completed. The business has got really very good value. You created a lot of value. Now somehow you want to retire. Very simple. You can sell your business as it is. Business itself you are selling. You are not selling any asset in the business. You are not selling any car. You are not selling any bad building of the business. You are selling business itself to somebody. Sale of an undertaking, getting the point, or a unit or a division in an organization, getting it? You are selling that organization itself, unit itself to somebody, business itself to somebody. So that is called slump sale, lump sum sale. Now in slump sale, how to compute capital gains? How to compute capital gains in slump sale? Getting it? What is full value of consideration? Nothing but full value of consideration of all the assets you transferred, or full value of consideration of full value of consideration, sorry, fair market value of the assets transferred or fair market value of consideration received, whichever is higher. Suppose no, I'm transferring the business to somebody, right? Transferring business means what? I'm transferring all my assets and liabilities, everything. So what is the market value of the assets I transferred? 1 crore. Since I transferred this business, no, I got something else. The other person paid me cash, or the other person paid me some land. What is the market value of the consideration which I received? Some 1.2 crore. So for slump sale, what is the full value of consideration? 1 crore or 1.2, whichever is higher, 1.2 crore minus. What is cost of acquisition and cost of improvement? Nothing but net worth of the undertaking. Whatever business I transferred, right, that business net worth value is zero. That itself is treated as cost of acquisition and cost of improvement. No indexation, nothing. Getting it? Now, how to calculate this net worth? Assets minus outside liabilities. Getting it? Now, assets, what are they? Non-depreciable assets, whatever balance sheet value, nothing but book value. Depreciable assets, block values. Depreciable assets, block value as per section 43 subsection 6. Getting it? So block values we will take. Getting it? Minus outstanding liabilities, outside liabilities, you reduce it. So you will have net worth calculation. So that net worth will be treated as cost of acquisition. Let us assume net worth is 80 lakhs. So balance 40 lakhs is treated as capital gain. Now is this long term or short term? If you started this business 3 years back, more than 36 months, then it's a long term. If the business started so and so date you started, now you are selling this business, right? If the gap is less than 36 months, then it's a up to 36 months. If the gap is up to 36 months, then it's a short term. Then accordingly, capital gain will be a short term capital gain. So what is the criteria for slump sale? 36 months is a criteria to decide whether it's a long term or short term. Why you need this criteria? In order to decide rate of tax. If it is a long term, flat 20% is the rate of tax. If it is a short term, normal rates of tax, not 311A. 311A is for shares, not for slump sale and all. For clarity, 50B is over. 50B is over. Getting it? So special issues over. This is over. 50B is also over. Now, full value of consideration in case of immovable property. Generally, if you sell immovable property, what is the consideration? At what price you are selling? Check out. Compare that with stamp duty value. Compare that price with the stamp duty value. Now, suppose for immovable property, whenever you sell, so whenever you sell any immovable property, what is the full value of consideration? Actual consideration received or stamp duty value, whichever is higher. Provided there is one condition. Suppose here no, generally actual consideration. Suppose if stamp duty value is more than 110% of consideration. Suppose if stamp duty value is more than 110% of consideration, then stamp duty value. If actual consideration, if the very simple, let us take one example. Suppose I sold it for 95 lakhs. Stamp duty value is 120 lakh. Stamp duty value is what? 120 lakh. Okay, but I sold it for 95 lakh. Just a minute, emergency call. Yeah, sorry. So I sold land. Okay, some land and building. I sold it for 95. I received 95 lakh. But you know, stamp duty value was 120 lakh. Now, is 120 more than 10% of, is the stamp duty value more than 110% of actual consideration? Actual 95, right? 95 plus 10%, 110% is 104. Stamp duty value is more than 110% of actual, which means the stamp duty value 120 will be the consideration. Suppose no, stamp duty value is 97 lakh, whereas actual consideration is 95. Now, 95 into 110, 110% is 104. Getting it? So if stamp duty value is greater than 110% of actual consideration, then stamp duty value. Otherwise, actual only. Nothing but indirectly what the law says is, if at all stamp duty value and actual consideration, the difference is more than 10%, then take stamp duty value. If the difference is not exceeding 10%, up to 10%, market rate and stamp duty value can vary. In that case, actual only we will consider. If the stamp duty value is more than 10% of the actual consideration, then stamp duty value only we will take. Now, stamp duty value means which stamp duty value? On the date of registration, or on the date of agreement. On which date you should take? You should check the stamp duty value. Registration date stamp duty value or agreement date? Generally registration date. Suppose you received some advance amount before you sell the land, you received some token amount, and you received it on or before date of agreement. So you enter into agreement, no? So on or before date of agreement, you received some token amount. Getting the point? And that amount is received by other than cash, electronic mode, permitted electronic mode, account to pay check, account to pay bank draft, or any other electronic mode you received, then stamp duty value on date of agreement will prevail, not date of registration. Suppose no, you have not received advance at all, or you received advance in cash, or you received advance after the date of agreement, then agreement date stamp duty value will not apply. Stamp duty value means registration date only. That's it. So first identify which stamp duty value apply in the case. In exam they'll give you a question. Identify which stamp duty value, registration or agreement, fix. Registration agreement, something you fix. Then that stamp duty value compare with 110% of the actual consideration. If this stamp duty value is higher than 110% of the actual, then stamp duty value will be the full value of consideration. Similar logic will apply for gift taxation also. If you receive any immovable property as gift, so stamp duty value you need to consider. Which stamp duty value? Stamp duty value on the date of registration if the gift is received without consideration. Suppose if it is for inadequate, means you paid some money, then stamp duty value, agreement date or registration date, any of these two will apply as per the provision. Getting the point? If as on the date of agreement some advance is received and the advance is received by any mode other than cash, then stamp duty value on the date of agreement will apply. So that STV compare with actual. If it is more than 110% and the difference is more than 50,000 rupees, then gift provision will apply. 56 subsection 2 clause 10. That's it. At this speed if I teach also, you should understand. If you are unable to recollect what you read, that means you have not studied properly. So with this 50C is also completed. That's it. Next, exemptions under capital gain 54, 54B, 1037, 54EC, 54F, 54D, capital gain account scheme and extension of time limit. So what are all this? Now you see, some full value of consideration, some 10 crore minus indexed cost of acquisition or cost of acquisition, whatever as the case may be, some 7 crore. Getting it? So what is the capital gain? Long-term capital gain or short-term capital gain? Some 3 crore. Now, this is how you compute the gain. So how to compute this consideration? How to compute this cost? Everything is what we are discussing all these hours. Now, here, if you go and now you got gain, right? Suppose you don't want to pay tax on this. You have an option. Invest this amount. What? Invest this amount. Invest it as per 54 series sections. As per the rules given there, you invest it. Getting it? If you invest the amount as per the 54 series, whatever the amount is applicable, you need not pay tax on this. That 3 crore will be exempt. Balance taxable gain will be 0. What are the investments? So there is a section called 54B and 10 subsection 37. Both are talking about urban agricultural land. Suppose you transferred urban agricultural land. Okay. This land, before you transfer, 2 years you are only using it or your parents are using it. The land, urban agricultural land which you transferred, you are using it before the date of transfer for 2 years for agricultural purpose. Whether it is a long term or short term, doesn't matter. What you transferred is urban agricultural land. Before transferring, you are using it. Suppose the land which you transferred, it is through compulsory acquisition by government. Because of compulsory acquisition, the urban agricultural land which you are having, government acquired. And before acquisition, 2 years you are only using or your parents is using. Then government acquired, compulsory acquisition. That is also a transfer rate. Capital gains will apply rate. It is exempted. 10 subsection 37 says any compulsory acquisition of urban agricultural land which is used by the SSE or his parents or HUF or his family for 2 years preceding the date of compulsory acquisition, the capital gain or loss, whatever comes, is exempted. If it is loss, ignore. Gain, exempted. Sir, it is not compulsory acquisition, sir. I have an urban land, sir, which I am using it from the past 2 years or more than 2 years, sir. And I sold it to my friend. So full value of consideration is there. I have got a profit of 3 crores, sir. It's not compulsory. 1037 will not apply. What should I do? Buy another agricultural land. What is it? Buy another agricultural land. Sir, should I buy urban? No need. You can buy rural also. So whether you buy urban or rural doesn't matter. Buy within 2 years. Within 2 years from the date you sell the original land, within another 2 years, you buy another agricultural land. Enough. Whatever. How much price? What is the profit? You got 3 crore. I have got a 3 crore rupees gain. So buy with another 3 crore land. That's it. So capital gain is balance 0. You should buy this amount. This entire 3 crore should be invested in another agricultural land within 2 years from the date of transfer of the original agricultural land, which is for 10 crore. So that is 54B. Now there is a condition. Now you are buying a new agricultural land, right? Yes or no? By buying, what you sold one asset, you got a profit. That profit, if you invest in another asset, same asset, the profit whatever you got is exempted from payment of tax. So now there is a condition. You purchased another land right, that you should not sell it for 3 years. Lock-in period is there. This 3 years, there is a lock-in period. For how many? 3 years lock-in period. What happens if you sell the asset once again within lock-in period? Whenever you sell, at the time, what you are selling is a capital asset, right? Capital asset, right? At the time when you sell, no. Let us assume you transferred it in 22-23. You purchased this in 23-24. 24-25, this 3 crore worth of land, you are selling it for 5 crore. Now, what is the cost of acquisition? You purchased it for 3 crore, no? Minus, earlier, when you purchased it for 3 crore, capital gain 3 crore is exempted, no? How much is exempted? 3 crore. So, from the cost, earlier exempted capital gain reduced. Balance cost is 0. So, 5 crore minus cost of acquisition, 5 crore is taxable in that year. Suppose in this case, no, 54B, no? You sold for 10 crore. You purchased for 3 crore, right? This 3 crore, if it is a rural agricultural land, this rural land you sold within lock-in period. Capital gain computation itself will not come. So if rural agricultural land is purchased under 54B, that rural land is transferred within lock-in period, retaxability will not apply indirectly. That's a loophole created. Why? Under 54B, except 54F, 54EC, except these two sections, in all other sections, how, if a new asset is sold within lock-in period, how retaxation wordings they drafted? They drafted wordings like, on transfer of new asset within lock-in period, while computing capital gains, cost of acquisition shall be reduced by earlier exempted capital gains. This word they used. Which means, if new asset when you transfer within lock-in period, if capital gains is applicable, then only retaxation will apply. Clear. I hope you should be able to recollecting this. I'm just reminding you. I thought of not to cover this point, but I'm covering. Suddenly it came in my mind, so I covered it. Okay, because some students may not know the difference exactly how to retax, these items. So 54F, 54EC retaxation is different. 54B, 54D. In these three sections, retaxation is different. In 54, 54B, 54D, if the new asset is sold within lock-in period, then the new asset is sold now, which means that is also a transfer of capital asset now. At the time you compute capital gains, no. At the time you will reduce cost of acquisition, no. Cost of acquisition means what? Whatever the price of the new asset. That amount you already claimed exemption, so you reduce it. Balance only cost of acquisition you will claim. So that's how retaxing will apply. I cannot give detailed explanation on this. I can only give that in regular class. Okay, already 1.5 or 1 hour 40 minutes first part is there. Now already 40 minutes is there right now until now. Getting it? So more than 2 hours 15 minutes until now. Another 15 to 20 minutes will take. So that's 54B. Next. So 54B over, 1037 is also over. 54B over, 1037 is also over. Now 54. What is 54? Suppose you sold a residential house property. You sold what? Residential house property, which is a long-term capital asset. Which is a long-term capital asset. This one, and this one. In these three sections, the original asset must be long-term. The original asset must be long-term. Whereas in 54D, 54B, 1037, the asset can be either short-term capital asset, the asset can be either long-term. So only in 54, only in 54, 54EC, 54F, the original asset which you are transferring must be a long-term. So you transferred a long-term residential house property under 54. You transferred a house. You computed capital gain. You have got some 5 crore capital gain. If you want to claim exemption, buy another house. Provided in 54, no. What is the capital gain amount? First of all, what is the capital gain? Suppose if the capital gain is exceeding 2 crore, you can only buy one house property. One house property. Either you can buy or you can construct. If you want to buy 2 years from the rate of transfer of original house, if you want to construct 3 years from the rate of transfer of original house. So original house, whatever you transfer, no, on that you got some 5 crore capital gain. If you want to claim exemption for this 5 crore, invest that 5 crore in another house property. If you want to acquire, within 2 years you acquire. If you want to construct, within 3 years you construct. If the capital gain is more than 2 crore. Suppose if the capital gain is less than 2 crore. If the capital gain is less than 2 crore, I'll just show you. Yeah. Suppose exemption. If the amount of capital gain is more than 2 crore, one residential house you can buy in India. Okay, purchase within 2 years after the date of transfer, or construct within 3 years. If you want, you can even purchase in advance. Like before you sell the house, you purchased another house, you shifted into that house, and then you sold it. So how much in advance you can purchase? 1 year before the transfer only you can purchase. Suppose I purchased a new house in 2021 and I sold my old house in 23-24. No. This amount is not considered as investment. Suppose you purchased a new house in January 2022 and you sold your old house in August 2022. Means when you sell, the gap is 1 year in advance, less than 1 year. That is only considered as investment. Getting it? Or once you sell, later on you purchase, that is also considered as a valid investment. But remember, only if you invest in one house, only one house investment is considered as 54 investment. Getting it? Now, or you can even purchase 2 years after the date of transfer, or you can construct within 3 years from the date of transfer. Getting it? Suppose if the capital gain amount is not exceeding 2 crore, then if at all it is not exceeding, see, whether it is less than 2 crore or more than 2 crore, one house if you buy, whatever the value of the house you bought, that is exempted. Getting it? But if the capital gain is below, less than or equal to 2 crore, no, you have an option. You can invest in 2 houses. Whatever the investment in these 2 houses put together, you can claim for exemption. So either you can purchase or construct 2 residential houses. Getting it? So if it is purchase, within 2 years you should complete. If it is construction, within 3 years you should complete. That's it. Now, whether it is more than 2 crore, less than 2 crore, doesn't matter. You purchase a new house, right? Lock-in period is 3 years. If you transfer the new house or houses within lock-in period, capital gain again will be applicable. Earlier given exemption, whatever, will be reduced from cost of acquisition while computing capital gain on transfer of the new capital set. Then 54D, not an important provision at CA into, leave it. 54EC. Here what you are doing is, you are transferring long-term capital set being land or building or both. Remember in 54, residential house property. Means compulsory it's a land and building or only building, doesn't matter. Only land if you are selling, 54 section will not apply. 54 EC, even if you sell a land, this section is applicable, or only building or both land and building. It can be residential or non-residential, doesn't matter. It can be depreciable, business related building also, not an issue. Getting it? But that asset must be long term, means for this particular immovable property, you are the owner for more than 24 months. Simple logic. Now, if at all you got any capital gain on these land or building or both, capital gain amount you invest in bonds, long-term specified bonds. Within 6 months only if you invest, whatever amount you invest, that much is exempted, provided maximum exemption cannot exceed 50 lakh rupee. Maximum exemption under 54 EC in respect of a particular transfer cannot exceed 50 lakh rupee. Next, 54F. Here in 54F, no, original asset which you are transferring is any asset which is a long term but not residential house. Getting it? If you sell a land, no, vacant land, that is eligible. But if you are selling a residential house, 54F is not open. So if you sell any asset, jewelry I sold, or my business itself I sold to somebody under some sale, I have got a capital gain. Now whatever the amount at which you sold, no, sale consideration, if you invest sale consideration in buying a new residential house, capital gain is exempted. See, in all, very simple. I'll show you a simple calculation. So you just remember this point, 54F. Again, some students will do mistake if they don't remember this point. Suppose, no, I crore my asset, original asset for 10 crore. Minus cost of acquisition is 8 crore. Okay, my capital gain is long-term capital gain or short-term 3 crore. Minus, generally if it is 54, 54B, 54D, 54 EC, if I invest 3 crore I can claim deduction. So balance is 0. But if it is 54F, no. If you want to claim 3 crore exemption, you should invest net consideration. Suppose, no, I invested 10 crore in the new house, then 3 crore is exempted. Suppose I invested 5 crore only. In this example, I invested only 5 crore to buy new house. Then out of 3, proportionate exemption, 3 crore. See, if you invest entire net consideration, if you invest, 3 crore is exempt. But you invested only 5 crore. So 1.5 crore only exempted, nothing but the amount of exemption is equal to long-term capital gain multiplied by amount invested in the new house property divided by net consideration. This is the formula. Generally, how much is exempted? Amount invested or long-term capital gain, whichever is lower. But here, exemption is equal to long-term capital gain multiplied by amount invested divided by long-term net consideration. So here, in proportion to the net consideration, 54F exemption will be calculated. Now under 54F and 54EC, no. In 54EC, 5 years is a lock-in period. Whereas in 54F, again 3 years lock-in period. If you sell the assets within the lock-in period, earlier given exemption is re-taxed separately. It is re-taxed separately. It is not reduced from the cost of acquisition. No, nothing such. It is re-taxed separately. Sir, what is re-taxed separately? What is reduced from cost of acquisition? I am unable to recollect anything regarding this point. Ignore it. Which means you did not study these provisions properly at all. Ignore it. Don't even think about it. If at all you already studied, by this time you will be recollecting the points which I am saying. Next. So that's 54EC and 54F. Okay, 54 is not relevant. Capital gain account scheme. What is capital gain account scheme? I'll simply tell you. Under 54B, if you want to invest in a house property, you have a time limit of 2 years for purchase, 3 years for construction. Under 54B, agricultural, if you want to purchase, 2 years time limit you have. Under 54EC, to buy bonds, 6 months. For 54EC, capital gain account scheme do not apply. For 54F, to purchase a house property, 2 years time. To construct, 3 years time. Now you see, in order to invest in new asset, you have 2 years, 3 years time limit like that. But you know, I sold the asset in this year and I have got a gain and I want to invest and I have a time limit. But department don't want to wait until the time. You have to file IT return. No, immediately in the next year itself, assessment year. At the time of IT return, you told the department that, sir, this 3 crore amount I will invest, sir. What is the proof that you will invest? Okay, I'll give exemption. You invest, I'll give exemption. Sir, but I have time limit of 2-3 years. How come I invest immediately? Okay, don't invest immediately. Deposit the capital gain, whatever the amount of exemption you want to claim, the amount of exemption, whatever you want to claim, how much ever you should invest so that you can claim this much exemption, whatever the amount you have to invest so that you can claim this exemption, that amount, deposit in a bank account called capital gain account scheme. Open a bank account in a nationalized bank with a name called capital gain account scheme. In that you deposit. Show me that proof. I will give you exemption at the time of filing IT return itself. If you don't deposit in capital gain account scheme within 139 subsection 1 due date, I will not give you exemption at all. But sir, you may say, sir, I have time limit of 2 years, 3 years to buy new asset. Okay, man, you buy new asset within 2-3 years only. But that amount, no. What is the proof that you invest in the new asset within 2-3 years? What is the proof? Deposit in capital gain account scheme, separate special bank account. You deposit, fine, you claim exemption. 54F. Now you see, in all these sections, the new asset must be purchased within 2 years from the date of transfer, 3 years from the date of transfer, 6 months from the date of transfer, like that. Everywhere the time limit is given from the date of transfer. Now 54F says, in case of compulsory acquisition of original asset, my original asset is compulsory acquired by the government. But 19-20 years the asset is acquired. But I received compensation only in 22-23. Now capital gains I will compute in 22-23 as per 45 subsection 5. I am computing in 22-23. By this time I want to buy house, but 2 years time limit is over because government acquired in 19-20. 2 years time is already over. After expiry of 2 years as per 54, whatever the section, no, I received compensation. Now, how can I claim exemption under capital gain? So 54H, department is saying, in case of compulsory acquisition of capital asset, for the purpose of claiming exemption under 54, 54B, 54D, 54EC or 54F, for the purpose of calculating these time limits, date of transfer is not considered. Date of receiving the compensation is considered. Logic. That's 54H. Almost I spent 3 hours, 2 hours 40 minutes I spent only on theory part of the capital gains. Getting it? Especially part 1. If at all you are watching this part, no, sorry, I should tell this disclaimer at the beginning itself. You should be watching part 1 at first and then come and watch this. Only then you will understand. Otherwise, you will not understand this part. Okay, take care. That's it. The next video which I'll upload is PGBP. Let's begin the capital gains related amendments part. So these are the amendments that were there in the Finance Sec 2023. In the supplementary material, there are no amendments on capital gains. So better watch these amendments video for sure because it is very important. This capital gains related part for sure. So these are the broad amendments that we have. After Finance Act 2022. So in the Finance Act 2023, these are the amendments that were brought in the capital gains. In this, I personally feel 50AA amendment and taxation of electronic gold receipts. These 2 amendments are very, very crucial. And the next crucial amendment is section 54 and 54F. 2 amendments were there, section 54 and 54F, where maximum the investment in the new house property shall not exceed 10 crore. Indirectly, the maximum exemption is restricted to 10 crore. These are the main key amendments. And by the way, for the previous year 23-24, nothing but assessment year 24-25. If at all you transfer the capital asset in 23-24, the index number is applicable is 348, which means nothing but when you are calculating indexed cost of acquisition for long-term capital asset, getting it for the purpose of computing long-term capital gain, the numerator, year of transfer, if at all year of transfer is 23-24, then 348 is the number. If at all you are an old scheme student who prepared capital gains based upon previous year 20-23, getting it, where some 331, some number is there, whole number. If at all you followed with that, just it's a number change, automatically amounts will change. So you need not worry about, sir, you have learned it with the Finance Act 2022 and nothing to worry. It's just a number game. Only the number has been changed. Now, there are two amendments, mainly 50AA, electronic gold receipts, and 54-54F. Typically speaking, I call only these two amendments are typical from my point of view. Fine. So let's begin without any delay. So by the way, what is the index number that is applicable for the previous year 23-24? 348. In exam and all, you need not remember index numbers. They will give you index number. Year of transfer, they'll give you index number. Whatever financial years they used in the question, no, for all those years they'll give you index number. You need to clearly pick what is the right index number applicable for the given problem. By the way, please watch the marathon on the capital gains. Open a marathon video, go to the timestamp, capital gains timestamp. Watch that entire, approximately some 2 hours 15 minutes marathon I have uploaded on capital gains in that particular entire full video. Watch that, then you continue watching this, and I'm telling you, you're going to get goosebumps clarity in capital gains. Fine. So one amendment is, of course, index number. Another amendment is 50AA. I'll come back to 50AA a little while later. First, I will talk about electronic gold receipt taxation. Or let us do one thing. Let's talk about 54-54F taxation. Then I'll go to electronic gold receipt. So 54-54F, very simple. You all know in 54, what is 54 section? Where you're transferring a house property. You're also, and you got a capital gain. That too, it's a long-term capital gain. You transfer a house property, which is used for residential purpose. And you got a capital gain. And the capital gain may be more than 2 crores or less than 2 crore. If at all it is less than 2 crore, you can buy 2 houses. If the capital gain is more than 2 crore, you can buy 1 house. Now, whatever the asset that you are going to buy, right, new house, whatever amount you invested in the new house, right, that is eligible for exemption. That is eligible for exemption. Generally, whether it is 1 house or 2 houses, whatever it is, you are having time limit of 1 year before the date of transfer per purchase, 2 years from the date of transfer per purchase, 3 years in case of construction. And whatever amount, if at all you don't want to purchase immediately or construct immediately, before filing IT return due date, before filing the return of income, before the due date for filing IT return, the entire amount that you want to invest and claim exemption, you have to deposit in the capital gain account scheme. This is what you learned in the 54 section, correct? Now, in the 54 section, the new house that you are purchasing, right? If at all the new house value is more than 10 crore, if at all the amount invested by you on the new capital asset which you purchased for the purpose of claiming exemption, if the amount invested is more than 10 crore, the excess amount shall be ignored. That excess amount shall be ignored. Remember, they did not say exemption is restricted to 10 crore straight away. Here I told you for your convenience purpose. In the original law, in the original Income Tax Act, they did not say exemption is restricted to 10 crore. They didn't say like that. But they indirectly restricted exemption by saying amount invested in the new house more than 10 crore shall not be considered. Amount invested in the new house for more than 10 crore, that excess amount is not considered. Even if you deposit under section 54 in capital gain account scheme for more than 10 crore, that will not be considered. That's what the department said. That's what the act, the taxman said. Are you getting it? So indirectly, what are they saying? Amount invested in the new house cannot exceed 10 crore. I mean, if at all exceeds 10 crore, that excess amount is ignored, right? Indirectly, maximum exemption that you can claim under 54, maximum deduction is 10 crore. Similar amendment is brought even in 54F. What is 54F? You are transferring any long-term capital asset other than house property. Other than house property, you are transferring any long-term capital asset. Maybe a land also you are transferring. And where you are acquiring, what asset you are purchasing to get exemption, you are purchasing house property. What you are purchasing actually, you are purchasing house property. And if you recollect, in 54F, no, whatever amount you invest, you will not get exemption. you will get exemption based on a formula. What is the capital gain and how much amount you invested and what is the net consideration you got. Please watch the marathon if at all you are unable to recollect. Please watch the marathon if you are unable to recollect and then continue watching this. Fine. So how the 54F exemption is calculated, what is the gain and how much amount to be invested, what is the net consideration actually to be invested. In this proportion, exemption is calculated. Here, the amount invested more than 10 crore in the house, right, shall be ignored. So up to 10 crore amount invested only will be considered. So in 54F, no, maximum amount to be invested in the new house shall not exceed 10 crore for the purpose of calculating, exemption. I have given you page reference. This is the page reference, page number 75 in capital gains. After you just open capital gains, inside that 75. Getting it? You open capital gains, inside that 68. I say study material, I'm telling you. If I don't know whether you follow which material, right? Because this video I'm going to upload on the YouTube also. Getting it? That's it. So these are the two amendments. Please remember, MCQ might come. That's it. This is one important amendment in capital gains. Then we have another amendment that is relating to taxation of electronic gold receipts. SEBI has given vault manager rules. There is something called vault manager rules. Vault, V-A-U-L-T, vault means nothing but a locker. They are maintaining a locker. Getting it? So vault manager rules in 2021. In India right now, there are some 3 registered vault managers. 3 registered vault managers were there in India. Just a minute. Right now I will show you. So this is the link. Vault managers who are registered in India. I'm just showing you. Just 2 minutes hardly. Now you see here that the link has been opened. So you see, these are the 3 registered vault managers. Registered vault managers who got registration from 2022 year onwards. 2022 year onwards. Getting it? So what is this electronic gold receipts? Very simple. To promote electronic gold holding. To promote holding of electronic gold, SEBI has introduced a new concept called vault manager, gold related vault management services. Getting it? So what happens there? Very simple. If you understand this, in ICA Metal they have not given any problem, but we don't know in the exam a problem might come. Getting it? We don't know. So what they're saying is, suppose if I have a physical gold of 1 kg, suppose if I have in home physical gold of 1 kg, I don't want to use it anymore, and I also don't want to sell it. Because the gold is appreciating like anything. In the past 3-4 years, gold is appreciating really good. Getting it? Especially China is buying gold from the past 2 years. From 2022 year onwards, China is aggressively buying the gold. So the price is increasing. Steeply it is increasing. So I don't want to sell the gold. But at the same time, I don't want to maintain the physical gold in my home because of the theft, bulgery, all that. I don't want to. So what option I have? One, I have an option of converting this into gold monetization bond. That option is there, but I felt that is not interesting also. So you do one thing, you submit your physical gold to a vault manager and get a gold receipt, electronic gold receipt. You get electronic gold receipt. You get a receipt, electronic receipt. And you know what? This receipt can be traded in stock exchanges. This receipt can be traded in stock exchanges. This is something like a scrip. This is something like a security, shares and security. Just like that, you can trade it in. Yeah, I'm sorry. So this can be traded in the stock exchanges. This can be traded in stock exchange. So just like a shares and securities, electronic security kind of. Now, what is the capital gains treatment for electronic gold receipt? If at all physical gold, I know physical gold, if it is held for more than 36 months, it's a long-term capital asset. And if you transfer this gold, you have long-term capital gains while computing this indexation facility, all that and all we know. What about electronic gold receipt? Now, actually what I'm doing is, I am converting my physical gold into electronic gold receipt. I'm converting, right? Is this conversion treated as transfer? Yes. But section 47, 7D, a new clause has been inserted in 47 where they say, conversion of physical gold into electronic gold receipt with a vault manager as per SEBI vault manager rules, that is exempted transfer. Means the conversion from physical gold to electronic gold receipt is not. Finally, okay, I converted into receipt. Suppose I want physical gold back. Suppose I sold to somebody this electronic gold receipt. He want to get a physical gold for the receipt. He can surrender this. Gold receipt to the vault manager and get physical gold. conversion of electronic gold receipt back to gold, conversion of this receipt to gold, that is also not treated as transfer under section 47. So 47 clause 7D, which says that conversion of physical gold into gold receipt, conversion of gold receipt to physical gold is not a transfer. Why? Because we are just changing the shape of the gold. That's it. We are not actually selling gold to somebody and encashing it. We are just converting physical gold into a digital gold back to physical gold. So where is the transfer here? Where consideration movement? Where is the consideration? Where is the profit and all? So section 47 says it is exempted. This is not a transfer. Fine. What about, okay, suppose sir, I have a physical gold. I convert it into electronic gold receipt. Now can I sell this gold receipt to somebody? Absolutely, you can sell. This is not exempt, man. This is not covered under 47. This is taxable. This is taxable. Oh, fine. So if I sell electronic gold receipt, if I transfer the receipt to somebody else, it is taxable. Now, how to compute electronic gold receipt related capital gains? Just like a gold. Suppose no, I purchased my gold in 2021, April 2021. I converted this into April 2023. I converted this into electronic gold receipt in April 2023. I sold this in the June 2023 in the stock market to somebody. This receipt, no, I sold it to somebody in the stock market in June 2023. Now, whether this electronic gold, no, actually what I sold, remember, what I actually purchased is gold, physical gold. I converted into gold receipt. This is not a transfer under section 47. Now, this receipt I sold to a third party. This is treated as transfer, capital gains will apply. Now my question is very simple. Now I sold in June, right? Is this gold receipt long term or short term? First of all, for electronic gold receipt, what is the period of holding criteria? 36 months only. Now, sir, I got this receipt in April 23. Sir, I sold it in June itself, June 23, which means less than 36 months. Wrong. That is not the period of holding. For electronic gold receipts, period of holding includes previous asset holding period. Previous asset before the receipt is what? Physical gold. Whatever the physical gold that you have right earlier. Suppose you are the original owner who converted the gold into electronic gold receipt. That receipt now you are selling to somebody. Now this receipt is a long term or short term? If this receipt is a long term or short term, to calculate period of holding, physical gold you held right before conversion, that period will also be considered. Which means in my hands, April 2021 I purchased physical gold, right? Conversion happened in April 2023, right? Ultimately sold in 2023 June, right? Which I sold electronic gold receipt. Is this a long term or short term? From which date period of holding will you consider? From the date of creation of the receipt or from the date of purchase of original gold? Original gold. Since April 21 to 23, let's assume it is 24. Since April 2021 to April 2024, sorry, June 2024, this entire period is considered. More than 36 months. It's a long term. Accordingly, indexation facility, all that is available. This is one clarification which they in the period of holding. Section 2, subsection 42A, they clarified this. Now fine. Suppose this electronic gold receipt, I sold in the June month for, let us assume 1.5 crore. What is my cost of acquisition? Electronic gold receipt I got because of converting my physical gold. Whatever my physical gold cost is there, that is the cost of acquisition. Cost of acquisition of electronic gold receipt is nothing but physical gold cost. Physical gold cost I got it for 1 crore multiplied by index numbers of the year of transfer, index number of the year in which first held by the SSE. So reduce that, you will get whether it's a whatever, the long term or short term or whatever it is. So simple, long story short, what I'm trying to tell you, if at all you purchase physical gold, you convert it into gold receipt, that conversion is not a transfer. Gold receipt you are selling subsequently to somebody, that's a transfer. What is the full value of consideration? Minus what is the cost of acquisition? Cost of acquisition of gold receipt is nothing but cost of acquisition of the physical gold. Now, whether it's a long term or short term, from when you purchase the physical gold, from that date till the date on which you are selling electronic gold receipt, right? That entire period is considered for determining whether it's a long term or short term capital asset. Got clarity? Fine. Now, let's look at the buyer of the receipt. Suppose now I sold receipt to the buyer, somebody. Suppose Mr. A sold electronic gold receipt to Mr. B buyer. So I am the one who bought this gold receipt. For me, what I can do with this gold receipt? I can hold it, or I can submit this to vault manager and get physical gold. I can get physical gold. Now, suppose I purchased gold receipt from you. You sold me for 1.5 crore. You sold me this electronic gold receipt for 1.5 crore. You sold me this receipt for 1.5 crore. For the first time, I'm buying gold in the digital form. That's it. For me, it's the first time buy. For me, I bought. In which year I bought? 23, 24, or else let us assume 24, 25 year I bought for the first year. Now what I can do with this? I can hold it for 36 months. From now, I can hold it for more than 36 months and sell it, and long-term capital gain might get. Or what I can do is 24, 25 I got, right? I went in 25 and 26 to vault manager. I went to vault manager and I surrendered this gold receipt to vault manager. What I did? I surrendered the gold receipt to vault manager. Means I am converting gold receipt to physical gold I got. This conversion is exempted under 47. This conversion is exempted. Fine. No tax treatment as of now. You know what I did? In 28, 29 previous year, whatever physical gold is there, no, I sold it for 3 crore. The physical gold I sold. Remember in the previous example, I have a physical gold originally converted into receipt and sold receipt. Now you see, I purchased the receipt first, then converted into physical gold. That gold I am selling for 3 crore. Now how to compute capital gains? First of all, full value of consideration is what? 3 crore minus cost of acquisition of this physical gold is what? Originally you didn't buy the gold, you bought the receipt. In exchange of the gold receipt, you got physical gold. So the cost of acquisition of physical gold will be the cost of acquisition of the electronic gold receipt. So 1.5 crore. Now is this a long term or short term? You converted into physical gold in 25, 26, right? You sold it in 28, 29, right? Now physical gold you sold. From which date you will consider period of holding? Conversion data? No. This gold you got physically because of the gold receipt conversion which you purchased in 24, 25. So when I purchased gold receipt, from that date period of holding I will consider. You getting it? From the date of purchasing gold receipt through which I got physical gold now, gold receipt holding period will be considered. Getting it? For physical gold which you got in redemption of the gold receipt, the period of holding will be considered from the date of acquisition of the gold receipt. Same way, for physical gold, for gold receipt, period of holding will be considered from the date on which gold was originally purchased, through which it is converted into receipt. Are you getting it? Suppose I purchased gold receipt. I did not convert it to physical gold. I directly sold it to another party. Now, from the date on which I purchased till the date on which I sold, that is the gap I will consider. If it is more than 36 months, it's a long-term asset. Otherwise, it's a short-term capital asset. This is what amendment is in the Finance Act 2023. So, I will show you in the book, don't worry. So, section 47, in that clause 7D has been added. What are they saying? Any transfer of capital asset being conversion of gold into electronic gold receipt. If you are converting physical gold into receipt, or conversion of electronic gold receipt back into gold, getting it? It is exempted because it is covered under section 47. This conversion from gold to receipt to gold is not a transfer. But if you are selling it to a third party after conversion, that is a transfer. Now, when you sold to third party, it's a transfer, it is liable for capital gains. What is the cost of acquisition? Cost of acquisition of receipt is nothing but cost of acquisition of the gold. Cost of acquisition of gold is nothing but cost of acquisition of the receipt. You getting it? Now, so what is the cost of acquisition? Suppose if the asset is a capital asset being a receipt, which is issued by a vault manager, it became property of the person because of the conversion. You converted physical gold and then got EGR. Now EGR you are selling it. What is the cost of acquisition of EGR? That is nothing but cost of gold you purchased. Getting it? In whose name EGR is issued. Suppose where gold is released against a EGR, means you purchased EGR and you surrendered to the department, you surrendered to vault manager and you got a physical gold. That physical gold you are selling. Physical gold you sold. Physical gold you are selling. What is the cost of acquisition of physical gold? You sold this gold not by directly purchasing the gold. You got this gold by surrendering EGR. EGR you paid some amount, na? The cost of EGR in the hands of the person, that is the cost of acquisition. Same way, where electronic gold receipt is issued in respect of gold deposited. Getting it? The period of holding for such gold, the period for which gold was held prior to the conversion. So, for electronic gold receipt, while computing whether it's a long-term capital asset or short-term capital asset, while considering this, you have to consider gold holding period, physical gold you held, right? That period. Same way, when gold is released, in conversion of EGR. You surrendered EGR and you got gold. That gold you are selling ultimately. Now, whether this gold is a long term or short term, EGR holding period shall be considered. The period for which EGR is held prior to conversion, that will be considered in the period of holding. So simple. If at all you have not got the clarity, don't worry. Once again, play the past 10 minutes. Once again, that's it. Slowly watch, neatly watch. Don't watch at higher speed. That's why you'll not get clarity. Watch at standard speed. So clear example it took, along with the taxation. In the institute book and all, nothing. They just gave these 3 points. Nothing they gave. I in fact told you very clearly what is the period of holding is applicable with examples and all I told. Just make use of it. Then one more amendment, cost of improvement. Earlier for goodwill and all, cost of improvement is to be taken as 0. Now for any other intangible asset of a business, for all intangible assets, cost of improvement shall be taken to be nil itself. Straight away nil. Cost of improvement for all intangibles is straight away taken as nil. No more argument. Then finally, one more important amendment, that is section 50AA. That is section 50AA. 50AA is talking about computation of capital gains in case of market-linked debentures or specified mutual fund. Specified mutual funds or market-linked debentures. So 50AA is talking about taxation of market-linked debentures, specified mutual funds. Until before 50AA, just a minute. Yeah, sorry for the interruption. Yeah. So 50AA is the new section. Until introduction of 50AA, until before 50AA, market linked debentures, they come under 36 months criteria to decide whether it is a long-term capital asset or short-term capital asset. Suppose if this market linked debenture is a security listed on a stock exchange, 12 months only the criteria. Getting it? If at all it is listed on a stock exchange. If at all it is not listed on a stock exchange, it comes under 36 months criteria, debentures and bonds, unlisted securities other than shares. Getting it? 36 months criteria. But now what section 50AA says, you know, section 50AA has a overriding effect in spite of anything contained in 2 subsection 42A, 2 clause 42A. What they say, you know, 50AA, market linked debentures, specified mutual funds, they are always short-term capital asset irrespective of holding period. This is the first stroke. The market linked debentures and specified mutual funds, they are always short-term capital asset. So first of all, what is a market linked debentures? Are they really practical? Yes. There is a company called Piramal Enterprises Limited which have issued market linked debentures somewhere in 2019 or 18. Getting it? The market linked debentures were getting famous now. Getting it? In market linked debentures, no, principal is guaranteed by the company, but the interest amount which they pay on the debenture, right, that is not a fixed percentage, that depends upon the market movement. So these debentures, no, the rate of interest, the return on these debentures to investors, no, is decided by the market forces. So it's one more way to attract investors, to attract lenders. Getting it? That is market linked debentures. Another one is what? Specified mutual funds. Here, many students will not observe one point. Market linked debentures, whether you acquire before 1/4/2023 or after 1/4/2023, when you acquire doesn't matter. If you are selling it in the previous year 23-24 onwards, if you are selling, suppose this 23-24 year I sold some market linked debentures, it's always a short term capital. Sir, when I purchased this market linked debentures, you purchased in 2019, 2018, 27, doesn't matter. You are selling it after Finance Act 2023 is implemented. It's a short term capital asset. Suppose if I sold this market linked debentures in 22-23 financial year, previous year, at that time 36 months criteria, 12 months criteria, whatever is applicable, that only we will see. But from 1st April 2023, if at all you are selling any market linked debentures, it's always a short term capital asset, no indexation. Of course, debentures by default, no indexation. But specified mutual fund is there, no. Specified mutual fund, section 50AA we will apply only if the specified mutual funds are purchased on or after 1st April 2023. Only if the specified mutual funds are purchased on or after 1st April 2023. If the specified mutual fund is purchased after 1st April 2023, then only section 50AA will apply. Suppose no, I purchased some mutual funds specified which comes under 50AA specified mutual fund. Yes, the definition. Yes, the definition under 50AA, some mutual funds I purchased, it falls within the definition. But I purchased it before 1/4/2023. Before 1st April 2023, I purchased. It will not come under 50AA. Getting it? It will not come under. Now, if a specified mutual fund purchased before 1st April 2023, now whatever criteria, suppose if it is equity oriented fund listed on the market, 12 months criteria. If it is debt oriented fund, it will probably come under 36 months criteria. But if at all the specified mutual fund, you know what is a specified mutual fund? Very simple. It's nothing but maximum in equity, not more than 35% of the total proceeds are invested in equity shares of domestic companies. So maximum 35%. So how much in this mutual fund investment goes to equity shares? Equities of Indian domestic companies, maximum 30, maximum 35, means minimum 65% or more than or equal to 65% of the amount of the mutual fund is invested in other assets other than equity. It may be debt, or it may be, you know, real estate assets, or it may be any other assets which are there in the market. So that's called specified mutual fund. That's it. Now here, percentage of equity shareholding will be computed based upon daily average of annual average of daily closing balances. Whatever daily closing balances 365 days they list out, and average of it annually they'll consider. If it is less than 35%, that's a specified mutual fund. Getting it? What is a market linked debenture? It's nothing but a security which has an underlying principal component in the form of a debt security. So underlying concept, it's actually a debenture where the returns are linked to market returns on other underlying securities or indices, nifties, Sensex, all that. It includes any security which is classified or regulated as market linked by SEBI. So SEBI will specify the list of securities which are treated as market linked. They are also market linked. So that is market linked debenture definition, specified mutual fund definition. Now remember, specified mutual funds 50AA section can be applied only if the specified mutual funds are purchased on or after 1st April 2023 and then you sold, then 50AA is applicable. Suppose market linked debenture, you may be purchasing it before 1/4/2023 or even after 1/4/2023. That doesn't matter. Is it a market linked debenture? Yes, it's a 50AA. 50AA section will apply. So automatically to decide whether market linked debenture is a long term or short term, specified mutual fund acquired on or after 1st April 2023, long term or short term, you need not apply all these 24, 12 or 36 or no confusion. Straight away there's short term capital set. Fine, agreed. Okay, now how to compute capital gains? Very simple. Suppose I sold specified mutual funds which I purchased after 1st April 2023. I sold it now. Whatever sale price you are getting now, that itself is treated as full value of consideration received minus as reduced by at what price you purchased the debenture or at what price you purchased the unit. Check out. And the expenditure incurred for wholly transfer expenses, you reduce that. Cost of acquisition you reduce, transfer expenses you reduce. The balance would be deemed to be capital gain. Remember, the concept of indexation will not come for market linked debentures. Indexation concept itself is not there, but specified mutual fund. Remember, specified mutual fund, if at all they were purchased before 1st April 2023, if at all they were purchased before 1st April 2023, indexation concept possibility is there. Indexation concept possibility is there. Specified mutual fund purchased before 1st April 2023, 50AA section will not apply. So in that case, this can be either a long-term capital asset or this can be either a short-term capital asset. In such a case, if it's a long-term, indexation is available. Are you getting it? But if the specified mutual fund is purchased by the SSE on or after 1st April 2023, it's always a short-term. Obviously, indexation will not come into picture. Clear? Next. So, capital gain arising from transfer or redemption or maturity of a unit of a specified mutual fund acquired on or after 1st April 2023 or market linked debentures, whether acquired before 1st April or after 1st April, doesn't matter, would be deemed to be a short-term capital gains and chargeable to tax at normal rates of tax. It's a short-term capital gain. Remember, 111A and all will not come here. So it's a normal capital gain. It's a short-term capital gain which is taxable at normal rates of tax. Normal rates means what? SSE specific rates of tax. Sir, what is normal rate, special rate? Just watch the marathon basic concepts. You will get a clarity on that. In the marathon, just go to basic concepts timestamp. That's it. You will get it. Appa, that's it. Entire capital gains amendments is also over. Almost 30 minutes we spent. So capital gains arising from transfer of market linked debentures and units of specified mutual funds would always be capital gains arising from short-term capital asset, irrespective of period of holding of that asset. That is what provided in 50AA. And many students know here they are thinking short-term capital asset definition has been modified like this. No. Short-term capital asset definition is not modified. In the diagram, ICA book, they just mentioned for a clarification purpose like this. Original short-term capital asset definition 2 clause 42, if you see, there is no amendment inside that. 50AA only amended, 50A inserted. No, this have a overriding effect. The 50A section starts with notwithstanding anything contained in 242AA. It starts non-obstante clause. I hope you are confident on capital gains, all the amendments. 50AA, electronic gold receipt taxation, cost of improvement for intangibles is treated as nil. 54, maximum investment in house cannot exceed 10 crore. 54F, maximum investment in house cannot exceed 10 crore. Clear? By the way, please watch the marathon on the capital gains. Open the marathon, open the timestamp capital gain. Watch that, you will get a best clarity. Let's begin the amendments on income from other sources. In income from other sources, we totally have 3 amendments. 2 amendments are given under supplementary material. Like it's not, I can say amendment, it's a CBDT clarification on computation of exemption under 1010D, 10 clause 10D with respect to amount received under a life insurance policy. Getting it? How to calculate exemption, especially if you are able to recollect the provision where if the insurance premium paid for any previous year is exceeding 5 lakh, that insurance policy is not exempt from, that insurance policy is not exempt. Accordingly, maturity procedure is fully taxable. I hope you are able to recollect. Getting it? So regarding that, CBDT has given a very big clarification, and I'm telling you, for sure a question is going to come on 10 clause 10D. For sure, I'm expecting a question might come on 10 clause 10D because they have given 10 problems. In the supplementary material, they have given 10 problems on 1010D, either as a single adjustment you might get or as a dedicated problem you might get. Even at CF final also, this is one of the important amendment for CF final direct tax students. Getting it? Now, and another amendment that we got in Finance Act 2023 is winnings from online games. So winnings from online games, there is a separate section 115BBJ has been introduced, and corresponding 194BA. There is a separate TDS provision is also introduced for that. So we are going to discuss all that. And most importantly, in other sources, now there is a specific section which is inserted, 56 subsection to clause 13. In the ICS study material, it is wrongly printed as clause 12. Clause 12 is talking about ULIP taxation, maturity amount from ULIPs. Clause 12 is not there in our syllabus at CA. Inter ULIP related taxation is not there. But in the ICA material, for life insurance policy maturity, they wrongly referred it as clause 12, but it's actually clause number 13. 56 subsection to clause number 13. Yes, these are the 3 amendments we are going to discuss. Now, straight away, let's look at what is the amendment exactly is talking about. Now, so there is a there is a notes like this which is available. I'll give you, you can directly download this particular notes from our website. So in the below comments, in the YouTube video, if at all you're watching, in the comments, the notes link is given. So you just directly click on that link, you'll be directed to our website. You can download that material. Okay, this notes you can download just 2 pages notes. Now we all know. So what I'm exactly trying to talk about is, I'll open this material by the way. So winnings from online games, I'll get back later. Okay, first I'll straight away discuss on 10 clause 10D. What is 10 clause 10D actually talking about? First of all, what is taxable under income from other sources? 56 subsection to clause 13. As per Finance Act, any sum received, if at all you are receiving any amount, including bonus, generally whenever insurance policy matures, you will get sum assured plus bonus also you'll be getting. So whatever it is, whatever the sum assured and bonus, whatever you are receiving under a life insurance policy, other than ULIP and other than Keyman insurance policy, because clause number 13 is dealing with life insurance policy, not ULIP. ULIP is dealt under clause number 12. And Keyman insurance policy maturity amount is always taxable. 10 clause 10D. If you look at 10 clause 10D, it straight away says Keyman insurance policy is taxable, which is not exempt under 1010D. If at all you're receiving any sum from a life insurance policy which is not exempt, that life insurance policy, that amount so received, getting it, would be chargeable to tax under income from other sources. Now, how much is chargeable to tax? The sum so received exceeding aggregate premium paid for which you have not claimed any deduction under the provisions of the law. Fine, let me keep this aside little while later. First of all, which policy is taxable? That policy which is not exempt under 10 clause 10D. Remember, I am explaining the entire provision 10 clause 10D. I am also covering ATC point. I am also covering 194D, a TDS provision. Entire insurance policy related taxation I'm going to cover in this video. If you watch this, I'm telling you, you have learned, TDS provision on the same, other sources provision on the same, exemption of the same. Getting it? 3 points I'm going to talk about on the same point. So fine, I'll talk about this brown color highlight part later. So if a policy is not covered under 1010D, if you're receiving any amount from that policy, that is taxable under other sources. This is what through clause number 13 they specifically clarified. Even before Finance Act 2023, this clause is not there. At the time also we tax it under income from other sources, but we tax it as a residuary head of income. Now there is a dedicated clause. There is a dedicated clause which says this income is always taxable under income from other sources. Fine. Now let's look at actually what is this 10 clause 10D is actually talking about. So straight away you can use this diagram for a simplest understanding purpose. 10 clause 10D. 10 clause 10D. We all know section 10 is talking about exemptions. Section 10 is one thing which is talking about exemptions. Exemptions for what? Exemptions for amount received under a life insurance policy. Amount received under a life insurance policy. For a life insurance policy, whatever you have joined earlier, if at all you are getting any sum, any money, whether you call it as maturity, whether you call it as surrender value, whether you call it as bonus, it doesn't matter. It doesn't matter. So maturity, surrender value, bonus, whatever amount you are receiving from a life insurance policy is exempted if at all it falls under any of these three categories. If at all it falls under any of these three categories, it is exempted. If at all it is not coming under these three categories, it is straight away taxable. Now look at it. Suppose if at all you have purchased the insurance policy on or after 1st April 2012. If at all you purchased insurance policy on or after 1st April, actually there is one more date. On or after 1st April 2003, but before 1st April 2012. After 2003, before 2012, that column was also there, but now it is not relevant considering those policies and all were expired. That's why I'm not taking those policies references. Okay, straight away. But in the material, no, I gave even that also. Before 2003 picture I gave, after 2003 picture I gave, after 2012, after 2013, and even now the latest amendment after 2023. This is Finance Act. This is Finance Act 2023 amendment. Getting it? On that, in the supplementary material, they have given 10 illustrations how to apply that amended portion, how to apply that Finance Act 2023 provision. They have given 10 illustrations. We are going to discuss all that. So what are they saying? So if a policy is issued on or after 2012, but before 1st April 2013, if the premium paid for any previous year, premium paid is there, right? Premium paid means what is this premium paid? Premium paid for any previous year. So during the term of the policy, suppose each policy might have a term of some 5 years, 3 years, 10 years, like that. Every year, how much premium you are paying for every previous year? Getting under income tax, we only see previous year wise. So in a previous year, for a particular policy, how much premium you paid? Check out. Okay, so and so amount you paid. What is that amount as a percentage of sum assured? So what is the sum assured? You see, what is this amount percentage? Premium paid percentage of sum assured. If at all the sum assured, if the premium paid is less than or equal to 10% of sum assured, that policy is treated as an exempted policy. And moreover, you know very well, up to 10% of sum assured, whatever premium that we are paying for a policy that has been taken on or after 2012, but before 2013, you can claim 80C deduction for the premium paid. Whatever premium that you are paying, you can claim deduction. Moreover, the premium paid is not exceeding 10%. Getting it? That insurance amount is also exempted. If at all you have taken the policy between this year, 2012 to 2013 year. Suppose, I have taken policy after 2013 only, and I am not having any 80U or 80 DDB disability. I am not having, the SSC is not having any disability or any disease given under 80U or 80 DDB. Same 10% only. So for an SSC who is not having any disability or disease, getting it? If at all he has taken a policy on or after 2012 or on or after 2013, it doesn't matter. 10% of the premium is the cutoff. 10% of the sum assured is the cutoff. If the premium paid for that policy in a previous year do not exceed 10% of the sum assured, that policy is exempted. Suppose If at all the policy is taken on a disabled guy, disabled SSE, or if the policy is taken in respect of a deceased, in respect of a person suffering from 80 DDB diseases, specified diseases. Suppose if at all he is having any disability or if he is having any specified diseases, then up to 15% of sum assured excuse is given, relaxation is given, because generally for handicapped people, disabled persons, people suffering from diseases, the insurance premium is generally higher. Getting it? So compared to normal people, that's why for exemption also the criteria, for exemption criteria also, they have increased the percentage. Now this for disabled people and all, the percentage is 15%. When if the policy is taken on or after 2013, suppose there is an SSE, he is suffering from disability under 80U, and he took a policy on 1st July 2012. What is the percentage applicable? 10% only. Because 15% is applicable for a disabled person or a person having specified diseases. 15% logic is applicable if the policy is taken on or after 1st April 2013. Now remember, whether he has taken policy here or here or here, whatever it is, up to 10% or up to 15%, he can claim deduction under ATC. Whatever the premium that he is paying, he can claim under ATC deduction. Moreover, if at all premium is less than or equal to 15, less than or equal to 10, less than or equal to 10, means premium payable itself do not exceed 10, itself do not exceed 15. Straight away the policy is exempt. If the annual premium payable do not exceed 10%, 15%, straight away the policy is exempted policy. When you are receiving maturity, that maturity amount is also exempted. This is the amendment. This is the provision which every one of us know, because this provision is there from long ago. Now, in the Finance Act 2023, they have added one more provision. If at all there is an insurance policy, issued on or after 1st April 2023, and the premium payable for those policies is not exceeding 10% of sum assured for normal SSEs, not exceeding 15% of sum assured for 80 DDB SSE or 80U SSE, 80U or 80 DDB SSE. If the premium is not exceeding this, even those policies are also exempted, provided this proviso is what added in 1/4/2013 onwards. A proviso has been added. The point is very simple. There are many SSEs who are, especially high salaried individual, high net worth individual. What they're doing, you see, very simple. Now they are claiming optional tax regime, especially high salaried individuals, high net worth individuals, salaried employees, especially this is very popular. Some high paid employees where their monthly salary is 10 lakhs to 15 lakhs. What they're doing, they are happily going with default tax regime. They are going with the default tax regime under 115 BSE, and they are paying tax at very consistent rate. Even though their yearly package, yearly salary is 5 crore to 10 crore or more than 10 crore also, they are happily paying surcharge at maximum 25%. They're enjoying all the benefits under 115 BSE, and they don't even claim ATC deduction and all, because ATC 1.5 lakh deduction is not a big deal for them. 80D maximum deduction is how much? 50,000. That is also not a big deal for them. Yes or no? So these are all not a big deal. So they don't claim any deductions under Chapter 6A. They straight away go with 115 BSE. These people, what they are doing, they take big life insurance policy. So some life insurance policies, they will be having a sum assured of 10 crore, 20 crore sum assurance. Sum assured term insurance and all they take. They take term insurance where the amount of premium payable is, more than 5 lakhs in a year. The premium payable for those policies is more than 5 lakhs. Every year they pay more than 5 lakhs premium. But still, the premium amount which they are paying, it is less than 10% of the sum assured. It is less than 15% of the sum assured. And these people, anyhow, they don't have any Chapter 6A and all, and are buying bulk, big insurance policies, and they are enjoying, they are getting maturity amount, which is also very huge amount, because they buy insurance policies where the high rate of where the return is very high. Getting it? Of course, it's not ULIP, normal insurance policy, aggressive policies they buy. So where the maturity amount is so big, income tax department want to tax those maturity amounts, especially to these high net worth, high paid individuals. Getting it? Department want to tax them. See, we gave exemption because what? All these exemptions were given for what logic? What is the reason behind it? Because normal middle class or lower middle class or upper middle class, whatever it is, who are working as a salaried employee, if at all they are saving some amount, one of the savings method in India is insurance is one of the savings approach. So if they're saving money and they're getting maturity amount, if at all it is not a commercial policy. If at all it is not a commercial policy. Commercial policy means what? Where the premium is high every year. Non-commercial policy means what? Premium is not even 10%. Sum assured is 100, you are paying just less than 10, 5 or 6% or something, or less than 15. These are non-commercial policies. For them, income tax department gave exemption. But for commercial policies, even though premium payable in a year is not exceeding 10, not exceeding 50, but the sum assured is 5 crore, sum assured is 10 crore, sum assured is 1 crore, term insurance and all, where the SSC is paying premium, in percentage point of view, it is very less than 10%, less than 15. But if you look at the amount of premium which they are paying, the amount which they are paying is more than 5 lakhs for a single policy, for a single insurance policy, which the SSC is taking on or after 1st April 2023. Remember, this 5 lakhs amendment and all will be applicable only if the policy issued is on or after 1st April 2023. Suppose, if at all the policy is taken before 1st April 2023 and the premium that I am paying every year is some 10 lakhs for the single policy, still, is that insurance policy maturity taxable or exempted? What criteria we check? We only check these criteria. We only check what? 10%, 15%, 10% criteria. We don't check all this. From 1st April 2023 prospectively, if at all you are taking any insurance policy, the premium payable is not exceeding 10% of the sum assured or not exceeding 15% of the sum assured, as the case may be, is exempted, provided if at all the aggregate premium in any previous year for a single insurance policy, for a single life insurance policy, premium paid in any particular previous year is exceeding 5 lakh during the term of the policy. Suppose the term of the policy is 10 years. Any previous year, if at all aggregate premium paid in a particular previous year is exceeding 5 lakh, no exemption. That's a commercial policy. We will not give exemption. Income tax department straight away denied exemption. So indirectly, what are they saying? With effect from 1st April 2023, if I have to get exemption, if I have to get an exemption for a life insurance policy maturity amount, annual premium shall not exceed how much? First, it should not exceed 10% of the sum assured. In case of a person with disease or disability, 15% of the sum assured. Plus, for that policy, total premium amount in a particular year throughout the tenure of the policy, throughout the term of the policy, shall not exceed 5 lakh. If at all, throughout the term of the policy, suppose 10 years you paid premium every year. Any 1 year, if at all premium exceeds 5 lakhs. Sir, though I paid, let us assume 7 lakhs in 1 year, sir, but it is still less than 10% of sum assured. Still it is less than 15% only. Doesn't matter. The moment premium paid for a single insurance policy crosses 5 lakh in any previous year, straight away it loses exemption under 1010D. Straight away it loses exemption. No exemption. Straight away the maturity amount is taxable as per 56 subsection 2 clause 13. You see, I am not saying maturity amount is fully taxable under 56.2. I am saying maturity amount is taxable as per the section. In the section they tell you how to tax it, maturity amount. First time what I am saying right now here, maturity amount is taxable. That's what I am saying. I am not saying how much is taxable. So no exemption. Fine. Very good, right? This amendment is very good. But our SSCs are very clever. If at all for a single insurance policy, if the premium amount is exceeding 5 lakh, okay, you will tax it. What SSCs will do, if at all this kind of provision, if at all this kind of condition is added, people are very clever. They take multiple policies. What they do? They take multiple policies where each policy premium will not exceed 5 lakh. For each policy, premium will not exceed 5 lakh. So, because everybody got to know about this amendment, if I pay for a single policy more than 5 lakh, department will tax straight away that policy maturity amount. If I get maturity, that amount is fully taxable. So what SSCs cleverly can do? they will start taking multiple policies on or after 1st April 2023. Like I'll take 4 policies where every policy the premium is 1.5 lakh only. Every policy 1.5 lakh only premium. Single for a single policy premium will not exceed 5 lakh. So every policy premium is 1.5 lakh, less than 5 lakh for every policy. And for each policy, whatever premium I'm paying, it is less than 10% of the sum assured. Percentage wise less than 10, amount wise less than 5. Like that, I will take multiple policies, and I will violate this intention of this section. No, that is also not possible. Department added another provision. If at all, this is where the entire confusion for the students. This provision is what entirely confusing. To clarify this provision applicability only, they gave in the supplementary material 10 problems, 10 illustrations they gave. And that illustration, students are struggling like anything to solve those illustrations. But you see how easily I'll make you to solve. Without even reading single line in that, directly see the question and look at the answer, it will match. So in such a way, I'll make you listen carefully. So understood, right? Second, this another provision. Now SSCs know what they do. They take multiple policies. After 1st April 2023 onwards, they'll be taking multiple policies. If at all policies are taken before 1st April 2023, 5 lakh limit and all, no need to bother. I have taken policy before 1st April 2023. It is less than 10% of the sum assured. Straight away exempt. Mature amount is exempt. Starts it. No more taxability. The problem is, if the policy is taken by you on or after 1st April 2023, less than 10%, less than 15%, no doubt we will see. In addition to that, one more condition we will see. For a single policy, the premium paid is more than 5 lakh, no exemption for that. What about if I take multiple policies? What about if I take multiple policies where in each policy, premium is not exceeding 5 lakh? In that case, what will you do? If at all, aggregate premium for all those policies, aggregate premium for all those multiple policies taken on or after 2023, the aggregate premium for all the policies which are taken on or after 1/4/2023, if the aggregate premium exceeds 5 lakh, if the aggregate premium is exceeding 5 lakh in any previous year during the term of those policies, suppose I have taken 4 policies, 1.5 lakh, 1.5 lakh, 1.5 lakh, 1.5 lakh, 4 policies I have taken. Aggregate premium of these 4 policies, how much? 6 lakh. Now the 6 lakhs in any 1 year during all these terms, in entire the terms of these policies, all these policies are valid for 10 years. Getting it? In all the 10 years, all these 4 policies put together, more than 5 lakh. Or maybe 10th year only, all the 4 policies put together cross 5 lakh. Up to 10th year, each policy is 1 lakh, 1.2 lakh only. Up to 9th year, less than 5 lakh total amount. But 10th year, premium is increased. In the 10th year, all 4 policies put together, premium total, how much I paid, more than 5 lakhs I paid, 6 lakhs I paid. In any previous year, aggregate premium for such policies is exceeding 5 lakhs in any previous year during the term, then exemption is available only for those policies whose aggregate premium in any previous year does not exceed 5 lakh during the term of their policy. This is something similar to single insurance policy. If at all you have taken a single insurance policy, the premium payable does not exceed 5, I'm giving exemption. Here you have taken multiple policies combined together. What is the total premium paid? Not exceeding 5 lakh. Then you will get exemption. What does it mean? You see here, suppose, if this example itself I will take, you see here, what happened? I have taken 4 insurance policies. Each insurance policy is less than 5 lakh. But aggregate of this is more than 5 lakh. Now you see, aggregate premium for all the policies which are taken on or after 1st April 2023 is exceeding 5 lakhs in our example. Yes, it is exceeding, sir. In one of the year it is exceeding, sir. 10th year it is exceeding, sir. Okay. So which means this provision of first party satisfied. Now exemption is available. Yes, available. Only for those policies whose aggregate premium in any previous year. Only for those policies whose aggregate premium does not exceed 5 lakh. 3 policies if I total together, 3 policies put together I'll total. What is that? Out of 4, I will claim the exemption for 3. What is the premium paid for these 3 policies? 4.5 lakh only. So only those policies whose aggregate premium does not exceed 5 lakhs in any year. 3 policies I've selected. These 3 you can claim exemption. Now the one policy where If one policy which do not come under exemption, this is tax. Sir, can I claim exemption for all the 4? Aggregate premium for all these 4 policies exceeding 5 lakh, man. Getting it? Since it is exceeding 5 lakh only, we are giving exemption for remaining policies. Whether you will take these 3 policies, exemption. Whether you take these 3 policies, whether you take only for 2 policies, that is your choice. But you have 4 policies totally, right? All the 4 put together, premium is crossed 5 lakh. You cannot claim exemption for all the 4. But you can claim exemption for either 3 or 2, provided the premium for those 2 policies, premium paid for those 3 policies in any previous year shall not exceed 5 lakh. In such a case, you can claim exemption. I hope you are clear by 90%. Still 10% confusion. That's why I say I've given CBDT. That's why CBDT has given a clarification with so many examples. Shall we solve those examples? I think you'll understand better. Yes, let's try to go to the supplementary material and solve the examples. No need to read this entire theory. You are done. You know, here they say situation 1, situation 2, that and all not required. You straight away look at this problem. Now, straight away, entire provision. On the entire provision, I'm applying. Okay, just a minute. Yes, let's look at this example. Straight away, we'll solve examples and apply the as it is provision, whatever we discussed in the past 20 minutes. Okay, fine. So what is the date of issue? 1st April 2013, not after 2023. Therefore, 5 lakhs criteria and all do not apply. So what criteria we should apply? Since after 1st April 2013, disabled guy and a person having disease 15%, others 10%. Here no, they have not given any information. So life insurance policy A. So let us take an assumption that all the examples are from the point of view of a normal guy, a normal human being who is not having any disability, who is not having any disease under 80 DDB. So that's it. So 1/4/2013 means after 2012, right? Now what is the sum assured? 60 lakhs. How much amount of annual premium which he paid? 6 lakhs only. Now what is the percentage? 10%. 10 clause 10D, can I claim exemption? Yes, absolutely, because the premium paid is not exceeding 10, right? It is exactly 10. If it crosses 10 only, the problem. If the annual premium payable for an insurance policy does not exceed 10%, means up to 10 is permitted, it is exempted. Now how much amount is received? 70 lakh. So entire 70 lakh is exempted. Over. The answer is over. The consideration received under LIC A, so life insurance policy A, would be exempt since the annual premium does not exceed 10% of the sum assured. Moreover, the policy is issued before 1st April 2023. You see here the premium paid is 6 lakhs, but it doesn't matter because the policy is issued before 1st April 2023. When amount of premium we will see mainly, whether it is a single policy or multiple policy or whatever it is, when the amount point we will see only when the policy is issued on or after 1st April 2023. Amount will come into picture. For exemption purpose, we only say percentage always. Amount we will see only if the policy issue date is on or after 1st April 2023. Correct? So, since the policy issued before 1/4/2023, limit of 5 lakhs is not applicable. Therefore, since it is not an eligible ULIP, of course, it is not ULIP also. By the way, this is not a ULIP. They have given very specifically that it's an LIC. So, note this note point is also not required. This note point is not at all required. Ignore it. Next, example number 2. This note point is required for the later thing. Okay. For now, it is not required. Another example. 1st April 2023 policy is issued. The moment you see 1st April 2023, immediately what it should strike? Amount also you should check. For calculating exemption, for determining exemption, amount of premium paid annually also you should check. What is the annual premium paid? 5 lakhs only. If it is more than 5 only, the problem comes. What is the sum assured? 50. What is the percentage? 10%. The policy is taken on or after 1st April 2012 means 10%. Moreover, the policy is taken on or after 1st April 2023, which means 5 lakh. If at all premium paid exceeds 5 lakh, obviously it is taxable. So it is less than 10, less than or equal to 10% of the sum assured, and amount is also not exceeding 5 lakh. Therefore, amount consideration whatever you are receiving 52 lakh fully exempt. So the consideration received would be exempt under 1010D. When it is received, by the way, 1st November 2033, which means previous year 33-34, which means assessment year 34-35. So for the assessment year, entire amount received is exempted since the premium payable on the policy does not exceed 5 lakh and moreover it does not exceed 10% of sum assured. Next, another example, example 3, policy name is A. Now, when the policy is issued 1st April 2023, immediately we should check 10% criteria, plus we should also check 5 lakhs criteria. How much is the premium paid? 6 lakhs. What is the sum issued? 60 lakh. Premium paid is less than or equal to 10% only. But the policy is issued on or after 1st April 2023. And moreover, you see, this is a single insurance policy. Only one policy data they have given. Yes or no? For a single insurance policy, the premium paid is exceeding how much? 5 lakh. Therefore, entire 70 lakhs is not exempt under 10 clause 10D. It is not exempt under 10D. The consideration received is not exempt under 10D because the annual premium payable is exceeding 5 lakh. So simple until now. I hope you are able to correlate. Now let's look at this. Let's look at this. This situation here, they have given no circumstance, eligibility for exemption, that and all. You don't read, ma. If you read that, you will never understand anything. Look at the diagram. What I, just to follow the diagram which I explained. Not even diagram. Look at the content which I'm explaining and then sync it with the given example. Now you see life insurance policy number A policy. Are 2 policies were there. Okay. When these 2 policies were issued, date of issue 1st April 2023, 1st April. Both are issued on or after 1st April 2023, which means we should see percentage first. Then we should also see what? Aggregate premium for both of them put together, we should check. Now let's see. Annual premium paid is how much? Here it is 3 lakhs, sum issued 30. So first criteria for exemption, amount paid to sum issued, it is 10%. Here also amount paid to sum issued, it is 10%. Both the policies are less than 10% of less than or equal to 10%. So one of the criteria for exemption, both the policies satisfied. Suppose no, if at all for policy B, if the premium is 2.2 lakh, if the premium is 2.2 lakh, which is more than 10%, B is straight away taxable. No need to talk about exemption. But B policy, insurance policy B less than 10%, insurance policy A less than 10%. Both are less than 10%. One of the criteria for exemption they satisfied. But one more criteria is there. Because both the policies are issued on or after 1st April 2023, we should see what is the aggregate premium paid for both the policies. Annual premium, how much they paid? 3 lakhs for A, 2. Both the policies put together, how much premium paid? 5 lakh only. Aggregate premium paid for multiple insurance policies is not exceeding 5 lakh. Not exceeding 5 lakh. There, and moreover, for both the policies, the amount of premium paid for each policy is less than or equal to 10% of sum issued. And aggregate of both the policies put together 5 lakh. Exempted. Both are exempted. Correctly? So how, now what is the maturity you receive? 32 lakh, 21 lakh. Both are exempted. In this case, aggregate premium payable does not exceed 5 lakh during the term. And for moreover, annual premium, both of them are not exceeding 10% of sum issued. Therefore, the consideration received would be what? Exempt under 1010D. Easy or not? Fine. Let's see another example. By the time we solve all the 10 examples, you will be master in this provision, believe me. Next, let's see another example. What is the date of issue? 1st April 2023, which means we need to see 10% criteria as well as we should see 5 lakhs criteria, both. Fine. First, let us see 10%. What is the premium you are paying? 4.5. Sum issued is 45 lakh, 10%. Here also you are paying 5.5 lakh premium, 55 lakh sum issued, 10%. Both, first criteria for exemption, both the policies satisfied. But you are having 2 policies, not single policy. In such a case, how exemption is to be calculated? If for multiple policies, if aggregate premium payable, no need to even see to that extent. For one single policy itself, straight away, aggregate also no need to check here. Because one policy is straight away paid annual premium, how much? More than 5 lakh. Straight away, this entire 60 lakh is not exempt. You need not even check aggregate amount. If at all no, B policy, this is also less than 5 lakh. Then A and B put together, you should check. Already B, only one policy is straight away crossed 5 lakhs. Na? Therefore, you need not see aggregate picture also. Single policy itself crossed 5 lakhs. What is the question? Straight away it is not exempt. What about the remaining policy? Other policies, no. Only one policy is there where the aggregate premium in a year does not exceed 5 lakh. And moreover, percentage also not exceeding 10%. This 52 lakhs is exempt. This 52 lakh is exempt under 10 clause 10D. I hope now by this time you might have got 95% clarity, not 100%. You have not got 100%. Wait, remaining illustrations once you solve, you will get 100% clarity on this. Okay, that's it. It is exempted. I hope you understood now. Let's look at the answer. So consequently, consideration received under B would not be exempt, which means the consideration received under A is exempted. The aggregate premium for both are exceeding 5 lakhs. In that case, what is the provision if at all SS is having multiple policies? If at all multiple policies put together is exceeding 5 lakh aggregate, only those policies whose aggregate premium does not exceed 5, that is exempted. However, the consideration for A would be exempt because annual premium payable is not exceeding 5 for any previous year, and moreover it does not exceed 10%. But B policy is taxable because it is the single policy itself is more than 5. So that itself is enough. Now let's look at another example. Example number 6. When the policy has been taken 1st April 2023, 1st April, 1st April. Oh, all the 3 are taken order after 1st April. 3 policies SSC is having. Now, what is the annual premium paid? 1 lakh, which is 10%. Of course, this is also 10%. Of course, this is also 10%. But you see, insurance policy C, the amount of premium paid is already crossing 5 lakh. Already crossing 5 lakh. So only for single policy C itself it is crossing 5 lakhs. Forget about remaining multiple. That one policy itself is crossing already 5. This is straight away taxable. This is straight away taxable. Now remaining 2 policies put together. 4.5 lakh. Remaining 2 policies put together 4. Since the remaining premium is not exceeding 5 lakh. Remaining policies premium is not exceeding 5 lakh. These 2 policies I will claim exemption. They are exempt under 10 clause 10D. 10 clause 10D. Are you getting it? Now I applied the provision in such a way. C policy I separately did. For A and B alone I applied the provision. I got the right answer, but this is not the way to do the answer. You need to apply 7th provision carefully. If multiple SSC, if at all is having multiple policies, aggregate premium under all these policies are exceeding 5, then exemption is available only for those policies whose aggregate premium does not exceed 5 lakh. Now, okay, for 3 policies put together, premium is crossing 5 lakh. Now, exemption is only for those policies whose aggregate. Now, can I claim exemption for A and C? No. If A and C total, more than 5. Can I claim exemption for B and C? No. For B and C put together, it's more than 5. Can I claim exemption for A and B put together? Yes. For A and B put together, total premium is still 4.5 lakh, not exceeding 5. So, I will claim exemption. You should apply the provision exactly. Here, no. Even if I do not apply provision straight away. For C, no. Straight away premium is more than 5. So, it is taxable. For remaining 2, both put together, since premium is less than 5 lakh, both are exempted. So easy. But this logic may not always correct. This logic you apply may not always correct in all the circumstances. Fine. I will show you the next problem. So by the way, so consideration received under C alone would not be exempt. C alone is not exempt, which means A and B is LIC A and B would be exempted. Since aggregate premium for these 2 policies do not exceed 5 lakh. Okay, 3 insurance policies understood. Look at another example. From here, be careful. Yes. Just observe what I am reading and explaining. Until I say, yes, example number 7 is finished, don't come into any conclusion. So, until I say example 7 is over and going to example 8, until that, don't conclude anything about whatever I'm talking. Listen until I move to example 8. Entire example 7 you listen and then take your conclusion. Fine. What is it? When the policy is issued? 1st April 2022. If it is issued on 1st April 2022, I will see what is the percentage. 5 lakh 50, 55 lakh. Percentage is how much? 10%. It is less than or equal to 10%. Right away the amount is what? Exempted under 1010D. Sir, annual premium is more than 5. It doesn't matter, man, because the policy is issued on 1st April 2022. Before 2023, the policy is issued. So, straight away exempt. Good. What about remaining 3 policies? Remaining 3 policies were issued on or after 1st April 2023. What is the annual premium that they are paying? First 10%. And this is also 10%. Of course, this is also 10%. In all the 3 policies, the annual premium paid is not more than 10% of the sum issued. But you see, for insurance policy C, no, the premium alone, single premium alone is single amount. The annual premium is more than 5 lakh. Straight away, 1010D will not apply. I will say this entire 70 lakhs is not exempt. This entire 70 lakhs is not exempt. You see, I am not looking which year it is. I am ignoring this. That's not relevant for me right now. I will discuss about this year point later. This is not exempt for me. Okay. So if the SSC has taken on or after 1st April 2023 multiple policies, and all multiple policies premium annually is more than 5 lakh, then only those policies A and B whose aggregate premium does not exceed 5 lakh will be exempt. You know, A and B aggregate premium is 4.5 lakh throughout the term of the policy from 2023 to 2033. Up to this, every year premium paid is not exceeding 5. So for both of them, I will claim exemption. So it is exempt. It is exempt. Now immediately, if at all you are not getting this doubt, very good. If at all you are getting this, sir, what about this premium 1.4? This will not at all considered in aggregate premium 5 lakhs. That criteria, no, we don't consider this itself because the policy is taken before 2022, which means in this example, this is exempted, X is exempted, A is exempted, B is exempted, only C got taxed. So you see here, the conclusion is, consequently, the consideration received under LIC, life insurance policy C alone would not be exempt under 1010D. Which means in respect of A, consideration received under A and B would be exempt, and moreover LIC X policy is also would be exempted. X policies also would be exempted. You know, as per CBDT guideline, no. Only if a policy is taken on or after 1st April 2023, that comes under eligible policy for 5 lakhs criteria. So X policy is not an eligible policy, eligible LIP. What is this eligible LIP? Eligible LIP means what? Eligible LIP means those policies which are taken on or after 1st April 2023. If at all an insurance policy is taken before 1st April 2023, that is not an eligible policy for 5 lakhs criteria determination. Therefore, LIC policy X is not an eligible policy because it is taken before 1st April 2020, before 1st April 2023. Therefore, limit of 5 lakhs is not applicable. What clarity? Now you see. Here if you observe, X related insurance maturity amount is received in 32-33 previous year 32-33, nothing but assessment year 33-34. In that year they claimed already exemption. And moreover, 3 insurance maturity amounts we are getting A, B, C in previous year 33-34, nothing but assessment year 34-35. Now out of 3, A is exempt, B is exempt, C is taxable. C is taxable under which section? 56 subsection 2 clause 13, it is taxable. How much is taxable? That amount, no, the CBDT has given a formula for that. How much is taxable? As per that, we will have to compute. No, so that formula we will discuss later after we finish 2 or 3 more examples were there. After we finish that, we'll discuss that. I hope until now you understood example 7. Now it is over. Example number 8. This theory is irrelevant. Don't read at all. You will not understand anything if you read that. Look at the direct question. Same analysis, whatever analysis I'm applying, no, same analysis you apply. Don't even change the analysis. Now, example number 8. Little more critical. Be careful. Observe carefully. Because what I have seen in many students is from example 8 onwards only they are unable to understand. Especially example 9 and 10, many could not understand. I will tell you very simple. You know, the problem is they are looking at the years. Ignore the year for the time being right now. Okay. We will understand the year logic later. Now look at example number 8. How many policies is having? 4 policies. X, A, B, C. When the policies were issued, all are eligible LICs only because all are issued on or after 1st April 2023, which means 10% criteria we should check, 5 lakhs criteria we should check. Moreover, multiple policies, provision 7 we should check. Getting it? What is the percentage? 10. Here also 10. Here also 10. Here also 10 only. Everywhere it is 10 only. But you know, routine learning, straight away policy number C. Since the annual premium is more than 6 lakhs, sorry, more than 5 lakhs, straight away, this is not exempt. This is not exempt. I will apply that in the not exempt. This entire 70 lakhs is not exempt. This is taxable. Straight away will tax it. But remember, the C related maturity amount is received when, 1st April 2034. Previous year 34-35 year. Assessment year 35-36. ABC, all these three are received in assessment year. Previous year 34-35. Fine. Forget about the year right now. Next. Now look at XAB. Okay. X policy, the consideration X amount is matured in 33-34. Assessment year 34-35. Whereas A and B is matured in 34-35, 35-36 assessment year. Forget about the year right now. Now look at it. Now, C policy we understood. Now, you see, aggregate premium for more than, because all these are multiple policies, right? Multiple policies, right? Aggregate premium is exceeding 5 lakhs. Yes. In such a case, exemption is available for only which policies? Exemption is available only for those policies whose aggregate premium do not exceed 5 lakh. Whose aggregate premium do not exceed 5 lakh. Now here XAB is there. Aggregate premium is how much here? Aggregate premium. These three put together, 4.5, 1.5, 7 lakhs it is coming. So I cannot claim exemption. So can I claim exemption? So these three put together is more than 5 lakhs, no doubt. So either I can claim exemption for A and B, because A and B both put together less than 5 lakhs. Can I claim exemption for X and A? No. Can I claim exemption for X and B? Both put together aggregate premium is more than 5. Can I claim exemption for X and A? More than 5 lakh. Can I claim exemption for A and B? Yes, both put together less than 5 lakh. You getting it? Remaining policies, see, if C straight away is taxable, straight away taxable, because single premium policy itself more than 5 lakh. For a single premium policy already more than 5 lakhs is straight away taxable. What about remaining policies? Where annual premium of each policy is less than 5 lakh, where annual premium of each policy is less than 5, but aggregate is more than 5. If a single policy is more than 5, straight away taxable. Now I want you to revisit the definition. For a single insurance policy, if the premium is more than 5 lakh, straight away no exemption. If at all, multiple policies SC took, single policy, it's multiple policies, each policy is less than 5 lakh. But aggregate premium for each of the aggregate premium for all these policies are exceeding 5 lakh. For a single policy, if at all straight away premium is more than 5, straight away taxable. For multiple policies, where each policy, premium every year is less than 5, but total is more than 5. Now apply this logic. For remaining policies, each policy premium is less than 5, but aggregate is more than 5. Then exemption is available only for those policies whose total premium is less than 5. Now, okay, so XAB aggregate all three put together more than 5. Then can I claim exemption for only those policies? Either of any two policies I can claim exemption, provided these two policies premium paid put together do not exceed 5. So X and A I want to claim, both put together is crossing 5, so I can't claim exemption. X and B I want to claim, both put together it is exceeding 5 lakhs, so I can't claim exemption. A and B I want to claim, both put together is not exceeding 5 lakhs, so I can claim exemption. So therefore, this is exempted. This is exempt. This is exempt. Whereas this is not exempt. This is not exempt. This is not exempt. Now here logic we should check once. First of all, if you observe, X policy is received in 33-34. In this example, this is first year in which the maturity is received. In these four policies, first maturity amount happened where for 33-34. In the subsequent year, remaining policies were mature. Now suppose if SSE, here SSE has to do a tax planning. Carefully, SSE has to do a tax planning. This is exempt, right? Now, based on this, we understood like this. Now let us see how much maturity amount received. We should be very clever. 50 lakhs is a maturity amount which you are saying not exempt. For these two policies put together, since the premium is less than 5 lakh, you are saying exempt. Both put together, how much amount is there? 30 lakh only is their maturity amount. Whereas for this policy, 50 lakh is their maturity amount. Now, I said, right, two policies put together, since premium is less than 5 lakhs, it is exempt. That's what I told, right? But I will not claim exemption for this. I will not claim exemption for this. No, I will not claim. I will claim exemption only for X, because for X alone, what about A and B? Two policies. Okay, let them tax, because both the policies, if taxed also, total taxable amount is 30 lakhs only. But for X policy, maturity amount is 50 lakhs. So big amount. So what I will do, I will claim exemption for X. That's why you say I wrote blue color. Now I am writing my final answer. I will claim exemption for X policy, whereas I will tax A policy. I will red color. I'll write. I will tax policy number A. I will tax policy number B. Why? Because for policy number A, policy number B put together, total amount of maturity is 30. Maximum worst case, how much is taxable? 30 lakhs only. But if I claim exemption for these two, what is the provision says? What the provision says? If at all, aggregate premium payable for multiple insurance policies where each policy premium is less than 5, but aggregate is more than 5, SSC can claim exemption for any policy. Any policies of his option, at the option of the SSC, aggregate premium if it is not exceeding 5. That's SSC's choice. Whatever policies you want to claim exemption, ensure that aggregate premium for those policies not exceed 5. Now what I did originally, we did these two comparison, but we did not. Immediately, some students may not observe. Maturity amount also you should see. Maturity amount also see. It's not how many policies you are claiming exemption, it's for how much maturity amount you are claiming exemption. That is important. From tax point of view, amount is important rather than the number. Getting the point? Since maturity amount in X is 50, whereas A and B put together only 30. Tell me, if I have given an option, will you claim exemption for 50 lakhs or will you claim exemption for multiple items put together 30 lakhs? 50 I will claim exemption, man. Why 30? So, single policy alone I will claim exemption. Remaining two I will offer for taxation. What clarity? Now here there is one more law. Here there is one more logic. Suppose if at all SSC did not claim exemption for this. If SSC did not claim exemption for this, thinking next year A and B maturity will come, that year maturity amount will be high, so I will claim exemption for that. SSC will lose. SSC will lose. Getting it? In that case, even updated return also we cannot file, because updated return we can file only when there is an increase in income, not decrease in income. Getting it? So we have to be very careful. So the moment when X received this amount, you should immediately inquire with the insurance company. Dear insurance company, next year my A and B are also maturing, right? How much amount I will be getting approximately? Ask them. Suppose if the insurance company says, sir, put together 60 lakhs you will get, sir. Then don't claim this exemption. You offer for taxation. A and B are receiving next year, right? Both put together 60 maturity amount, right? Claim exemption for that. You need to apply tax planning. That's why they have given years here to confuse you. So here, consequently, A, B, C would not be exempt. Straight away, we will claim exemption for X, as it does not exceed 10% of the sum assured. Clear? Not yet over. The game is still there. We have two more examples. If at all you understood example number 8, 9 and 10 will be damn easy for you. Okay, just a minute. Yes. So example number 9. In all these cases, if you see, the policy is issued on or after 1st April 2023. First of all, is there any single policy where the premium paid is exceeding 5 lakh? Yes, C policy is there. Premium paid is straight away more than 5. I will tax it, not exempt. So straight away I will tax it. What about remaining policies? Premium paid for each of them is less than 5, but aggregate premium is more than 5. Then exemption is available at the option of the SSC for those policies where aggregate premium do not exceed 5. X and A, aggregate premium is 4.5, not exceeding 5. X and B, aggregate premium is 5 only, not more than 5. So I can claim either exemption for X and A or X and B. I can claim. But let us see. Let us not decide based upon this. Let us see based upon maturity amount. How much maturity amount you are having? 38 lakh. X policy 30 lakh. A policy 24. I can claim exemption either for X and A or X and B or A and B. Anyway, I can claim exemption, right? Now, I will claim exemption for which two policies? Those two policies maturity amount which is high. Now, X and A put together maturity amount is how much? 30 lakhs and A 24, 54. X and B maturity policy is how much? 30 plus 38, 68. A and B maturity amount is how much? 24 plus 38, 50, 62. So any two combinations I can claim. I can claim either X and A, or I can claim X and B, or I can claim A and B. Now either this I can claim, this I can claim, this I can claim exemption. But which one I'll claim exemption? I will claim exemption for X and B policies, because X and B put together, the maturity amount is more than, this maturity amount is highest of any other two combinations. Therefore, I will claim exemption for X and B. So I will claim exemption for X and B exempt. So I will tax it. I will tax A policy, insurance policy number A. Here you need to exercise this again. But you see, X policy is matured in 1 year, 33, 34. Remaining policies are matured in 34, 35. So here only the problem comes. So what X has to do, can he claim exemption for, this policy in this year, in the year in which he got this maturity amount? He should inquire, dear insurance company, how much I will get for A, how much I will get for B in the next year. Generally, if the policy is maturing in the next year, most of the times maturity amount is very, very predictable. Very rare cases only it is not predictable. Ask insurance company, how much I am going to get. Suppose they told you, sir, you are going to get this much, sir, for A and B. Then you can happily claim X policy exemption. Suppose no, insurance company said, sir, for A no, for A policy no, sir, you are going to get 40 lakhs, sir, not 24, you are going to get 40, they said. Then I will do one thing. I will not claim exemption in this year. No, I will tax it. A and B next year put together, 40 plus 38, 78, I will claim exemption in the next year. You getting the point? But in this example, whatever the point I told right now, that's why year is given to confuse you like this. Year is given to confuse you like this. Getting it? Generally, what happens, we don't think about the next year. So if you have multiple policies, you should do a proper tax planning. You should think about the next year maturities, how much I'll be getting. Because in a lifetime, if at all you're having multiple policies, maximum premium for not more than 5 lakhs, aggregate premium of all the policies in your lifetime, up to 5 lakhs, getting it? Only that you can claim exemption. Able to understand? 2 policies. Now you see eligibility for exemption. In this case, so what are the 2 policies I am exempting? A, X and B. A and C I am taxing it. Look at the conclusion, alternate answer. The most beneficial treatment is claim LIP X, claim LIP, life insurance policy B as exempt. This is the best answer. This is the best answer. So original answer, no, they have given so much of explanation. What they said is very simple. Since LIP X is exempted because it is not exceeding 5 lakhs, so it is exempted. They claimed X exemption. Aggregate amount of premium for A and B and C along with the LIC X exceeds 5 lakhs during the term of these policies. However, consideration received for A and B can be claimed as exempt under 1010D. So you can claim exemption for 1010D for A and B. If consideration received under LIPA is claimed to be exempt as aggregate of the annual premium payable did not exceed 5 in any previous year, the consideration under B would not be exempt. Same entire that analysis, whatever analysis we did know, they are just explaining it. If consideration received under policy B is claimed to be exempt as aggregate of the annual premium payable for X and B did not exceed 5 lakh. Hey man, nothing but whatever analysis I told no. That only they're explaining. You can write this analysis in your own words. It's a taxation subject, not an audit subject. You can write happily in your own words. Whatever analysis I told no, that you write. If you read this and all, no, your mind will be corrupted unnecessarily. Whatever analysis we did, they are explaining it. The best answer that we already, if at all, X was not claimed exempt under 1010D, the consideration received under LIPA would be exempt in 35 since aggregate premium payable for A and B did not exceed 5 for any previous year. However, the most beneficial treatment is X and B you claim exemption, not A and B. Getting it? So that's why year and all don't see at first. Year don't see in exam at first. Don't see year. Maturity amount, in one of the problem they said maturity amount is received in so and so year. Look at another maturity amount is there. Some more maturity amount see. If at all there. Ignore here and see this criteria and claim exemption for those 2 policies and give that explanation in the notes to accounts in the problem. Getting it? Don't worry. Question number 10 is even more bigger. 5 policies were there. Until here at least we have only 4 policies, but here we have 5 policies. You see, I think now you will get, right now you're having already 99.9% clarity. With this you will get that even 0.01% clarity also. Policy issued is on or after 1st April 2023. All are eligible policies where you need to check 10% criteria plus 5 lakhs criteria. Is there any policy, single policy where premium is more than 5 lakh? Yes, straight away as per provision 6, taxable. It is not exempt, straight away taxable. Is there any other policy where the premium is less than 5? Yes. But aggregate is more than 5? Yes. Provision 7 you need to apply. For all these 4 put together, provision 7 you need to apply. And if you observe, one policy is received in year 1. This is year 1. Another policy is received in year 2, 34, 35. Another policies, remaining policies are received in year 3, 35, 36. 3 years. The maturity amounts are received in 3 years. In third year, 3 maturities were received. Of course, third one straight away we tax it. A single insurance policy premium is more than 5 lakhs. Straight away we tax it. Now, so remaining policies, let us see. Remaining policies, no. Aggregate premium is more than 5 lakh, right? Where insurance premium payable for a single policy is not exceeding 5, but aggregate of premium for all multiple policies are exceeding 5 lakh at the option of the SSE. At the option of the SSE, he can claim exemption for all those policies whose aggregate premium does not exceed 5 lakh. Now, X, Y, A, B, all 4 put together, premium is exceeding 5. SSE can claim exemption for what and all? SSE can claim exemption for X and Y. SSE can claim exemption for Y and A. SSE can claim exemption for A and B. Can SSE claim exemption for X, Y, A put together? Again, it is crossing 5 lakhs. Can the SSE claim exemption for YAB? Again, it is crossing 5 lakhs. So, either you can claim X and Y, or you can claim Y and A, or you can claim A and B, or you can claim X and A put together 4 lakhs only, or you can claim X and B put together 5 lakhs only, or you can claim Y and A put together 4 lakhs only, or you can claim Y and B put together 5 lakhs only. So many combinations. So, now, which one I will claim exemption depends upon the maturity amount. Now look at this. I will put this on the this one. I'll put it on the paper. Be careful. Don't make yourself hurry. Don't hurry up. X policy how much? 12 lakhs. Y policy how much? Y policy is 24 lakh. 24 lakh. A policy is how much? 24. 36. B is 36. A is 24 lakh. B is 36 lakh. Now, by the way, annual premium is how much? 2223. That's it. 2223. Now, aggregate of all these policies is more than 5. So, you can claim exemption for any those policies whose premium is less than 5. But here 3 means again it's more than 5. So, any 2. So, either these 2 I can claim, or these 2 I can claim, or these 2 I can claim, or these 2 I can claim, correct? Or these 2 I can claim, or these 2 I can claim. These 2 I can claim anyway. Now let us see. Suppose if I claim exemption for X and Y, where both put together annual premium is how much? Where annual premium X and Y 4 lakh. What is the maturity amount? Maturity amount is how much? 12 plus 24. How much is the maturity amount? 12 plus 24? 36 lakh. Now, okay. Now then X and A. Getting it? Both put together 4 lakhs only. Premium paid is not exceeding 5. What is the maturity amount? XA. So XA, X 12 plus 24. Oh, here also the same. 36 lakh. Fine. Then X and B I will see. Both put together maturity is how much? X and B. Oh, 5 lakh. You see here. X and B 5 lakh. What is the X and B put together? 48 lakh maturity amount. Then fine. Now let us see. XY we saw, XA we saw. AB also we will see. A and B we will see. A and B put together how much it is? 5 lakh. Annual premium paid is 5. Both put together how much it is exemption? How much is the maturity? 60. Very good. Then Y and A we will see. Y and A how much? Both put together 4 lakhs. Y and A is put together 4 lakhs. YA combination has not come, right? YA 4 lakhs. Y plus A 4. Both put together 48 lakhs is a maturity. Y and B we will see. Y and B both put together premium paid is 5 lakh. And Y and B put together premium is 60 lakh. Okay. Is there Y and X already? XY or YX both are same only. So 6 combinations I can claim exemption. I can claim exemption for either X and Y policy, or I can claim exemption under XA policy, or I can claim exemption for XB or AB or YA or YB. Now if you see, And if you observe, no, X policy is matured in year 1, Y policy is matured in year 2, A and B policy is matured in year 3. These amounts were matured not in a single year. If at all these three are matured in a single year, I can happily compare like this and claim exemption. But they were matured in 3 different years. Here the problem comes. But what I told, ignore the year. First identify best combination. What is the best combination you identify? You know what I will do? I will claim exemption for Y and B. But actually, no, here, no, there are so many other factors also come into play when you're doing tax plan. But let us not go that in depth. I will claim exemption for Y and B. I will claim exemption for Y and B. Or why I will claim exemption? Why, you know, why WHY, I will claim exemption for policy number Y, you know, because policy number Y is received in second year. Getting it? So first year, no, I will tax X policy. I will offer insurance company, sir, I will tax X policy, because no, I asked insurance company, next year how much I'm going to get? Sir, you're going to get Y, 24 lakhs. That next year you're going to get A and B. So I do a pre-planning. Getting it? I'll call insurance company and ask, I know what's the maturity amount I'm going to get, all that. So accordingly, I will tax X. Getting it? And I will also tax A. I will claim exemption for Y. I will claim exemption for B. You can also claim exemption for A and B also, right? A and B also 60 lakhs, right? You can claim exemption for A and B also, right? No, I will not do that. Why? You know, second year I will claim exemption for Y policy. My tax level will be reduced. Third year, if you want A policy, I will tax it. Time value of money, interest at least I can save, na? Exactly. So Y and B, I will claim exemption. So I will claim exemption for policy number Y. I will claim exemption for policy number B. Getting it? You need to observe. That's why when you're seeing, when you see, now I applied time value of money technique also. Time value of money, financial management equation also I used. So when you're doing tax planning, you must think in all the angles. So which means, what are the policies are exempted? Y is exempted and B is also exempt. So I will offer A, I will tax it A, and I will even tax X. X I will tax it because it is only 12 lakhs, man. Remaining at 2024, that and all big amounts. So X I will offer. If you want, first year I'll pay tax on the premium. I'll pay maturity amount, I'll pay tax on that. No problem at all, because the income itself is so low. So this is the answer. So finally the answer is what? Y and B are exempted. Look at the answer ultimately. So look at the answer ultimately. They have given so much discussion. The consideration is received under C is not exempt. That anyhow we know. C is not exempt. C we tax rate. We claimed exemption for Y and B, right? They have given entire this analysis. First year, second year, all that analysis they have given. The consideration received under A, B, C would not be exempt. Since aggregate of the premium, I told you A, B, C anyhow taxable. A, B also they are not claiming exemption. Better than this, what is better? If at all surrender value of X was not claimed to be exempt. Not exempt means what? If at all you tax it. In our example, what we did? In our example, we taxed A. Yes or no? We taxed X. We taxed X. If at all X policy is not claimed exemption, then the consideration received for Y would be exempt, and consideration received either under A or B, anyone can be exempt. In other words, our answer Y or Y plus A or B. A or B, A 24 lakhs, B 36 lakhs. 36 lakhs claim exemption. Getting it? If the consideration received under A is claimed to be exempt as aggregate, you know, premium payable for L and A, Y and A put together not exceeding 5. So the consideration B would not be exempt. But that is not a correct belief. The consideration received under B is exempt. Aggregate premium payable for Y and B did not exceed 5. The consideration received for A would not be exempt. Exemption for consideration under B is preferred as it is most beneficial. So Y plus B is most beneficial treatment. That's what in our example also we solved. We solved the same. Getting it? A and B also you can claim exemption alternatively. But the point is, if at all I want to claim exemption for A and B, why I have to tax it? If I have to tax Y in the year number 2, I have to pay tax in much more in advance. Why to pay tax much more in advance? I will defer it up to year 3. Getting it? So I will claim exemption for I will offer A for taxation. Time value of money. If at all you understood, very good. So if at all on surrender of X, on maturity of Y, if at all you didn't claim exemption, then A and B would be exempt, which is not a beneficial treatment. Y and B is the most beneficial treatment. So you need not write entire this analysis in exam. This is just a CBDT clarification for purpose. In exam, no, you straight away write this answer. Y and B is exempt because aggregate premium is not exceeding 5 lakh. So now whether you claim exemption in year 1 or year 2 or year 3, you need to have a proper planning in the year 1 itself. Year 1 itself, you should get the entire data and do a tax planning clearly. So complicated. Now, by the way, clarification on GST component. Whether the premium payable or aggregate premium payable, no, for the policies issued on or after 1st April 2023, whatever the policies we are discussing on or after 1st April 2023, premium amount we are saying, right, is it including GST component or excluding a CBDT clarified? Exclusive of GST you check. Exclusive of GST you check for the policies which are issued on or after 1st April 2023. And here also term insurance policy. Term insurance policy means if it is further clarified that the limit of 5 lakhs would not be applicable in case of term insurance policy where the sum is only paid to the nominee in case of death of a person. No amount is paid. Just for the sake of example, at the beginning of the class, I use the term insurance. But for term insurance policy, 5 lakhs limit and all will not apply. Why? Because in term insurance, maturity amount is generally received by nominees only. In term insurance, maturity amount will not be received by the policy holder. Any amount received on death of the policy holder, if any amount is received under death, it is always exempt. Getting it? Hence, any sum received under term insurance policy will be exempted under 1010 irrespective of the premium payable. Further, premium paid for such policies would not be counted for 5 lakhs limit. Why? Term insurance, by definition, term insurance means if the person who is insured is died, only then amount will come. Are you getting the point? In case of death, not just term, any policy, if at all maturity amount is received on death, it is exempted. 5 lakh limit and all we don't see. Key man insurance policy is always taxable. ULIP is taxable as per the ULIP related provisions. Provision number 5, provision number 4 and provision number 5 both are dealing with ULIP where 2.5 lakh limit and all is there. That and all is not there in CA Inter. In CA Inter, ULIP related taxation is not discussed. Next. Now, how to compute taxable portion? By the way, I hope you understood right now. I hope you understood right now entire 1010D thoroughly. So now, if you go back to this diagram and read once again, or even if you read in our amendments material once again. So what are exempted policy? Any sum received under insurance policy, including bonus, will not be included in total income. When if the policy is issued on or after 2012, but before 2013, where the premium payable for any year does not exceed 10%. Exemption is not available if the premium is exceeding 10. Exemption is available if the premium is not exceeding 10. If policy is issued on or after 1st April 2013, where it is issued for a ATU or a person having diseases, then the amount is exempted. However, exemption is not available if the premium payable is exceeding 15%. Indirectly, if the premium payable does not exceed 15, exempted. Where insurance is on other persons, 10% is the criteria. Suppose if the policy is taken on or after 1st April 2023, you must check whether it is 10% or 15% logic, you should check. In addition to that, if at all, for a single policy, if the premium payable is exceeding 5 lakhs, exemption is not available. Suppose you are having multiple policies where each policy is less than 5, but aggregate premium payable on such policies exceed 5 lakhs in any previous year during the term of the policy, exemption is available only for those policies at the option of SSEs whose aggregate premium does not exceed 5 lakh. You see, straight away I applied this provision on the problems. I did not read the entire supplementary material, situation 1, situation 2, cases, multiple policies, single policy, the theory and all they gave. Don't even read that. If you read that, you will not understand. Straight away read the provision, understand the provision, apply the provision. And that's what I showed you in all the 10 problems. Next. Let's look at one more related amendment. Taxability. So when the amount received under insurance policy is taxable under 56 subsection to clause 13, if it is not exempt under 1010D, it is taxable. How much is taxable? For that also I have given a notes. How much is taxable? Maturity amount from life insurance policy which is not covered under 1010D, only income portion is taxable under other sources. What is income portion? Taxable amount is how much? Maturity amount how much? Just now we saw 36 to 24 lakhs, all that maturity, that is maturity, minus, see, whatever premium I'm paying, no, that also they're returning it back, right? Whatever amount I paid, that they're returning back. Can I call it as income? No. But premium I paid, no, I claimed deduction under income tax. When I paid this premium, no, I claimed a deduction. Now I am getting it back. It is income. Suppose I paid premium so much, ATC and all, I have so many other principal, housing loan, principal repayment, so many items I claimed in ATC. Getting it, 1.5 lakh over limit. Insurance premium related, I did not claim single rupee under ATC. Whatever premium I paid, that also they are adding and then sending it me back. How can I tax whatever amount I paid? That also I am getting in the maturity amount. That I will exclude. Aggregate premium paid and not claimed as deduction under provisions of the law. Whatever premium I paid in the past 5 years, 10 years, but I did not claim deduction, that I will eliminate from the maturity amount. Only balance I will tax. That's what the supplementary material, they gave a clarification, another clarification. For that they used A, B, A minus B, C minus D, all that. This and all is not required. Getting it? First previous year, first time when you receive maturity is called first previous year, subsequent previous year, that and all not required. Very simple. Have you received any amount? Yes. Minus what is the aggregate premium paid during the term till the maturity date, which has not been claimed as deduction. Check out. For each policy, how much maturity you got, how much premium you paid, whether that premium you have claimed deduction. If so, don't reduce that from the maturity. If at all you did not claim deduction of the premium, reduce it from the maturity, balance only tax it. For each policy base you calculate. No need to apply this clarification. So with this other sources. Remember, received under ULIP and Keyman insurance policy, they are always received under ULIP and Keyman insurance policy. For them, separate taxation is there. For Keyman insurance policy, it is always taxable. For ULIP, separate taxation is there, which is not discussed at CA interlevel. Then we have one more amendment, which is 115 BBJ. 115 BBJ. This 115 BBJ is regarding winnings from online games. So we have already 115 BB where lottery, gambling, betting, any other game of sort, horse races, winnings, all these are taxable in 115 BB straight away. 115 BBJ. In order to understand 115 BBJ, 194 BA is also to be understood. But before that, sorry, one more provision I want to introduce related to insurance policy. By the way, insurance company, when they're releasing maturity amount, they should also deduct TDS. On which maturity amount? If at all the policy is exempted under 1010D, no TDS. So insurance company, when they're releasing maturity amount, they need to inquire, they need to get the data from the SSC, whether the amount which is receiving is taxable or exempted. After deciding that, they need to deduct TDS accordingly. Suppose if the amount which they're receiving is taxable for SSC, insurance company has to deduct TDS at 5%. 5% on the income portion only, not on the maturity amount. In institute material or somewhere I've seen problems, they have deducted TDS on the sum assured. Only income portion. Income portion means what? Whatever is taxable for the SSC under other sources, that is only called as income portion. On that only 5% TDS. However, if the aggregate payment made, if the payment itself is not exceeding, only if the payment is exceeding 1 lakh, TDS will apply. If at all payment is not exceeding 1 lakh, less than 1 lakh, no TDS under 194 TA. Clear? So we discussed the ATC point, we discussed the 1010D point, we discussed other sources taxability point, we even discussed the TDS point. Now let's look at the final amendment, that is 115 BBJ. Winnings from online games. For this, what I will do is, instead of discussing here, I will discuss it as part of TDS amendments related video. Getting it? You just continue watching this in the marathon or even the amendments class. The timestamp on TDS is there, you will get it. Getting it? That's it. With this other sources related amendment is over. Later, first let me focus on 115 JEE, alternate minimum tax. One important point, if the SSC is paying tax under 115 BAC method, if the SSC has chosen optional tax regime, getting it, 115 BAC, AMT provision will not apply. Remember this point. If 115 BAC is chosen, AMT provision itself will not apply. Now, what is this AMT provision? I have made a beautiful simple notes. Last minute, you can take a simple screenshot of it and then keep it. Don't write anything. It will be time waste. Just focus on result. Now, what is this AMT? When this AMT is applicable, I will explain entire provision through this particular revision. Getting it? Now, is the SSC, did he claim deduction under section 35 AD 10 AA chapter 6A heading C? If the answer is yes, 115 JEE AMT provision is applicable. If the SSE has claimed 35 AD under PGBP investment based deduction, 100% of the capital expenditure will be allowed as deduction for specified businesses, 14 specified businesses. 10 AA. If a person has established any manufacturing unit or providing any services from special economic zone where he has commenced operations on or before 31st March 2020, or he got approval before 31st March 2020 but started operations on or before 31st March 2021, approval was before 2020 but started before 2021 or started before 2020 directly, that fellow first 5 years, whatever exports he is making, of the articles of goods or services, whatever exports, related profit, 100% deduction. This is for first 5 years. 6th year to 10th year, 50% of the export profit is deductible. First year to 5th year, 100% of the export profit. 6th year to 10th year, 50% of the export profit you can claim deduction under 10 AA. 11th to 15th year also under 10 AA, 50% of the export profit you can claim deduction subject to investment reserve. Subject to creating an investment reserve, special economic zone reinvestment reserve. Once you create that reserve, you can claim from 11th to 15th year also deduction, provided you create reserve equal amount. Whatever exemption you are claiming, suppose 11th year your profit is some 10 crore. 50% you can claim deduction, 5 crore. If you want to claim 5 crore deduction, for 5 crore, transfer to reserve account. Then you claim deduction. That reserve, you should utilize it within 3 years from the date of creation. Getting the point? So from the date, just a minute. So from the date of creating the reserve, within 3 years, you must utilize that reserve for purchasing new plant and machinery and all. Then under 10 AA, first 5 years, 100% of the profit is exempted, no condition, reserve and all does not apply. Next 5 years, 50% of the profit is exempted. Which profit? Not total profit. Export profit only exempted. Export profit only you can claim deduction. First 5 years, 100% of export profit. Next 5 years, 50% of the export profit. Third set of 5 years, 11th to 15th year, 50% of the export profit subject to investment in the reserve. Subject to creation of reinvestment reserve. Whereas for first 10 years, 5 years, 100%. Another 5 years, 50% of the export profit. Here, deduction you can claim without any condition of creation of reserve. Then, Chapter 6A, Heading C, like 80 IA series, 80 JJAA, 80 QQB, 80 RRB, these deductions. If the SSE is claiming deduction under 80, Chapter 6A, Heading C, income-based deductions. So, if the SSE is claiming 35 AD, 10 AA, Chapter 6A, Heading C, for him, 115 JEE, AMT provision is applicable. Remember, SSE means anybody other than company. Other than company. For companies and all, this provision is applicable. Just a minute. Yeah, so this provision is applicable for any person other than for company. For company, 115 JB provision is there, separate provision. For company related taxation at CA Inter, we don't have. At CA Inter, we only have individual partnership firm taxation. Getting it? So, if any person who claimed deduction under these provisions, whatever I have told here, getting it? For him, AMT provision is applicable. Now, okay, if AMT is applicable, what should I do? Very simple. You have to compute adjusted total income. What? You have to compute adjusted total income. Very simple. In the question, no. Did they give any information? SSE claim deduction under these sections? Yes, sir, they gave. Very simple. 115 JE is applicable. Okay, what should I do? Compute adjusted total income. How to compute? In exam, they may give you total income. They may give you total income. To that total income, add back 10 AA deduction if there. 10 AA is not there. 35 AA deduction is there. Then add back. Both of these are not there. 80 IA, 80 JJ, 80 QQB, RRB. Chapter 6A, Heading C based deduction is claimed by the SSE. For computing this total income, he claimed already. Add back that. Either this or this or this, any of these only will come. Any one only will come generally. If SSE claimed 10 AA, 35 AD will not be there. If SSE claimed 35 AD, 80 JJ, QQB, 80 IA, these are all will not be there. These are all mutually exclusive. If the SSE claimed any of these, while calculating total income, add back to that. Now, if the SSE who has claimed 35 AD, you added back, right? Now, calculate depreciation and reduce. Calculate depreciation and reduce, because when the SSE is claiming 35 AD deduction for computing this total income, he has not claimed depreciation. Directly 35 AD deduction he claimed for capital expenditure. So add back that capital expenditure, which means you did not claim any depreciation, and deduction also added back. So now you claim depreciation. If at all 35 AD you are adding back, this point will come. Suppose you are adding back 10 AA deduction, this will not come. You are adding back 80 IA, 80 all this will not come. Able to understand? So very simple. Add back these items less depreciation under section 32. You will have adjusted total income. Very simple. Remember this format. Don't do so much of interpretation and all. Very simple. Whatever total income is there, add back this. You will have adjusted total income. Suppose if this adjusted total income is more than 20 lakh rupee, more than how much? 20 lakh rupee. Then flat 18.5% tax rate you apply. On this adjusted total income, 18.5% flat tax rate apply. So you will compute some tax. On that apply surcharge. At what rate? If this total income is more than 50 lakhs, adjusted total income is more than 50 but not exceeding 1 crore, 10% surcharge. If the adjusted total income is more than 1 crore but not exceeding 2 crore, 15%. If the adjusted total income is more than 2 but not 5, 25%. Otherwise 37%. So depending on that logic only, very simple. So 18.5 plus surcharge, which may be 10, which may be 15, which may be 25, which may be 37, whatever adds us, you will have AMT. This is called alternate minimum tax, nothing but the minimum amount of tax which you must pay to the income tax department at any cost. Sir, whatever the deduction I'm claiming, you are adding it back. No, what is the purpose of then these deductions? You are again adding back and giving me, department is collecting tax. What is the purpose of then 35, 80, 10A, all this? No, useless, huh? No. What department is saying is, suppose, see, generally, you compute regular by applying 35 AD, 10 AA, whatever is applicable, you compute total income. Getting the point? So on that you compute tax, and that's called regular tax payable. What is it called as? Tax computed under regular method. That is called normal. So normal, whatever provisions that were given under income tax law. So you calculate a turnover from that, whatever deductions that you are eligible, you reduce the deductions, you calculate a total income on that, whatever tax you computed, that is called regular tax payable. This regular tax payable also should be basic tax plus surcharge plus cess, everything. So regular tax. Now suppose now by applying AMT, whatever I have told, by applying 115 JEE, you computed some other tax also, right? That's called alternate minimum tax. If alternate minimum tax is more than regular tax payable, then you must pay income tax department AMT by challan. So pay by challan, file IT return. This much amount you must pay because your regular tax amount is 0 or just some 10 lakhs. Some amount is there, but AMT is some 50 lakhs amount is there. So you must pay AMT. Now immediately you felt this. Sir, when I'm paying alternate minimum tax, when I'm adding back all the deductions, 10 AA, everything when I'm adding, what is the purpose of claiming all these deductions? What is there is no use because of these deductions, because at the end of the day again you are adding back and collecting tax from me in the name of alternate minimum tax. Wait, whatever AMT you pay, no, minus regularly how much you have to pay tax. If at all 115 JEE is not at all there, what is your regular tax payable? 10 lakhs. What is the AMT? 35 lakhs. The excess amount 25 lakh rupee, I will call it as AMT credit. Okay, what should I do? Forward it for 15 years. Carry forward it for 15 years. What should I do by carry forwarding? In the second year, suppose year one. Suppose in year 1, AMT you calculated 35 lakhs, but regularly if I calculate only 10 lakhs is the tax. So 35 lakh you pay to the department at the end of the day, because this is a minimum tax that you have to pay as per 115 JEE. The minimum tax amount comes 35 lakhs, so you have to pay that by cash. You cannot claim any exemption on that. That's a minimum tax you have to pay. Now, sir, I paid 35 lakhs AMT, sir. Regularly, if I calculate only 10 lakhs, sir. So, I paid excess amount of 25 lakhs. Whatever the excess amount of tax you paid because of 115 JEE provision, that excess amount is called as AMT credit, which you can carry forward for 15 years. Now, I'll carry forward for next 15 years. In this year 1 I claim, year 1 I paid 35. Sorry, year 1 I paid 35 lakhs. 25 lakhs extra I paid. This 25 lakhs I can carry forward from year 2 to year 16. Yes or no? So year 2 to year 16. Oh, what should I do? Now in year 2 to year 16, no. Year 2 to year 16, no. Let us assume year 2. In year 2, if you see, again in year 2 also you have total income. Again you claim some deductions, whatever. Your AMT tax is 20 lakhs. Whereas in that year 2, regular tax payable is 40 lakh. In the year 2, no. If I compute, if you compute your tax, if you compute your total income and tax on that regular mode, you have to pay 40 lakhs tax. And in the year 2 also you claimed some 35 AD deduction, all that. So AMT provision applied. Accordingly, AMT amount also calculated, 20 lakhs only it came. What department is saying, I want you to pay 40 lakhs. If AMT is higher than normal tax, regular tax, AMT. If regular tax is higher than AMT, then pay regular tax. So you have to pay how much? 40. So, but out of this 40, AMT is how much anyhow in that year? Minimum tax, how much you have to pay to the department? 20 minimum you have to pay at any cost. So 20 you pay to the department by challan. What about balance 20 lakh? I can set off this 20 lakhs liability by brought forwarded AMT credit. AMT credit opening how much? 25 lakh AMT credit is there. I can set off against this 20. So balance 20 only I will pay. Nothing but if any AMT credit I brought forward, that AMT credit can be used to set off regular tax which I have to pay over and above AMT in the succeeding years. So suppose in year 2, AMT amount is 20. Regular tax payable 40. Minimum whatever AMT is there in every year that you have to pay department by challan for sure. Excess amount is what? 20. This 20 lakhs you can set off AMT credit. You can set off with AMT credit. That's it. Are you getting the point? With this 115 JEE provision is completely over. Now this 115 JEE 18%, 18.5% AMT, all this and all do not apply if adjusted total income is less than or equal to 20 lakhs. If the adjusted total income is not exceeding, if the adjusted total income does not exceed 20 lakh rupee, this 115 JEE AMT provision itself do not apply. Further, AMT provision do not apply if the SSE, it will not apply if the individual or HUF is opting concessional tax under 115 BAC. Suppose if at all you are choosing 115 BAC method of payment of tax, AMT provision will not apply. Suppose you are not choosing 115 BAC and you have claimed 35 AD deduction, you have claimed 10 AA deduction, or you have claimed heading C chapter 6A income based deduction. Now where is it? For your total income we will add back all that. We again give you depreciation benefit. Balance amount, if it is more than 20 lakhs, then AMT provision we apply. On that total income, adjusted total income, we apply AMT tax rate plus surcharge plus everything. We calculate what is AMT liability. If it is more than your regular mode of tax liability, then AMT, whatever is there, we collect that amount, entire amount. Then the excess of whatever the extra AMT you paid, beyond your regular mode of tax, that extra amount I will give you AMT credit, carry forward. Succeeding years, you set off with regular tax, full regular tax. No. Regular tax in the succeeding. Suppose in year 2 you have regular tax. In the year 2 also AMT is there. Regular tax minus AMT is there in year 2. So whatever the extra regular tax you are paying over and above AMT in the succeeding year, that extra regular tax you can set off AMT credit. So indirectly, department, though they gave deduction, they are adding back deduction and collecting AMT, and by carry forwarding that AMT and permitting you to set off against regular tax excess regular tax which you pay over and above AMT in that succeeding year, they are allowing you to set off indirectly 35 AD deduction, 10 AA benefit, everything is given. Just so that in order to save cash flows, in order to temporarily save the cash flows of the department, they just did this kind of adjustment. So at the end of the day, they are giving next 15 years you can carry forward my AMT. Obviously, in the next 15 years, definitely there will be 1 year where I will not have 35 AD, I will not have 10 AA, nothing. So in that year, I have to pay regular tax only completely. AMT is also not there. I can set off this. Very simple. Now, in this, there are some noteworthy points. Now, can I set off AMT credit in this year even though my adjusted total income is less than 20? You can. No question at all. Suppose in year 2, I don't have AMT at all. I have only regular tax. Can I set off? You can set off. Able to understand. Suppose in the succeeding year, I don't have 35 AD deduction itself. Everything is not there. Still, you can set off. Once AMT is carry forwarded, you can set off against regular tax payable, provided in that year if AMT is also there, that much minimum amount you pay to the department by cash. Extra over and above AMT, whatever regular tax that you have to pay extra, against that only you can set off AMT credit. That's it. So with this, 115 JEE is completed. Now in this, there is one important question in total income chapter. So I will open and show you. You please solve it. You can download this book from my website. Rest of us CMA, there is a website inside there. You can download this book. So in total income, there is a problem. Even in the last attempt, I think May 23, they have given similar kind of question. 220 page. Just a minute. 249 you go. 245. Just a minute. Yeah, this question number 11 is there, Every one of you try to solve this particular question. There is a high possibility that a similar question will come in exam. The high possibility. So this itself, if at all asked, no, they'll ask for 14 marks or at least 12 marks they'll ask. Getting it? So very careful. Now, in this question, no, they have 115 JEE, 115 BAC, everything is tested in this question. Anyhow, I will talk 115 BAC now. Let's begin our amendments class with the first topic, that is default tax regime. Spelling mistake, regime. Okay, default tax regime. So 115 BAC. Now, so directly I'll go to this. See, earlier, before default tax regime, the same section is called as optional tax regime. Earlier it is called as optional tax regime. And now how it is renamed as? It's renamed as default tax regime. So what is a default tax regime? Here you are having concessional rates of tax. Here you are having what? Concessional rates of tax, which is applicable for individuals and HUFs. Even for companies, even for cooperative societies, for all of them also default, concessional rates of tax were given under different sections, 115 BAD, 115 BAB, like the different sections were there. But at CA Inter, we don't have those sections in our syllabus. In CA Inter, we are only having concessional rates of income tax only for individual and HUF. The objective of default tax regime is very simple. The objective is to provide concessional tax rates. So where income tax department will be charging you tax at a very concessional rate. Generally, what are the rates of tax that are applicable for an individual or HUF? What are the rates? Slab system up to 2.5 lakh, 0. 2.5 lakh to 5 lakh, 5%. 5 lakh to 10 lakh, 20%. Beyond 10 lakh, it is 30%. In case of senior citizen who is an individual resident in India, aged 60 or more, for him, initial slab limit is 3 lakhs. For a super senior citizen who is aged 80 years or more and a resident individual, for him, the initial slab is 5 lakhs. So 5 to 10, 20%, beyond 10, it is 30%. And we know, that is called as normal tax system or normal tax regime. Now that normal system is referred as optional tax regime. Now the normal system is referred as what? Optional tax regime. Now, by the way, what is a default tax regime? You see the word, initially they used the word default, which means by default, income tax department assumes you are going to compute income tax liability using these tax rates. By default, when you are filing IT return, by default, you are going to compute using these tax rates. By default, you are going to use concessional income tax rate. It's a concession. They are giving tax concession by reducing the rates of income tax. By reducing the rates of income tax, by keeping multiple slabs. Now, now they are charging at a reduced rate, right? Not everything will be given at free of cost, obviously. So concession is not given at just like that. They have given certain conditions. The income tax department has kept certain conditions. The 115 BSE, as per section 115 BSE, you are having an option. By default, you can pay tax at this rate. If you don't want this option, that's a different story. But you can pay tax by using this option, where at the concessional rate, nothing but up to 3 lakhs income, you can pay tax nil. 3 lakhs, what is this 3 lakhs? Before, no, in the Finance Act 2022, no, this is a Finance Act 2023 amendment. Before Finance Act 2023, old scheme, no, in the old scheme, no, this limit is going to be 2,50,000. At the time, for every 2.5 lakh, we have tax rate. Now, for every 3 lakh, the tax rate will increase. The tax slab rate will increase. Up to 3 lakhs, the tax is 0. 3 lakhs to 6 lakhs, the tax is 5%. 6 lakhs to 9 lakhs, the tax is 10%. 9 to 12, 15%. 12 to 15, 20%. Beyond 15, it is 30%. Now, let us do one small calculation. Suppose if the SSE total income is 15 lakhs exactly, let us assume. Now, under default tax regime, how much tax he will have to pay? Under normal provisions of the income tax, normal provisions, that is what is called as optional tax regime right now. As per Finance Act 2023, default tax regime means 115 BAC rates. Optional tax regime means normal rates of tax given in the Finance Act. Getting it? So let us assume, let us calculate tax up to 15 lakh rupee, how the tax amount varies. Now under default tax regime, up to 3 lakhs, how much? 0. 3 to 6 lakhs, how much? 5%. 6 to 9 lakh, how much? 10%. 9 to 12 lakhs, how much? 15%. Then 12 to 15 lakh, how much? 20%. Correct? Just check it out. So 5, 10, 15, 20. Correctly? There is no 25%. Why they were, remember? Straight away, once 15 lakhs crossed, straight away flat 30%. Now let's calculate. So 0 at 0% means 0. So 3 to 6 lakhs means 3 lakhs into 5% is 5% is 15,000. 6 to 9 means 3 lakhs. 3 lakhs into 10% is 30,000. 9 to 12 means 3 lakhs. 3 lakhs into 15% means 45,000. 12 to 15 lakh, which means 3 lakh. On the 20% means 60,000. So how much is this? 60 plus 60, 120 plus 30, 1,50,000 is the basic tax. What is the basic tax amount under default tax regime? If an SSE is having 15 lakhs income, what is the base? I'm talking only about basic tax, remember. If at all SSE total income cross 50 lakhs, 10% surcharge applicable. If at all you're going with the default tax regime, no. You have surcharge, everything else is common. But the surcharge rates under 115 BAC, if at all you are declaring income under 115 BAC, the surcharge rates, the surcharge slabs are slightly different from normal income tax rates. If you like the next, in the marathon, you will find basic concepts timestamp in the marathon, income tax marathon. Inside that, I specifically spoke about normal tax regime in depth. Getting it? So this is amendments class. Inside that marathon, in the marathon also amendments, the same, whatever I'm discussing right now is there even in the amendment marathon video also. Getting it? Fine. So under normal tax regime, surcharge is in 5 rates. 5 surcharge rates we have. So 50 lakhs to 1 crore, 1 surcharge rate, 1 crore to 2 crores, 1 surcharge rate, beyond 2 to 5, 25%, beyond 5, 35%, and one category is there where surcharge rate is 15%. So 37% surcharge is the maximum surcharge under normal tax rate. But under default tax regime, whatever your income might be, maximum surcharge rate is 25%. Here it is a very big benefit. But anyhow, if an SSE is having income less than or equal to 15 lakhs, especially if an SSE whose income is less than or equal to 15 lakhs only, default tax regime or normal tax regime, there is a variation. Once if the SSE income crosses 15 lakhs, the tax rate is going to be 30%. Even in the normal tax regime, the moment it crosses 10 lakh, it is going to be 30%. The moment it crosses 15 lakh, it is even, of course, it is going to be 30%. If your income is more than 15 lakh, your basic tax rate, your tax rate is going to be 30 anyhow. There is no much variation. Now, let us look at, let's look at normal person, normal SSE, up to, if at all his income is 15 lakhs, how tax amount will be? First 2.5 lakh, 0, 2.5 to 5, let's assume is a normal citizen, 2.5 to 5, 5%, 5 to 10, which is 5 lakhs, 20%, beyond 10 means which is 5 lakhs at 30%. Let us look at this, 1,50,000, which is 1 lakh, which is 12,500. So all put together, how much it is? So 5 lakhs into 30% is all put together. So 2,62,500. 2,62,500. Let me once again check it. So if at all you are going with the normal tax, default tax regime, initial 3 lakhs tax is 0. Next 3 lakhs tax is 5%, 3 to 6. The next 3 lakhs, 6 to 9 lakh tax at 10%, which is 30,000. Next 3 lakhs tax is at 15%. So 3 into 15, 45. That next 3 lakhs, 60. So 3 lakhs, right? 3 lakhs multiplied by 20%, which is 60. Now, as a whole total, suppose if you are having income 15 lakhs under default tax regime, your tax liability is coming 1,50,000. Same 15 lakhs income if you have under normal tax regime, your tax is going to be, here 1,50,000, here it is 2.6. So approximately the difference is 1,12,500 rupees difference. So obviously, since tax amount more than 1 lakh, approximately if I have to apply a percentage, as a percentage, 1,12,500 divided by 1,50,000, 75% extra tax you are paying percentage wise. Under default tax regime, between default tax regime to normal income tax rates, how much tax you are paying? 75% extra you are paying on the same income. But the point is, here income means total income. Here also income means total income, but this total income is after Chapter 6A deductions, after various exemptions, after various deductions, whereas this total income is excluding Chapter 6A deductions, excluding various exemptions and all. You can't claim additional depreciation under default tax regime. If you want to declare income at concessional rates like this, concessional tax rates like this, there are some conditions for you. Like, what are the conditions that you are having? What are the conditions that you are having? You see, if at all you are a salaried employee, you cannot claim entertainment allowance and profession tax as deduction. Of course, entertainment allowance maximum deduction is 5,000 rupees. That too, it is only for government employees. Not a big deal. Profession tax also here fulla maximum it will be 2,500 rupees or 3,000 rupees profession tax. So these two deductions you will not get if you want to pay tax on total income at default tax concessional rates. So you will not get deduction under these two. That's not a big deal. You will not get deduction for leave travel concession. You can't claim exemption under 10 subsection 5, 10 clause 5 for leave travel concession. You cannot claim exemption for house rent elements. You cannot claim exemption for house rent elements. Not only that, you cannot claim exemption for various allowances that you are going to get. Various allowances under income from salary, you are getting various allowances. 10 subsection 14, you are having so many allowances. Some are fully taxable, some are partly taxable. Forget about partly or fully, all that. You are not going to get exemption under 1014 at all. You will not get exemption for these allowances. Those allowances are fully taxable. How HRA is fully taxable. Leave travel benefit is fully taxable. You will not get deductions under entertainment tax, profession tax. But remember, once upon a time, in Finance Act 2022 up to assessment year 23-24, nothing but previous year 22-23, standard deduction also they won't get. But now, even if you are declaring income, even if you are computing income as per 115 BAC, even if you are computing income as per 115 BAC, you will still get, even if you compute standard deduction, you will still get. That's why you see conditions to be satisfied. The following are the conditions to be satisfied for availing concessional rates of tax. In order to get these concessional rates of tax, getting it, you have to satisfy the following conditions. What are the conditions? The following deductions, following exemptions would not be allowed. You will not get the following deductions, following exemptions. What you will not get? First one, entertainment allowance you will not get. Profession tax you will not get. Leave travel concession you will not get. HRA you will not get. Suppose if you are a salaried employee, these many deductions you will not get. 10 subsection 14 various exemptions you will not get. But there are exceptions to this particular 1014. Only these items you can still claim. Transport allowance exemption, transport allowance up to 3,200 rupees deduction you can claim. No. Whether you are declaring under normal tax regime or default tax regime, 3,200 rupees per month up to transport allowance can be claimed as deduction. That too only a blind and deaf and dumb person. Getting it? Or orthopedically handicapped employees, they can claim. Traveling allowance, daily allowance conveyance, these are generally given for official purposes. These allowances are generally given for official purposes. These allowances are exempted up to spend. Whatever amount you spent actually, suppose company gave you traveling allowance. Traveling allowance means what? Traveling allowance means allowance given for you to travel to various cities for official purpose. Official purpose allowance, how come it's a benefit to me? So it is exempted to whatever amount you spent. Suppose company gave you 10,000, you spent 8,000, 2,000 only taxable. Getting it? So 8,000, can I claim deduction? You can claim. So whatever amount you spent, that much amount you can claim deduction. Daily allowance, conveyance allowance, uniform allowance, all those allowances you will get deduction, which are of official nature. You can claim deduction up to the amount it is spent. Transport allowance means what? It's an allowance given to blind, deaf, dumb, orthopedically handicapped, or even for other employees also, to come from office to home, home to office, to commute from office to home. So getting it, between home and office commutation purpose, if allowance is given, that allowance is called as transport allowance. That is fully taxable. That's an income. Will you get an exemption? Yes, exemption is there up to 3,200 per month. Can this exemption be claimed by SSE who is declaring under default tax regime? Absolutely, he can claim. That's why I called this exception. Remaining all other allowances under 10 subsection 14 which are exempted, you can't claim. Suppose if a company is giving you hill area allowance, fully taxable, no exemption at all, no deduction at all. Suppose a company is giving you children education allowance, fully taxable. Generally for children education allowance, how much exemption is there? 100 rupees per month per child, maximum of 2 children. Hostel allowance, 300 rupees per month per child, maximum of 2 children. These allowances and all, you can't claim deduction. You cannot claim deduction for these allowances. Getting it? So under 10 subsection 14, no deduction can be claimed under salaries except transport allowance deduction, travel allowance deduction, and any allowance paid to you outside India for services rendered to government. Getting it? Services rendered outside India by a government to a citizen of India. Actually, by a citizen of India to the government for services rendered. Any allowance paid. Remember, you see that. Any allowance or perquisite allowed or paid outside India by the government. If a government is giving you any allowance to a citizen of India, why a government is giving? For services rendered outside India. So you are providing some. Suppose you are working in foreign service department of the government. So you are working outside India for government purpose. Whatever allowance you are getting, fully exempted. This allowance you can claim deduction. Travel allowance you can claim deduction. Transport allowance you can claim deduction. Remaining all other allowances you cannot claim deduction. You cannot claim HRA deduction. You cannot claim leave travel concession. You cannot claim entertainment allowance, profession tax allowance, nothing. Sir, what about 10 subsection 10 gratuity exemption? Where payment of gratuity act is applicable or not applicable? Yes, you can claim. What about leave encashment 10 subsection 10 AA? Some deduction is there up to 25 lakhs maximum limit as per the latest amendment. You can claim. What about 10 subsection 10A pension, commuted pension and all? You can claim. What about 10 subsection 10C VRS exemption? You can claim. What about 10 subsection 13B retrenchment compensation exemption? You can claim. This and all is not covered here. Now, what is covered? Suppose if you are having income from salaries, if you want to pay income tax as per these concessional rates, you cannot claim section 16 entertainment and profession tax. You cannot claim leave travel concession. You cannot claim HRA. You cannot claim 1014 except these items. That's it. Are you getting the point? Now I will show you in salaries chapter. In salaries chapter, no, they have given one table. They have given one table. I'll show you this. Wait. Suppose we have computed income. We have computed income under default tax regime for salaries employee. Suppose there is a salaried employee. He has given his salary data and all. We computed as per default tax regime. What we computed as per default tax regime and all. We computed under default tax regime. We did not take HRA exemption. We did not take whatever HR received, we fully taxed it. Whatever leave travel concession benefit is that, we fully taxed it. Whatever special allowances and all he got, we fully taxed it. We taxed it fully. Like that, as per default tax regime 115 BSE, we computed income from salaries. We computed. Now, sir, suppose SSE changed his mind. SSE changed his mind, sir. Now he want to calculate tax as per normal regime, optional tax regime, normal regime. Should I have to recompute the entire problem? No need. You see, you just from the salaries income computed as per 115 BS, this is in the ICA material, salaries chapter. You just reduce HRA exemption and you reduce children education allowance, children hostel allowance, food related benefits, leave travel concession, and even HRA already shown, HRA, entertainment allowance, profession tax. You reduce all this. Now, if you reduce all this, which are not reduced earlier, you reduce all these exemptions and deductions which are not reduced by you earlier. If you reduce this, you will get income from salary as per new regime, old regime. That is nothing but optional tax regime. So simple. Getting it? In exam, no, sometimes they'll give you a question. Like they'll give you a question in exam, like they'll give you entire salary data, they'll give you HRA, they'll give you leave travel allowance, they'll give you children education allowance, they'll give you telephone allowance, they'll give you various other allowances and all. Problem. They will ask you to compute income under the head salaries, under default tax regime and optional tax regime, both. They'll ask you both. First, how will you compute income from salary? First, compute as per default tax regime. General, I don't think they'll ask to this extent. To best of my knowledge, they'll not ask. because default tax regime is a very big failure. Default tax regime is useful for whom, you know, those who are having more than 2 crore income, more than 2 crore income. And default tax regime is useful for those who are having less than 20 lakh income, plus they have chapter 6A deductions, they have various exemptions under various other provisions of the income tax law. Only for them it is useful. Getting it? Those who are having less than 20 lakhs income and having this, suppose no, you are having income somewhere between 10 to 20 lakhs. You don't have any LIC investment, you don't have any fixed deposits, you don't have any investments, you don't have any chapter 6A. You don't have any deductions, exemptions and all. Basically, you don't have. Whether you go with normal regime or default, doesn't affect for you. For you, concessional tax regime is best. Getting it? Concessional tax regime is best for these SSEs. SSEs having more than 2 crore income. Getting it? SSEs who are especially, sorry, not even 2 crore, I can say more than 5 crore income, I will say. Not even 2, sorry, more than 5. If at all an SSE is having income more than 5 crore, for them default tax regime is best. Why? If at all your income is more than 5, your surcharge rate is going to be 37%. Whereas under default tax regime, what is the maximum surcharge rate? You know, 25%. Sir, you didn't explain till, don't worry, I'll come to that. Going there only. I hope until now you understood. So how to compute income under default tax regime for salaried employee, and how to compute income for under how to derive income under the head salaries for optional tax regime by using base default tax regime. Simple. So that's it. So that's with respect to salaries related thing. Then suppose if at all you're an SSE having income from house property, if at all you want to go with the default tax regime, no, you cannot claim interest on loan on self-occupied property or unoccupied property. We all know under section 24B, we are eligible for up to 2 lakhs rupees deduction. Up to how much? 2 lakh rupee maximum limit for interest deduction. That to this 2 lakh rupee. Anyhow, in the marathon video you will find. So to which SSEs 2 lakhs rupees limit is applicable, and there are some SSEs for self-occupied property, unoccupied property, 30,000 only maximum reduction. So all that you will understand in the house property marathon video. So right now this video is purely in this particular part. I'm only focusing on amendments. Fine. So interest on housing loan, you can't claim deduction. Interest on housing loan, that too for self-occupied property, unoccupied property, you cannot claim deduction under default tax regime. So if you want to pay income tax under default tax regime, you cannot claim this. Suppose I am a business SSE, sir. Salary also I have, house property I have, I'm also doing business. So if I'm having PGBP, there are so many deductions under PGBP, right? Can I claim all the deductions under default tax regime? No. You cannot claim additional depreciation. We all know additional depreciation we get on new plant and machinery installed in factory. Yes or no? Additional plant and machinery installed in factory, we are eligible to claim 20% additional depreciation. Yes or no? So that additional depreciation you will not get. If at all you want to pay tax under default tax regime. If at all you want to pay tax at concessional rate. So if you want to pay tax at concessional rates, you don't have additional depreciation facility. Not only that, you will not get deductions for contributions for scientific research, contribution to social research, contribution to a company involved in scientific research, contribution to some national laboratory, university, IIT, you will not get deduction. Which means, suppose if you are incurring any capital expenditure and any revenue and capital expenditure under 35 subsection 1 or any capital expenditure under 35 subsection 1 clause 4, in-house scientific research if you are doing, for that you will get deduction. You will not get deduction for what? You will not get deduction for donations. If you are giving a contribution to a research association for scientific research, or for social or statistical research, or national laboratory, university of IIT or any other university or education institution, if you are given donation, generally in PGBP, what you can do, you can claim deduction. If at all you want to declare under default tax regime, you can't claim these deductions. You cannot claim these deductions. Not only that, suppose if at all you are involved, suppose you are doing a 2-star and above hotel business, you are doing a hospital business of 100 beds and more, you are running a cold chain facility, you are running a warehouse for sugar, you are doing some specified business activity, 14 businesses we have. If at all you are in those 14 businesses, if at all you want to declare income under default tax regime, 35 AD investment linked deduction you will not get, which is a very big blow. So tell me, do you think these businesses will go with the default tax regime? Definitely not. These businesses will never go with the default tax regime. These businesses, they will never go with the default tax regime. Even any unit which is established in special economic zone, export oriented units especially, they have deduction for 15 years. First 5 years 100% of export profit, next 5 years 50% of export profit, that next 5 years 50% of export profit provide subject to creation of reinvestment reserve. Getting it? 15 years, any unit established in SEZ from export business, whatever profit is there, no, that is exempted by 50%, 100%, 50% subject to some conditions for 15 years. They also will not use this default tax regime. They won't use. Why? If they use default tax regime, they can't claim. They can't claim this exemption. They can't claim this 10-year benefit. Same way, if at all they are in specified businesses, they can't claim 3580 deduction. Be able to understand. So generally, so suppose no, in exam, no, here also in exam what they'll give you, I'll show you the concerned problem itself directly. Suppose no, in exam no, if at all, generally they don't ask like this. I'm very sure they will not ask questions on this. Sometimes in exam no, they'll give you a problem under PGBP. They'll give you all the deductions. You compute income from PGBP, take all the incomes minus all the deductions except additional depreciation, except contributions for Scientific Research Association, contribution to Social Association, contribution to Indian company involved in scientific research, contribution to National Laboratory, IIT, all that. 35 subsection 1, 2, 2A, 3, 35 subsection 2AA. These deductions you will not get. And 3580 benefit you will not get. Getting it? Except this, all other deductions you can claim, right? Expenditure on family planning, expenditure on interest on borrowed loan, 36 all deductions, 37 all deductions, 35 preliminary expenditure deduction, all that you can claim. No restriction at all. Yes or no? So compute 115 BSc profit as per PGBP without claiming all this. From that, no, claim additional depreciation at 20% of the cost of new machinery acquired during the year and installed during the year. Balance 10% of the actual cost of the machinery installed in the last year and now you claim it. Now that and 3580. In addition to this, section 3580, you also claim deduction along with the 35 subsection 1 clause 2, clause 2A, clause 3, 35 2AA, subsection 2AA. All these deductions you claim. You will get profits and gains as per normal provisions. You will get. You see, that's what here it is given, ma. That's what here it is given. So take profit as per 115 BSc and compute this. Suppose, you know, sometimes they'll ask you like this: compute income under normal provisions of tax and derive income under 115 BSc. In that case, no, claim PGB, calculate PGBP profit as usual. How you calculate in heads of income when you're learning? In the marathon also I explained. So how you calculate PGBP income normally, calculate as per that. For that, no, add back. What? Additional depreciation add back. Add back 3580 deduction. Add back 35 subsection 1 clause 2 donation, 2A donation, 3 donation, 2AA donation. All that you add back. You will get income as per PGBP, income from PGBP as per default tax regime 115 BSc. You know, many students, you know, especially in the new scheme book of ICI, I did not like personally. If you personally ask me, the new scheme of ICI book, where in every chapter they discussed 115 BSc then and there, which is not at all correct according to me. Most blunder what I felt, you know, in the institute book, basic concepts, introduction chapter is there now. In the first chapter itself, the entire 115 BSc is discussed. If a student is a repeater, he will understand. How do you think a fresher student understand 115 BSc in the very first chapter? Impossible. Are you getting the point? Because they don't know anything about what is the normal tax regime, what is default tax regime. They don't understand what are heads of incomes first of all. So at that level, the first chapter itself, how come you expect a student will understand? In the old scheme, no, entire 115 BSc is discussed in total income chapter, which is the best approach. It's the best approach. In the new scheme only, it is discussed, you know, in every chapter. That too, in the first chapter itself, full provision is kept. So whoever is in old scheme, no, you are learning the tax subject wonderfully. Why? You know, you don't know anything about this 115 BSc section until you come total income. First, you learn entire salaries chapter, house property, PGBP capital gains happily. Then you will realize, okay, 115 BAC if I have to come, under salaries, these items I will not claim. Under house property, this item I will not claim. Under PGBP, I cannot claim this. Under chapter 6, you can't claim this. Like this, you understand very well. If at all you are discussing 115 BAC at last. That's it. So this is related to PGBP. This is related to PGBP restrictions. Now, under income from other sources also we have restrictions. Suppose if you are having any income from other sources, no, under other sources, gift income is there, lottery income is there, online games income, recently added new provision, 115 BBJ. So that income is taxable under other sources. Maturity amount from life insurance policy, maturity from ULIP, they are also straight away taxable under income from other sources. From that, no, you can claim certain deductions. Deductions you can claim. Like for compensation, interest on compensation, enhanced compensation, flat 50% reduction, family pension, 1/3 of the pension or 15,000, whichever is lower. You can remember all the deductions and other sources. Now you can't claim two benefits. Suppose no, you are an MP or MLA, you are receiving daily allowance or some allowance. Generally, the allowance is exempt under 10 subsection 17, 10 clause 17. But if at all you want to pay tax under default tax regime, you cannot claim this exemption. Same way, if at all any income is clubbed, minor income is clubbed, that barely 1500 rupees only exemption, minor income, and we are clubbing no income of a minor when it is clubbed with the parent's income, how much benefit, how much exempt, 1500 rupees, that they are denying. This 1500 all nonsense. Entertainment allowance reduction for salaried employee, profession tax allowance for salaried employee deduction, and this what minor child related, these three are so basic amounts, but of course you don't get deduction. Remaining all other you will get. Earlier, no, in Finance Act 2022, family pension related deduction also you won't get. But now, as per Finance Act 2023 for May 2024 exam, you can still claim family pension related deduction. How much? 15,000 rupees or 1/3 of the family pension received, whichever is the lower. So 1/3 of the pension or maximum 15,000 rupees. That much you can claim deduction from the family pension. So no, family pension means what? Amount of pension received by family members of the deceased employee. Employee died, his family members are receiving. Therefore, it is taxable for them under the head other sources, fully taxable. Minus deduction for family pension is available. That deduction, whether you go with the optional tax regime, whether you go with the default tax regime, both of you will get. Next. And if an employee who is declaring if an SSC who is declaring income under concessional tax rate under 115 BAC, he cannot claim entire chapter 6A deduction. No chapter 6A deductions at all. Only 3 sections. ATCCD subsection 2. What is ATCCD subsection 2? Contribution by employer to National Pension System, Central Government Health Scheme. That you can claim deduction. Subject to 10% of salary or 20% of gross total income. There are some limits, which you will understand in the deductions related marathon. And deduction for ATJJAA for recruiting new employees. ATJA, that deduction you will get. You will also get deduction for central government contribution under section 80CCH subsection 2 Agnipath scheme. Agnipath scheme, this section 80CCH, this section is added in the new Finance Act 2023. Don't worry, you will find that in the chapter 6A related amendments class. Right now, this is default tax regime concept. In the amendments, you have another timestamp, that is chapter 6A related, amendments. So there you will understand what is 80CCH. Getting it? You will get. Remember, only subsection 2. Here also only subsection 2 deduction. What is subsection 2? All that you will understand in the chapter 6A. You clear? So once again, long story short. So once again, I'll explain this. 115 BAC, an individual or HUF, they have an option to pay tax in respect of the total income at the following rates. Of course, for 111A, 112, 112A, 115 BB, 115 BBJ, getting it? For all them, special rates of tax applicable. So the tax rate, the concessional rates of tax, I'm talking about which incomes? Normal incomes. Normal incomes means what? Those incomes which are taxable at SSC specific rates. Income specific rates means what? A short-term capital gain on 111A is always taxable at flat 15%. Long-term capital gain is always taxable at 20%. Long-term capital gain on listed shares and all taxable at 10% after 1 lakh. 115 BB, winnings is always taxable 30%. These are all income specific rates. For them and all, 115 BAC is not applicable. 115 BAC is applicable for which types of incomes? 115 BAC is applicable for those incomes which are generally taxable at normal rates. Marathon you watch. In that marathon, basic concepts is there. Inside that I clearly explained, clearly demonstrated what do you mean by normal rates of income, what do you mean by special rates of incomes, all that I clearly explained. This is an amendments class. I'm reminding you once again, don't think it's a marathon. Getting it? So up to 3 lakhs, 0, 3 to 6 lakhs, 5%, 6 to 9, just 10%, 9 to 12, 15%, 12 to 15 also just 20%, only if the income is crossed 15 lakh, 30%. Some students are by mistake after 15. There some students know what I saw is 15 to 18, 25%, 18 above 15, 30% I saw some students. No, don't mug up 5% increase. No. Up to 15 lakhs only 5% increase. The moment it cross 50, straight away 30. 25% slab rate is not there. Earlier we have 25% slab rate, I think. Now it is not there. Next. So what are the conditions to be satisfied? You cannot claim various deductions and various exemptions. So that I have given you headwise. For better understanding, I have given you headwise. Getting the point? Actually, if you look at the original provision, no, it is in zigzag order. But now I have given you the headwise. I hope you understood. Default tax regime section is predominantly over. Predominantly over. And one more thing. If at all you are going with the default tax regime, first of all, if at all yours is a self-occupied property or unoccupied property, interest deduction you cannot claim. What about let out property? You can claim. Whatever interest expenditure is there, you can claim deduction. If at all after claiming interest deduction for let out property or deemed let out property, if at all the house property head of income is going to be a loss, you can set off against other heads, right? Up to 2 lakhs. Up to 2 lakhs house property loss, you can set off against other heads, right? That set off is not permitted. That set off is not permitted. Loss under the head house property with other heads of income is not permitted. Certain losses not allowed to be set off. Certain losses not allowed, would not be allowed. So loss under the head house property with other heads of income is not allowed to be set off. Not only that. Suppose no. Last year, right now I'm in previous year 23-24, assessment year 24-25. Last year, no, I am doing actually specified business. Even this year also specified business, 35 AD. Last year, I have 35 AD specified business loss. Section 73A. Section 73A specified business loss I have. Generally, 73A specified business law, what we will do? We will carry forward it for infinite number of years. No limit at all. So last year, I paid income tax under normal regime. Getting it? I filed income tax with normal regime because I have a loss in 35 AD. This year, what I did, you know, I claimed default tax regime. I did not claim 35 AD loss. I did not claim 35 AD deduction itself. I went with the DTR. What the section says, you know, 115 BSA. Last year, I have carry forwarded the loss, right? You cannot carry forward now. You cannot carry forward additional depreciation loss. Additional depreciation loss. If such loss or depreciation is attributable to above. So if at all any loss that you are getting in a particular head of income because of these, actually PGBP, this is the only head where loss is possible. In salaries, no, loss is not possible. In salary is not possible. In house property, of course, the loss is clearly mentioned here. The loss is clearly discussed here. Getting it? So in PGBP, if at all any loss is there, that too because of additional depreciation, you have a loss, depreciation loss. Because of 35 AD, some loss is there. Because of 35 deduction, you have some loss last year. That loss you cannot carry forward. You cannot carry forward from the year in which you claimed DTR, from the year in which you declared income as per default tax regime. Suppose this year you declared income as per default tax regime. Last year, whatever carry forward loss is there, that loss how you got, you know, because of specified business. That loss you got because of additional depreciation. That loss you got because of house property, self-occupied property, unoccupied property. Not only you claim DTR, don't carry forward. Not only that, under house property, this year you have a loss again. This year you have a let out property, you have a loss under house property. You can't set off with other head of income. If an SSE who is declaring under 115 BAC, house property loss cannot be set off with other heads. And self-occupied or unoccupied property, interest expenditure itself you cannot claim. For let out property, you can claim interest expenditure. And you have loss, ultimately, you can't set off. if at all you're going with the default tax regime. And further, maximum rate of depreciation, 40%. Maximum rate of depreciation is 40%. For some pollution equipment and all, the flat 100% depreciation rate is there. But if at all you're going with the default tax regime, if at all any of the block where depreciation you can claim more than 40%, not permitted. You can claim maximum depreciation of 40%. You cannot claim 100% depreciation rate. And any other elements, any other perquisite, whether in a business or otherwise, if at all it is exempted, now it is not exempt. Now it is not exempt. And so here some additional points were given. This point is very simple, very simple. Directly I'll give this example. Directly I'll explain you the example. Suppose, what happened is, last year picture I'm telling you. Last year, for example, previous year 22-23. Right now, previous year 23-24. Getting it? Nothing but assessment year 24-25. This year I'm going with the default tax regime. Whereas last year I went with the normal tax mode. Last year, I have declared income. I have declared income from business or profession, which is actually 10 lakhs. Minus it is. It's actually loss. It's a loss from business or profession. And if you look at this 10 lakhs breakup, why I got this 10 lakhs loss, I will show you my PGBP income sheet. My PGBP income sheet, if you see, PGBP income before depreciation is 5 lakhs. Oh, very good. Before depreciation, my PGBP income is having actually profit. Minus normal depreciation, I claimed 5 lakhs. Oh, very good. Minus additional depreciation I got in last year, that is which is again 10 lakhs. From PGBP, after depreciation reduction, my net PGBP result came 10 lakhs negative. My net PGBP business came 10 lakhs negative. Now tell me, this 10 lakhs entire negative is because of what? Additional depreciation. This depreciation is because this loss under PGBP, nothing but unabsorbed depreciation is there. Total unabsorbed depreciation is how much? Actually, if out of 5 lakh business profit, normal depreciation, my business profit absorbed. 10 lakhs additional depreciation I have, right? That is not absorbed by my business profit. So unabsorbed depreciation is nothing but additional depreciation in our example, which is 10 lakhs. What I did, I carry forwarded it as per 32 subsection 2. 32 subsection 2, I carry forwarded. Unabsorbed depreciation, I carry forwarded. Okay, you carry forward. What's wrong? Now, in this year, I claim I want to declare under DTR, right? If I have to declare under DTR, unabsorbed depreciation, I can't carry forward. Yes, agreed. We can't carry forward. What the department is saying, whatever unabsorbed depreciation that you cannot carry forward. How much in our example? 10 lakhs. This is what brought forwarded here, right? 10 lakhs, but I can't set off. I can't carry forward further. Okay, it brought forward because last year I carry forward. This year I have brought forward, but I can't use it. I can't set it off because I'm declaring under DTR. What department said, whatever unabsorbed depreciation you are unable to brought forward and set off and further carry forward. Add back this to block of asset. Because this depreciation is belonging to some plant and machinery. This plant and machinery last year, previous year 22-23 opening is some 50 lakh minus normal depreciation 5 lakh minus additional depreciation 10 lakh, closing WDV 35 lakh as on 31st March 2023. Now here you reduced this additional depreciation rate. Now you can't carry forward and set off, right? So there is no point of claiming this additional depreciation rate in the last year. So there is no benefit at all because I cannot carry forward it further. So what department said is add back additional depreciation 10 lakhs. Make the block value 45 lakhs. Make the block value 45 lakhs. On this value, you calculate depreciation in the current year. In the year in which you are claiming DTR rate, in this year, you calculate depreciation on the revised block value after adding back additional depreciation, which you carry forwarded and brought forwarded, but could not set off, could not further carry forward because of default tax regime. Add back. And on this, you claim normal depreciation. And remember, normal depreciation is allowed under default tax regime also. What is not allowed? Additional depreciation is not allowed. This is what this point says. I'll show you right now. I'll read it. You see here. Let us consider Mr. X, who is carrying on business of manufacturing steel. He is doing a steel business. he has an unabsorbed depreciation as on 1/4/2003. Unabsorbed depreciation on opening date means it's last year depreciation brought forward, which includes amount attributable to additional depreciation of last year. Opening unabsorbed depreciation includes additional depreciation of last year or some earlier year in respect of a block of plant and machinery. If at all he pays tax under default tax regime for this year, previous year 23-24, the amount so attributable, whatever additional depreciation portion is there now of earlier years, which is not absorbed as on 1/4/2023, would not be eligible for set off against current year income, and no further reduction, no further carry forward and all is there, right? Shall be allowed for, shall be allowed, right? Accordingly, the WDV of the block 1/4/2023 as an opening date, block itself is then a block value. How the block value is arrived after reducing additional. But that additional we are unable to further carry forward or set off. Has to be increased by said amount not allowed to be set off. Whatever that additional depreciation we are not further carrying, right? Back to the block. Because in the block computation, you reduced it. You reduced in the block value, but you didn't set up that loss with income or other heads. That's why you carry forwarding. I hope you understood the logic behind this. If not, don't worry, watch the marathon. In the marathon, I clearly explained about in the setup and carry forward depreciation loss topic very clearly. Okay, that's it. So with this default tax regime, entire concept is over. Very simple, ma. Learn as if you are declaring income under normal tax regime only. Don't get confused with the institute material given in the new scheme. No, don't get. First learn as per normal provisions of tax. Forget about 115 BAC. Forget about 115 BAC. You can claim all the deductions. You can claim all the exemptions which are given. Compute normal income. If at all they are asking you default tax regime, what you have to do from the normal income, add back deductions which you claimed but not allowed as per 115 BAC. You will get this. Very simple. Now, what is the time limit? Fine, sir. Suppose no. Okay, what is default tax regime? We understood. What is normal tax regime? We understood. Now, tell me, when should we choose this option, sir? When we should choose this option? You can choose every year, ma. Every year. 1 year you can go with the default tax regime. Another year you can go with normal tax regime. That option is there only for an individual HGF who do not have business income. If an individual and HGF who do not have PGBP head of income, happily he can choose every year. 1 year I'll go with the DTR, 1 year I'll go with optional tax regime, whichever is beneficial for me. Wherever at the end of the day I'm getting lesser tax payment, that option I'll choose. So at the time of filing of the ITR, at the time of filing the return of income, no, you tell your auditor whether you want to go with the DTR or normal. Auditors, no, they will tell you based on the information you give, they will tell you which is beneficial for you. So you just follow that. So where individual or HUF has no business income, the option to shift out or opt out of the DTR along with return of income, you have to exercise while filing return of income for a previous year relevant to the assessment year. In effect, such individual can choose whether or not to exercise option of shifting out of DTR in each case, each previous year. He may choose to pay tax under DTR in 1 year, exercises the option to shift out of the DTR in another year. Here, no, one crux is there, I'll tell you. The terminology which they use is so complex again, but I can make it very simple for you. Just observation is important. You know, I'm going to make it very simple. Observation is very important. What is the observation? You know how the wordings are used? SSE exercised the option of shifting out of default tax regime. SSE not, just a minute. That's it. So there are two sentences. One, SSE exercises the option of shifting out of default tax regime. SSE exercises the option of shifting out of default tax regime. Before here, there is a point called not. The sentence, no, why they made so complicated, I don't understand. They can simply say SSE chooses default tax regime, SSE chooses normal tax regime. Simple. Or they may say SSE want to declare income under default tax regime, SSE want to declare income under optional tax regime. They can simply use these words. No, they unnecessarily made complicated. What? You know, in exam, no, they'll give you questions like this. SSE exercises the option of shifting out of DTR. SSE exercises which option? Shifting out of DTR. Means DTR you are not choosing. You are coming out of DTR. which means you are going for normal tax regime, also called as optional tax regime, under normal system of income tax, where you can claim all the deductions, all the exemptions, like whatever I said now in this particular restrictions, that and all will not apply. Suppose if the SSC not exercised the option of shifting out, remember, by default, that's why it's called default tax regime. By default, you are not exercising shifting out. If you want to shift out of default tax regime, you have to exercise the option carefully. You have to exercise manually. You have to exercise specifically this option of coming out. If you don't exercise the option of coming out, if the SSC is not exercising the option of coming out, you are declaring under DTR. If you want to come out of DTR, you need to exercise the option, man. If you don't exercise the option, you are in DTR. If you don't exercise the option, if you want to come out, exercise the option. So in IT return, by default, DTR is ticked. If you want to come out of it, you need to exercise the option of coming out. So in exam, they'll give you all the income from salaries, all the compute income from salaries for the SSC. If the SSC exercises the option of shifting out of default tax regime, what does it mean? He want to declare under normal rates. Many students, what I have noticed is they are confused between these wordings. SSC not exercised, just word. Exercised means the normal tax regime. Not exercised means default tax regime. Which option? Coming out of the DTR. If you do not exercise coming out of DTR, you are going with DTR. If you exercise coming out of DTR, you are going with normal provisions. Understood? This sentence you need to be very careful when you are reading exam. See, exercise word is there, not exercised word is there. Carefully interpret. Exercising the option, shifting out. Exercise the option of what? Shifting out, which means it's coming out of the DTR. Be careful. Next. So now, when if the SSC do not have PGBP income, now every year you can choose. Suppose what if the SSC having business or profession income, you have an option to shift out. You have an option to opt out of default tax regime. You have to exercise it on or before the due date for filing the IT return. Once such option is exercised, it will apply for all the subsequent years. Once you exercise, it is saying it is applicable. Getting it? Such person who exercises the above option of shifting out shall be able to withdraw that option only once and pay tax under default tax regime for a previous year other than the year in which it is exercised. Suppose if you exercise shifting out, means you are declaring under normal regime. You are declaring under what? Normal regime. Okay, happily go and declare. Even for the subsequent years also go and declare. For previous year 23-24, you declare normal regime. For remaining years also declare normal regime. 23-24, right now 23-24 assessment of 24-25, I declared under normal because I exercised the option of shifting out. So I declared under normal mode. Next year I want to declare under default. Next year what I did, I withdraw the option of exercising of opting out. Exercising of opted out, I withdraw. Means I declared under default tax regime. Then after, you are never eligible to exercise that option. Except where the person ceases to have a business income. Just a minute. That's it. You see, for business SSCs, very severe. First year, 23-24 financial year, declaring, right? Income. If you are declaring income by exercising out, by opting out of normal tax regime, by opting out of default tax regime, you have to declare under normal regime only forever. Suppose in the later year you withdraw. Like let us go with DTR. You can only go with DTR forever. Unless your business is closed. You don't have PGBP income further. Once PGBP income is not there, every year you can declare freshly. Every year you can choose. Where there is no PGBP income, 1 year you can choose DTR, another year you can choose other than DTR. And one more thing, if an SSC who is declaring income under 115 BAC, an SSC who has not exercised the option of shifting out, which means he's going with DTR, he will not have AMT responsibility. Alternate minimum tax under 115 JC, JD, they will not apply to you. Getting it? That's it. This point is not required. This point is not required. Here they just simply say SSC has to take most beneficial treatment. If at all who is not having business or profession income, he just have to take a beneficial treatment. Then we have surcharge concept under optional tax regime, rebate concept under optional tax regime. I will be discussing this in the continuation. Just watch continuation. I'll be discussing this. Okay. Let's continue the discussion of surcharge and rebate concept under default tax regime. Earlier, we don't have any separate, tax rates for surcharge, separate rates for rebate and all for default tax regime. It is same old rates which are applicable. But now, for default tax regime, the surcharge rate is maximum restricted to 25%. In fact, I told you at the introduction of the default tax regime itself. This is very useful for those individuals who are having more than 5 crore income. High salaried people or high net worth individuals, for them it is best to go with the default tax regime. Those who are having more than 5 crore income, because surcharge rate, we all know, normally under normal tax rates, if the surcharge rate is more than 5 crore, what happens? 37%. Sorry, if the total income is more than 5 crores, what happens? The surcharge rate is 37%. But here, maximum surcharge rate is 25% only. The moment your income crosses 2 crore, it is not 2 to 5, 25%, beyond 5, 37. No, not like that. Beyond 2, whatever income you have, on that whatever tax you have computed, 25% is the maximum surcharge rate. The surcharge rates are same rates like normal tax regime, optional tax regime, normal. Just that the fourth slab is there, right? One slab, fourth slab. What is the fourth slab? 2 to 5, 25. Beyond 5, 37. That point is removed. The moment it crossed 2 crores, straight away 25%. Just like in normal tax regime, if the total income including dividend, everything is more than 50 lakhs but not exceeding 1 crore, 10%. Including dividend and all, it is not exceeding 2 crore but more than 115. If at all excluding dividend, the total income is more than 2 crore, 25. But on the dividend component, capital gains component, it is 15%. Suppose if at all your total income is more than 2 crore only because of dividend and capital gains. If at all you don't have a dividend and capital gains, your income is less than 2 crore. Because of dividend and capital gain only, your income as a whole crosses 2. In such a case, the overall surcharge rate will not exceed 15%. Able to understand. Next, same marginal relief. Whenever there is a surcharge applicability, marginal relief is also there, right? We already discussed it in the, it is covered in the marathon basic concepts discussion. Relief. The relief concept is applicable even under both the tax regime. Like under default tax regime also relief concept is there. Even under normal tax regime also relief concept is there. Next, rebate. They have added a proviso. To section 87A in the Finance Act 2023. In the Finance Act 2023, under 87A, they have added one proviso. As per that proviso, if an individual is declaring his income, if an individual is declaring for an individual resident, if at all he is declaring income under default tax regime, if at all he does not exercise the option of shifting out, means he is declaring income under default tax regime, he is also eligible for 87A rebate at an increased limit. It's not a 12,500. Generally, 87A rebate is what? If the total income is not exceeding 5 lakh. If it is not exceeding 5 lakh, you have a rebate of up to 12,500 rupees from the basic tax. Getting it? Basic tax means what? Before education cess, before surcharge, before relief, whatever the basic tax is there, right? That basic tax. From that, you are eligible for how much rebate? Maximum 12,500. Now, for default tax regime, the rebate limit is, the threshold limit for rebate is 7 lakh. Getting it? If the total income of an individual does not exceed 7 lakh, the rebate shall be equal to how much? Tax payable or 25,000, whichever is less. If you look at, if you calculate 7 lakhs on 7 lakhs tax, remember in a new tax, in this default tax regime, no, you don't have limits for normal citizen, senior citizen, super senior. No, not such a kind of classification is not there. Cost to 3 lakhs is exempted. 3 to 6, 5%. 6 to 9, 10%. But here it is only 7 lakhs. So 3 to 6, 5%, right? 15,000. And 6 to 7, 1 lakh, right? 10% means 10,000. So what is the total tax? 25,000. If at all you're exactly having income 7 lakh, your total tax is 25,000, basic tax. Now, minus rebate how much? Rebate how much? Since income is exactly 7 lakhs, not more than 7 lakhs, not exceeding 7 lakhs. tax amount or 25,000, whichever is lower. Tax amount is 25. Even 25,000 is a monetary limit. Whichever is lower means 25,000. So balance tax is 0. Plus education says 4%, obviously 0. Are you getting it? Now, a kind of marginal relief concept is also introduced here. It's a similar to marginal relief concept. Suppose, no, very simple. I'll show you. See, very important this one. In the recent MTP also this point is asked. Suppose if the SSC is having 7,15,000 income, 7,15,000 income, for example, 7,15,000 is the income. Now, for him, no, what is the tax? Generally, we know if at all income is 7 lakhs, 25,000 tax, rebate also 25 is there, 0 tax. But just because the SSC has got 15,000 extra income, what is happening, department is asking to pay first 3 lakh 0, next 3 lakh 5%, next 1.15 lakh 10%. So here it is 3 lakh into 5%, 15,000. Here it is 11,500. So how much it is? 26,500 rupees tax is coming. So what is the basic tax now? 26,500 minus, is rebate applicable? Array, income is more than 7 lakh, man. How come rebate comes? So 0. So straight away 26,500 plus 4%, whatever tax amount comes, that much department is asking to pay. Unfair, right? Array, my income is just 15,000 extra. If at all I have only 7 lakhs income, not 7.15 lakh. If I have only 7 lakhs income, I have to pay 0 tax. But now you see, just because my income is 15,000 rupees extra, you are asking me to pay 27,000 approximate tax. How fair it is? It's not at all fair. If at all a situation like this comes, what SSC will argue? Sir, on 7 lakhs, my tax is 0, right? Whatever extra 15,000 income I got, now you take it if you want. Don't ask me this tax. I will give you 15,000, sacrifice my income itself. Exactly. That kind of marginal relief concept is brought even in the rebate. So what department said, okay, fine. So if at all your income is, suppose if your basic tax is 26,500 and if your income is 7,15,000, we'll see one thing. So what is your income? What is your total income minus, total income minus 7,15,000. How much tax department is asking? 26,500 department is asking. For extra income of 15,000, department is asking 26,500. What is your argument? If you want, I will pay 15,000. The whatever 15,000 taxes, I will pay that happily. Don't ask me further. This is what SSC argument, right? This is what the SSC's argument, right? So what department is saying is, so there is a format, you see here, there is a format straight away given, very simple. Total income minus 7 lakhs. In our example, how much? 15,000. What is the tax on the total income? Income tax payable means only basic tax, only basic tax. What is the basic tax that we computed? 26,500. Is B more than A? Yes. Just because I got extra 15,000 income, you are asking me to pay 26,500 tax only for 15,000 income which I got extra. If at all I don't have this 15,000, my rebate would have been 25,000, my tax would have been 0. Just because I have 15,000 extra income, you're asking me to pay 26,500. So is B greater than A? Are you asking more tax because of more income? Yes, the tax that you are asking is more than the income I got. Therefore, rebate is equal to how much? B minus A. 26,500 minus 15,000. So how much is the rebate? 11,500. Now what we should do this rebate? What is the basic tax that we computed? Basic tax we computed 26,500. Now from this rebate you reduce how much? 11,500. So what is the balance tax? 15,000. For this add education says 4% and pay. That's it. So 15,000 plus 4%. 15,600 you have to pay over. This is what department argument. This is how department is giving benefit to the SSC. This is how department is giving a benefit to the SSC. In the recent MTP, one MCQ has been asked for 1 mark exactly on the rebate concept. So just like that, suppose if your income is 7,25,000. Suppose if your income is 7,25,000. How to compute tax? Very simple. First 3 lakhs, 0 tax. Next 3 lakh, 15,000 tax. Next 1.25 lakh, 12,500 is the tax. Total basic tax is how much? 27,500. So my actual income is how much? My step 1 calculation of relief for 87A. Getting it? Step 1, 7.25 minus 7 lakh is equal to 25,000. Step 2, what is the basic tax on actual total income? 27,500. Is step 2 more than step 1? Yes. So step 3, 2,500 will be the rebate. So 2,500 is the rebate. So 25,000 is the balance tax you have to pay plus 4% which is 1,000. So 26,000 is the tax payable. This is the same question asked in the MTP. So very simple. I hope you understood. So in the rebate, marginal relief concept is introduced. Marginal relief is also similar. Generally, when surcharge is there, marginal relief is applicable. Just because if my income crossed 50 lakh, 10% surcharge you are asking, extra tax you are asking, but my income crossed only 1,000 rupees. For that you are asking me on my total tax 10%. Same logic. For better understanding, watch the marathon basic concepts. In that surcharge topic, relief topic, I beautifully explained with the live, with many examples. Getting it? So I hope you understood this step. So how to calculate relief? Getting it? How to calculate rebate? How to calculate rebate if at all income is exceeding 7 lakh? Total income minus 7 lakhs, how much? Check out. On the total income, whatever total income, what is the tax payable? Check out. If this is more than this, rebate is there. Rebate is there. So rebate is equal to B minus A. Here, rebate is computed on lines with the marginal reliefs. How marginal relief compute? On same logic, rebate is computed here. Then whatever basic tax you computed, from that reduce this rebate. Whatever is calculated as per these 3 steps. Then balance tax, for that add 4% education cess over. So with this entire default tax regime, surcharge concept, everything is discussed. Now with respect to surcharge calculation, marginal relief calculations, in the marathon basic concepts, it is clearly covered. Getting it? If at all you already watched, no problem. Otherwise you can go and watch it. That's it.